Hello students, welcome for FM Marathon, which I would be doing for CS Executive as per new syllabus. In this video, I would be covering all the 9 chapters. First, I would be discussing the concept under each chapter. Then I will also be telling how do we apply it in the questions along with some questions or examples. At the end, I will also discuss 2 question paper, that is the past exam question paper, that is December 2023 as well as June 2024 exam question paper, guys. So this marathon will be totally for around 10 hours. First 8 hours would be on concepts and chapter coverage, whereas the last 2 hours will be on question paper discussion. So whatever marathon I would be doing is as per new syllabus, where we totally have 9 chapters. Totally we have 9 chapters. Each and every chapter I would be covering. Now coming to the old syllabus students, sir, can we also refer for the same video? Yes, guys. I will just tell you whatever is the changes so that you guys can update yourself. So you guys also have totally 9 chapters, but for you the exam pattern would be multiple choice questions, which is for 60 marks. And financial management is a part of group 2 for you. Hope you guys are aware of all those things. So coming to whatever is the changes for you guys, I've just mentioned it in this column. You can observe. So time value of money and capital budgeting is a single chapter for you, whereas for the new syllabus, it is 2 different chapters, chapter 2 and 3. Yes, sir. Then 2 additional chapters which you guys have to manage yourself, which is there only in old syllabus, whereas this is not there in new syllabus, guys. Yes, sir. That is chapter 5 and 9. And coming to one additional chapter which is covered for new syllabus alone. This is not a part of your financial management paper, but you have something called as management accounting. Na? So this chapter, whatever I would be covering, is a part of management accounting for you guys. So this is with respect to old syllabus students. Hope you guys will enjoy this session. All the best, guys. Yes, students. Now we will start with chapter 1, which talks about introduction, more about the basics. First, finance. Finance function is the procurement of funds and their effective utilization in the business concern. It may also be defined as the art or science of managing the money. So finance or business finance is all about, sir, how do we get the money and how do we effectively utilize in order to maximize the returns. And when we are raising the money, we have to make sure that we are keeping the cost of the capital as low as possible. And when we are utilizing the money, we should make our decisions in such a way that whatever returns we get from our investment, we will get maximum. So that after meeting our cost of capital, we are left with something to enjoy ourselves. Financial management. Financial management deals with the procurement of funds and their effective utilization in the business and concerned with investment, financing and dividend decision. 3 important decisions which we will make it in financial management. In relation to the objectives of the company, raising of funds should involve minimum cost and bring maximum returns. So minimum cost is with respect to financing decision. Sir, what is financing decision? How do we get the money? From what all sources? There are 2 major sources, that is debt and equity. Whereas for debt, the cost of capital is fixed. We will either pay interest or if it is preference share capital, preference dividend, which is at the fixed rate. Then coming to equity and all, there is no fixed commitment as such, but still definitely the equity investor would have invested in our business with some expectations. Whatever is their expectations will become the cost of equity for the business. Then coming to investing decision. Sir, once we decide about financing decision, now we have so much money. For example, assume 20 lakh or 30 lakh. Where do I invest it? And I should make such decision considering capital budgeting techniques and all. So I will have different opportunities or alternatives available or proposals available with me. So I need to choose one best among them. Or if I have an option, I can choose 2 or more also, but within the money limit, whatever I have. Then dividend decision. Dividend decision is always with respect to equity shares. Because for preference, the percentage of dividend is already agreed at the time of issue itself. So we, no matter what, we have to pay at such a rate. Whereas equity dividend is at the discretion of the board of directors. They will decide based on the profit, how much the company has earned, and also what is their expansion plan, what is the growth they can give. Based on that, we will decide. And all these 3 decisions in detail we will be learning as a separate chapter also. In this chapter, whatever we are covering is only the basic part, guys. Raising of funds should have minimum cost and bring maximum returns. Yes, sir. And also we saw this is an art of science, art or science of managing the money. What is that? Finance or business finance. Guys, see in our school, colleges and all, we have been taught that once we qualify, we have to start working for money. That is why we ultimately study or get qualified. Yes. But somewhere our system, education system is lacking with teaching us how do we manage the money, because if I keep on earning the money and spending the money throughout my life, I have to work. But when it comes to if I know the art of managing the money, I can build the passive income and try to retire as early as possible. If not retire, at least I need not work for money. I can work for passion, or even if I am interested, I can work. If not, I can take the back seat or relax for some time. Yes, so that is where many people, even after their retirement, they might not be financially independent, or they will be dependent on their next generation, that is their children's, for their taking care of purpose. Yes, now coming to types of financial decisions. So what I try to mean here is managing the finance or financial management is very, very important, because once we start earning, we should know a part of that we have to save and invest, and that investment will take care of us later. Financial decisions. So first one is investment decisions. Sir, I assume I have a money of 20 lakh or 30 lakh. Where do I invest it? In which asset class, or in which projects, or in which investment proposal? And this decision I cannot blindly take it. I should take in such a way that whatever returns I get from the investment decision is the maximum. Then coming to working capital management, sir, to run my day-to-day show also, or to meet my operating expenses, that is regular expenses like salary payment, electricity bill, or whatever it is, we need some money. We have to set aside a part of our capital towards working capital. Working capital is nothing but the capital which is required to run the day-to-day operations of the business. Then on capital budgeting is more about investing for a longer period, like purchasing fixed assets or starting a new business, opening a new branch. It is all about capital budgeting. Then coming to financing decision. Financing decision first is capital structure. Sir, in my capital structure, assume I want to have a total capital of 50 lakh. How much should I have it as a debt? How much should I have it as a equity? And in the debt also, we may have different options. For example, debentures or loan or borrowings. What are those? Short term, how much? Long term, how much? We normally talk from long term point of view, but there can be short term borrowing as well. So that is called capital structure. Then coming to cost of capital, each capital, whatever I raise from different sources, will come to me along with some cost. Whatever I have to pay to the investors in return is called cost of capital. And we have different formulas to calculate that also: cost of debt, cost of preference shares, cost of equity and all, which we will learn in the later chapters. Then dividend decision, as I told you, it is all about the equity dividend, not any dividend, because see, in the material or in the topics, they will not use the word only equity, but dividend decision is always here from equity shareholders point of view. Whereas for preference, we cannot take any decisions because we have already agreed to pay a certain percentage. No matter what, we have to pay it. Yes. Financial management is concerned with all the three: investment, financing and dividend decisions in relation to objectives of the company. Investment decisions ordinarily means profitable utilization of funds. Investment decisions are concerned with the question whether adding a capital assets today will increase the net worth of the firm. Why that today and all, sir? Where the present value concept or the time value of money will play a role. Guys, I will make the investment decision today. Assume I am investing in a project 10 lakh rupees. Will it give return today only or tomorrow? No. It will take years together. So I have to consider, sir, if I invest 10 lakh today, that is the present value of my investment. How much return will it give in the future? How long? 5 years, 6 years, 10 years. And we need to calculate the present value of all our future earnings and compare with my present value of investment. So if I am getting more return, that is, we call it as net present value and all. If cash inflows is more than cash outflow, or present value of cash inflow is more than present value of cash outflow, I will go with that investment. If not, no. Because, sir, what I invest is today. So 10 lakh today is not equal to 10 lakh after 5 years or after 10 years. So we need to simply, sir, can we simply add up all our cash inflows and compare with cash outflow and decide which one is better and go with it? No. Because whatever earnings I will be getting is in the future. I need to apply the discounting factor or present value factor on all that and find out what is the value of that earnings today and compare with my initial investment and then take the decisions. Financial decision making is concerned with the question as to how funds requirement should be met, keeping in view their cost, and how far the financing policy influences the cost of capital. Dividend decision equity, I have mentioned clearly, it is always from equity point of view, helps the financial manager in deciding whether the firm should distribute all the profits or retain them, or distribute a portion and retain the balance. This depends on 4 factors, many very important factors like, sir, what is the cash flow position of a company? Because when they decide to declare the dividend and pay it, they should have enough cash with them. That is cash and cash equivalent balance. Okay, sir. Then what is the future growth prospects of the company? If they have good growth opportunities, then normally they will retain more profit and they will invest in their expansion. Then what is the shareholders' attitude? Are they expecting dividend or are they expecting growth? That is the capital appreciation in the share price. What is their expectations? So all this we have to consider and then take a dividend decision call with respect to equity shares. Management needs to ensure that enough fund is available at the right time to meet the needs of the business. Then value of the firm, risk and return trade-off. Higher the risk, higher will be the return always. Now, for example, sir, I don't want to take any risk. I have around 10-15 lakh with me. What do? Keep FD. And that too FD with very good banks. Okay, if you are going on keeping with your some cooperative banks or local banks or with your friends and all, then you are taking again a risk there. And they may offer little higher interest also, but still the safest is like commercial banks or nationalized banks. If I am keeping it there, my capital is protected, sir. But I will get very less returns, like 7-8% maximum. Yes, sir, I am ready to take little extra risk, sir. So can I invest somewhere else? Yes, maybe mutual funds. No, sir, I am ready to take high risk and I depend on my own potential. Then can I straight away invest into stock market? Yes. So there higher risk is there, higher return also will be there. And higher risk here is, sir, can I lose my own capital also? Definitely. Sir, can my capital be doubled 3x, 4x, 5x, 10x and all? Yes, you would have heard about some stories, but nothing is assured here. There is no assurance that you will make money or you will lose money. It again depends on which type of company you are picking and all the things. What is the fundamentals about the company, guys? So it is always higher the risk, higher would be the reward. A finance manager cannot avoid the risk altogether, nor he takes a decision by considering return aspect only. Just by considering return aspect, I cannot invest anywhere. Obviously, some assume one asset class is giving me a 20% return. Can I go and invest it blindly? No, I have to consider what is the risk associated with it. Usually, as the return from the investment increases, the risk associated with it also increases. Therefore, the finance manager is often required to trade off between the risk and return to maximize the market value of the firm. Market value of the firm is nothing but the market price of the share. A particular combination of risk and return where both are optimized may be known as risk-return trade-off, and at the level of risk-return, the market price of the share will be maximized. That is the share price of the company. Now, if I have to show the diagram also, you can just show. Sir, if I don't want to take any risk, then I will invest and get risk-free return. Assume it is 7%, guys. Assume it is 7%, like FD and all. No risk, with zero risk. We call it as a risk-free return. 7% or 6% I can earn. Yes, sir. Even like government bonds and all. No, sir, I'm ready to take risk and I'm investing in equity. Assume I will get 15% return, guys. So risk is also high. Yes, sir. Risk will go up. Even return is going up. Yes. And what is that extra risk return I am getting for taking the risk is called risk premium. How much is that, sir? In my example, 8%. Means for bearing extra risk or for taking extra risk, I am getting some additional return. That is called risk premium. Risk premium, which is nothing but actual return what I am getting minus risk-free return. Minus risk-free return, guys. Yes, coming to liquidity. Liquidity means, sir, do I have enough money to meet my short-term liabilities? That is current liabilities, which I am supposed to pay within 1 year, like creditors, bills payable, or any expenses outstanding. All this are something which I have to pay within 1 year. Do I have enough balance with me? That is cash and cash equivalents. Liquidity is defined as the ability of the business to meet its short-term obligations. It shows the quickness with which a business company can convert its asset into cash to pay what it owes in the near future. What it owes means what they are liable to pay. Liquidity is assessed through the use of various ratios, and this ratio calculations and all is not there in the first chapter. It is not more about the calculation, guys. It is more about understanding of concepts. But I have just mentioned the formulas here because you should know how do we calculate those ratios. current ratio, which tells how much is my current assets when compared to current liabilities. Current assets divided by current liabilities. And the ideal ratio or the standard ratio is my current assets should be twice of current liabilities. Then coming to quick ratio. Quick ratio means we will use quick assets divided by current liabilities. Sir, what is quick assets? Current assets minus stock minus prepaid expenses. See, prepaid expenses may not be there always. If at all, if it is there, you will reduce it. If not, ignore it. Or else stock, we should always reduce it. Yes. So quick assets divided by current liabilities, the ideal ratio is 1:1. Means they both should be at least equal. Yes. So then cash ratio, cash and cash equivalents we call it as cash and cash balances plus marketable securities. Marketable securities means it is highly liquid securities which I can sell at any point of time without any risk involved. If I want, I can sell today only or tomorrow itself. Clear? But because, sir, what about the other securities and all? They will have some lock-in period. For example, assume I have invested in debentures, preference shares, or even bonds. Sir, can I sell it whenever I want? No. Normally, they will have lock-in period, like 3 years, 5 years and all. So, can I consider them as marketable securities? No. If I can sell the securities today whenever I want at whatever price it is available in the market, then we will call it as highly liquid marketable securities. Yes. So, in simple, I can put it as cash and cash equivalents, guys. Cash and cash equivalents divided by current liabilities. Then working capital ratio, it is nothing but current assets minus current liabilities. And this is nothing but the working capital which I would have kept to run my day-to-day operations, to meet my regular expenses. Then coming to profitability. Profitability and liquidity is from always short-term point of view. Sir, can I pay my expenses with next 3 months? Or can I pay all my liabilities within 1 year? Liquidity is all about short-term period. They don't talk about long-term liabilities and all. Yes. Profitability. Profitability as a decision criterion is another important tool in financial management for taking decisions from different angles after evaluating the performance of the company in different spheres. Now, sir, we have to generate money from the business. That is when we can survive in the long run. Now, sir, I have a capital of 50 lakh, 60 lakh. I can meet my expenses for next 1 year or 5 months, 6 months. Yes, sir. But how long will you manage your expenses or take care of your business from the capital? You should start generating income or profit from your business in order to survive for a longer period. So that is all about profitability. So we have various profit ratios, that is gross profit ratio, gross profit divided by sales into 100. It is more about accounting, guys, but still part of FM. Then net profit ratio, net profit divided by sales into 100. Then operating profit ratio, operating profit divided by sales into 100. Sir, what are these terms? Of gross profit, net profit, operating profit, everything is profit. I have heard only about one profit, that's all. What about these 3 different types of profit, sir? See, this is what the current asset and current liabilities, guys. I have just given the current asset and current liabilities part, not the entire balance sheet. You can see under current asset what all will come, sir. Cash in hand, cash at bank, debtors, bills receivable. These 2 put together we call it as trade receivables also. Then inventory, and also if there is any prepaid expenses or outstanding incomes, they will also come under current assets. Then coming to current liabilities, trade creditors, bills payable, both put together we can call it as trade payables. Then provision for doubtful debts, total current liabilities, or there can be a few more current liabilities like outstanding expenses. Outstanding expenses. Yes, so coming to the profit part. Yeah, you can see how do we derive various figures. This is just a format for you to understand. Sales minus cost of goods sold, we will get gross profit. Sir, what is this cost of goods sold, sir? Opening stock plus purchases or production minus closing stock will give you cost of goods sold. Or if there is any purchase related expenses also, you will add it. I repeat, if you are a trader, cost of goods sold is nothing but opening stock plus purchases plus purchase related expenses minus closing stock. Sir, I am a manufacturer, sir, then opening stock plus production cost or cost of production minus closing stock will give you cost of goods sold. Then all indirect expenses like salary, wages, everything, electricity bill, all those things, director's fee, auditor's fee, everything will come here. All indirect expenses, if you deduct from gross profit, which we normally take care in P&L account, we will get operating profit. In short, we call it as PBIT or EBIT, earnings before interest and tax. Then from this, if I have a debt capital, we will reduce interest on debt capital. We will get profit before tax. And from profit before tax, we will reduce tax because this is the figure on which we have to pay tax. And if at all, if the tax rate is given in the question, we will consider it. Sometimes the tax rate may not be given in the question, ignore it if that is the case. Then we get profit after tax, which we also call it as net profit. Then from that, we will reduce preference dividend if we have preference share capital, whatever percentage we have agreed to pay on them. Then we will get profit available to equity shareholders. From that, if I reduce equity dividend, we will get retained earnings. And this is what is all about dividend decision. Sir, is it fixed amount? Is it fixed rate and all? No, it is always at the discretion of board of directors. They can take the decision with the approval of shareholders. Yes, sir. And one more thing you can ask me, sir, why interest is reduced before? Guys, as per income tax law, interest is allowed as an expenses to be claimed, whereas dividend is not allowed as an expenditure. It is treated as appropriation of profit. So that is why interest is always reduced first. After that, whatever is profit left, on that we have to pay tax. On that we have to pay tax. So please be careful. For interest, it is allowed as an expenditure as per income tax law provisions, whereas preference dividend and equity dividend, it is not allowed. So that is why preference dividend and equity dividend, we will declare and pay what out of the profit, whatever is left out after paying the tax. Yeah. Then coming to this, yeah, I will just make you understand the balance sheet format. Now we have schedule 3 format and all, but in FM, sir, is schedule 3 plays any major role? Is it important for us? No. For FM, not required, guys. Clear? Yes. So equity share capital, equity and liability side I am talking about. Equity share capital, reserves and surplus. This always belongs to equity shareholders, guys. Reserves and surplus. Yes, sir. Then preference share capital, long-term or non-current liabilities, then short-term or current liabilities, one and the same. This is liability side. Coming to asset side, fixed assets. So fixed assets can be in two forms, tangible, intangible. Tangible is like land and building, machinery, furniture, all those things. Intangible is like patent right, copyright, goodwill, all those things will come here. Then current assets, fictitious assets. Sir, what is this word fictitious assets? Guys, actually it is not assets. Just because this account may have debit balance, we will show it on the asset side of the balance sheet. For example, preliminary expenses or discount on issue of shares or any expenses incurred on the issue of shares or debentures. All this normally will have debit balance. Sir, we can straight away debit it to costing, we can straight away debit it to P&L account. No, sir. No. Because as the amount would be huge, we treat it as a deferred revenue expenditure and we will write it off over a period of time against P&L account. So that is why whatever is the balance, for example, assume I have incurred 10 lakh. As of now, I have debited 2 lakh to P&L account. Remaining 8 lakh, as it is an expenses, it will have debit balance. Yes, I have write off to P&L account only 2 lakh. Remaining 8 lakh, what will I do, sir? As it is having debit balance, we will show it as an asset in the balance sheet. But it always depends on whom. It always belongs to whom? The equity shareholder. It always belongs to equity shareholder, guys. Yes. Okay. Then current assets, as I already told, it is a short-term assets. It can be converted into cash within 1 year. And current liabilities is something which I have to pay within 1 year. I have to discharge it within 1 year. Long-term or non-current liabilities like debentures, long-term loan, long-term borrowings and all, we have to pay. I have to pay it for more than 1 year. Maybe I would be paying it in installment or EMI basis. Yes, sir. So I have given some equations also, guys. This will help us in future calculations and all. I have just given it to you. Equity shareholder fund or net worth. How do we calculate it, sir? Just a minute. Equity shareholders fund or the net worth of the company, we call it as. It is nothing but this figure, guys. You can see equity share capital plus the reserves and surplus minus debit balance of P&L. If at all, if there is a loss, maybe we will have a balance here, guys. Clear? Or else they might show it under reserves and surplus only as negative balance if it is a loss. Clear? Which we have to reduce. Sir, what if it is a profit? We will add it because it ultimately depends. Ultimately, it belongs to whom? Equity shareholders. Minus fictitious assets. Then equity or shareholder fund or proprietary funds may not match with the name, but still, guys, equity, no, sir. Yes, equity or shareholder fund or proprietary fund. Same thing, but now one addition, that is preference share capital. Preference share capital will get added. You can see preference share capital plus equity share capital plus reserves and surplus minus loss minus fictitious asset. Sir, what if it is profit, sir? Normally it will be included in reserves and surplus only. Sir, what if they have given separately, sir? Add it. Add it. Then capital employed. Capital employed means all this put together, including debt part. Capital employed is equal to long-term debt, additional thing, plus remaining all is as above. Preference share capital plus equity share capital plus reserves and surplus minus if any loss minus fictitious assets. And even fictitious assets, they may not give it always. If at all, if they give, please reduce it. If they are not given, ignore it. Sir, loss is also not given in the question. Very good, ignore it. What all can come, I am giving it here. Clear? You need not think, sir, you taught me like this, but in the question only equity was there. Or only preference share capital plus equity share capital was there. Nothing else was there. Yeah, I am trying to cover what maximum can come. Because in every question, all these items may not come, guys. Yes. Yeah, coming back. Next, profitability ratios related to overall return on assets or investments. Normally, this is looked by the investors. Return on investment, return, profit or earnings, one and the same, different names I have given, divided by investment into 100. Now, for example, sir, I have made an investment of 10 lakh. For me, the company has earned a profit of 2 lakh. So, if I divide 2 lakh divided by 10 lakh, I will get how much is the return on my investment, which is 20%. Then return on assets, net profit after taxes divided by average total assets, means company have invested, assume on assets 50 lakhs. From that, how much income they are able to generate, we have to calculate. Using so much asset or by investing in so much assets, how much profit they are able to generate. So net profit after tax we take, which is nothing but net profit divided by average total assets. So what is that average total asset? Opening asset, that is on the opening day, plus closing asset, whole divided by 2. Or sometimes only closing asset might be given, straight away take that only as denominator. Return on capital employed pre-tax, EBIT divided by capital employed into 100. Guys, this is what the profit we have earned for whom? All the investors. All the investors put together before paying interest, preference dividend as well as equity dividend. So, this is on a total investment of how much? Capital employed. Correct? Because we have to take debt providers also, preference also, equity also. So, this is what the profit I have earned for all the investors put together. So, we are calculating return on capital employed. So, EBIT divided by capital employed. Capital employed. This will be pre-tax. If I want to calculate post-tax, that is also possible. So, you can see EBIT into 1 minus tax rate, whole divided by capital employed into 100. Then return on equity. Return on equity means what is the profit we are earning for equity shareholders, guys? Profit available to equity shareholders. And they have made an investment of how much? Net worth or equity shareholders fund. For example, sir, for an investment of this much, minus fictitious we should take, if at all if it is there. For an investment of this much, whatever amount they have invested, we have made a profit of how much? This figure. Clear? This is what the return we are giving to equity shareholders. Then what about EBIT? This is for all the investors put together, not only equity, debt providers, preference plus equity. Clear? And even denominator we took what? Capital employed, not equity shareholders fund. So please cross check whether the numerator and denominator is for the same parties. Same parties. Yes, there is the inverse relationship between liquidity and profitability. We discussed about liquidity, which is more related to short term, whereas profitability is over long term. And you guys would have seen many companies, sir, initially startups, they are making loss and they're loss making, but still they're able to survive their business. How? Through capital. But can they survive through capital for a very long period? May not be. They should start generating income from their operations or business. So profitability is over a longer period, guys. Liquidity ensures short-term survival and profitability ensures long-term survival. Liquidity and profitability are competing goals for the finance manager. So we have to take care of both. It's not like I will take care of only liquidity and I will ignore profitability. No, or the same way. Sir, I will take care of profitability and ignore liquidity. No, that can also not happen. For example, sir, I have made a huge profit, huge sales, but everything is in credit. I'm not able to get the money. So then you are a failure in liquidity. You are managing the money, you have failed. Why? Because whatever sales, crores together sales I have made, but everything is credit sales. So in my balance sheet also, debtors is crores together, but cash and cash balance or cash and cash equivalents is like around 2 lakh, 3 lakhs. Out of that, I am not able to pay my liabilities or pay my expenses. What do I do with it now? Failure of liquidity. Yes. Now, we also have few more things. Guys, see, if I divide this, what is the total earnings for equity shareholders? There will be number of equity shareholders, especially if it is a public company and all, we will have lakhs together or thousands together of shareholders. Now, if I want to calculate, sir, per share how much we have earned. This is for all the shareholders put together, correct? Assume it is 10 lakh. Now, I want to calculate per share how much. What do I do? Divide it by number of shares. Number of equity shares. What do we get? EPS. That is earnings per share. Here we are getting 10 rupees. Assume I am a shareholder who is holding 5 shares. How much company has earned for me? 50 rupees. How much the company has earned for me? 50 rupees. So this is nothing but total earnings which the company has earned for the equity shareholders divided by number of equity shares. We get earnings per share. Same way equity dividend, whatever they have declared and paid. If I want to calculate per share how much? Total equity dividend which is declared and paid divided by number of equity shares. We will get dividend per share. In short, we call it as DPS. Sir, if I want to calculate how much of my earnings we have declared as dividend, can we calculate dividend payout ratio? Yes. How is it? Dividend per share divided by earnings per share. We call it as dividend payout ratio. For example, 10 rupees is the earnings per share, sir. And the company has declared 2 rupees dividend for each and every share. So what is the dividend payout ratio? 20%. 20%. This you can calculate in percentage, whereas this two will be in rupees always. Earnings per share and dividend per share. Yeah, all this will help us in our future calculations as well, guys. So please be very careful with it. Then costing and risk. Financial risk or leverage. The presence of debt component in the capital structure is called financial risk or leverage. For example, sir, assume my long-term debt is 0 or debentures is 0. Can I tell my financial risk is 0? Yes. I don't have any financial risk in the company. Clear? And sir, assume the amount is like 5 lakh, 10 lakh, 15 lakh. Higher the amount of debt in the capital structure, higher would be the financial leverage. Because we have a fixed commitment towards interest. We have to pay, no matter how much profit I have earned, I have to pay whatever interest I am liable to pay, which I have agreed at a certain percentage. The use of borrowed funds or fixed cost funds in capital structure. Fixed cost because we will pay at a fixed rate. In the capital structure is a financial risk or financial gearing or leverage. Business or operating risk. Business risk is associated with the chance of loss due to variability of the return created by the enterprise, and as such it is known as operating risk. Operating risk is nothing but, sir, what if I don't take care of my operations well? I will suffer loss, or I will not earn enough operating profit. Yes, that is called operating risk. If I don't take care of my operations well, then there is a high chance that I may suffer loss or I may earn very less operating profit. That is called operating risk. Operating risk is concerned with EBIT. So higher the EBIT, that means my operating risk is less. So lower the EBIT means my operating risk is more. Whereas financial risk is concerned with what? Earnings available after interest and tax. That is, you can see operating risk is related to this. Higher the operating profit, that means the risk is lower. Same way. Sir, what about the financial risk? Sir, after paying interest and tax, whatever we have, that is profit after tax. The financial risk is related to this. After paying interest and tax, still if I am left with good amount of profit, then I have kept my financial risk as low as possible. Sir, after paying interest, tax and all, I am left with very less amount. Then my financial risk would be higher. Clear? So it's simple, guys. From operations, how much I have earned, more or less, that is related to operating risk. Sir, after paying interest and tax, whatever is left with us, especially after interest. So even tax is considered because, sir, after interest, whatever profit we have to pay tax on it. We cannot escape from it. So that is why we are more concerned about this figure when it comes to financial risk. Next, purchasing power risk. Sir, the value of the money will not remain same. What I could purchase with 100 rupees 1 year back, I am not able to purchase the same thing today with the same 100 rupees. Why? Due to inflation. So the purchasing power of money is coming down. That is also one of the risks. Purchasing power risk affects all investors. The risk is associated with changes in the price level on account of inflation. Under inflationary conditions, the purchasing power of money decreases over time, and the investor is faced with the possibility of loss on account of investment made to the extent of inflation. So you guys would have observed, whether it is whatever provisions we buy or items we buy, whatever we used to pay 10 years back or 1 year back, not even 10 years, 1 year back, whatever we used to pay, now we would be ending up paying more. Why is that? Due to inflation. Due to inflation. Interest rate risk. Interest rate risk is concerned with holders of the bonds due to changes in interest rates. If interest rate falls, the price of the bond will rise, and vice versa. Now I have already purchased a bond, guys. Okay, interest rate risk is market driven always. Assume I have already purchased a bond for 10% return. 10% return. So no matter what, I will be getting 10% interest. Now in the market interest rate comes down to 8%. Market rate comes down to 8%. Now whatever is the price of my bond, will it go up or come down? It will go up. Why? Because I am getting more than what is now prevalent in the market. So normally the price of the bond will go up, whichever I already purchased. Same way, let me take vice versa scenario. On my bond, I am already getting 10%, which is locked interest rate. But in the market now the rate has gone up to 12%. The rate has gone up to 12%. What about the price of my bond? It will go down, because I am getting less than what is actually prevalent in the market. Yeah, social and regulatory risk. This is always external. No one has a control over it, especially when it comes to business. We don't have control over it. Social and regulatory risk arise due to harsh regulatory measures like licensing, nationalization, price controls, limiting profits, etc. Now, one of the external factor for us is, sir, Donald Trump has been re-elected again. Now he takes some measures which may affect Indian market, exports and all. Yes, sir, it will affect. So, does any business has any control over it? No, until and unless the business is run by Elon Musk. Hope you got it. He is the biggest supporter of Donald Trump. Maybe the influence might work for him, but not for others. Yeah, objectives of a firm: profit maximization or shareholders' wealth maximization. Under profit maximization, our core idea, our core focus is only on maximizing the profit. So, is it long term? No, guys. Whereas wealth maximization, the main focus is to increase the share value or the share price of the company. Now, sir, will share price of the company depends only on the performance of the company, higher the profit, higher the share price? See, majority of the time, yes, but it also depends on various other factors. What is the brand reputation the company has? What is the service they are giving to their customers, after sales service, or even how do they treat their employees? What is the employees' retentionship? Is the employees leaving the company due to mismanagement or whatever reasons? It depends on various factors. And what is the brand value of the products they are selling? And what is the features they are offering to the people? And what is their expected growth in the future? All this they will consider. Based on that only, the share price movement will happen. So now wealth maximization is not only considering the profit element, but considering all the factors, that is from company's point of view, how are they taking care of their employees, customers, and also how are they building their brand for future, what is their future growth, will they grow or will they just remain stagnant? All these factors will matter. And over a long period of time, the company has to focus on wealth maximization rather than profit maximization. And when we are focusing on wealth maximization, automatically profits also will be taken care. Economic value added. Guys, what is economic value added is, sir, after paying all the amount, including the cost of capital, including the cost of equity. Normally in accounts, we don't consider cost of equity. That is what we pay to the equity shareholders and all. Sir, here do we consider it? Yes. But for equity shareholders, we don't have any fixed commitment, no sir. Whatever is their expectations, we consider that as our required rate of return for shareholders. That will become a cost of equity for the company, for shareholders. That is equity shareholders. Yes. So, how much profit is ultimately left even after meeting all the cost of capital, is called economic value added. Economic value added represents the value added to the shareholders by generating operating profits in excess of cost of capital employed in the business. How do we calculate it? EVA, that is economic value added, is equal to operating profit minus capital charge. Capital charge is nothing but cost of capital, what we are paying to the providers of fund. So here operating profit is like we call it as NOPAT, that is net operating profit after tax, minus if there are different sources of capital in the capital structure, we have to calculate on an average what is the cost of the capital all put together, which we call it as weighted average cost of capital into capital employed. Yes, I will quickly show how do we calculate this. You can see XYZ Limited has a capital investment of 150 crore. After tax operating income is 20 crores, that is NOPAT. Okay, I am taking that 20 crores straight away. And company has a cost of capital 12%. So on 150 crore investment, they are supposed to pay 12%. They are supposed to pay 12%. So how much is left? Quickly. 18 crore. Yeah. This comes to 15, 15, 7, 20, 18, that comes to 18. Okay, left, what is left is 2 crore. 2 crore. What do we call it as? Economic value added. That is after meeting all my operating expenses, we had got 20 crore. Yes, sir. Now, sir, after paying all the providers of fund, that is debt, equity, preference, everything put together, still we are left with what? 2 crore. This belongs to whom? Equity shareholders. This belongs to equity shareholders. Then say you made a 20,000 capital investment in your company. Your operating profit after taxes is 10,000, which is nothing but NOPAT, net operating profit. The opportunity cost of the investment is 10%. So on an investment of 20%, what is the opportunity cost, which is nothing but cost of capital? 10%. We have earned a profit of how much? 10,000. So how much is EVA? 8,000. Economic value added. The goal of EVA is to take into account the cost of capital invested in the company, which includes all the different sources of capital. Thus, EVA represents the value added to the shareholders. Which shareholders? Equity shareholders. Because ultimately 8,000 here also belongs to the owners or equity shareholders. By generating operating profit in excess of cost of capital employed in the business. Sir, next, what we have different sources of capital. Then we have to calculate weighted average cost of capital. Guys, in this examples and all, sir, 10%, 12% and all, they are given directly. In some of the questions, they may not give it. Now, how do we calculate it, sir? I have taken an example here. See, different sources of capital are there. 3 sources for the company or the business. So, equity 12 lakh, 12% preference share capital 5 lakh, 10% debentures 3 lakh. Cost of capital would be, they have given 50, it will be given in the question, 15%, preference 12%, same rate we will take. Whereas debt should always be after tax. Debt should always be after tax. Sir, why? What is the reason? Interest is allowed as an expenditure. So on whatever amount of interest the company will pay, they save tax on it. They save tax on it. Clear? Yes, sir. For example, assume guys, I am paying 1 lakh interest. 1 lakh interest. Can I debit it to my P&L account as per income tax law? Yes. Accordingly, my profit will go down by 1 lakh. Yes. On that 1 lakh, assuming tax rate is 30%, we have saved 30,000. We have saved 30,000. Yes, for example, sir, if there was no interest, my profit would have gone up by 1 lakh. On that, I should have paid a tax of 30%. Yes. So my tax payment would have been increased by 30,000. Now, just because I have an interest payment of 1 lakh, I am debiting it to my P&L account. So automatically my profit will come down by 1 lakh. So I will save tax of 30,000 on it, which is nothing but 30% of 1 lakh. So interest will always help you to save tax. So now if I ask you in this example, what is my net expenses? Actually 70,000. What is my net expenses? 70,000. So whenever we are calculating cost of debt, we will always calculate after tax. So 7%, how did I get it? 10 into 1 minus tax rate, 30%, which comes to 7 or 7%, guys. Yes, please be careful with it. Then weight we are calculating. So total capital is 20 lakh. How much is the weight of equity? 12 divided by 20, 0.6. Then what is the weight of preference? 5 divided by 20. What is the weight of debt? 3 divided by 20. And weight should always be equal to 1 total. Yes, sir. Now if you multiply cost by weight, cost into weight. If you multiply each other, you will get weighted average cost of capital. Please give me individually.
0.09.
1 second. Yeah, 0.09, 0.03. Quickly. Matthews.
0.0100105.
So how much you are getting totally? 0.05. So that means 13.05%. What is the weighted average cost of capital? 13.05%. Actually, we have a formula for it, guys. It is like this: weight of equity into cost of equity plus weight of preference into cost of preference plus weight of debt into cost of debt. That is what we have done here. Okay, individually we multiplied and at the end we have added. Yes, sir. Now, assuming operating profit after tax. Okay, or it's operating profit. Only operating profit is 5 lakh. After tax, how much it would be? Operating profit after tax. Come on, guys. No PAT. It is like this. Please listen here. EBIT or operating profit is 5 lakh. Yes, sir. So what do we pay first? Interest. Interest is how much? Capital 3 lakh, 10%. So on 3 lakh, 10%, 30,000. Correct?
Yes, sir.
30,000. So 470 is profit before tax or earnings before tax minus tax 470 into 30%. 1,41,000. So profit earnings after tax EAT 3,29,000. Now this is earnings after tax, but no PAT means what? Net operating profit after tax. Did they tell after interest? No, because interest we will take care later. So what should I do now? Add back interest. Add back interest. How much is that? 30,000. So 3,59,000. Can I call it as no PAT? Yes. See, normally they will give this figure directly in the question. If they are not given, this is how you will derive. Now you may ask me, sir, interest, why did you reduce? Why did you add? Because when you want to pay tax, tax is always on profit after interest. After interest, I cannot straight away pay on 5 lakh. So first reduce interest, calculate what is the profit before tax, reduce tax, and then add back interest. That is nothing but no PAT. Sir, why are you adding back interest? Because we will reduce it here. We will reduce it here. So how much is that? 3,59,000. And see, I am repeating again. Most of the time they may give this figure directly in the question. You will straight away take it and do the calculation. If not given, how is it also? I am proving it or I am showing it. Yeah, minus. What is the total capital, guys? 20 lakh. On that, what is the weighted average cost of capital? 13.05%. Final figure. Final figure.
Like 61 minus 98,000.
98,000. What do we call it as? EVA. This is left to whom? Equity shareholders. Even after paying equity shareholders expectation, still we are left with how much? 98,000. Because while calculating weighted average cost of capital, have we considered cost of equity also? Yes. Even after paying them, still we have earned more. How much? 98,000. 98,000, guys. Yes. Next, market value added. Market value added concept shows that management, the increase or decrease in the value of the capital, that is when compared to book value, is market value increased or decreased. Market value added is equal to market value of capital minus book value of capital. I will show an example for that also. Example of market value added. Equity share capital, assume the face value is 10 rupees, 10 lakh. So how much is the number of shares? 1 lakh. Correct? The number of equity share is 1 lakh. Reserves and surplus is 3 lakh. It belongs to always equity shareholders. 12% preference share capital, face value 10 rupees. So number of shares would be 50,000. Then 10% debenture face value 100 rupees, 2 lakh rupees. Fine, sir. Total is 20 lakh. Current market price per equity share is 22. They have given it. Sir, what about preference and debt? If they have not given anything, we will assume book value is equal to market value. Book value is equal to market value. So now, market value added is equal to market value of capital. Guys, market value of capital for equity shares. What is the number of equity shares? 1 lakh. What is the current market price per equity shares? 22. So can I call this as market value of equity? Yes, sir. Plus, we have to add market value of preference and debt. So reserves and surplus is a part of equity. Again, don't add it separately. Okay, na? Yes, sir. So we have to add 5 lakh plus 2 lakh, which we are assuming it as equal to market value. Okay, now if nothing is given, we are assuming for preference and debt, market value is equal to book value. Minus, what is the book value? 20 lakh. 20 lakh. So how much we are getting?
9 lakhs.
9 lakh. What is this? Market value added. Sir, is it positive? Yes. That means the company has added some value to it in the market. Sir, what if by chance if this is negative? That means they have destroyed the value. They have destroyed the value. Now guys, if I ask you, what is the book value per equity share? It is like this. 13 lakh divided by number of equity shares, 1 lakh. 13 rupees per share. 13 rupees per share. We call it as book value per share. Now what is the market value? 22. So if I am simply calculating only, sir, for equity, what is the value added? Market value of equity, 22 rupees into number of shares, 1 lakh. Minus book value of equity, 13 lakh. Not only 10 lakh, 13 lakh, including reserves and surplus. So 22 minus 13, it is 9 lakh. Sir, what about for preference shares and debentures? Guys, when nothing is given, we assume market value is equal to book value. Now assume in the question they are given, sir, for example, current market price of preference shares is 15 rupees. Debentures is like 120 rupees. Then consider them while calculating these values. Don't straight away take 5 lakh, 12 lakh, sorry, 2 lakh. You consider the respective value. For example, what is the market value of preference shares? It would be 50,000 shares into 15 rupees. Then 2 lakh divided by 100, that is 2000. 2000 into 120, that is the market value of debt. Minus its book value. Book value would remain same. That is the value at which the capital is appearing in the book. Yes. Financial distress and insolvency. Generally, the affairs of a firm should be managed in such a way that total risk here includes business as well as financial risk borne by the equity holders is minimized and is manageable. Otherwise, the firm would obviously face distress. When the company cannot manage their risk, if it is out of their control, then they will get into a situation called distress. Firm may have to sell its assets to manage its obligations to outsiders at a prices below their economic values, resort to distress sale. Now, sir, when I am not able to pay my liability, I will start selling my assets. And when I start selling the assets, and if the buyer know that I am closing down my business or I am in a distress situation, he will definitely capitalize it. He will make use of it and he will try to negotiate with me at a very less price possible. Even guys, when it comes to your preparation, you have to manage your time really well. If not, in the last moment, you will be at distress situation. Sir, unnecessary pressure. Now we have so much things to cover. I don't know what to do. I'm feeling like I'm forgetting whatever I have studied. All this will happen. But whatever time you had before, now also you guys have good amount of time left. Make sure that you are using effectively. Sir, how many hours in a day? It depends on you. If you're doing anything other than CS, then accordingly plan your day in such a way that you will maximum give the time for CS. Because this is very, very important. I know you might be busy with other things or you might be doing any other like degree courses. But what is more important for your life as of now is this CS degree, guys. So you have to prioritize it and you have to give time as much as possible. Instead of regretting later after getting the results, it's better to work hard now. And to the extent possible, don't target that 40-50. Your target should always be above 60 in all the papers. Sir, but FM is only for 40 marks, sir. Overall, I'm talking about. Okay, I know in FM you cannot target above 60. Overall, a complete paper put together or any paper as a whole I am talking about, please target above 60, guys. That is what your goal should be. Because if your target 40, 50 will go for the exam under prepared, and there one or the other googly will be there, and you will not read it, you will not read the ball, you will not read the question, or you will not able to answer the question. So all these things will get into trouble for you. So please make sure as a student, you always do the work what you're supposed to do. Rest will be taken care, guys. Trust me. You think that sometimes we will think about some external factors which are not in our hands. First, let us think about what is in our hands. Now, for example, sir, this attempt question paper will be tough. Evaluation will be tough. What will be the result? Is it in our control? No. Why should we bother about it? What I can do is only I can prepare to my best. Rest, leave it to ICSI or God. Okay, and it will happen, don't worry. So if you are giving efforts, if you are putting your maximum efforts, you will get the results what you deserve. Yeah, coming back. So when the sale proceeds is inadequate to meet the outside liabilities, the firm is said to become bankrupt, or after due processes of law are gone through, they may also become insolvent. That is when they are not able to discharge all their liabilities. Then emerging roles of financial manager, FM, not finance minister, finance manager, performs mainly the following duties: forecasting of cash flows, that is how much cash requirement we have in the future, from what all sources we will get it. So we can prepare something called as estimated cash flow statement for this. Then raising funds, that is all about financing decisions, or from where can I get the money, from which source, and deciding about capital structure is also biggest thing. I cannot drain little equity this much, debt so much. I have to consider the advantages, disadvantages of both the sources. Only then I have to go with it. Then managing the flow of internal funds, that is whatever profits we generate, how do we manage it? Should we declare the equity dividend? Should we retain it? If I retain, what do I do with it? Then to facilitate cost control, no company will be happy with whatever cost they are incurring. They will always be looking forward to control their cost. And for controlling the cost, they cannot compromise with the quality. They cannot use cheap quality of raw material. They cannot use the unskilled workers and all in their operations. They have to make sure that whatever standard we are maintaining, we should continue with the same, by doing some research on unnecessary things on which we are spending, or there might be some losses, process loss which we are suffering. So if I have a proper control over all that, then my cost can come down. Then to facilitate pricing of a product lines and services, that is the deciding what should be my selling price, or what is the amount I have to charge to my clients and all. Then forecasting profits. So many a times we sit today and forecast what can be my profit for next 3 months, 1 year, 5 years, 10 years and all, for which I have to consider various factors. It is not like simply I am predicting 10 crore, 5 crore. No. If someone asks me how 10 crore, how 5 crore, how will you make it, from what all sources you are expecting, from which branch how much, India how much, export how much, I should be able to give a justification for it. Measuring required return, how much return I am expecting from my investments. Managing the assets of the business. Sir, if I have purchased, just because I had crores together of capital, I have purchased all the assets and I have kept it. What is the use if the assets are kept idle? You should make sure that you are using that asset and generating revenue out of it. And the return what the asset will generate should be more than what cost we are paying for it. Then managing the funds. It is all about the features the finance manager should have, or the roles which the financial manager will play. Yeah. Next, second chapter is a small topic but very important, because again this will also have an impact on many other chapters, guys, especially the next chapter, capital budgeting. Time value of money, simple. 1 rupee today is not equal to 1 rupee after 1 year. 100 rupees today is not equal to 100 rupees after 1 year. Now if I ask you, sir, for you guys, I will give you 100 rupees today or 100 rupees after 1 year, what will you choose? Definitely today. Now your parents also would have given some offer for you, okay, telling if you pass I will get you this, but you are now little doubt, better let me get now only, okay, risk is reduced. So if I get it now only, you tell I will definitely pass, get me today only. So this is how, because we always play around with that time value of money. I want to enjoy now better than after 1 year or 2 years. But when it comes to CS course, guys, yes, we have to struggle for few years. I know here, sir, there is a lot of uncertainty. When will I complete? At what age I will be CS and all? No one is sure about it. But I can make it as early as possible. That is what the belief you should have. Okay, because this is not a course where 3 years means they will push us, or 5 years means they will push us. No, It may take as long as 20, 25, 30 years also. But make sure that you complete as early as possible, because there are many things you have to experience after qualification. And this is just the end part of your academics. So we have to struggle for few years so that we will be more comfortable for a long period of time, or rest of our life. So I always believe in this. So if I can spend few years of my life like others are not, I can live my rest of my life like others cannot. So you guys also please believe in that and work hard for it, guys. Instead of regretting later, thinking I should have done that, I should have done this, I should have studied and all. Because many people who will go out of this professional courses like CA, CS and all, throughout their life they will have a regret. Shit, I should have done that. So you people should not fall in that category, no matter what. Yes, I agree it is hard, it is difficult, but not impossible. If you give your best, you can definitely do it. One of the most fundamental concept in finance is that money has a time value. That is to say that money in hand today is worth more than money that is expected to be received in the future. Some standard calculation based on time value of money are as follows. First, I will just explain, guys. Then I will also show you how do we apply this and all. Important. Present value. Present value refers to the current worth of the future sum of money or stream of cash flows given a specified rate of return. How do we calculate it? Present value is equal to future value or future cash flow divided by 1 plus r to the power of t. And r here is nothing but interest rate, discounting rate and all. To the power of t is nothing but number of years. Means after how many years I am expecting to earn that future cash flow. We can also rewrite the formula like this. Present value is equal to future value into present value factor. That is future value at the end of n year into present value factor, or we also call it as discounting factor after n years at I rate. Sir, how do we get this present value factor? Guys, very simple. 1 divided by 1 plus r to the power of t. To the power of t. For example, assume I want to calculate it for 12%. So it would be 1 divided by 1 plus 0.12 to the power of, assume for 5 years I want to calculate. It is 5 to the power of 5. Why, sir? Because the future value what I am getting is at the end of 5th year. How do I calculate in the calculator? Simple. 1 divided by 1.12 you do is equal to, that is for the first year, is equal to second year, is equal to third year, is equal to fourth year, is equal to fifth year. How much you are getting? 0.56 74. What do we call this as? Present value factor for fifth year at 12%. For fifth year at 12%. Sir, can we cross confirm this? Yes, through a table. Through a table. I will just show you. Guys, see, this table will have 4 things. First table is with respect to future value factor. Second table, future value annuity factor. And everything here given is per dollar. Even if it is per rupee, the values remain same. Don't worry. Table 3 is present value factor. And table 4 is present value annuity factor. Present value annuity factor. Now what we are looking is present value factor. At what rate? 12%. For how many years? 5 years. You can see here. It is 0.5674. Sir, how did we get it? I repeat once again. In your calculator, 1 divided by 1.12 is equal to, that is for the first year. I think you would be getting 0.8929 is equal to second year, is equal to third year, is equal to fourth year, is equal to fifth year. You are getting 0.5674. Same way, if you want to keep on getting for 8th or 10th year and all, you will be keep on pressing is equal to, guys. Yes. So I repeat, present value factor, how do we get it? 1 divided by 1 plus r to the power of t, or t can also be used as n, that is number of years. Higher the discount rate, lower would be the present value of future cash flow. So higher the rate, lower would be the present value. Present value factor will always be decimal, guys. That is less than 1. That one thing, keep it as a shortcut. You need not write it in your answer. This is just a point which you have to keep in mind while doing the calculations. So whenever you take present value factors, you make sure that it is less than 1. It would be in decimals for at any rate for any year. Yes, so I will just show you in the calculation. So you can see present value. I have just given an example here. Find present value of 80,000 to be received after 5 years when required rate of return is 10%. So after 5 years, I will be getting 80,000. I want to know what is the value of that today. What is the value of that today? So how do I calculate? 80,000 by 1 plus R. R is how much? 10% here. To the power of 80,000 I am getting at the end of 5th year. So T is 5. So how much will I get? 49,674. Clear? Sir, how do I get the value for this, sir? Divided by 1 plus 0.10 to the power of 5. Simple. In your calculator, take 1.10 into is equal to you do. That is for the second year straight away. Then is equal to third year. Is equal to fourth year. Is equal to fifth year. Yeah, I repeat, guys, when you take 1.10 into is equal to, that is straight away for second year. Okay, so you have to press is equal to only 4 times to get the factor for fifth year. Yes, and this is division. That is why we are not taking 1 by 1.10. Clear? How much you will get? How much you will get? 6105. So if I divide 80,000 by 1.6105, you will get this value. Are you getting it quickly? You have to cross check. 80,000 divided by 1.6105. Yes, sir. Next, sir, can I get it in another way? Yes, I can multiply with present value factor. I can multiply with present value factor. Sir, how do I get that present value factor? Calculate 1 divided by 1.10 is equal to, that is for first year, is equal to second year, is equal to third year, is equal to fourth year, is equal to fifth year. How much you are getting? 0.6209. So now multiply, don't divide it. It is present value factor means multiply. Because, sir, why, sir? Simple logic. While calculating present value factor only, we did 1 divided by 1.10. No? Again, no division. It is straight away multiplication. Clear? If not, if I am not doing 1 divided by, then you can put this as denominator. That is 1.10 to the power of 5. You will get same number. Some minor differences you may get, that is acceptable. Even in the exam, it is acceptable. So you can see 0.6209 will be my factor in the table at 10% for 5 year. 0.6209 for 5th year at 10%. Yeah, next. Here one more is there. For the same question, if I take 15%, then it would be 80,000 divided by 1.15 to the power of 5. Same way we have to calculate. Sir, here we did now 1.15 into is equal to 4 times. Whatever value you get, divide. Clear? Huh? Yes. No, sir, I want to use present value factor. Can I do it? Yes, like how we did here. 1 divided by 1.15 is equal to 5 times. You will get 0.4971 multiply with 80,000. You will get 39,776. So you can observe, sir, when we increase the rate from 10% to 15%, what is the value? Value is decreasing. The present value will decrease. As the rate increases, the present value will decrease. As we decrease the rate, the present value will increase. Yes. Then coming to future value of lump sum. Future value of a lump sum means in this case, present value will be given. We have to calculate what will be the value of this investment or money after 3 years or after 5 years. Refers to the value after a certain period of time at a given rate of interest. In our previous example, if I tell, now 80,000 is what we are supposed to find out. Present value, they would have given it. It is like that. Yeah. So the formula is like this. Future value is equal to cash flow, which is nothing but present value, into 1 plus r to the power of t. Into 1 plus r to the power of t. And one more, that is instead of cash flow, it is nothing but present value. Present value into 1 plus r to the power of t. Sir, here 1 divided by and all will come? No. That is only for present value. Present value factor will always be less than 1. Whereas future value factor, sir, it will normally be more than 1. Yes. So present value will always be less than future value. For example, future value is 80,000, sir. Present value, if I calculate, will it be always less than future value? Yes. Future value factor will always be more than 1. Present value factor, I told you, it is always less than 1. Whereas future value factor is nothing but what we get here, guys. 1 plus r to the power of t is there, na? That is nothing but future value factor. And it will always be more than 1. Clear? Yes. Sir, how, sir? Simple. I want to calculate it for 10%. Assume 1.10 to the power of 5. So will it be more than 10%? Sir, will it be more than 1? Definitely. Yes. So how do I calculate it, sir? In the calculator. 1.10 into is equal to, straight away it is for second year. Now for fifth year, if I want to do, is equal to 4 times is equal to. This is for future value factor, guys. Please be careful. And sir, future value factor we did for present value calculation also. Yes, but there it was denominator, not multiplier. There it was denominator. And what multiplier we used to calculate present value was not future value factor, present value factor. How did we get it? 1 divided by 1 plus r to the power of t. If I am not using that 1 divided by 1 plus r to the power of t, straight away you use 1 plus r to the power of t as a denominator, not as a multiplier. Whereas to calculate future value, it will always be multiplier. Future value factor. So that is why I am telling you, because sometimes students may get confused with it. Always remember like this, guys. Present value will be less than future value. Or future value will be more than present value. Or else, another way if I put it, present value factor will always be less than 1. Whereas future value factor will always be more than 1. Yeah, we'll just discuss this with an example, future value. Find, please observe, there are two things here. Find present value of maturity value of 10,000. So first we have to calculate maturity value of 10,000, then find out the present value of it. Okay. Which has been given on 15% interest for 5 years. Means I have invested 10,000 at 15% return for 5 years. Well, required rate of return is 10%. So 10% I should use to calculate present value. So first let me calculate maturity value. I am investing 10,000 today at 15% for 5 years. At the end of 5 years, how much will I have? 20,113. How did I get it? Present value into 1 plus r to the power of 5. What is r here? 15%. Whatever return I am getting. Yes, sir. So what is the maturity value at the end of 5th year? 20,113. Can I call it as future value? Yes. Find out the present value of it. How is it, sir? So future value divided by 1 plus r to the power of 5, or else into present value factor. For example, 20,113.57 into present value factor. Present value factor for 10%. 1 divided by 1.10 is equal to. Come on, catch up. So how much you will get? 0.6209. 0.6209. Are you getting the same amount? Yes, near to it. If not exactly same, near to it. 12,488, guys. Is that clear? Please be careful. While calculating present value factor, you have to do 1 divided by 1 plus r to the power of t. If not, straight away you can use 1 plus r to the power of t as a denominator. While calculating what? Present value. While calculating future value, it would be multiplier. That is present value into 1 plus r to the power of t, guys. Okay. Next. From the following information, compute balance in an account at the end of 10 years. If 2,500 is deposited today and account earns 4% interest. Whenever they give interest rate, discounting rate and all, it is always per annum, guys. But it is compounding annually and quarterly now. If it is compounding annually, means interest is compounding every year, sir. So what is the rate per year? 4%. Straight away we'll take. And they are asking at the end of 10 years. So what is T or N year? 10. So 2,500 I am investing today for 10 years at 4%. So into 1 plus R. R is how much? 4%. To the power of T, 10 years. So we will get 3,700. Yes. Now if it is compounding quarterly, so interest is compounding quarterly, we have to calculate the period in quarter. In quarters. So 10 years. Each year has 4 quarters. So what is the total period? 40. Now we should also calculate interest per quarter. Interest 4% is per annum. Sir, 4% divided by 4 quarter. Per quarter how much? 1%. 1%. Observe you. 2500 into 1 plus R. Here R is per quarter because it is compounding quarterly. 0.01 to the power of T. T, how many quarters? Not how many years. How many quarters? So 10 years into 4 quarters, which is 40. So this and all will take time, don't worry. Or else most of the time this value they may give it in the question itself. This value. They will give it in the question itself. Because sir, pressing 40 and is equal to 39 times and all will take time, sir. Yes. You know how to calculate. If they don't give this value also, you're ready how to do it. If not, if they give, straight away multiply with 2500. Clear? In the question, they may give like this. 1.01 to the power of 40 is equal to 1.4889. They may give like this. Straight away use that as a multiplier. Yes. Sir, what if it is compounding monthly, quarterly and all? Nice, simple. Assume it is compounding monthly. So, rate also divided by 12. Whatever you get, you take. That is per month. Even the period should be 10 years into, for each year how many months? 12 months. So it is 120 months. T to the power of 120. Sir, what if it is compounding half yearly? Then it is 4% divided by 2. 2%. Then 10 years as 2 half years each. So it would be 20 to the power of 20. It is like that. So please be careful. You have to alter both interest as well as T. T is total number of period. And R should always be for compounding period. That is quarterly, monthly, half yearly, whatever is that. R should be for that. Next, future value of annuity. An annuity is a stream of equal regular periodic payment made or received for a specific period of time. Future value of annuity is equal to equal cash flow. That is, sir, I am earning same amount every year. Same amount. Equal cash flow into future value interest factor of annuity, or else simply future value annuity for n years at I rate. Yes, let me show the present value of annuity also, then we will go for example. Sometimes instead of single cash flow, the cash flows of a same amount is received for a number of years. So how do we calculate present value of annuity? Equal cash flow into present value interest factor of annuity for n years at I rate. Note, under annuity concept, the cash flow should always be equal. Only then I can use annuity concept. If not, I have to do individual calculations. Yes, sir. So how does this annuity works? Quickly, let us see the examples. Find the amount of annuity if payment of 5,000 is made annually for 7 years at the interest rate of 14% compounded annually. Given future value interest factor of annuity, they have only given it. Normally, they will only give it in the question, guys. You need not worry. For 7 years at 14%. 14% at 7 years, they have only given it is 10.7305. That means, guys, 5,000 we are investing for 7 years. At the end of 7 years, how much my investment would have grown? So it is 10.7305. 7305. How much is that? Vishnu? 50,000? 53,000? 652. What? Okay, 652. This is the future value of my investment. Every year, at the end of every year, how much I am investing? 5,000. For how many years? 7 years. And the investment will give me return of how much? 14%. So at the end of 7 years, what would be the maturity value or future value? 53,652. Sir. Yes. Sir, how do we get this value? Through the table also I will show you. Through the table, present future value annuity. Yeah, second table. Future value annuity. 14%, right? Yes. 7 years, right? Yes. 10.730. And don't worry, sir, they will give, especially when it is a future value annuity, they will give the value in the question. But I'm just showing how do we check this in the table also. Next, you can see quickly, a person is required to pay for 4 equal annual payments of 5,000 each in his deposit account. That pays 8% interest per year. So I am depositing 5,000 every year for 4 years at 8%. find out the future value of annuity at the end of 4 years. So at the end of 4 years, what will be my investment value? 5,000 into 4.50506. What is this? Future value interest factor of annuity for 4 years at 8%. 2 lakh.
22,000.
530. One extra zero. That's answer. 22,530. Same way. 2,000 is invested at the end of each month. In an account paying interest at 6% per year. Rate is per year. If I can calculate per month, can I do it? Yes, 6% divided by how many months in a year? 12 months. So per month, how much? 0.5%. What is the amount of this annuity after 10th payment? So we are making the payment for 10 months. Here T or N will be 10. Okay, sir. So you can see for 10, 0.005. It is 0.5%. So it is decimal wise 0.005. What is the value? They were given 10.22. So straight away multiply 2000 with 10.22. 440. Yes. What is it? The value of my investment at the end of 10th month. Please be careful, guys. Here T or N is in months. So even interest we have to convert per month, which is 0.5%. Then coming to present value of annuity. Present value of annuity. Find out the present value of 4-year annuity of 20,000 discounted at 10%. Yes, sir. So present value of interest factor of annuity for 4 years at 10% is how much? 3.1699. So what should I do, sir? Straight away multiply 20,000 into 3.1699. What would be my present value today? 63. 398. 398. Yeah. So 63,398. So what is this present value annuity factor we call it as? Sir, how do we calculate? Guys, this again will be given in the question. If not also, they will give it, is what I believe. If they don't give also, you can calculate in calculator. How is it? I will show. Please listen. Rate is 10%. Please clear all the memories, whatever would have been there in your calculator. Press MRC, clear the memory. Do whatever I tell. 1 divided by 1.10 is equal to M plus. 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 Now MRC. How much you are getting? 486. 2.486.
486. 3.1698.
Give the calculator quickly. Guys, do it like this. 1 divided by 1.10.
3.169.
So you are getting the same number now. I will just show you. I will explain along with me. Do it. Clear all the memories. Press MRC. Clear the memory. Do it along with me. 1 divided by 1.10. 1. I'm repeating. 1 divided by 1.10 is equal to. You are getting 0.909. Press M plus. Is equal to. You are getting 0.826. Press M plus. Press is equal to 0.713. 7513. This is for third year. Press M plus. Again is equal to 0.6830 you are getting. This is for the fourth year. Present value factors. Whatever it's showing now here in the calculator, they are present value factor. So press M plus. Now MRC. It would be 3.169865 you will get, which we will make it as 99. Clear? So whenever it is the decimal, for example, sir, when it is decimal, how many decimals should I take? 3 or maximum 4, guys. If you are taking 3 decimal, if fourth decimal is 5 or more, round off the third decimal to next number. If you are taking 4 decimals, if fifth decimal is 5 or more, round off the fourth decimal to next number. This and all you take. Clear? Yes. This is how we derive the value of present value annuity factor through calculator. Sir, no, sir, I cannot do it. Individually, can I do? Yes. So what you can do is, for example, add up everything individually. 1 divided by 1.10 is equal to, if you do, this is for first year. First year. Then again is equal to you do, you will get 0.826. Then again is equal to you do, you get 0.7513, or else I am taking only 3 decimals. Then again is equal to you do, you will get 0.683. If you add up all this, you will get present value annuity factor. Present value annuity factor. Or else, sir, instead of doing this, it will be time taking. Can I do it straight away in the calculator? Yes, that is using M plus. I will just explain again the M plus calculation, that is using calculator. How do we derive present value annuity factor? 1 divided by 1.10 is equal to, that is for first year, press M plus, is equal to M plus, is equal to M plus, is equal to M plus. We are done for fourth year. Now press MRC. Now press MRC. Yes. Next, determine the present value of 7,000 each paid at the end of each year for the next 6 years. So, present value interest factor of annuity for 6 years at 8% is how much? 4.6229. Sir, can we find out this using table also? Yes. So, last table you can come to table 4. Present value of annuity. So, there 8%, right? 8% for 6 years. Okay. 8% for 6 years. 4.6229. Sir, can I get it in calculator also? Yes, same way. Clear the memory. I will help you. Clear the memory. It is 1 divided by 1.08 is equal to M plus. 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 Now MRC. Now MRC. You will get 4.6229. And choice is yours. You can either take 3 decimals or maximum 4, but not more than 4. But not more than 4. Yes, friends. So if I multiply 7,000 with present value annuity factor, which is 4.6229, we will get what is the present value of it. What is the present value of it? How much is that? Quickly. 32,360. Yes, 360. Yes, sir. Next, perpetuity. Sir, what is perpetuity? May not be in reality, guys. Sir, what if I invest now and get return forever? I am only not forever, but still. Okay, the concept is like that. What if I get the return forever? There is no N here. There is no T. Yes, N and T is one and the same. Don't get confused. Perpetuity is an annuity in which the periodic payments or receipts begin on a fixed date and continue indefinitely or perpetually, forever. In the company law also you would have learned perpetual succession. Members will come and go, but company will go on for ever. And here also, return will go on for ever. So how do we calculate the present value, sir? Return divided by I. R is nothing but return here. Whatever amount of return I would be getting. Yes. Sir, what if that return is growing annually at a constant rate? Then R divided by I minus G. G here is nothing but growth rate. I is nothing but interest rate. Yes, if it is growing. And in that case, if it is growth, R should always be at the end of first year. R should always be at the end of first year. So R or cash flow at the end of first year divided by I minus G, guys. Okay. So perpetuity also will just quickly see. Uday wants to retire and receive 3,000 a month. He wants to pass this monthly payment to future generation after his death also. Okay, even if he die, his family member should continue to receive 3,000. It is like forever. Even the family member also one or the other day they will go, but we will follow the concept of perpetuity here. He can earn an interest of 8,000 compounded annually. But 3,000 what he has to get is monthly. Okay. How much will he need to set aside to achieve his perpetuity goal? How much he has to invest now? He wants to receive 3,000 at the end of every month till he die, plus after his death also family members. Yes, sir. So what is the cash flow here? 3,000. So 3,000 And interest rate, as we want to receive it monthly, so even interest rate we are calculating monthly. 8% is per annum divided by 12 months. You will get this much in decimal. Yes, sir. Divide each other. Cash flow divided by I. I year is per month. You will get 4,49,775. So that means if Uday invest 4,49,775 today, at the end of every month, 3,000 he will be getting. When he die, his family members also will continue to receive 3,000. Now, sir, what if Uday wants to receive 3,000 from today? Today 3,000 plus one after 1 month, after second month, like that. In that case, he has to invest 4,49,775 plus 3,000 plus 3,000, because 3,000 is equal to 3,000 today only. So if you want to start today itself, he has to add 3,000 and invest it. No, sir, Uday wants to receive 3,000 from the end of first month, then he has to invest 4,49,775 today. Clear? Yes. Sir, what if it is growing perpetually? Means the amount is not same every year. Year it was 3,000 forever, na? It is not like that year. Assume 3,000 is like growing every year at a constant rate. Yes. Assuming that the discount rate is 7% per annum, how much would you pay to receive 500 per annum, growing at 5% annually forever? Okay. Assuming 500 is at the end of first year. Okay. Growing, I is 7%, so 0.07 minus growth rate is 0.05. So 500 divided by 0.02. 25. So if I want to get 500 at the end of every year forever, and also along with growth, means 500 I will get it at the end of first year, but at the end of second year, third year and all, will it be same? No, it will be growing at a growth rate of 5%. So I have to invest today 25,000. Now see, for academic purpose, the growth rate would be constant. Sir, actually in reality, will growth rate be constant? May not be. So first year it might be 5%, next year 6%, next year 7%, again 6.5%. So it can be fluctuating. But if that is the case, we cannot calculate any amount. So if at all, if in the exam, if there is a question on growth and all, it will be constant growth rate, guys. Yes. Next, sinking fund. Sinking fund is normally created when I have some obligations to be paid in the future, guys. Now assume I have issued a debentures of 50 lakh. I know that it is redeemable after 10 years. So after 10 years, I should have 50 lakhs to pay or to repay or redeem my debentures. Now, all of the sudden, I may not be able to arrange the funds. So what I will do is, I will plan from today only, I will set aside a part of my profit so that at the end of 10th year, I will have 50 lakh with me to smoothly redeem the debentures. So for that, I may create something called a sinking fund. It is the fund which is created for a specified purpose to be fulfilled at future date by way of sequence of periodic payments over a time period at a specified interest rate. Size of sinking fund deposit is computed by using the following formula. That is, future value of annuity is equal to R into future value interest factor of annuity at I rate for n years. R year is nothing but equal annual cash flow. Means how much I have to set aside every year. So for this also, I have one example. ABCL company has issued a debentures of 50 lakh to be repaid after 7 years. How much should? So they have to repay 50 lakh after 7 years. So at the end of 7 years, they should have 50 lakh. So can I call future value factor as 50 lakh? Yes, sir. Because that is what they should have at the end of 7th year. How much should the company invest in sinking fund earning 12% per annum in order to able to repay the debentures? So R I don't know. R we don't. That is what we are calculating. Means how much every year we have to set aside. Into future value factor for 7 years at 12% is how much? 10.089. Future value interest factor of annuity for 7 years 12%. Future value of annuity. I will just show it. Second table. So what was the year? 7 years 12%. So 12%, 7 years, 10.089. Hope it is visible. 10.089. Yes, sir. Yeah. Now I am just taking this to the other side. It will become denominator. So R is equal to 50 lakh divided by 10.089.
49 lakhs, sorry,
4,95,000.
95,589. What is this, guys? This is the amount which I have to set aside every year and invest in an investment which will give me 12% return. For how many years? 7 years. So that at the end of 7 years, what would be my investment value, or what is the value of my investment? It would be 15 lakh. I can liquidate my investment, that is I can sell it and redeem my debentures. Yes. Then the last one here is net present value. Net present value is nothing but what is the value of my investment or proposals or asset class as on today. There are two formulas to calculate. At the end, result will be same as present value of cash inflows minus present value of cash outflow. Or else, if I consider, if at all, if there is any cash flow in between the period or in between the term, then I can consider year only. The present value of future cash flows. For example, assume third year, inflow is 5 lakh, outflow is 2 lakh. What is the net cash inflow? 3 lakh. So I will calculate the present value of it. Yes, sir. So present value of future all net cash flows minus initial investment. You will get NPV. If NPV is positive, good. If NPV is negative, no, it is not better. It is not good to invest in that asset. I'm not discussing the questions here because we will discuss this in the next chapter. NPV. So we are done with 2 chapters, guys. Yes, guys. Now we will get into chapter 3, which talks about capital budgeting. It is all about investment decisions. Sir, in which asset class or in which proposal or in which project we should invest so that we get maximum returns. So using various capital budgeting techniques, we will be deciding that. Capital budgeting. Capital budgeting is the process of determining which capital expenditure project should be accepted amongst various projects and given an allocation of funds from the firm. Allocation of capital resources function involves organizations' decisions to invest its resources in long-term assets like land, building, facilities, that is nothing but land and building, equipment, vehicles, etc. So capital budgeting decisions or investment decisions will be normally based on long-term assets, guys. Should I invest in this asset or not? If yes, what is the return I would be getting out of it and how long? That is for how many years? Kinds of capital budgeting decision. The first one is accept or reject decisions. Business firm is confronted with alternate investment proposals. If the proposal is accepted, the firm incur the investment and not otherwise. Broadly, all those investment proposals which yield a rate of return greater than the cost of capital are accepted and others are rejected. Under this criterion, all the independent projects are accepted. So any project which will give me a return more than the cost of capital, I will go with it. And assuming I don't have any monetary constraints, that is, I don't have any money limit or investment limit. Yeah. Any projects which will give me return better than my cost, I will go with it. But in reality, can it happen, sir? No. Our investment or the money what I have or the capital what I have will be a limiting factor for me. I cannot invest in all the projects, even though it is giving me positive return. So that is what we call mutually exclusive decision. Means out of the various alternatives available, I can choose only one. I can choose only one. Once I choose the one, it is understood that I am not choosing the others. It includes all those projects which compete with each other in a way that acceptance of one precludes means we are not accepting the others. The acceptance of other are others. Means out of the various alternate available for me, I am choosing only one. Only one. Capital rationing decisions. Capital rationing refers to the situation where the firms have more acceptable investment requiring greater amount of finance than is available with the firm. It is concerned with the selection of a group of investment out of many investment proposals ranked in the descending order of the rate of return. So for example, sir, I have assumed totally 10 lakh investment with me or capital with me. Now we have various options available. A, B, C, D, E projects. So capital investment which I have to make is like 2 lakh, 3 lakh, 3 lakh, 2.5 lakh, then 4 lakh, then again 1 lakh. Okay. Sir, what is the return? I am taking return in percentage. Assume 10%, 12%, 15%, then 11%, 12%, and 8%. Okay, sir. Now I have a total capital budget of 10 lakh. Sir, in which project should I accept? So can I go with only one? Need not be. I can choose more than one also, but the aggregate should be within 10 lakh. Yes, sir. So which all will I choose? I will come with the highest return first, 15%. So will I choose C? Yes, sir. What is the total investment? 3 lakh. Then is 12%, 12%. So 3 plus 3, 6 exactly it will be. So this I am going with. So this is 3. So 3 plus 3 plus 4 is equal to 10. So I will go with B, C and D is twice here. Yeah, this let me make it as Z. Okay. So this is Z. I will go with B, C and Z. I will go with B, C and Z, guys. Clear? So that I am utilizing my money in a more better manner where I am getting my maximum return. Sir, assume my cost of capital is only 5%. Even A and D as well as E is giving me return more than my cost, but still I don't have so much money to invest. I don't have so much money to invest. So with available capital, I will choose whichever project is giving me the best returns. This is called capital rationing. Okay. Next, capital budgeting techniques. This is important point, guys. We have various methods to do decisions with respect to capital budgeting. Discounted and non-discounted methods. Traditional or non-discounted cash flow techniques. These techniques do not discount the cash flows to find out their present worth. Yes. So we don't use any time value of money concept here. We'll straight away do the calculation without using time value of money concept. That is present value concept. First one is payback period. Sir, what is payback period? How long will it take to recover our investment? We also call it as like break even and all. Sir, how long will I take to recover my investment? It is not like we will stop it there. We will continue. We will start earning profit also. But how long will it take to recover my investment? Assume, guys, I have invested 10 lakh. The project life is 10 years. Now, sir, will I take 10 years to recover my 10 lakh? No. If that is the case, why will I invest? Because, sir, I have to earn something more than 10 lakh. So assume to recover 10 lakh, it will take 7 years. So what do I call 7 years as? Payback period. This technique estimates the time required by the project to recover the firm's initial outlay through cash inflow. So that is through cash inflows, how long will it take for me to recover my investment? Payback period is equal to initial investment divided by annual cash inflow, provided it is equal. Where the cash inflows are not uniform, that is not equal, cumulative cash inflows will be calculated and by interpolation, exact payback period can be calculated. How is it? I will show it with the example. Decision rule. Accept the project if the payback period computed is less than the maximum set up by the management. Now assume I have set up maximum payback period as 8 years. Now for my project it is 7 years. Can I go with it? Yes. Assume now vice versa. I had set up maximum payback period as 8 years. But for my project I am getting payback period as 9 years. Should I accept it? No. Now sir, what if it is a multi-project company or we have various alternate proposals available? I will choose the project whichever is having lower payback period, because I want to recover my investment as early as possible, guys. Yes. How do we calculate it? I am showing it here. First example on payback. A project requires 25,000 as initial investment and it will generate an annual cash inflow of 5,000 for 10 years. Find the payback period of the project. Payback period is equal to initial investment divided by annual cash inflows. So initial investment is 25,000, equal annual cash flows are there, which is 5,000. So as the cash flows are equal, simply use it as a denominator. So how long will it take for me to recover my investment? 5 years. Sir, for the life, but the life of the project is 10 years. Yes, obviously after 5 years, whatever I earn will be like a profit for me. Clear? Yes. Next, a project needs an initial investment of 25,000 and annual cash inflow for 5 years are 6, 9, 7, 6, 4. They are not uniform. They are not equal. Respectively, find out the payback period. So we have to follow cumulative approach here. So at the end of first year, how much I would have earned? 6,000. At the end of second year, 6 plus 9, 15,000. At the end of third year, 15 plus 7, 22,000. At the end of fourth year, 22 plus 6, 28,000. Did I recover? Yes. So I have recovered in between third and fourth year. Third and fourth year. Sir, how do we calculate the exact period, sir? It is like 3 plus. Guys, how much I require totally? 25,000. 25,000 is my initial investment, right? Yes. So by the end of third year, how much I have recovered already? 22. So how much short is there? 3,000. 3,000. In the fourth year, what is the cash inflow? 6,000. I need 3,000, but in the fourth year it is 6,000. So can I tell 3.5 years? 3.5 years. Or if you want to calculate in months, it will be 0.5 into 12 months. It will be 6 months. So it would be like 3 years, 6 months. 3 years, 6 months, guys. This is when the cash flows are not uniform or not equal. Next, average rate of return or accounting rate of return is equal to average profits divided by initial investment. Accept the proposal if ARR is more than minimum rate of return which is kept by the company. Normally they will keep it as cost of capital and all. Or reject the project if ARR is less than minimum rate of return, which is cutoff rate. In case of multiple projects, the project yielding a higher rate of return will be preferred. Clear? I have assumed 2 or more projects. Now, which one should I choose? Whichever is giving me the highest ARR. Yes, sir. How do we calculate it, guys? Simple. Assume first calculate total profit. Assume the life of the project is 5 years. Over a period of 5 years, what is the total profit you are calculating, getting or earning? Add it for all the years. Divided by what is the life? 5 years. What do you get? Average profit. On an average per year, how much? Divided by initial investment. Divided by initial investment. And if you are calculating in percentage, into 100. Into 100. Now, sir, sometimes there will be investment at the end of the life of the project also. There might be some investment at the end of life of the project also. In that case, we have to take average investment as the denominator. How is it? Initial investment plus investment at the end of the period, whole divided by 2. However, you calculate average stock, similar to it. Yes. Then modern or discounted cash flow techniques. One of the disadvantages of both these methods are they don't use time value concept. They don't use time value concept. Even payback period. After the payback, whatever cash flows we are getting, they ignore it. That is, assume we achieved a break even, payback period at 5th year. Whatever we earn after 5 years, they don't consider it. Yes. And also, sir, whatever we are earning in the future, they are not using the present value concept to calculate what is the present value of it. So, the disadvantages for both these methods is they don't use the present value concept. Now, coming to modern or discounted cash flow techniques, they use the concept of time value of 1 year. So, first one, NPV, that is net present value method. How do we calculate? One of the important method, guys. Present value of cash inflows minus present value of cash outflows, or else, I always suggest with this, present value of net future cash flow. That is, if there is any outflow in between the year and all, we will adjust it there itself. Minus initial cash outflow or initial investment. I will explain it along with the question. Yeah, you can see a company has invested 8 lakh in the business and expects a series of cash flow as per given information. So first, second, third and fourth year, what is the cash inflow they have given? Also cash outflow they have given. Initially they are investing 8 lakh. That is as on today. As on today is always a zero period, guys. That is 8 lakh today is equal to 8 lakh. Means 8 lakh is equal to 8 lakh today. Yes, so. Additional cash outflow is there also there. Yes, so can I calculate what is the net cash inflow? Yes, so for the first year it is 2.5 lakh, second year 420 minus 1 lakh 5,000, 3 lakh 15,000, 3.15 lakh. Then 3.5 lakh for the third year and fourth year it is 2 lakh 40,000. Net cash inflow I call it as. At the end of fourth year, company made a sale of scrap for 2 lakh 40,000. Okay, that means fourth year. We have to add 2.4 also again. Cash inflow. Yes, scrap is nothing but cash inflow. And realized 30,000 from working capital. Okay, we have to add this also 0.3 lakh. Find the net NPV if required rate of return is 10%. Guys, come on. First, we have to calculate net cash inflow. How much is that? I already told. First year 2 lakh 50,000. Yes, so. Second year it is 420 minus 1 lakh 5,000. 3 lakh 15,000. Then third year it is 3 lakh 50. No other outflows are there. 3 lakh 50. Then fourth year important 250 minus 10 plus 240 scrap value plus 30,000. It is 510. 5 lakh 10,000. Then what is the required rate of return? 10%. So present value factor or discount factor we have to calculate at 10%. How is it, sir? 1 divided by 1.10. Give me 3 decimal. 0.909 is equal to 8 to 6 is equal to 683. Multiply. Individually you give me quickly. 2,50,000. Each one of you do for each year. So first year 2,50,000. 27,250. Second year
263,160.
263,160.
262,955.
262,955. Last year 3,48,330. Total please. Present value of all net cash inflows. $10,98,851. So 10,98,851 is the present value of future cash flows minus initial investment is 8 lakh. So what is the NPVs? 2,98,851. Positive, yes. Can we go with it? Yes. Whenever NPV is positive, we can go with it. If they ask any comment, conclusion and all, we just give it. Yes. And sir, can we do it in any other way? See, this is like I have tried to consider everything. May not be, for example, especially scrap value, working capital recover, realized of working capital and all may not be there in every question. Yes, so if at all if it is there, how to consider it? Then even cash outflow in between the life of the project and all, they may not give it in every question. If at all if it is there, how to consider it? Alternatively, we can calculate like this also, guys. We will find out present value of all the cash inflows even after considering 240 and 30,000 for last year, and present value of cash outflows. Present value of cash outflow. Then deduct each other. At the end, you will get same only. But this will be little time taking if you are doing it individually. So better go with net. Whatever net cash flows we have calculated, go with that. Yeah. Yes. And whenever we are calculating NPV and all, guys, if they are not asked anything, we always assume that whatever is the discount rate or interest rate, same thing will be reinvestment rate. If they have given it in the question, separately the reinvestment rate, then we are supposed to calculate modified NPV. What is it? Under this modified approach, terminal value of cash inflows is calculated using the reinvestment rate, which will be separately given in the question. And it will not be same as discounting rate. If discounting rate and reinvestment rate is same, then we will always go with NPV. And if nothing is given in the question about reinvestment rate, we always do only NPV, not modified NPV. Thereafter, modified NPV is determined with present value of such terminal value. Terminal value is nothing but the future value. Terminal value is nothing but future value of cash inflows and present value of cash outflow using cost of capital as a discounting factor. Guys, first we will calculate terminal value. Means at the end of each year, whatever cash inflows we get, we will reinvest it for the remaining period. We will reinvest it for the remaining period. And at the end of the life of the project, what would be the value of it? That is nothing but terminal value. Terminal is nothing but the end of the life of the project. At that point, whatever is the value of the inflows, which I would have reinvested. Reinvested at what rate? Reinvestment rate. So here R stands for reinvestment rate to the power of n minus t. N minus t means so simple. Assume the life of the project is 5 years. I have earned 2 lakh at the end of second year. So whatever I have earned, I am not withdrawing and taking it home. I am reinvesting it. This reinvestment, whatever I am doing, will grow for another how many years? 3 years. Because the life of the project is only 5 years. So I have earned this at the end of second year. So 5 minus 2, what is the remaining period? 3 years. So 2 lakh will grow for 3 years at reinvestment rate. So modified NPV is equal to terminal value divided by 1 plus k to the power of n, which is nothing but terminal value. As per my example, will be the value at the end of 5th year. We need to calculate the present value of it. Yes, sir. Why? Because initial investment is today, as on today. So when we are deducting each other, it should be for a common base. So we will find out the present value of terminal value first, then deduct initial investment. If modified NPV is positive, go with it. If not, don't invest. If it is negative. Yes, sir. And here, please be careful. K would be different. R would be different, guys. It is not one and the same. It is not one and the same. K is like a discounting rate or interest rate, whereas R is the reinvestment rate. We will do one question on this. For the same question, Find the net present value of the cost of capital is 10%, whereas the reinvestment rate is 12%. Net cash flows I am taking same. It will be same only. 2,50,000. Please keep your calculator ready. 3,15,000. Then 350. Then 5,10,000. Okay, guys, come on. Help me with the numbers. 2,50,000 I have earned at the end of first year. I will reinvest it at the end of first year. So it will grow for remaining 3 years. Total life is 4 years. I have earned this at the end of first year. So I can reinvest it only at the end of first year. So for first year, will I get anything on this? No. Because I am reinvesting. I am earning 2,50,000 itself at the end of first year. So I will reinvest it. And I will earn the return at reinvestment rate how much? 12%. For how many years? 3 years. How much is that? Quickly. 3,51,232. You do 1.12 into is equal to, that is for second year directly, is equal to third year into 2,50,000 into 2,50,000. Same way, 3,15,000 I have earned at the end of second year. I will reinvest and it will grow for another 2 years. 3,136. Then 3,50,000 what I have earned at the end of third year. I will invest and it will grow only for 1 year. That is fourth year. Exactly. Then 5,10,000. As I have earned it at the end of fourth year, will I reinvest it? No. The life of the project itself is 4 years. So I am not reinvesting it. So it will be as it is. 5,10,000 itself is the value at the end of fourth year, guys. Total up 48,368. What is this, guys? Terminal value we call it as, which is nothing but the value of my investments at the end of fourth year. Can I call it as future value also? Yes. So to calculate NPV, I need to find out the present value of it. So as this is the value at the end of fourth year, I need to calculate the present value, for which I have to multiply with present value factor at 10%. That is the cost of capital, discounting rate we have to take, not reinvestment rate for fourth year. So terminal value 16,48,368 into present value factor at 10% for fourth year. Do it. 1 divided by 1.10 is equal to for 4 years. 6830. 6830. So what is the present value of terminal value? 11 lakh 857. 11 lakh 25,857. So 11 lakh 25,857 minus initial investment 8 lakh. So that is 3 lakh 25,857. So what is modified NPV? It is 3,25,857, guys. Sir, we are not getting the same number. Yes, we will not get, because here we had assumed that whatever is the discounting rate or interest rate or cost of capital, same thing is the reinvestment rate. That is why we would have not followed a terminal value and all. Whereas in this question, they have separately given what is the reinvestment rate. Whatever we are earning at the end of every year, we are not withdrawing it. We are reinvesting it at 12%, which will grow for a remaining life of the project, guys. So will we accept this project? Yes, we will accept it.
Will you just minimize it and take a picture? It's not.
Okay, fine. Yes, sir. Next, we'll go to IRR. Yeah, if you just want to click a picture or refer to it, you can just pause the video and do it. Yeah. Now IRR, internal rate of return. The internal rate of return refers to the rate at which present value of cash inflows and present value of cash outflows are equal, or else NPV is 0. Sir, how come NPV? How is NPV? Present value of future cash flows minus present value of cash outflow. When both are equal, what is NPV? 0. So IRR is the rate at which present value of future cash flows is equal to present value of initial investment, or simply initial investment, or cash outflow, or else where NPV is 0. How do we calculate? We will calculate present value annuity factor using the following formula. Initial investment divided by average cash inflows. Second step, find out the present value annuity table for a given period at what percentage value is nearer to our calculated present value annuity factor. So present value annuity factor would be our fourth table. In this table, we have to pick whatever is the value we would have got for that many years, at what rate it is nearest. You may not get exact, what rate it is nearest. No, sir, I want to calculate the exact rate. Can I calculate? Yes. Using interpolation, you can do it. Such percentage will be the approximate IRR, not the exact. To calculate the exact figure, we use the method of interpolation. Yes, how is it also? I will show. Let me explain with an example. Yeah, a project whose initial investment is 18,000 and annual cash flow will be 5,600 for a period of 5 years. Every year 5,600 equal. IRR, find the IRR. Initial investment is 18,000. Every year what is the cash flows we are getting? 5,600. Quickly. 3.214. Yes, sir. This is what? Present value annuity factor. What is the life of the project? 5 years. So up to 5 years, at what rate you find out this rate is, or this derived value is nearer? 3.214. 3.214. 5 years, right? Yes. 5 years. 3.214. Yes, 16%. You can see it is not exact, but nearer. Because when we do like this, exact number we may not be able to get it, sir. Yes, sir. So can I tell approximately 16%? Yes, sir. Sir, no, I want to calculate exactly. Then check in between what it is lying, guys. So can I tell, sir, the value what we have got is in between 16 and 20%? Yes. So I can consider the lower rate as 16% and higher rate as 20%. And guys, sir, how do we know this? Will they give interest table in the question? Normally, they will not give interest table in the examination all, but they will give the present value annuity factor for 4 or 5 percentages. Here, like 3 or 4 or 5, whatever exact number, we may not know it until unless question paper comes. So they may give for just to confuse you. You need to consider only 1 or 2 there. If you want to calculate exact, you will consider 2. But will they give exactly 2, sir? May not. Clear? First, what I suggest is do approximate. Check where is the nearest. So it will normally be in between the 2 percentages. So the lower here, as per my question, is 16%. Higher would be 20%. So if I want to get exact IRR, I can do the calculation using interpolation method. How is it? We will see. So approximately, if you ask me, the rate is 16%. But in bracket, you can mention approximate. If the marks weightage for the question is less, go with this, approximate. No, sir, more, then they are expecting exact answer. How do we do it? Very simple. Annual cash inflows is how much? 5,600. As the cash flows are equal, can we use the annuity factor or annuity concept here, sir? Yes. So I am considering lower rate as 16% and higher rate as 20%. Clear? So check present value annuity factor for 5 years at 16% is how much? 3.2743. 3.4723, na? 2743. 2743. 2743. Same way, I am calculating present value annuity factor for 20% for 5 years. It is 2.9906. 2.9906. Yes. So multiply 5,600 into 3.2743. Quickly, guys. 36.08. Okay, 36. I will keep it. Then at 20%, multiply 5,600 with 2.9906. 747.
136.
Okay, 47. I will give exact numbers. Yes, these are the present value at 16 and 20%. Sir, why did you straight away multiply? Because the cash flows are equal. If not, individually we will do it and add it. Clear? So for example, I will take like this years 1, 2, 3, 4, 5 like this. Then cash flows, then present value factor. Then we will calculate present value and add up everything. We will get the present value at the respective percentage. Yes, guys. Now, what is the formula? Sir, to calculate IRR, exact IRR I want, sir. What is the formula? Lower rate plus present value at the lower rate, present value of cash flow at lower rate minus initial investment divided by present value of cash flow at the lower rate minus present value of cash flow at higher rate. Lower rate minus higher rate. And please be careful, when the rate is lower, present value will be higher. You should know that, or else you will, by mistake, you will apply present value of cash flow at higher rate minus present value of cash flow at the lower rate. We already discussed. Higher the rate, lower would be the present value. Clear? So just keep one thing in mind, you have to get positive figure here. Positive figure, guys. Into higher rate minus lower rate. Here also you have to get positive. Sir, what if I take lower rate minus higher rate? You will get negative. You will get negative. There itself you should know it should be higher minus lower. Lower rate is how much? 16 for me. I am writing 0.16 plus present value at lower rate is 18,336. Initial investment is 18,000. Correct now? Given in the question, where did you get it, sir? 18,000. Divided by present value at lower rate minus present value at higher rate, 16,747 into higher rate minus lower rate. Higher rate is 20, lower rate is 60. Okay. If you just solve this, guys, you have to keep this as it is, 0.16. Numerator 336 divided by 1589 into 0.04. Okay, first finish this part. 336 divided by 1589 into 0.04 plus 0.16. 0. Quickly.
Full answer.
Final.
0.1684.
Which is nothing but 16.84. What is the exact IRR? 16.84%. Clear? I am trusting and I am going with the numbers whatever you are giving.
Yes.
So please make sure it is correct. Clear? Yes, this is exact IRR. I just repeated the formula, guys, to calculate exact IRR. What is the formula we use? First, calculate approximate IRR. Okay, that is, sir, present value annuity factor you get. How do you calculate it? Initial investment divided by average cash flow. Even if the cash flows are not equal, just add up everything, divide it by number of years. You will get average cash flows. And this you find it out in present value annuity table, where the number whatever we have got is nearest at what percentage. That is the approximate IRR. Or else whatever number we would have got may be in between two percentages. Consider one as lower rate and the other one as higher rate. And find out the present value at each rates, whichever you have taken as lower rate and higher rate. Then apply this formula. Lower rate plus present value at lower rate minus initial investment divided by present value at lower rate minus present value of cash flows at higher rate into higher rate minus lower rate. Yes. Then, I guess one more question is there. Company A is proposed to install a new machine costing 16,200. So initial investment is 16,200. Having an economic life of 3 years. The annual cash inflow shall be 8,000, 7,000, 6,000 in the respective 3 years. So they are not equal. So what should we do, sir? Average you calculate. How do I calculate average, sir? 8,000 plus 7,000 plus 6,000 all divided by 3. 7,000. So now calculate 16,200 divided by 7,000. 2.314. What is this? Present value annuity factor for 3 years at dash percentage. At dash percentage. So 2.314. 2.314. Oh, just. Okay, sir. What is the year? 3 years, right? Yes. So at the 3 years, you try to find out. 2.314. Okay. So if you want to tell approximate, wherever it is near, you see. Sir, 2.2832 is nearer. 2.3216 is nearer. 3.3216. So what is the approximate IRR? 14%. Approximate. No, sorry, I want to calculate exact. Then take 14 as lower rate, 15 as higher rate and calculate like however we did it. But here you cannot use annuity concept to calculate present value. So how should we do? I am just showing it here. Okay. So you will take 14 and 15%, guys. 14 would be lower rate and 15 is higher rate. So cash flows we know 876 na 8,000, 7,000, 6,000. You have to do individual present value calculation. Clear? Multiply it with present value factor, you will get present values. So the present value at 14% would be this value, present value at 15% would be this value. Take it accordingly. That's all. That is to calculate exact IRR. You will apply the same formula. Yes.
So to find out the nearest IRR.
Yeah. So nearest IRR it is 14%.
Is it okay if it is more than the actual listing 2.314? In the table, that 14% of this thing was higher than this one. So is that okay?
314. See, wherever you are getting, for example, if I take 13%, it is too far, sir. Okay, wherever it's near, we are taking 2.314. So it is not exact. I'm not telling 14% is exact. We are approximately giving it. If I want to calculate exact, then where does this 2.314 falls? In between 14 and 15%. In between 14 and 15, so take them as lower rate and higher rate. Yes. Next, similar to modified NPV, we have something called as modified IR. That is when reinvestment rate is different. So here, how do we calculate it? First step, present value of cost we have to calculate. Present value of cash outflows or initial investment, which is already given in the question. It will be given. Then step 2, terminal value, which like however we discuss same way. So it is like whatever cash flows we are earning at the end of each year, we will reinvest at reinvestment rate for the remaining life. Okay, sir. Then find out the present value of terminal value. How do we calculate it, sir? Terminal value divided by 1 plus MIRR. At that rate, it will be equal to the power of N. So we know that at IRR, present value of cash investment or the initial investment should be equal to present value of terminal value. I repeat, at IRR or here modified IRR, initial investment should be equal to present value of terminal value. So here, using this formula, we will try to figure out what is MIRR. It is nothing but this concept, guys. Present value, how I will calculate? Future value divided by 1 plus R to the power of T. We learned it now? Yes. So here future value is nothing but terminal value. And R what we are calculating is nothing but MIRR. And present value here is nothing but initial investment. This two should be equal at MIRR. That is modified IR. That is the concept behind this formula. Now whatever we get here, find at what rate the derived value is the nearest in future value table. Not annuity table, only future value table. Yes. For n years. N will be given in the question. We need to find out. Nearest. Yes. Modified NPV or modified IRR may be used to resolve the conflict in ranking of the alternate projects under NPV and IRR methods. Here, R is the reinvestment rate, K is the cost of capital, and N is the life of the project. Yes. We will quickly do this. Yeah. Modified IRR. I am explaining. Srivatsa Limited is evaluating a project that has the following cash flow stream associated with it. Here 0 means today. Okay, 140 we are making initial investment. Then at the end of each year we are getting 10, 20, 60, 80, 90 and 100. Reinvestment rate is 15%. Find MIRR of the project. So cash flows at the end of each year we are taking inflows only 20, 60, 80, Be ready with the numbers 90, 100. Working 10 rupees or 10 lakhs, whatever it is. It will grow at 15% for remaining life. So I am earning this at the end of first year. So I will reinvest it for remaining 5 years.
Yes.
Correct. N is totally 5, 6 years minus T. T is like that will be at what point you are reinvesting it. That is first year. So it would be 5 years. That is 6 minus 1. Come on guys, quickly. Vishnu.
2.114.
No, you will get more than
20.
20 point. Come on, quickly.
114.
114. Then 20 into this will grow for remaining 4 years.
34.98.
34.98. Then 60 into, I'm straight away writing 1.15 to the power of 3. Next. 105 point? Sorry?
103.5.
100. Whatever I earn at the end of the life, I am not reinvesting it because I have got that at the end of the life. Add up everything. Terminal value. $455.64. What is this? Terminal value at the end of 6 years. Can I calculate the present value of it? Yes, so. Okay, guys. Present value of cost. How much is my initial investment? 140. 140. What is the terminal value? 455.64. Can I calculate present value of it? Yes, sir. Which is nothing but 1 plus r to the power of n. But here, instead of r, I am writing it as MIRR, modified IRR, to the power of 6. N is 6. Okay, I am taking it to the other side. So 1 plus MIRR to the power of 6 is equal to 455.64 divided by 140. So 1 plus MIRR to the power of 6 is equal to
3.25.
256 to 3.2546. Find out in future value table. Future value, first table. 2 point, how much we got? 2.54. Come on guys, be at 2546. 2546. 2546.
If 3.
Yeah, 3.2546. What is the n here? What is n? 6 guys. So I have written here 6. Yes, sir. At what rate for 6 years we are getting the nearest value we have to take it? Yes. So 6 I am trying to lock it. Yes, sir. So 3.2546. 3.2546. Nearest is 25. Sorry, 20%. 6 years, right? 6. Okay, sorry. It is 3.2546. It should be 24%. 24%. 6 years, not 7 years. It is 6 years. 3.635, not exact, but again nearest. 24%. Now, sir, if I want to calculate exactly, you can see 3.2546 falls between what? 20 and 24. So, if I want to calculate exactly, can I do it, sir? Yes. Lower rate would be how much? 20. Higher rate would be 24%. Lower rate, higher rate, and you will do the calculation using the same formula. Yeah. So, approximately, if you ask me, it is 24%. Approximately. Approximately, MIRR is 24%. For this question also, can we do the exact calculation, sir? Yes, same way I told you, lower rate. You will apply the same concept, whatever we did here, by taking lower rate as 20%, higher rate as 24%. Yeah. Let me proceed further. Then profitability index. And guys, whenever reinvestment rate is different, we have to calculate. That is either if they have asked NPV, it is modified NPV. If they have asked IRR, it is modified IRR. So first thing there is we have to calculate the terminal value by considering reinvestment rate. Then profitability index. Profitability index is equal to present value of future cash flows divided by initial investment. Yeah. So similar to however we calculate NPV, but in NPV calculation we deduct each other, but here we are dividing each other. We are dividing each other. Yes. Then considering all these three, what is the decision rule, sir? If NPV is positive, accept, negative, reject. If it is zero, indifferent. Whereas IRR, if IRR is more than K, accept it, less than K, reject. K is nothing but cost. Okay. If it is exactly equal to K, indifferent. Then profitability index, if it is more than 1, accept it, less than 1, reject it, or in decimals, reject it. If it is exactly 1, indifferent. Yeah. In case of more than one project or proposal, the project with higher NPV or IRR or profitability index, we will choose that. Whichever project is giving the highest. But, sir, will we always make decisions based on NPV or IRR, or which is the most popular one, sir? NPV. But sometimes, guys, when it is like 2 or 3 projects, assume we have 2 projects. Assume for project A, IRR is more, even NPV will be more. Both ways, if I am making the decision based on IRR or NPV, both ways I will choose one project only. Majority of the times. But in few cases, IRR and NPV will be giving conflicting results. That means, assume as per NPV, it is project A. Whereas as per IRR, it is project B. Sir, why is it? Then now I am confused. Which one should I select? Both are decision making criteria for me, NPV as well as IRR, but they are giving different results because of disparity. Sir, what is that disparity? We will see now. In case of mutually exclusive projects, financial appraisal using NPV and IRR methods may provide conflicting results. Normally, they will give same. For example, if I am choosing project A as per NPV, even as per IRR also project A only. But in the following cases, it will have conflicting results. They will not go with the same. What are those, sir? Difference in timing or pattern of cash inflows of the alternate proposals. We call it as time disparity. For example, you can see here, project A initially is giving less, later it is giving more cash flows. Whereas project A initially it is giving more, later it is giving less. So can I make the decision based on NPV or IRR, sir? No, we cannot. So in that case, what do we use, sir? We will use modified NPV or modified IRR. Whenever there is a time disparity, we will make the decision based on either modified NPV or modified IRR. Because here we will consider reinvestment rate and all. Simple logic, guys. Because here, assume 12 lakh I will invest at the end of first year. It will grow for remaining 3 years, 12 lakh. Whereas 3 lakh I will earn at the end of first year, which I will reinvest for the remaining 3 years, it will grow. When compared to E, this is like project B. So when compared to A, which amount will grow more? B. Because first itself I have earned more and I will reinvest it and I earn the return for the remaining 3 years also. Clear? So reinvestment rate has to be considered and decision has to be made based on modified NPV or modified IRR. Next, difference in the amount of investment, size disparity. Initial investment itself is different. Yes, sir. So you can see this, we will take this project B. Initial investment for project A is 15 lakh, whereas for project B is 25 lakh. It need not be same number, like 15, 25, any number, but it is not same. For example, project A, 10 lakh, project B, 15 lakh. Initial investments are not same, sir. We call it a size disparity. When there is size disparity, we will make decision based on incremental approach. What do we do there? Find out the differential cash inflows between the two proposals, both cash inflows as well as cash outflow, incremental. That is the differential we will calculate. Yes, sir. Calculate the IRR of the incremental cash flows. That is the difference. Clear? Yes, I will show it along with the example. Then, if IRR is more than the cost of capital, the project with greater non-discounted net cash flows, that is before you applying present value calculation and all, whichever project has higher cash flow, we will choose that. Sir, what if IRR is less than cost of capital? We will not choose both. Okay, because both will not give us any benefit. Yes. Last one. Difference in the life of the alternate proposal. That is, N itself is different. Life. One project 3 years, another project 5 years. Like this. You can see. In that case, we call it as life disparity. Yeah. So decision is based on what? To resolve such conflict, compare the alternatives on the basis of their equivalent annual benefit or equivalent annual cost. If cash inflows are given, we will go with equivalent annual benefit. If expenditure or cost is given, we will go with equivalent annual cost. Not both for the same question, any one will be there. And select the alternate with higher EAB or lower EAC. EAB means benefit, na? So go with higher. EAC means cost, na? Go with whichever is low. How do we calculate it? EAB is equal to NPV into capital recovery factor, which will be given in the question, or NPV the other way, divided by present value interest factor of annuity at K rate for n years. Equated annual cost is equal to present value of cost divided by present value interest factor of annuity at K rate for n years. Yes, I will explain this along with the question. Yeah, question example on size and life disparity. Investment 50 lakh and 75 lakh, size disparity. Initial investment is not same. Yes, sir. Net cash inflow 62 lakh 50 and 91 lakh 50. Only 1 year. Fine, sir. So differential cash inflows we will find out. Or cash inflows as well as cash out. What is the difference? Yes, sir. And they have given some more information. K is 10%. NPV and IRR of the project are calculated and it has been found that NPV of A is less than NPV of B. Okay. If I am going with as per NPV, I will choose project B. Then IRR of A is more than IRR of B. So if I am going as per IRR, I will choose project A. Yes, sir. Now I cannot choose both. Assume it is a mutually exclusive project. Sir, as per NPV B, as per IRR it is A. I am confused now. It is giving conflicting results. Okay. So there is a conflict in results. So differential cash outflow we are finding, that is 75 minus 50, 25. Then inflows, differential 9150 minus 6250. So you will get 29 lakh. So at IRR we know present value of cash inflows is equal to present value of cash outflow. So anyway cash outflow is 25 lakh, 25 lakh, which is equal to today only because it is at 0 period. Yes, sir. Whereas cash inflow I will earn only at the end of first year. Sir, you told only 1 year, no sir? Yes, that we will not earn today only. We will earn it at the end of first year. So whatever the differential cash inflow is there, 29 lakh, it is at the end of first year. So can I calculate the present value of it? Yes, sir. 1 divided by 1 plus R to the power of n. R here is nothing but modified IRR. Yes, sir. Yes. So now let me take it to the other side. So 1 plus R to the power of n is equal to 29 lakh divided by 25 lakh. Quickly. 1.16. So if I take, as it is only 1 year, it is easy. If not, we have to find it out in the table, but here it is easy. So it is 16%. That is 1.16 minus 1. It is 0.16 or 16%. 16%, guys. Now 16%. Sir, is it more than K? Yes, K is 10%. Which project will we choose? Whichever project is having higher cash flows before discounting. Higher cash flow before discounting. We will choose which project? Project B. Okay. Then coming to investment 50-50, same. Whereas cash inflows you can see only for project P, only 1 year, 75 lakh. Whereas project Q, 20-20, 70. Life disparity. Whereas the life of project P is only 1 year, whereas project Q is 3 years. K is 12%. It is found that there is a conflict in ranking of the project under NPV and IRR. The reason may be attributed primarily to unequal life, that is life disparity. Suggest which project is better as per the above information. They have given the information about what, guys? Cash inflows. So we will calculate equated annual benefit. Sir, here initial investment is given. Yes. See, when do we calculate equated annual cost is for each year they have given what is the cost. We have one question on it. We will see that. Okay. So first we will calculate NPV, guys. Present value of cash inflows minus initial investment. Quickly, come on. For project P, it is 75 lakh into present value factor at 12%. 1 divided by 1.12. 1 divided by 1.12. 892. This will give us present value of cash inflow minus initial investment 50 lakh. How much? Guys, come on.
1696.
1696
4 to 8.
40.
4 to 9.
4 to 9. Be quick. Okay. Next, project Q. This is like more 3 numbers are there. 20 lakh into 0.892. This is for first year. Same way. 20 lakh. 20 lakh into present value factor for second year at 12%. 1 divided by 1.12 is equal to, that is for first year, is equal to second year. 79 plus another cash flow is there. 70 lakh into third year is equal to again third year present value factor at 12%. 711. This will give us present value of cash inflows minus cash outflow 50 lakh. 50 lakh.
21 lakh. 21,000. 268.
What is this?
No, I'm telling the total amounts.
All this put together. Okay, minus 50 lakh.
Yeah.
Already you have done that also. So for NPV is 21 lakh 21,000. Okay, 21 lakh 21,268. If there is any difference, please let me know. Guys, please be careful. Each year I am multiplying with present value factor. Each year I am multiplying with present value factor and I am adding. We will get present value of cash inflows minus initial investment. Any difference? Guys, cross check. Or else students will be like, sir, you are done wrong. For adding, you can use M plus feature. Same. Quickly check it now. Online students, anyone give your answers? Sir, aram se we are sitting and watching, sir. Don't disturb us.
33 lakh. 62.
33 lakh. Somewhere I got doubt. That is why I waited. If not, I would have proceeded further.
55,000.
33.
Lakh. 55,000.
That's all. First one is correct, na? Project P. Project P is correct.
1690.
Quickly, guys. Project P, you check. 75 lakh into 0.892. First one is anyway easy. Quickly. 90,000 or 96,000?
90.
Guys, come on. You should save my time. Everyone participate. See, even if by chance if one person goes wrong or one decimals, so that if everyone are participating, immediately you can correct the other. If not, we will be going with wrong answers only. Yeah. Listen. Next. So we have got the present NPV of each of the products. Next, how do we calculate equated annual benefit? NPV divided by present value of interest factor of annuity for K rate at N years. Yes, sir. So for first project, it is 16,90,000 divided by present value of annuity factor for N years at K rate. What is K year? 12%. What is the period? N is only 1 year. Yeah, at 12% for 1 year. You can also find it in calculator. I'm just showing present value of annuity in last table. 12% for first year. It is 0.8929. 8929. 8929. Quickly.
18 lakhs.
Sorry?
18 lakhs.
18 lakhs. 705. This is on an average 709. 709. This is the per year benefit. Clear? Yes, sir. We got actually 75 lakh. No, sir. Yes, but that is at the end of the year. We are calculating equated annual benefit even after considering the initial investment. Yes, sir. So divided by now. Q for life is 3 years. So at 12% for 3 years. For 3 years, 2.4018. 2.4018. 13 lakh. 869. Okay. Which project is giving us higher equated annual benefit? Project P. So which one will we accept? Project P. Why? Because we have unequal life, guys. Next, sir, what if cost information is given in the question? Quickly see here. Cost of machine 1, 75,000. Life is 5 years. Every year, 75,000 is initial investment. Plus, every year we are supposed to incur 12,000. For how many years? 5 years. Then cost of machine 2 is 50,000. Initial investment. Life is 3 years. Again, unequal life. You can observe here only. Yes. Annual operating cost is 20,000. Cost of capital is 12%. So every year for this project also we have to incur 20,000 even after doing initial investment. So here we are supposed to calculate what? Equated annual cost. Yes, sir. Present value of all the cost equal annual operating cost into present value interest factor annuity. Why, sir? Because the amounts are same every year. So can I use the concept of annuity? Yes. Plus initial investment. So for machine 1, it is every year we are incurring 12,000. For how many years? 5 years. At what rate? 12%. So at 12%, what is the present value annuity factor? Present value annuity factor for 5 years at 12% we need to calculate. Using calculator, how to do using M plus and all, I have already taught. I am straight away going. So it is for 5 years. No, 3.6048. 3.6048. This will give us the present value of all the expenses which I will incur at the end of every year. Plus, today also I am making some investment, 75,000. 1,18,000. 257.6 or 258 you can do. Yeah. This is for machine 1. Same way for machine 2. So how much we are incurring every year? 20,000 into present value annuity factor for 3 years at 12%. It is 2.4018. 2.4018 plus today I am investing 50,000. 036. This is the present value of all the cost which I am incurring to this machines today plus whatever expenses I will be incurring at the end of every year. So now machine 1 equivalent annual cost. Sir, what is my total cost? 1,18,257. The present value of all my cost divided by PVIFA, which we already done, 3.6048. 806. This is on an average per year. This is the cost of having machine 1. Machine 2.
40.
Sorry?
40.
40,818. So as we have done equated annual cost, we have to choose whichever project is having lower equated annual cost. So we are going with machine 1. Machine 1, guys. Yes. Next, risk and uncertainty. Uncertainty refers to the outcomes of a given event which are too unsure to be assigned probabilities. Means, sir, we are not even able to give probabilities for it. Whereas the risk refers to the unique outcomes for a given event which is assigned probability, where we can assign the probabilities. For example, sir, in the best possible case, I can get 10,000. What is the probability of it? Maybe 0.5. Sir, in the worst case, I can earn only 2,000. What is the probability of it? 0.3. In an average case, I can earn 6,000. What is the probability of it? 0.2. So can I assign at least probability? Yes, that is called risk. No, sir, I cannot even assign the probability, then it is uncertainty. In investment decisions, cash outflows and cash inflows over the life of the project are estimated, and on the basis of such estimates, decisions are taken following some appraisal criteria, that is NPV, IRR, etc. Risk and uncertainties are involved in estimation of such future cash flows, as it is very difficult to predict with certainty what exactly will happen in the future. Therefore, the risk is referred as the variability in actual returns in relation to the estimated return. So, for example, sir, I had expected that my return would be 6,000, but actually earned only 3,000. So, is there any variation? Yes. So, the chances of not earning what I had expected is called risk. The chances of not earning what I had expected is called the risk, guys. Capital budgeting techniques under uncertainty. Risk can be defined as the chance that the actual outcome will differ from the expected outcome. Uncertainty relates to the situation where range of differing outcome is possible, but it is not possible to assign probability to this range of outcomes. There are three different types of project risk to be considered. What are those? Standalone risk. This is the risk of my project. Assume I am investing in project A. This is the risk only associated with project A. Next, corporate or within the firm risk. Assume in a company there are 5 different projects. If there is any risk associated with all these 5 projects, means for a company as a whole, we call it as corporate risk. Clear? That is the risk associated for a company, and within the company there might be 5, 6 projects, whatever number of projects. For everything it is associated. Then market or systematic risk. Market risk is essentially the stock market assessment of a firm's risk, its beta, and this will affect the entire market. Not my company or only not my own project. It is for the entire industry or the economy as a whole or for a country as a whole. Due to practical difficulties of measuring corporate and market risk, the standalone risk has been accepted as suitable substitute for corporate and market risk. There are following techniques which we can use to deal with the risk in investment appraisal, guys. General techniques are risk adjusted discount rate or certainty equivalent approach, whereas quantitative techniques are under that statistical probability approach or measures of dispersion, standard deviation or coefficient of variation. Whereas other techniques are sensitivity analysis and decision tree analysis. So risk adjusted discounting rate method means we are adjusting the risk of the project with the discounting rate. Higher the risk, higher the discount rate. Lower the risk, lower would be the discounting rate. So risk adjusted discount rates method is used in investment and budgeting decisions to cover time value of money, and risk is adjusted with the discounting rate. The use of risk adjusted discount rate is based on the concept that investors demand higher returns from the risky projects. So higher the risk of the project, higher would be the discounting rate. Lower the risk of the project, lower would be the discounting rate. So that means risk we are adjusting in discounting rate. So how do we calculate it here? Risk adjusted discounting rate, risk free rate plus risk premium. Higher the risk, higher would be the premium. Yes, sir. Then how do we calculate NPV? Simple. So we will first find out the cash flows divided by 1 plus k to the power of t, which is nothing but the present value of cash flows. So sum up everything. The present value of all the future cash flows minus initial investment, which is nothing but our regular NPV formula here. Don't worry, sir. Summation and all you have used nothing. We have to multiply present value with the present value factor. Now present value factor we will calculate at what rate? Risk adjusted discount rate. So we will multiply both and we will get present value. Add up all the present value. Deduct initial investment from it. We will get the NPV. Yes, you can just see I have given it as an example here. So this rate they would have given, assume it is 12%. So present value factor we will calculate at 12%. Multiply that with cash flows, you will get present value of cash flows. Okay, so once you take the total, deduct the initial investment, you will get NPV. Nothing special here. We would have adjusted the risk in the discounting rate. That's all. And that rate will be given in the question straight away. If at all, if there is any question on this, don't worry. Next, certainty equivalent approach, CE approach. This is another method of dealing with risk in capital budgeting in order to reduce the forecast of cash flows, estimated cash flows to some conservative level. Certain cash flows means estimated cash flows, we will apply the certainty equivalent and we will try to reduce it to certain cash flows. And this certain cash flows, we will multiply it with present value factor at risk-free rate. Risk-free rate to find out what? Present value. Okay, sir. So this is the important thing here. We call it a certainty equivalent coefficient. and it always lies between 0 and 1, and it varies inversely with risk. That is, for the initial year it will normally be more, and for later year it will be less. Why, sir? Because the risk will be more for the later years. Clear? Because when it comes to future 3 years, 5 years, 6 years down the line and all, risk will be more. Whereas at the end of first year, second year and all, comparatively it will be less. So first, what do? I will just explain with an example. We will reduce the estimated cash flows to certain cash flows. Sir, how is it? Multiply estimated cash flows with certainty equivalent coefficient. And you can observe it will always go in a decreasing. For initial year, it will be more, later year less, because the risk for the later years will be more. So certainty equivalent approach coefficient will be less. So you can see certain cash flows we will get, multiply that with present value factor at risk-free rate. Here we are taking risk-free rate. Why, sir? Because the risk we have already considered here. We already associated risk with the certainty equivalent coefficient. So we are calculating the present value factor at risk-free rate. To confuse you, they may give different rates also. But please be careful. Present value factor or discounting factor, you have to take it at risk-free rate. Then multiply certain cash flows with present value factor, you will get present value. At the end, total it up, and from this deduct initial investment, you will get the NPV. If it is positive, go with it. Sorry, what if they have asked for 2 projects? Whichever project is having higher NPV, you will go with it. You will go with it. So you can observe, there I explained it in the table form. Here I have given it in the formula way. First, we have to calculate certain cash flows. Sir, how is it? Alpha. Alpha here is nothing but certainty equivalent coefficient into estimated cash flows. You will get certain cash flows. Find out the present value of it. How is it, sir? Divided by 1 plus k at risk-free rate to the power of t. To the power of t. Or else you can multiply with present value factor. Straight away you will get it. Yes. Find out the summation of it. That is, add up all the present value. Then deduct the initial investment. I have also mentioned here, certain cash flows is nothing but estimated cash flows, which will be given in the question into certainty equivalent coefficient. This will also be given in the question, guys. Next, probability assignment. Probability may be defined as the likelihood of occurrence of an event. Means, what is the chances of happening? What is the chances of happening? If the event is certain to occur, the probability of its occurrence is 1. Sir, I am very sure it will happen, sir. What is the probability? 1. Sir, I am very sure it will not happen, sir. What is the probability? 0. Sir, I am like, okay. Or I don't know exactly. Will it happen or not? I have also some dilemma. I have some confusion. Then it will lie between, probability will lie between 0 and 1 in decimals. So the probability of all the events to occur lies between 0 and 1. Probability estimate, which is based on the large number of observation, is known as objective probability. Such probability assignments that reflect the state of belief of a person rather than objective evidence of a large number of trials are called personal or subjective probability. If the probability depends on my belief, which is always subjective, correct? Because what I believe, you may not believe. What I assume, you cannot assume. So different things. So for each person, it would be subjective. Whereas if it is based on large number of observations, then it is called objective probability. Next, expected NPV. Expected NPV. Once the probability assignments have been made to the future cash flows, the next step is to find out expected NPV. Similar to NPV calculation, but here we are using the word expected because we also use the concept of probability here. It can be found out by multiplying the monetary values, that is nothing but the cash flows, of the possible events with their respective probabilities. The following equation describes the expected net present value. How is it, sir? First, we have to calculate expected net cash flows. How is it? Cash flows into its probability. Sir, what if I have multiple? You have to add up. For example, assume, sir, for first year, I am expecting that 10,000 can be my cash flow. Probability is 0.5. Then, sir, 3,000 might be my cash flow. Probability is 0.3. Then 1,000 may be my cash flow. Probability is 0.2. So if I multiply and add up everything, I will get estimated cash flow or expected cash flow for year 1. So these are nothing but probabilities. Sir, will all 3 happen? Definitely not. All 3 will not happen. Will I earn 10 plus 3 plus 1, sir? No. Either of these 3 or in between this I will earn, but I am not sure how much I will earn because this depends on the future. So what are we doing is, I am multiplying the respected estimated cash flow with the respective probabilities. And we will add up everything, we will get estimated cash flow. And using this estimated cash flows, we will calculate estimated NPV or expected NPV. So what is the formula to calculate expected NPV? Estimated net cash flow divided by 1 plus K to the power of t, which is nothing but present value. Sir, can I straight away multiply with present value factor also? Yes, instead of dividing by 1 plus K to the power of t, you can also multiply with present value factor minus initial investment, where estimated NPV is the expected NPV or estimated NPV, or ENCF, that is expected net cash flows in a period t, and K is the discounting rate. I will explain this with the next question. Yeah, so even in this expected NPV, we are considering the factor of probability. Okay, that is like, sir, how do we calculate expected cash flows using the concept of probability? Okay, see, the data is given for 3 years, year 1 to 3. Year 1, what are the estimated cash flow? Expected 2000, 3000 and 4000. Will I earn all 3? No. What is the probability? So probability of earning 20,000, sorry, 2000 is 0.2, that is 400. Then what is the probability of earning 3000? 0.5, which comes to 1500. What is the probability of earning 4000? 0.3. How much? 1200. So what is the expected value for the first year? 100. Yes. Next, year 2 also. Am I earning all 3? No. We are just checking the possibilities. What is the probability of earning 3000? 0.4. Then what is the probability of earning 4000? 0.3. 1200. What is the probability of earning 5000? 0.3.
3,900.
Next, third year. These are different years. Okay. So what is the probability of the earning 1200? 0.3.
360.
Then what is the probability of earning 1200? 0.5. What is the probability of earning 1500? 0.2.
160.
You are telling total already. 1260. Now these are nothing but like our cash flows, guys. Okay, here we have used the concept of probability, nothing up and down, one difference in each concept, that's all. We have calculated the expected value or cash flows at the end of every year. Take it here. So 3100, 3900 and 1260. Present value factor, what is their K? They have given it as risk-free rate. Sir, why risk-free rate? Because we have already considered risk here in probabilities. Again, will we consider risk in the rate? No. So while calculating present value, we should take what rate? Risk-free rate. Sir, in the question, what if they have given some other rate also like 12-15% and all? Please ignore. Please ignore. And for this concept, okay, so when it comes to certainty equivalent and the probability or estimated or expected, there already we would have considered the risk. So the rate what we take to calculate present value should be the risk-free rate. Give me the present value factor at 10%. 1 divided by 1.10 is equal to
09.
Next.
51.
Multiply quickly. 2818. 2818.
3223.
No.
3223.
946.
Sorry?
947.
947. Total.
9.
6988. We are getting negative 12. So should we go with it? No. As the NPV, expected NPV is negative, we need not, or I don't suggest investing in this project. Is that clear? Yes. Next, standard deviation. This is the way how do we measure the risk. Standard deviation coefficient of variation. Standard deviation, which is denoted by sigma, is considered as the best measure of dispersion or variability. Sir, how will my actual return vary from my expected return? I value of standard deviation indicates what? Higher variability, which means higher risk. Higher variability means higher risk. As future cash flows cannot be estimated with certainty, it involves risk. Therefore, risk in investment analysis can be measured by using standard deviation. Investment proposal with lower standard deviation will be preferred. So if I am going, see, when it is written, IR is always better. NPV also IR is better. IRR also is IR is better. Profitability index is also IR is better. But here risk, okay. So risk is always less is better. Clear? But still, we already learned, sir, higher the risk, higher the return. So considering both, we have one more measure, which is coefficient of variation. We will see it. But standard deviation, we are measuring only risk. Okay, sir. How do we calculate it? We have formulas. Square root of summation of x minus x bar square whole divided by n. That is when life is given. Or, sir, when probability is given, what should we do? The formula will slightly change. X minus x bar square into probability. Into probability. Into probability. This is the formula, sir. Yes. And standard deviation will always be absolute measure, guys. It is always absolute measure which will measure only the risk. They will not consider the return. Whereas coefficient of variation, what do? Standard deviation divided by mean. Mean is nothing but mean of returns. Or it's standard deviation divided by NPV. So they are considering risk as well as return both or cash flows. So standard deviation is the absolute measure of risk analysis. It can be used when projects under consideration are having same cash outflows. If the projects are compared involve different outflows or different expected value, that is cash inflows, the coefficient of variation is the correct choice, being the relative measure. Okay, considering both risk as well as return, if I have to make the decision, I will always go with coefficient of variation. And in the exam, if they just asked you to calculate standard deviation, calculate and stop it there. If they have asked you to make decisions and all, then better make decisions based on coefficient of variation. Yes, sir. I will just quickly show it. How do we do it? Yeah, find out the standard deviation of project X and Y, guys. See, normally they may, when standard deviation and all is there, they may ask for one project. But if they ask for both the projects, they may also ask you to make the decisions. Clear? Higher, the lower the risk, you have to choose it. Or if it is coefficient of variation, accordingly, we will see it. Yeah, cash flows, they have given 4, 5, 6, 7 and 8,000. So cash flow bar we have to calculate. Sir, how is it? That is nothing but X bar. Okay. So cash flow you can also consider as X. Okay. X bar would be, sir, 30,000 is the total divided by 1, 2, 3, 4, 5, 6,000. So cash flow or CF bar or cash flow bar is how much? 6,000. I am talking about cash flow bar. Okay. So next, cash flow minus cash flow bar or X minus X bar. Or else straight away, sir, can I skip this and straight away go with this? Yes, you can save time. So we will do it straight away like that. So cash flow minus cash flow bar to the power of 2. So 4 minus 6 into the power of 2. Quickly.
40 lakhs.
Do it. 40 lakhs. Save time, save time. If I am investing more time, you have to sit along with me. That is the problem. Matthews, you can also not go before me. Next, 5,000 minus 6,000 to the power of 2. Then 6 minus 6 to the power of 2. 0. 7 minus 6 to the power of 2. Here symbol will not matter because we are going with power of 2. So 10 lakh. So 8 minus 6 to the power of 2. 40 lakh. Okay, now. So multiply that with probability. Multiply that with probability. 4 lakh. 2 lakh.
2 lakh.
So 12 lakh. Total is 12 lakh. So can I call this as summation of x minus x bar to the power of 2 into probability? Yes, sir. Now what is the formula to calculate sigma? So as per my calculation, it would be summation of CF minus CF bar. Sorry, instead of CF, can I take it as x minus x bar also? Work here. Into probability, which is equal to square root of 12 lakh. 109 or 8? 0.95, yeah.
1095.
0.45. 1095.45. You can tell straight away like that. Next, project Y. They have only given various cash flows. Yes, sir. So cash flow bar. Yes, straight away I'm going with this. First, let us calculate CF bar. 40,000 divided by 5. 8,000. Yes, so 8,000. So let us straight away do with this, guys. CF, that is 12,000 minus 8,000 to the power of 2. 1 crore 60 lakh. Next, 10,000 minus 8,000 to the power of 2. So 8 minus 8 is 0. Then 6 minus 8 to the power of 2. Actually, this will always follow the pattern. Next, 160. Here, for this question I am talking about, may not be for every question. 160 into probability. Multiply this two. Multiply the 16 lakh.
0.
16 lakh.
44 lakh. Straight away find out the square root of it. This is sigma of project B now. Project Y.
2097.
One second. Square root of 44 lakh. 2000
97.62.
61 or 62?
62.
62. Okay. This is sigma of x. X. No, X means your alphabet, not yours. So 2097.62. So which is having highest? Y, sir. So if I am going with the risk, only standard deviation, I have to choose what? X. That is project X. Project Y is riskier as standard deviation of project Y is higher than the standard deviation of project X. If you are making decision only based on risk, you will choose project X. But we have to consider the return from each of the project, even the initial investment and all. However, the project Y has higher expected value also. So the decision making has to be done based on coefficient of variation. So NPV I am not doing. So straight away we are doing with expected cash flow as a denominator, or B, that is which is nothing but CF bar. So project X standard deviation is 1095.45 divided by 6,000, right? 6,000. 0.183.
263 also same. 26. It comes to
0.183, right?
Yeah.
Why? 2097. So many confusion mark.
8,000. 8,000.
1 to
262.
262. Which project is having? Sir, for each and every rupee of earning, here, project Y, what is the risk they are taking? 0.262. Same way, for project X, for each and every rupee of earnings or cash flow, they are taking how much risk? 0.183. So you can see, higher the coefficient of variation, the riskier is the project. So can I tell project X is riskier? Yes. Project Y is having higher coefficient, so it is riskier than project X. It is better measure of uncertainty of cash flow return than the standard deviation because it adjusts for the size of the cash flow. So which one will we choose, sir? Project X, because for each rupee of cash flow or for each rupee of earning, the risk what they are taking is less. It is less. So we will go with project X, guys. Fine. So now coming back to this two, sensitivity analysis and decision tree, not so important, but still good to know. The sensitivity analysis means, sir, whenever we are doing NPV, IRR calculation and all, we would have estimated few things like estimated future cash flows, discounting rate I would have estimated and taken. Will it remain same exactly throughout the life of the project? May not be. So if any of this changes, how will it impact my decision? That is called sensitivity analysis. So even a small change in maybe the rate or cash flows, will it affect my decision, sir? Maybe. So that is what is called sensitivity analysis. Then coming to decision tree is like this. Sir, year 1, what are my estimated cash flows? Assume I have 3 possibilities. I have 3 possibilities like 1 lakh, 50,000 and 75,000. Yes, sir. Will I earn all 3? No. We can assign the probabilities for it. Yes, sir. Now this is for year 1. Now year 2 depends on how much I have earned in year 1. Yes, sir. Now year 1, if I have earned 1 lakh, then in year 2 how much? 3 possibilities. Now again same way, sir, in year 1 if I have earned 50,000, then in year 2 what is the possibilities? 3 possibilities. Same way in year 1 if I have earned 75,000, what are the 3 possibilities for year 2? Clear? Same way for year 3, it will continue. This is for year 2. Whereas year 3, under each of this, there will be 3 wings. Clear? And it will keep on continuing. So it is like a branch, that tree, how it opens their branches and all, same way it is like. Again, from exam point of view, not important. This is called decision tree analysis. This is all about chapter 3, guys. Chapter 4 is about cost of capital. This is all about the financing decision. We have different sources of capital available. If I raise the amount through either debt or equity, each source will come with a cost for us. So how do we calculate the cost of each source of capital? And what is covered mainly here is in long-term finance point of view, guys. There can also be a few sources from where I can raise the money for short-term period, but none of them is covered for you in this chapter. So your capital structure may look like this. On liability side, so it is like equity share capital, reserves and surplus and preference share capital. Then debentures and long-term borrowings, we always call it as borrowed capital. See, preference share capital always will lie in between equity and the debt. So can I treat the preference share capital as a debt, sir? Yes. Why? Because we have a fixed commitment. Every year I have to pay fixed dividend, and also we will have a repayment period for it. That is, I have to redeem it at the end of 5th year, 10th year and all. Yes, sir. Now, sir, can I treat it as equity? Only in one situation. That is when it is a convertible preference shares, where we would have given the option to the preference shareholders to convert it into equity after a certain period of time. In that case, can I treat it today itself at par with equity shareholders? Yes, guys. But for the cost calculation and all, it is at par with the debt. It is at par with the debt. Why? Because, sir, we have to pay every year a fixed rate of dividend for preference shareholders, whatever we have already agreed at the time of raising the preference share capital. Yes, sir. Now, only difference between debt and preference is, for debt, we will always calculate cost after tax, because interest is allowed as an expenses for income tax purpose. Whereas for preference dividend is not allowed as an expenditure for income tax purpose. So we never consider tax there. Whatever we calculate is always after tax only. After tax itself, guys. Yes. Current liabilities, the short term finance and all is not covered for you in this chapter, so you need not worry. So these things we already discussed about, guys. How do we calculate all this? I have explained it. Funds required for permanent working capital, for purchasing fixed asset and for the expansion of business is called what? Long-term finance. And in this chapter, how do we get it? And what is the cost associated with it? We will be learning. Factor determining the long-term finance requirement of a business depends on the 3 important factors. Nature of business. If I am a manufacturing company, then the amount of capital what I require would be more, because I have to invest into my capital assets, my manufacturing plant, factory and all. Whereas if I am a trading concern, comparatively what amount I require would be less. I require, but compared to manufacturing company it would be less. Then nature of goods procured. If the business is engaged in manufacturing small or simple articles, it will require a smaller amount of fixed capital. Whereas if it is engaged in manufacturing heavy machines or heavy assets, then the amount of capital what I require is more. Like Adani is involved in shipbuilding. What capital he require and what capital, assume I am a pen manufacturer, what capital I require is not same. Yes, use of technology. So if I am using high-end technology, updated technology and all, the cost involved would be more. Whereas no, sir, I am using some simple technology or labor technique. In that case, the capital what I require would be less, guys. So the cost of capital. Any money what I get will not come freely. It will come with cost, guys. The cost of capital is required rate of return that the firm must achieve in order to cover the cost of generating fund. It is the minimum return that the investors expect for providing capital to the company. How do we measure it? Very simple, guys. Very simple formula. Only one thing you remember. Interest is allowed as a expenditure for income tax purpose. So cost of debt we will always calculate after tax. Whereas cost of equity and preference, whatever we get is always after tax. Is always after tax because that is not allowed as an expenses. Clear? So you need to, sir, should I do anything and all? No, whatever formula we use, it is already a final figure. You need not do anything extra. Okay. Now, when it comes to debt and preference, there is something called as redeemable and irredeemable. Redeemable is which we have to repay after 5 or 10 years. Irredeemable means we never repay. We pay only dividend or we pay only interest. Principal amount we never repay. But as per company law, it is not allowed. But for FM, they can give any kind of questions. Don't question the question. Telling this is not allowed as per company law, so we don't answer it. Clear? So we are a company law students. So in company law, as per section and all, I know in FM you will quote section of company law and all telling it is not allowed. Question is wrong. Please give grace marks. They will tell come again. No, it is correct question. Question is correct. So please answer accordingly, guys. Now, sir, how do we identify whether it is redeemable or irredeemable? Guys, if it is redeemable, they will give in. What is in? Life. It is redeemable after 5 years, 10 years. And also they will give the redemption value. If by chance, if redemption value is not given, assume face value. Assume face value. So please always have one thing in mind. If n is given, redeemable. If n is not at all given in the question, don't assume question is wrong and it is irredeemable. Okay. Cost of debt, irredeemable. Cost of debt refers to the cost of long-term debentures or bonds. How do we calculate it? Cost of debt into 1 minus tax rate. Most of the time interest rate will be given. Take into 1 minus tax rate. That's all. No, sir, I have to calculate, sir. They have not given it. Then interest into 1 minus tax rate divided by sale proceeds or issue price. Any one of them. At what price it is issued. This you will use only if sale price or the issue price is given. If not, we will always go with this. If interest rate is directly given. Yes. Sir, what if it is redeemable debt? In case of debentures repayable after a certain period of time, that is N, the cost of debt is calculated using the following formula. First, we will calculate before tax. I, that is nothing but interest, plus redeemable value minus sale proceeds. That is, what is that extra we are paying? Sir, I took 100 rupees from debenture holders, but I am repaying 110. I am paying 10 rupees extra. And this we have to write off during the life of the debenture. That is why divided by N. And divided by N is only for this part, not I. I is always per year because interest we will pay per year only. So redeemable value minus SP is nothing but what extra we are paying. See, if both is at face value, then nothing you will get it here. Clear? So in my example, I am redeeming it 110, whereas I had issued it at 100. What is that extra I am paying to the debenture holder at the end of 10 years? 10 rupees. And this 10 has to be write off during the life of the debentures. So that is life, assume 5 or 10 years, take that. Clear? Every year we have to write off a part of it. So assume 10 rupees is the extra I am paying. The life of the debenture is 10 years. So every year how much I have to write off? 1 rupee. So along with interest, what is my additional cost? 1 rupee. 1 rupee. I will be paying it at the end of 10 years. But even today itself I know now what is the extra I will pay. So every year, can I book for that extra amount which I will pay to my debenture holders? Yes, a part of it. Total is 10 rupees. A part of it every year I can book it. Assume guys interest is 8 rupees plus 1 rupee. So what is my expenses towards the debenture holders? 9 rupees. This one is nothing but whatever extra I have paid. We call it as premium on redemption. Per year, how much? Okay. Whole divided by redemption value plus sale proceeds. That is issue price. Whole divided by 2. We are calculating average, and this will always be before tax. If I multiply that with into 1 minus tax rate, we will get after tax. So instead of doing it separately, can I straight away multiply year only into 1 minus tax rate? Yes, well and good. Then preference also I will finish because it is very similar to this. Cost of irredeemable preference shares. Irredeemable means it is never repayable. So throughout the life, perpetuity, we pay only in dividend, preference dividend. Irredeemable preference shares are those shares for which the company has no obligation to pay back the principal amount of shares during the lifetime. The only liability of the company is to pay the annual dividends. So cost of preference share is equal to annual preference dividend per year, whatever we pay, divided by market price, if it is given. No, sir, market price is not given. We have freshly issued it as of now. So what do we take? Net sale proceeds after flotation cost. Flotation cost here is nothing but share issue expenses, which will be given in the question separately. We will see the questions later. Yeah, either of the two, we will use it as a denominator based on what is given in the question. Sir, what if both is given in the question? Use both and calculate two separate cost of preference shares. Okay. Next, what if it is redeemable, which is repayable after certain years? N is given. So in that case, similar to this formula, guys, but here into 1 minus tax will not come for preference shares. I already told. Yes, sir. So preference dividend plus redeemable value minus sale proceeds by N. N is only for the second part. Divided by redeemable value plus sale proceeds whole divided by 2. Guys, this N is simple. I have told you whatever extra we are paying, we have to write it off during the life of the preference shares. So every year, how much? Every year, how much? Yes. And here, should we multiply with into 1 minus t? No, because dividend is not allowed as an expenditure. Sales proceeds are issue price, redemption value. Fine. We'll just quickly go through the question. Tuck, calculation. How fast you will give me the answer? Let us see. If the cost of debt for Cowboy Energy Services is 10%, they have already given it. Effective tax rate is 40%. So what is the cost of debt after tax? 10 into 1 minus 0.4. 6%. 6%. What is the cost of debt after tax? 6%. Whether it is given or not, for cost of debt, we should always take after tax. Jain & Co. makes a new issue of 6% irredeemable debentures to raise 1 lakh and realizes the full at face value of rupees 100. What is the issue price? 100. And company falls at 40% tax bracket. Debt are issued at par. Okay. So interest is how much, guys? Let me calculate. Sir, face value is 100. What is the percentage? 6%. So 6 rupees into 1 minus tax rate, 1 minus 0.4, whole divided by sale proceeds, 100. If you want to multiply with 100, you will get percentage. How much? 6 into 6, 0.6. 3.6%. Cost of debt after tax. After tax. Then Jain & Co. makes a new issue of 6%. 1000 irredeemable debentures of rupees 100 each at 10% premium. Issue price is 110. Correct? 10% premium. The company falls in 10%, 40% tax bracket. So how much is the interest? I am going with per debenture. So 100 into what is the interest rate? 6%, 6 rupees. Into 1 minus tax rate, 0.4. Whole divided by sale issue price, 110. How did I get it? 100 plus 10%. Or into 110%. 100 into 110%. Into 100. This is to calculate percentage.
3.27.
Percentage. Cost of debt after tax. Next, Jain & Co. sells a new issue of 6%. 1000 irredeemable debentures of rupees 100 each at 10% discount. Issue price is how much? 90. The company falls in 40% tax bracket. Okay. Same way, guys. So 6 rupees is the interest into 1 minus 0.4. divided by issue price 90. How did I get it? 100 minus 10% or 100 into 90%. 4.4% into 100 also. Into 100. Yes. Sir, you are taking interest and all per debenture. No, sir. Can I do it for 1000? Yes. If you do it for 1000, then 6 into 1000 it would be. Even 90 would be 90 into 1000. Both you have to take for total. Better go with per debenture. That would be easy for you. Yes. A firm issues debentures worth 1 lakh and realizes 98,000 after allowing 2% commission to brokers. So what is the issue price or sale proceeds? 98,000. They carry an interest rate of 10% and are due for maturity at the end of 10th year. N is given. So what debenture it is? Redeemable. The company has 40% tax bracket. Find the cost of irredeemable. So redeemable debt, not irredeemable, redeemable debt. Yes, sir. So cost of debt before tax I am calculating. Interest is 1 lakh into 10%. So 10,000 of 1 lakh into 10%, 10,000 plus redeemable value. Nothing is given means face value 1 lakh minus sale proceeds 98,000. So what is the extra we are paying? We took 98. We are repaying 1 lakh. What is the extra we are paying, Matthews? 2,000. And this I have to write off during the life of the debentures. Whole divided by redeemable value 1 lakh plus 98,000 whole divided by 2. Give me the final figure quickly. Tax part we have not taken. 10,200 divided by how much? 99,000. Or else here I am doing into 1 minus tax rate. How much?
10.3.
Now final. Sure, 10.3. Quickly, man. Come on.
6.18%.
6.18. Cost of debt after tax. Redeemable debt. Yes. Actually, here we have to get into 100 also when we are writing it in percentage.
No.
Any confusion? Sam? Calculate the cost of 10%. Now we are done with debt. We are going to preference. 10% preference capital. What is the preference dividend percentage? 10. Of 10,000 preference shares whose face value is 100 rupees. The market price of the share is currently 115. So per share, what is the dividend, guys? 100 into 10%, 10 rupees. Divided by what is the market price? 115. So 10 divided by 115 into 100 you do. 8.69%. A limited company issues 8% preference shares which are irredeemable. The face value of the share is 100 rupees, but they are issued at 105. The flotation cost is 3, which we have to deduct. Calculate the cost of capital. So annual dividend is how much? 100 into 8%, which is 8 rupees, divided by 105 minus 3. So 8 by 102 into 100. 7.84%. If at the time of issue, if there is any issue, expenses or flotation cost, we have to deduct it, guys. Then a company issues 10,000 8% preference shares of rupees 100 each, redeemable after 20 years at face value. The flotation cost are 3 rupees per share. The cost of preference share capital would be redeemable. It is redeemable. Redeemable value when nothing is given, face value, and they have actually given at face value. Even if it is not given, if by chance if not given, assume it at face value at par. Sale proceeds 100 minus flotation cost 3 rupees 97. Annual preference dividend is 8 rupees per share. That is 100 into 8%. N is 20 years. So if I convert the values now, preference dividend 8 plus redeemable value 100 minus sale proceeds 97. So what is the loss? 3 rupees. I have to write it off over a period of 20 years. 20. Whole divided by 100 plus 97 by 2. No into 1 minus t and all here. At the end, if you can want 8.15 divided by 98.5 into 100. 8.27% cost of preference shares. Clear? Chandramali, how much you are getting? Preference system. Now let us move towards equity. Cost of equity capital. There is no coupon rate in case of equity shares. That is, there is no fixed rate as such. We have not agreed to pay anything as fixed. Further, there is no commitment to pay equity dividends, and it is the sole discretion of the board of directors to pay or not to pay the dividends and at what rate. So, as per, but still, whatever is the expectation of the equity shareholders, we consider it as cost of equity. We have different methods to calculate it. The most important is CAPM model, which keeps repeating in different chapters also. So, how do we calculate cost of equity as per CAPM model? Risk-free rate plus RM minus RF. RM is market return, RF is risk-free return into beta. That is systematic risk coefficient. This we also RM minus RF, we call it as risk premium also. RM minus RF. RM is market return, like on Nifty, Sensex and all. Yes, sir. Into beta. See, why is that additional return I will get? Because I have taken risk. That is nothing but beta. Yes, sir. Next, bond yield plus risk premium approach. Cost of equity is equal to yield on long-term bond plus risk premium. Yes, and this normally they have to get in the question. Next, dividend growth model. How do we calculate the present value of the share? D1, that is dividend at the end of the first year, divided by R minus G. R or K, you can use it. Yes, sir. Now, how can I calculate this R or K? Interchange the position. That's all. So, it would be just interchanging, cross multiplication, cross calculation. D1 divided by P naught plus G, that is growth percentage. Yes, D1 should always be at the end of first year. Then earnings price ratio approach. Earnings at the end of first year divided by P naught. Earnings divided by P naught, guys. Yes, I will discuss the question on all this. If by chance, if earnings at the end of the year is not given, you have to calculate it. How is it? Current earnings into 1 plus growth rate. 1 plus growth rate. Then cost of retained earnings. Expected return foregone by the shareholders on the foregone dividends may be treated as cost of retained earnings. For retained earnings also, actually we don't have any cost. But if I had given this money as a dividend to the equity shareholders, they would have earned something out of it now. So that becomes expectation for me. I have to at least earn that much from whatever amount I have retained and investing in the business. So what is the formula for it? Cost of retained earnings, or KR, which is nothing but cost of retained earnings, is equal to DPS into 1 minus T. So DPS, dividend per share. T is what here? Marginal tax rate applicable to individual shareholders. That is on dividend, whatever tax they pay, which will be given in the question, guys. As per income tax law, dividend is taxable at normal rate under the head other sources. Clear? But here it will be given in the question, whatever rate they have given, take it. Into 1 minus B. B is means what, sir? Brokerage cost, which will be given in the question. If it is not given, ignore it. Okay. Divided by MP into 1 minus TE, not TI, TE. So what is MP? Present market price. TE means what? Capital gains tax. That is when I sell the shares, whatever income I earn is called capital gains income. And on that, the tax rates are different. We consider it as special income taxable at special rate under income tax law. And it will be given in the question, sir, should we know the knowledge of the income tax law? Should we know what is the rate in income tax? Need not be. They will give it in the question. Yes, sir. Or else, if dividend is growing, then DPS plus G, growth rate. You know? Yes, sir. Then cost of retained earnings can be calculated by the above formula after tax cost. Sir, how do we do it? So whatever we calculate, it will always be after tax. If I want to calculate before tax, then whatever we would have got here using this formula divided by 1 minus tax rate. If at all, if they are asked. I repeat, using this formula, whatever we calculate will always be after tax. If you want to calculate before tax, or if they have asked in the question, then whatever we already got above, using the formula, divided by 1 minus tax rate. Not into, divided by 1 minus tax rate. Because we already got after tax, now if I want to go reverse and calculate before tax, this is what we will do it. Yes, sir. We'll quickly see it. Calculate the cost of, ninth one. Calculate the cost of equity capital for a company whose risk-free rate is 10%. Equity market return is 18%. That is nothing but RM with a beta of 0.5. So what is RF here? 10%. So I am taking in decimal plus RM 0.18 minus RF 0.10 into beta 0.5. So first solve this part. 0.18 minus 0.10 into 0.5. First finish that. For whatever you get, plus 0.10. 0.14. Answer is 14% or 14%. Cost of equity. Given the yield on debt is 10% and risk premium is 5%. So what is the cost of equity? 10 plus 5. 15%. That's all. Sir, will they ask this question? Definitely not in the exam. Okay. But still, just to make you understand, that's all. A company has issued 5,000 equity shares of rupees 100 each. Its current market price, that is nothing but P naught, 95. And the current dividend, which is called D naught, is 4.5. The dividends are expected to grow at the rate of 6%. Compute the cost of equity capital. So can we first calculate D1? Because D1 is the one which we used in the formula. So it is 4.5 is the current dividend plus growth rate 6%. 4.77. Now using this, apply the formula, guys. See, actual formula what we use is this one. We are just interchanging the position. That is P naught is equal to D1 divided by R minus G or K minus G, we call it as. Yes, sir. Now we need to calculate K. We are just interchanging the position and cross calculating it. That's all. Yes. So which is equal to D1 is 4.77, current market price they have given 95 plus growth rate which is 0.06. 11.02%. Correct na? 11.02%. Next, a company has currently 10,000 equity shares of rupees 100 each and its earnings are 1,50,000. Its current market price, that is P0. And growth rate of EPS is expected to be EPS 5%. Current EPS is how much, guys? 1,50,000 is the total earnings divided by, for how many shares? 10,000. Correct? Yes. How much is the earnings per share? 15 rupees. Now, what is the earnings at the end of the year? It would be 15 plus growth rate you can do, or else into 1 plus G. 1 plus G is how much? 0.05. 15.75. So use the similar formula. Instead of D1, it is now E1. That's all. 15.75 divided by MP, current market price, which is given as 112, plus growth rate, which is 0.05. Sorry? Percentage. Or you can keep it as decimal also. If you multiply with 100, you will get the percentage. Then, SK Limited has issued 1,000 equity shares of rupees 100 each as fully paid. It has earned a profit of 10,000 after tax. Okay. The market price of these shares are 160 per share now, P0. Find out the cost of equity capital before and after tax, assuming a tax rate of 50%. Guys, see, using the formula, whatever we calculate will always be after tax. If they ask before tax, we have to do reverse calculation. Yes. So cost of equity here is EPS. EPS is how much? Okay, 10,000 is the total earnings divided by how many shares? 1,000. So per share how much? 10 rupees. So EPS is 10 divided by market price is 160. Tell me in decimal only. How much? 0.06. So 6.25%. Yes, sir. Now I want to calculate before tax. 0.0625 divided by 1 minus 0.5. 0.125. Or if I have to put it in percentage, it is 12.5%. 12.5%. This is what? Before tax. What we have got using the formula is what? After tax. If before tax is not asked, you need not do this step. Whatever we get is always after tax for preference share, equity, and even for retained earnings. Yeah, this is like weighted average. Yes, weighted average cost of capital. I guess we already discussed this previously. I will just quickly explain it. The weighted average cost of capital, that is WACC, is the weighted average of cost of different components of capital structure of a firm. WACC is calculated after assigning weights to the components according to the proportion of that component in the capital structure. So what is the formula? KD into WD plus KP into WP plus KE into WE. The weights to be used for calculation of WACC can be either based on book value, normally book value we will use, but if at all, if they have given market value or market price and all, we will use that as a weight. Or the market value of the funds raised from the different sources. So I have just kept one question here. Kritika Limited is currently financed with 10 lakh of 7% bond and 20 lakh of common stock, which is equity. Okay, so cost of debt would be straight away, guys, 7% into 1 minus tax rate. Tax rate is 0.35. After tax, how much? Quickly. 4.55%. Next. Equity. Coming to equity, 20 lakh of common stock. The stock has a bit of 1.5 and risk-free rate is 4% and market risk premium is given straight away, 3.5. So risk-free return is 4%. 0.04 I am writing plus market premium is already given, guys. Straight away take that. Risk premium, not market return, risk premium into beta 1.5. So first you do 3.5 into 1.5. Just a minute. I have taken in one place decimal. I will write as number, actual numbers only. So 4 plus it would be 3.5 into 1.5. Final one. 9.25 percentage. 9.25 cost of equity. Then coming to preference and all is not there. Now can we calculate weighted average, sir? Yes. So weighted average, it would be cost of debt 4.55 into weight of debt. Weight of debt would be, what is the total capital, guys? 10 plus 20, so 30. So debt is how much? 10 by 30. 10 by 30, correct. Weight of debt plus cost of equity 9.25 into weight of equity 20 by 30. 1.52 plus 7.69 percentage. Is that clear? Sir, what if all the three sources and all is given? I have already discussed along with an example in chapter 1 only, guys. This is all about weighted average cost of capital. Next, marginal cost of capital, MCC, is the cost of additional capital introduced in the capital structure. Assume I already have 10 lakh capital with 10% cost. Now I want to raise another 5 lakh. So for another 5 lakh, my cost would be 12%. So what is that additional cost I will incur for raising additional capital? That is called marginal cost of capital, guys. So this is all about this chapter. Yeah, now starting with chapter 5, which talks about capital structure. Capital structure means, see, in the balance sheet of the company on the liability side, which we call it equity and liabilities. Sir, how do we plan this part? How do we plan this part? Assume, guys, I require a total capital of 50 lakh. Now, I cannot blindly go up with 50 lakh equity, 50 lakh debt and all. I have to plan in such a way that keeping all the things in my head, I have to plan out of 50 lakh, how much should be equity, how much should be debentures, how much should be preference, or how much should be loan or borrowings and all. Now, sir, each category of the finance or the way of raising the money has their own advantages and disadvantages. For example, equity share capital. Now, if I am raising the money through equity share capital, I don't have any fixed obligation to pay dividend. I am not agreeing that every year I will pay so much. It is at the discretion of the company. If I make profit, if I will to pay dividend, I will pay it. And even when I earn profit, it is not mandatory for me to declare dividend. Why, sir? If I have good expansion opportunity, I will retain the profit and reinvest it in the business and give capital appreciation to the shareholders. That is by way of increasing the share value of the company. Then coming to with respect to principal repayment, sir, do we have any obligation with respect to principal repayment for the equity shareholders? No. Until the company goes into liquidation, there is no obligation for the company to repay equity shareholders. Yes, sir. So as long as the company continue their show, there is no principal repayment with respect to equity shareholders. So these are the advantages. The disadvantages with respect to equity is we have to, sir, dilute our ownership. To whom? To the newcomer. That is for whomever we are issuing the equity shares. By raising the money, we have to give a part of the ownership of the company. So tomorrow he may dictate me, or see, if I still have controlling interest in the company, that is majority, if I am holding more than 50%, I am the one who will make the decisions, but I have to consider others also. Whoever is the shareholders, I have to invite them to the AGM, and if anything I have to discuss with them, I have to present my books of accounts, everything we have to do it. And see, many of the startups, what they do, when they start raising the money, yes, they might be diluting 1%, 2%, 5%, 10%. But as they go forward in the upcoming years, they may dilute more than 50% also. And that is where they will also lose the controlling interest in the company. Many of the founders have been thrown out of their own company, which they have built day and night, just because they have lost their controlling interest. One example is Flipkart, if you guys are aware of. So once we lose our controlling interest in the company, that is, if my shareholding, if it comes below 50% and someone else is holding more than 50%, any day he can take the decision even to remove me. So this would be the risk of raising the money through equity. I have to share the ownership and all. Next, coming to reserves and surplus is a part of equity share capital, guys. That is, it is a part of equity shareholders fund. Why so? Guys, this is the profit made by the company, and after meeting all the expenses, even after paying tax, preference, dividend, interest, everything, what is left, we are transferring it to balance sheet under reserves and surplus. And reserves and surplus include various elements like free reserve, general reserve, or any other type of reserve like capital redemption reserve, securities premium, profit and loss account credit balance. All those things would be here, and it always belongs to equity shareholder. Then coming to preference share capital, here we have a fixed obligation to pay every year a fixed rate of dividend, no matter whether we have made profit or not. And even this is repayment is there. We call it as redemption. See, when it comes to debt and preference share and all, we always call it as redemption. Whereas for equity share capital, we don't call it as redemption. Why, sir? Because we don't know when we have to repay. Only if company is going into liquidation, we have to repay. And no company will start with the aim of liquidating. Okay, due to some certain circumstances, they may do it at the end when they are in a difficult situation or distress. But the thing is, no one will start the company with an intention to liquidate. So we never know that when we will liquidate, when we will repay. So that is why for equity share capital, we never use the word redemption. Redemption is something, sir, I know when I have to repay. So at the time of issuing preference share capital or debentures or bonds, we know when we have to repay. And even investors will invest in the company only when they know that when they will get back their money. That I am talking about principal repayment. So that is why for preference, debt, debentures and all, we always use the word redemption. Redemption means when we are repaying it. Yes. So when it comes to preference share capital also, we have to repay the principal amount, and repayment sometimes can happen at premium or discount also. Or if nothing is given, redemption will always happen at par. Then coming to debentures or long-term borrowings, guys, even for this, we have a fixed obligation of interest. We have to pay every year whatever rate of interest we have already agreed for. Sir, how we would have agreed for? At the time of raising the money by issue of debentures or bonds or taking loan, I would have already entered into an agreement that I will pay so much of interest every year. So I have to pay that no matter what. Sir, what if I am suffering loss? Borrow money and pay interest. Okay, and that is what debenture holders will demand for. Yeah, and no matter what, you have to pay interest. Even when it comes to principal repayment, we have to pay it. Similar to EMI basis and all, we have to pay it. And principal repayment can happen like in installment or at the end of the period. Especially when it is a debentures and all, we don't pay it in installment. We will pay it at the end of the life of the debentures, like 5 years, 10 years and all. Whereas if it is a loan or borrowings and all, banks may offer you telling, see, every year, at the end of every year, pay so much of interest, pay so much of principal amount. Like however, housing loan, vehicle loan and all will operate similar to that. Yes, sir. So when it comes to this category, guys, the advantages or disadvantages are same. Sir, we have to pay a fixed amount, principal repayment would be there. And these are like a disadvantage for the business. And if they are earning enough profit, it is good actually. Because I need not share my profit. If I have to pay 1 lakh interest, only 1 lakh. If I earn 10 lakh, remaining 9 lakh is mine. Clear? So if you are willing to, or if you have an intention, or if you have a dream of, I will earn good amount of profit from my business, better to go with the debt or preference. Because whatever is their share, if I pay, rest belongs to me. Rest belongs to me. Whereas in case of equity, it is not like that. We have to share each and every rupee with them, depending upon the percentage of shareholding. Yes, sir. Then coming to debt, what is the advantages? We will not dilute the ownership. We will not dilute the ownership. See, dilute the ownership can happen if it is a convertible debentures or convertible preference shares. That too after a certain period. And that is not mandatory. It would be a choice given to the debenture holder or preference shareholder. Clear? Yes. Guys, see, as I already mentioned, preference share capital actually will fall in between the equity and, just a minute, in between the equity and debt. Sir, what should I treat preference share capital as? My suggestion is treat it at par with the debt. Because when it comes to obligation of repayment or dividend and all, it is fixed always. Clear? But in one situation, it can become an equity. We can call it as potential equity. That is in the future, if it is convertible preference share capital. That is, I would have given the option to the preference shareholders to convert it into equity after a certain period of time, like after 3 years or 5 years. And that is a choice given to preference shareholders. And assume after 3 years, they have a choice. They can either get the repayment or they can convert their preference shares into equity. Yes, sir. Coming to current liabilities, which we are supposed to pay within 1 year. It is creditors, bills payable, short-term borrowings, and outstanding expenses. And in this chapter, we will not discuss anything about this. We have a separate chapter called working capital management. There we will talk about current asset and current liabilities. How do we plan about it? So in this chapter, it is all about how do we plan this. Sir, how much will I keep my equity as, and preference as, or debentures as, long-term borrowings as, and also guys, see, whenever we are planning that, sir, 50 lakh, in that how much should be my equity, how much should be my debt, or how much should be my preference and all, even I should have mentioned it in my, there is something called as capital clause. Capital clause where? A memorandum of association. There, especially with respect to equity and all, I should have mentioned authorized share capital. Sir, what is authorized share capital? How much maximum I am authorized to raise the capital from the public or from the investor? Maximum. Sir, should I raise for example, assume my authorized share capital is 50 lakh. Will I go and raise full 50 lakh day one only? No. What will I do with so much money? So I may plan, I will call up today 30 lakh or 20 lakh. So, and I will keep paid up capital as 20 lakh. As and when I require in the future, I will raise the additional capital like that. So authorized is something maximum. So whenever we are raising the money, we should also keep the law in point. I cannot simply, I will raise 50 lakh today, 90 lakh tomorrow, 100 lakh day after tomorrow. No, we have to be within the limits. We have to comply with the law. Yes, guys. So we have something called as capital structure here. Sir, what is capital structure? It is nothing but capital employed. If I add up all this, I had given it as an equation also in the previous chapter. So if I add up all this, whatever we get is called total capital employed. We call it as capital structure. And the entire liability side of the balance sheet is called financial structure, including current liabilities. So can I tell like this, sir? Capital structure plus current liabilities is equal to financial structure? Yes. Or financial structure minus current liabilities is equal to capital structure, sir? Yes. So capital structure minus financial, no, is equal to this. So capital structure is equal to financial structure minus current liabilities. Yes. Coming back. Capital structure, and if you just have an understanding of all this, guys, if you just get any theory question, assume for 4 or 5 marks, aram se you can ace it. Sir, should we mug up these sentences and rewrite the same? No, these are not definitions. These are not, if it is a definition, yes, we have to copy paste. Clear? So when it comes to explain the features, so explain the different types of capital, sir, simply if you know, see now you guys have studied company law, you guys have studied corporate accounting, financial management, you should have a proper understanding of all these terms. And explain it in your own words. And in your own words means not general words and all. Like I told you, for example, for preference and debentures, we should use the word redemption. Assume if by mistake you use the word repayment. Maybe evaluator may deduct some half marks at least there. Because the right words has to be used in your explanation. Clear? And also you can mention, for example, as I told you, so even though there is no need of it, but you can just mention about capital clause of MOA in companies and all. So just giving that connection also may add some value to your answer. Always try to do like that. So even when it comes to my class, especially regular class, now I'm not going in detail about any topic and all because this is a revision or marathon. But when it comes to regular class and all, I would have connected to other topics or other subjects and all. And that is how you have to study, because that is how it is planned here in your professional courses. Each and every subject you have to pass, each and every subject you have to prioritize. No, sir, FM I don't like, only that subject I will like, I will pass there, I will score above 80. No, you are still fail. Assume you got 30 here and 80 in another subject, you are fail, na? Correct. So that is how the things are planned in professional exams or professional courses. We should know the knowledge of all the subjects, all the topics, and we should be the all-rounder. We should be the all-rounder. That is how they also will test you guys. Yeah, sure. Coming back. Capital structure means the breakup of the capital employed by a firm. The capital employed consists of both the owner's capital, that is nothing but equity, and the debt capital provided by the lenders. The optimal capital structure is the best debt to equity ratio for the firm that maximizes its value and minimizes the firm's cost of capital. Maximizes its value is nothing but the value of the firm, that is with the form of share price. Yeah, we have different types of capital structure. First one, see, horizontal and vertical is like opposite to each other, whereas pyramid and inverted pyramid is opposite to each other, guys. Yes. So horizontal, I have just drawn the line here also. Only one line item is there. Only one line. You can see, sir, here when I am doing, only one line item is there. Whereas it is not like this. If it is like this, we have everything. Agree? And if it is horizontal, you know, horizontal and vertical line, try to connect like that. So horizontal means what? Sir, one straight line, that's all. So in horizontal capital structure, the firm has zero debt. components in the structure mix. Expansion of a firm takes place only through equity or retained earnings. In simple, in their capital structure, they have only one item, that is equity. And if they want to expand, they will either raise the money again through equity, or they will earn the profit, retain that, and use it for expansion purpose. They never go with the debt. It is a zero debt company, we can call it as. Then vertical capital structure. So vertical line will be like this. So same like my liability side of the balance sheet. So we will have number of items here. Yes, sir. In vertical capital structure, the base of the structure is formed by a small amount of equity. So we will have some fixed amount of equity. For example, assume 5 lakh. Anything over and above 5 lakh, I will go with the debt. The addition in the capital structure is almost entirely in the form of debt. Quantum of retained earnings is low and the dividend payout ratio is quite high, because whatever we earn, we are repaying. Why? Because, sir, all the expansion is happening through debt capital. Debt capital. Yes. So you can observe. So I will just mention here, assume equity share capital is, we have just kept some minimum 5 lakh or 10 lakh. Anything I require over and above that, I will go with the debt. I will go with debt, guys. Yes. Then pyramid shaped capital structure. A pyramid shaped capital structure has a large proportion consisting of equity. Large amount of capital would be equity and retained earnings, that is which belongs to equity shareholders. Cost of share capital and retained earnings is usually lower than cost of debt. So this structure is indicative of risk averse conservative firms. Sir, I don't want to take any risk. I don't want to take any debt because I am not sure how much profit I will earn. If I don't earn profit, I will not be able to pay interest. So I want to be conservative. I don't want to take any risk. Better don't keep debt. So it is like this. Pyramid, you know the shape. So larger amount will be equity. If only necessity arises, we will have small amount of debt. We will have small amount of debt. And base will always be equity share capital, and debt I am not telling mandatory. If required, I will go with it. If required, I will go with it. So I am playing safe game here. Because equity share capital or equity shareholders, I don't have any fixed obligation. I'm not sure how much I will earn from my business. So I don't have any fixed obligation to pay dividend or interest or anything. I'm playing safe. I'm a conservative player. Okay. Next, inverted pyramid shaped capital structure. Virat Kohli. Now, such a capital structure has a small component of equity capital, reasonable level of retained earnings, but an ever increasing component of debt. All the increases in the capital structure in the recent phase have been made through debt only. So such capital structure is highly vulnerable to collapse. Sir, why did I tell Virat Kohli aggressive? So now they are like this, guys. Reverse. Small amount of equity they will have. Small amount of equity they will have. Anything over and above that is debt. And as the company is expanding, they will go with more and more debt. And as they bring more and more amount of debt, they have more obligation towards interest, principal repayment. There is high chances of collapse. Why? If they don't earn enough profit, they will not be able to repay their interest or principal repayment. The even debenture holders or the debt providers may wait for a few months, or else next they will take the company to the court. They will take the company to the court. Which may lead, I'm not telling every company will do this, because see, companies like Adani and all, they are running on huge debt. But I think somewhere he know how to use the debt also. For example, on debt, if he is paying 10%, he know whatever debt he is borrowing, he is able to generate more than 10% on it. Assume 15% or 20%. So even after paying interest, something might be left with him. But can this be done forever, sir? Question mark. Clear? So it is always better to have or invest in the business your own money and take risk, not someone else's money and take risk. So that is why, so when it comes to Reliance or any other good companies, okay, like Infosys and all, they have very less debt or zero debt. Why? Because they have started the business with very less capital only. But as they grow, they earned profit, they retained it and they reinvested in the business. So they are not putting anyone else at risk. They themselves might be at risk. They are the one, they are running the show. But borrowing huge crores, you know Vijay Mallya story also, okay? So all this will happen when you are borrowing huge crores of money. Initially, you might be using it very well. You have the capability to repay because so much crores you would have borrowed. But later, after 5 or 6 years, if you are not able to generate profit from your business, your whatever money you would have borrowed also you would have already spent. Now you have nothing left with you to repay, including interest. Okay, guys, sure. Now coming to some theories and calculations. Net income approach. First, according to this approach, there is a relationship between capital structure and value of the firm. Means, sir, the capital structure, how I will decide, based on that, the value of the firm will change. So I should decide my capital structure in such a way that the value of the firm would be maximum. So here, overall cost of capital, which is nothing but weighted average cost of capital. KO here is nothing but overall cost of capital, that is for the company as a whole. Sir, how do we calculate? It is nothing but weighted average cost of capital, guys. So assuming only we have equity and debt, KD, that is cost of debt, into WD, that is weight of debt, plus cost of equity into weight of equity. Sir, what if I have preference? Add that also. That's it. KP into WP. Okay. Now assumptions. There are few assumptions under this approach. KD is less than KE. That is cost of debt is less than cost of equity. Or else I can put it in another way. Cost of equity is more than cost of debt. Yes. And they remain constant. For example, assume I consider cost of debt as 10% and cost of equity as 12%. They remain constant in the sense, sir, when I am calculating any value of the firm and all, is it like only for today? No, for future. So we are assuming that even in the future, 10 and 12% remains constant. In reality, it will not remain constant, but we are assuming that it will remain constant. And guys, any theory, any concept, whatever assumptions will be there, actually they are not into reality. Okay, but to do calculation, we have to make certain assumptions. Because if I am not making assumptions, then I cannot do any calculations. Clear? And I cannot sit idle also, thinking, anyway, everything will change. So I will not make any calculation. I will not take any decision. I will not run the business. God is there to take care of me. I cannot be like that. Correct? So I have to make certain assumptions and make some calculation. Based on that calculation, we have to take the decisions. Then no taxes. In India, you know, okay, we are topmost country in taxing the people. So no taxes is nowhere relevant to Indian scenario, but still for this concepts, we are taking no taxes. Means the company or the investor, they are not paying a taxes. Our tax rate is 0. Okay. Conclusion. Higher the KO. KO means overall cost. Overall cost includes both cost of equity as well as cost of debt, guys. Considering both as a whole for a company, what is the average cost? Higher the KO, lower will be the value of the firm. Yes, we discussed. Higher the discount rate, lower would be the present value. Lower the discount rate, higher would be the present value. Similar concept. Yes. Inverse relationship exists between the value of the firm and overall cost of capital. If overall cost of capital increases, value of the firm decreases. Same way, it will go in opposite direction. Higher the debt portion in capital, higher will be the value of the firm. As per this approach, higher the amount of debt, higher would be the value of the firm. Why, guys? Simple. Listen here. Listen here. Sir, cost of debt is less than cost of equity now. Yes, sir. Which is 10% in my example. Now this is 10%, this is 12%. Now if WD goes up, WE comes down. WD goes up, WE comes down. Yes. When WD increases, the weight of debt increases. So accordingly, we will multiply with cost of debt, which is lower than cost of equity. So automatically overall cost will come down. Automatically overall cost will come down. I will just simply take an example. Assume it was 50-50 debt and equity. So it was like this overall cost. Okay, now so weight I am taking means assuming 5 lakh, both cost of equity share capital is 5 lakh, debt capital is 5 lakh. So what is the weight? 0.5, 0.5. Yes, sir. So how much we will get? 5 plus 6. So what is the overall cost of capital? 11%. Now, sir, I am borrowing more money. I am borrowing more money. So let me take it as now we are increasing the share the capital itself for 15 lakh. So equity is 5 lakh, debt is 10 lakh. I am taking debt first. So debt is 10 lakh and equity I am keeping it as 5 lakh only. Keeping it as 5 lakh itself. So what is the total cost? Sorry, total capital? It is 15 lakh. Yes, sir. What is the cost of debt? 10%. What is the weight of debt? 10 by 15. Do it. 0.67. Then plus 12 into 0.33. Sir, how did you get 0.33? 5 lakh divided by 15 lakh. Wait. Now, did we increase the weight of debt? How? By taking more amount of debt. So automatically my overall cost will come down now. Check it. How much? Quickly, guys.
10.6.
Final figure 10.66 or 67? 67%. Now can you observe from 11% it got reduced to 10.67%. Simple logic. Sir, my weight of debt increased, whereas my cost of debt is reduced, means less when compared to cost of equity. So automatically my overall cost will come down. automatically overall cost will come down. Hence proved. So simple. As per this approach, as the amount of debt capital increases in the capital structure, the weight of debt will increase. As the weight of debt will increase, the overall cost of capital, that is weighted average cost of capital of the company, comes down. And when overall cost of the capital comes down, value of the firm increases. Value of the firm increases, guys. So let me just explain with an example quickly. A company has a total capital of 2 lakh, guys, and net operating income, that is EBIT, 50,000. It is considering two scenarios. First scenario, no debt. So entire capital is 2 lakh equity. Okay, so debt is 0. So total capital is 2 lakh. Yes, sir. Scenario 2, equal level of debt and equity, 1 lakh each. So 1 lakh equity, 1 lakh debt. Total is 2 lakh. So let us see, cost of equity is 12%, cost of debt is 8%. So is cost of equity more than cost of debt? Yes, sir. One of the assumption. Yes. So cost of equity is more than cost of debt. Yes, under both the options. Now let us do some calculations. EBIT 50-50, net operating income. Yes, sir. Under both the scenarios, no change. In the first scenario, as there is no debt, so interest is 0. Second scenario, how much is the amount of debt? 1 lakh. On that, what is the interest? 8%. So 1 lakh into 8%, 8,000. So what is the earnings available to equity shareholder? No tax, so no preference here. Okay, so straight away this becomes earnings available to equity shareholders. Correct, na? After we reduce interest, we get profit before tax. There is no tax. So profit before tax is equal to profit after tax. And sir, after that we have to reduce preference dividend. There is no preference share capital. So ignore preference dividend. So straight away whatever figure we have derived is what? Earnings available to equity shareholders. Because now when I am explaining, you will understand later why that is not considered, why this is not considered. This figure is called profit before tax now. Why did he change it? Yesterday he explained one format, he gave like this, but now he is taking like this. Please be careful as per the assumptions we are going. And there is no tax, there is no preference share capital, hence no preference dividend. Okay. This is the earnings available to equity shareholders. So value of equity would be earnings available to equity shareholders divided by cost of equity. Divided by cost of equity, guys. So how is it, sir? Earnings available to equity shareholders 50,000 divided by cost of equity 12%. Same way here, 42,000 divided by 12%. What do you get? Value of equity or market value of equity. For that we will add market value of debt. I have told you if nothing is given in the question, guys, market value of debt and book value of the debt would be equal. So here I am taking it as 1 lakh. That is for only scenario B. So whereas for scenario A there is no debt only, so market value of debt also will be 0 as there is no debt component in the capital structure. So what is the total value of the firm? 4,16,667 and scenario B 4,50,000. So here debt was 0, here it is 50%. As the amount of debt in the capital structure increases, the value of the firm, can you observe, is it increasing? Yes. Now we will check overall cost of capital. How do we calculate overall cost of capital? We already discussed the formula KD into WD plus KE into WE. So 8% is the cost of debt into 0. There is no debt capital, so weight is 0. Then 12% into 4,16,000 divided by 4,16,000 change. Yes, sir. That is the entire capital is equity. Yes. So how much we are getting? 12%. What is this? KO. Okay, sir. Scenario B. 8% is the cost of debt. What is the weight of debt? 1 lakh divided by 450. Sir, how did you get it? How much is debt component? 1 lakh. What is the total? 4,50,000. So that is WD. Next, 12% into 3,50,000 divided by 4,50,000. That is equity divided by total. Weight of equity. So how much we are getting? Overall cost of capital 11.11%. So can you observe? As there is increase in the amount of debt from 0 to 1 lakh, my overall cost of capital is coming down, whereas the value of the firm is going up. Value of the firm is going up, guys. Hence conclusion is proved. Just have a look into it quickly. I will move forward. See, if you just mug up conclusion, under this approach, this is the conclusion, under that approach, this is the conclusion, assumptions. No, that may not work for you. You cannot retain it for a very long period. Understand the concept and then do it. I explained the logic also, guys. As debt increases, why the overall cost will decrease. All those things I have explained it. So now you can see through diagram also I will show you. So cost of debt and cost of equity remains constant. In my example also I took 10% and 12%. As the amount of debt will increase, guys, degree of leverage is nothing but amount of debt. as the amount of debt increases in the capital structure, what happens? Overall cost will come down. Can you see that overall cost line dropping down? Yes. Whereas cost of equity and debt, will it change? No. Now you may ask me, sir, by the way, they both are remaining same. How come overall cost will change? How come overall cost will decrease? Because of the weight. Because the weight of debt in the capital structure will keep increasing, whereas the weight of equity will drop. So accordingly, we multiply each other and add up. Nah? So there the overall will drop down, guys. Hope you understood. Yes. So there are 2 points to be noted here as per this approach. As the cost of capital decreases, the value of the firm would go up. When the cost of capital will decrease? Come on, when the cost of capital will decrease? When the amount of debt in the capital structure increases. As we increase the level of debt in the company, that is in capital structure, the value of the firm would go up even further. That is, the higher the debt portion in the capital, higher would be the value of the firm. Why? Because cost comes down, overall cost. Yes. So, next, net operating income approach. According to net operating income approach, the market value of the firm depends on EBIT and overall cost of capital. Overall cost of capital, weighted average cost of capital, average cost of capital, everything is one and the same. The capital structure is irrelevant and does not affect the value of the firm. They are telling the value of the firm depends on what? EBIT and overall cost of capital. Now, sir, will my capital structure affect the value of the firm? As per this approach, they are telling no. Whatever is the capital structure, that will not affect the value of the firm. Value of the firm is affected only by 2 factors. What are those? EBIT, that is operating income, and the other one is cost of capital, that is overall cost of capital. Assumptions. Okay, first formula. Value of the firm, EBIT divided by KO. KO means what? Overall cost of capital. Sir, here you did something. No, sir. See, here earnings available to equity shareholders. Numerator is for whom? Equity shareholders. So denominator also it took for whom? Equity shareholders. Next approach, we are taking EBIT as numerator. EBIT is for whom? Only equity shareholders. No. It is for all. All in the sense debt providers as well as equity. That is, EBIT is before interest to, preference dividend to, and before equity dividend, right? Yes. This profit we have earned for whom? All the providers of fund. So numerator is EBIT. So denominator should be what? Overall cost. Overall cost, guys. So please be careful. If you misapply the numerator and denominator, you will get different figures. So please ensure that numerator and denominator you are matching. In the previous approach, I took earnings available to equity shareholders. This belongs to only equity shareholders. Divided by what? Cost of equity. Whereas in the upcoming approach, that is whatever we are discussing now, we are doing EBIT divided by KO. EBIT is the profit which we have earned for all. That is debt providers as well as equity as well as preference. Yes. Divided by what? All these people put together, we have one cost. What do we call it as? Overall cost of capital. Yes. So, investors see the firm as a whole and thus capitalize the total earnings. Total earnings means EBIT of the firm and find the value of the firm as a whole. KO and KD is constant. Whatever is the number, it remains same, constant. The use of more and more debt in the capital structure increases what? Cost of equity, and there is no taxes. Here they are telling KD and KO remains constant. Whereas KE, will it remain constant? No. Guys, as we increase the amount of debt, now for equity shareholders, we are putting into risk. Yes. How, sir? Because I have to pay more interest. When I pay more interest, what is left to the equity shareholder is less now. Very less. Sir, what if I suffer loss also? Then entire loss has to be suffered by whom? Equity shareholders. What about interest, sir? At least we have to borrow loan and to give interest. But no matter what, how I bring the money, I have to pay interest. Now who is under risk? Equity shareholders. So as the amount of debt increases, equity shareholders' risk will increase. As their risk increases, they expect more from the company. Their expectation increases. When their expectation increases, cost of equity increases. Okay. Conclusion. KE, that is cost of equity, would go up or down with increasing or decreasing leverage. So they move in the same direction. That is, as the amount of debt increases, the cost of equity increases. Whereas cost of debt and overall cost will remain same. It means that as we increase the level of debt in the company, the value of the firm doesn't change. So capital structure will not affect the value of the firm. Note, in practical situation, both these approaches seems unrealistic. Clear? Huh? Yes. But for exam purpose and all, don't write it. In the sense, if they ask you, is it realistic and all, you will answer. If not, you have to answer as per the respective approach. So let me discuss that with an example. Net operating income approach. Yeah, we want a total capital of 2 lakh and net operating income or EBIT is 50,000. Now we have two scenarios. First scenario, no debt. Second scenario, equal amount of debt and equity, 1 lakh each. So overall cost, KO 10%, cost of debt is 8%. Both of these remain constant? Yes. What about cost of equity? They have not given, sir. It is not constant. As the amount of debt increases, cost of equity will increase. Yes, guys. So you can see the capital structure. Equity is 2 lakh and 1 lakh, depending upon 0 and 50%. Okay. Debt is 0 in the first scenario and 1 lakh here. So cost of debt, they have given 8%. So net operating income, that is EBIT, is given in the question, that is 50. Fine, sir. From now, here the calculation. Interest is 0 in the first scenario because there is no debt at all. Second scenario, 8,000. Sir, how did we get it? 1 lakh into 8%. Debt capital into interest rate. Okay. Earnings available to equity shareholders 50 and 42,000. Same numbers like before, guys. Nothing changed till here. And here KO is given. Here we found out KO, which is not constant. We found out it. But here they would have given it. Yes. How much is that, sir? 10%. Okay. Now can we calculate total market value? Yes. What is the total value of the firm? EBIT divided by KO. KO. You can see. 5 lakh we will get. How is it, sir? 50,000 divided by 10%. In both the cases, it remains same. Now, sir, capital structure changed, no, sir. How come value of the firm is same? That is what is their assumption, right? Or that is what their conclusion they are giving, right? The capital structure will not affect the value of the firm. Even though in both the scenario, capital structure, is it same? No. But what about the value of the firm? It is same. Value of the firm is same. Yes, sir. So debt capitalization rate, which is nothing but cost of debt, 8%. So market value of the debt would be how much? 1 lakh in the second scenario. How did you get it? Simple. 8,000 is the interest divided by 8%. Or else simply take debt capital. Simply take debt capital. So market value of debt is 1 lakh. Now what is the market? This is total market value. From total market value, if I reduce debt value, what do I get? Market value of equity. First case how much? 5 lakh. Second case how much? 4 lakh. Now can I calculate cost of equity? Yes, sir. What is the formula? Earnings available to equity shareholders divided by market value of equity. Earnings divided by the market value of equity. So first scenario, guys. Earnings available to equity shareholders is 50,000 divided by 5 lakh. 10%. 10%. Second case. Earnings available to equity shareholders 42,000 divided by 4 lakh. Divided by 4 lakh. 10.5%. Can you observe something? Sir, what? As the amount of debt increases, the cost of equity increased. As the amount of debt increases in the capital structure, the cost of equity increases. Whereas the value of the firm, total value of the firm remain same. There is no change in it. These are the conclusions of this approach, guys. So you can see here, diagram wise also I am showing. So cost of debt, cost of overall cost will remain same. Whereas cost of equity will increase with what? Amount of debt. As you borrow more amount of debt, cost of equity will keep on increasing. So the amount of debt and cost of equity will move in the same direction. So 2 points to be noted here as per this approach are, guys. As the cost of total capital and debt is constant, the cost of equity would go up or down with increasing or decreasing leverage. As we increase the level of debt in the company, the value of the firm doesn't change and the company does not benefit by taking on debt. This would mean that the companies would like to employ as much as equity as possible so as to reduce the risk of the company. And here, please be careful, sir, for calculating overall cost, do we use WACC formula? No, they would have given it in the question. For this approach, they will give KD and KO in the question itself. And what they will ask us to calculate is cost of equity. Clear? Yes, sir. Same way here. What do they ask you to calculate under this approach would be overall cost of capital, which is nothing but KO. As per the approach, the requirement also will change, guys. Yes. Coming back. Next, traditional approach. The traditional approach suggests that there exists an optimal debt to equity ratio where the cost of overall cost is minimum and market value of the firm is maximum. Guys, if the question is at what point of capital structure it will be optimum, what is your answer? Where the value of the firm is maximum and the cost of capital is minimum. That we call it as optimal capital structure. As per this approach, debt should exist in the capital structure only up to a specific point, beyond which any increase in leverage would result in reduction in the value of the firm. Assumptions. Rate of interest on debt remains constant for a certain period and thereafter with an increase in leverage, it increases. Actually practical, correct? Because here and all they assumed that it remains constant, Guys, just imagine. Now you have borrowed a loan of 2 lakh. They have given the loan for 10%. Now you want to go and borrow another 10 lakh. Will they give it the same rate? No. Because as I borrow more amount of debt, the risk for the bank or institution will increase. So they will start charging more interest. You would have observed, simple. Now assume I have very good credit score. What is the interest they charge? Very less, because the risk what they are taking is less. Who? The bank. Now assume, sir, I have very bad credit score. Okay, very bad loan repayment history, default history. So how much will they give still loan? Yes, they may take a chance, but they will charge high interest. So as the amount of debt increases, actually bank also will start charging more interest. This is more reality. Agree. Whereas in previous cases and all, sir, no matter what, cost of debt is constant, which is not practical. That is why at the end I had mentioned this is not realistic. They are not so realistic, but still, when you are solving any questions as per the respective approach, please follow the same. Okay. Yes. So as I borrow more and more amount of debt, the rate of interest will increase, guys. That means cost of debt will increase. Cost of equity remains constant or increase gradually. After that, the equity shareholders start perceiving a financial risk, and then from the optimal point, it increases speedily. Now, even cost of equity up to certain point remain constant. Later, it will also start increasing. As I borrow more and more amount of debt, I am putting even equity shareholders into risk, because whatever profit I earn, first I have to pay interest. After that, whatever is left, I have to give it to the equity shareholders. What if I don't earn enough profits? Who are under risk now? Equity shareholders. So as they are taking more risk, their cost expectation will increase. Cost of equity also will start increasing. So overall cost first decreases and then start increasing. The lowest point on the curve is called optimal capital structure. You can just see, I will explain through diagram first. As the amount of debt increases, which is an x-axis, guys. So cost of debt up to certain point, it will remain same. Assume until I borrow 10 lakh, they are charging me 10%. After that, they told 12%. 12%. So up to certain point, it will remain constant. After that, it will slightly start increasing. Now, as the debt cost increases or the amount of debt for me in my business increases, even cost of equity also slightly start increasing. Then see WACC up to certain point it comes down. After that, even that will start increasing. Clear? And here also you can observe, guys, KD is less than KE. KE is on the top. Debt is in the bottom. Yes, sir. Means, for example, assume cost of debt first it was 10%, whereas equity was around 15%. Later, it will start increasing. As I borrow more amount of debt, both will start increasing. So accordingly, even overall cost will start increasing. Yes, sir. So at what point the overall cost is minimum? That is my optimal capital structure, guys. Optimal capital structure. Now here, how do I calculate the weighted average cost of capital or overall cost of capital? Same way, KD into WD plus KE into WE. As you guys, I'm just explaining the traditional approach with the question or example. From the following information, calculate the value of the firm and state at what capital structure the value of the firm is maximum. At what value means at what capital structure it would be maximum. Fine. So there are 4 scenarios they have given: equity and debt, 100, 0, 80, 20, 50, 50, 25, 75. Okay. Cost also they have given accordingly. Fine, sir. So percentage of debt and percentage of equity we are taking, which is nothing but cost of weight of debt and weight of equity, guys. Yes. Cost of debt you can observe 6, it remain constant up to 20% of debt. After that, if I increase, it increased to 7%. Still, if I increase, it will go up to 8%. Same way, as the amount of debt increases, Up to certain point, the cost of equity was 12%. Later it increased to 13 and then 14 and then to 14. Yes, sir. Now, if I just solve this and calculate overall cost of capital, guys, overall cost of capital, first I am multiplying WD into KD. WD into KD, quickly, 1.2, 4, 3.5, 6 up. Next, coming to WE into KE, 12, 6.5, 3.5. So this is nothing but individually I did KD into WD, KE into WE. Now we should add up both. Yes, sir. We are adding up both. So 12.12 it is. So 10.8, 10, 9.5. Okay. Just observe where it is minimum. 9.5. Correct. Where it is minimum 9.5. Let us just keep it in mind. Okay. Market value of the firm. How do we calculate market value of the firm? Operating profit divided by WACC. And WACC is nothing but overall cost. Don't get confused. Okay. Whoa. So now divide. What is the operating profit? I have given it here. 1 lakh. So 1 lakh divided by 12%. 12%. 33,000? 333. Next, 1 lakh divided by 10.8%. 9,25,000. 926. Okay. 10 lakh. Next. 1 lakh divided by 9.5%. Hey, do man. Sorry? 10 lakh? 632. You can observe. At what point the cost is minimum? At this, that is 0.75 of debt and 0.25 of equity. That is 25% of my capital is equity and 75% is debt. And where the value of the firm is maximum? Same point. So this is what is called optimum capital structure. If the question is, what is the optimum capital structure? You have to do all this calculation and at the end you have to tell the optimum capital structure of the company is 75% debt and 25% equity. Yes. Yes, approach, Modigliani-Miller theory. Franco Modigliani and Merton Miller concluded that the value of the firm depends solely on its earnings. That's all. And hence, its value is unaffected by the debt equity mix. Means in simple, capital structure will not affect the value of the firm. Capital structure will not affect the value of the firm. So value of the firm depends only on its earnings. How much profit will they make? So proposition 1, value of the firm is operating profit divided by appropriate discounting rate, which is nothing but cost, overall cost. Yes, sir. So cost of equity, how do I get? Cost of overall cost plus some premium, because we are taking risk by investing in equity. Yes, sir. How do we calculate that premium? Debt equity ratio, that is nothing but debt by equity into KO minus KD. That is overall cost minus cost of debt. All these figures would be given in the question, guys. I repeat, how do we calculate cost of equity? Overall cost plus premium. We call it as risk premium. How do we calculate that premium? Sir, debt equity. Debt by equity. We call it as debt equity ratio. Amount of debt divided by amount of equity. Into overall cost minus cost of debt. Yes. Simple. This is very similar to yesterday we learned something called a CAPM model. Yeah, correct. So what did we take? Risk-free rate plus RM minus RF into beta. Guys, even if I don't take any risk, if I keep it in FD or somewhere, sir, I am not investing in equity or I am not starting any business, minimum return I will get RF. Yes. Assume it is 6%. Now I am investing in equity, means I am taking risk. I have to expect something more. For that risk, I have to expect some premium. Yes, sir. That premium is calculated where? Here. And risk is measured with beta. Systematic risk we call it as. Yes, sir. So in the market, what is the return? Minus what is that I will get on risk-free asset. So assume in the market the return is 15%, minus 6%. What is that extra I can earn here? 9%. Correct. By taking how much risk? That is beta. By taking how much? This 9% I am not getting freely. I am taking some risk. What is that risk? Beta. Clear? Yes, sir. Same way, similar to that here. Clear? So overall cost minus cost of debt into debt equity ratio. Debt by equity ratio. Yes, sir. As the firm use the amount of debt increases, the cost of equity also will rise. In simple, as the amount of debt in the capital structure increases, the cost of equity will increase. Because in simple, the numerator will increase. Correct. Now, as the amount of debt increases, the debt is in the numerator place. I have to do debt by equity. So, numerator will increase. So, overall cost of equity, not overall cost of equity will increase. Why, sir? Because premium will increase. Why premium will increase? Because of more amount of debt. Proposition 3. Investment and financing decisions are independent because the average cost of capital is not affected by the financing decision. So, my capital structure decision will not affect the overall cost of capital. Yes. This is all about approach. Next, measuring of operating and financial leverage. In the financial point of view, leverage refers to the ability to use fixed cost funds. Fixed cost funds means what? The debt. That is nothing but the debentures or preference shares and all, for which I have to repay the fixed amount of preference dividend or interest. To increase the return to its shareholder, use of debt component in capital structure of a company. I have just given the format here, which helps us in our upcoming calculations. See guys, sales minus operating expenses, we get operating profit. But here we are breaking the operating expenses into two parts, variable and fixed. Sir, what is variable? Which will vary with my operation. Higher the operation, higher would be the variable cost. Lower the operation, lower would be my variable cost. Whereas fixed operating cost means no matter what is my operation, this cost remains fixed. Clear? Like rent and all, whatever I pay to my building, no matter what I do, how many units I produce in my company, I have to pay so much of rent, which is like fixed operating cost. Yes, sir. So from sales, if I reduce variable operating cost, I get contribution. And from that, if I reduce fixed operating cost, I get what? Operating profit. Then from that and all, it is continuing. We have discussed already. Less interest profit before tax. From that, we have to reduce tax. We will get profit after tax, less preference dividend. Then you will get earnings available to equity shareholders. Then equity dividend. You will get at the end retained earnings. Yes. Only slight changes what I have made here is with respect to variable and fixed operating cost. And guys, coming to interest. Can I tell it is a fixed finance cost? Yes. Can I call preference dividend as fixed finance cost? Yes. See, in accounting language, interest and dividend is a finance cost. But equity dividend is not fixed finance cost because I will decide how much I have to pay. There is no law or there is no agreement telling me how much I have to pay. Whereas when it comes to interest and preference dividend, whatever I have agreed for, I have to pay it. Can I call it as fixed finance cost? Yes. So operating expenses is variable operating cost plus fixed operating cost. Fixed finance cost is nothing but interest plus preference dividend only. Then can I calculate earnings per share? Yes. So this is the total earnings available for all the equity shareholders put together. Per equity share, how much I have earned? Divided by number of equity share. Number of equity shares. Yes. So now coming to different types of leverage calculation. Types of leverage, operating leverage. Operating leverage associated with what? Name itself is telling operation. How well I have done with my operations. The leverage associated with investing activities is called operating leverage. Guys, now how well I am doing my operation depends on what? My investment decision. Because my investment will give me profits now or future cash flows, right? If I have made my investment decision good, then I will earn better earnings. In NPV and all we discussed, sir, I have decided based on what is my future earnings, present value of it, cash flow, everything we discussed. Yes, same way. So my investment decisions will decide how much I will be making from my operations. It is cost due to fixed operating expenses in the company. So what is the formula, sir? Operating leverage is equal to contribution divided by EBIT. Guys, simple. What is contribution? Profit after variable operating cost. Then what is operating profit? Profit after fixed operating cost. So in simple, what are we supposed to take in operating leverage calculation is profit before fixed operating cost and profit after fixed operating cost. Means how well am I managing my fixed operating cost? Is it more or less we are seeing? So before fixed operating cost, what was my profit? After fixed operating cost, what is my profit? Clear? That is what we are using it in the formula. So contribution divided by EBIT. Yes. Next, degree of operating leverage means percentage change in EBIT divided by percentage change in sales. Means if sales changes by 5%, how much will my EBIT change? Will it change? Definitely it will change. Guys, simple. Please listen here. Variable operating cost is directly proportional to sales. Why, sir? Guys, higher the sales means higher is my operation. Higher is my operations means higher will be my variable operating cost. Yes. And no matter what is my operation, my fixed operating cost will always remain constant. And what is good? From fixed operating cost point of view, operating at lesser capacity or more capacity? More capacity. Assume my fixed operating cost per annum is 10 lakh, guys. Now, if I produce more and sell, my profit will increase. Why, sir? Because no matter how many units I produce and sell, fixed cost will remain 10 lakh only. So, if my sales increases, will my EBIT increases? It will increase. Yes, it will increase. Clear? So, if there is any change in sales, how will it impact EBIT? It will change. So, that is what we are calculating here. That is what we are calculating. Where did I go? Percentage change in EBIT divided by percentage change in sales. Next, financial leverage. The leverage associated with financing activity. What is financing activity? Sir, from where I will raise how much money? What is the cost associated with it? So, in my capital structure, if I have debt, I have to incur something. What is it? Fixed finance cost. Now, how well am I managing this? Is all about financial leverage. Financial leverage is defined as the ability of the firm to use fixed finance charges. What is fixed finance charges? Preference and debt. That is preferential capital and the debentures are debt. Yes, sir. So financial leverage, what is the formula? EBIT divided by PBT, that is profit before tax. Yes, guys, listen here. So EBIT is what? Profit before fixed finance cost. Fixed finance cost. Then what is profit before tax? Profit after the fixed finance cost. Correct? Na? Simple. What did we do in operating leverage? We took profit before fixed operating cost divided by profit after fixed operating cost to know how well we are managed with fixed operating cost. Even after meeting fixed operating cost, how much profit we are left with? We did the calculation there. Whereas here, guys, please be careful. As per this formula, they are treating only interest as fixed finance cost. What about preference dividend? They are ignoring as per this formula. As per this formula. But if you ask me, sir, is preference dividend also fixed finance cost? Yes, even that is fixed finance cost. But as per this formula, they have ignored it. So what is the formula? EBIT divided by PBT. What it means, guys? Profit before interest and divided by profit after interest. Now, what is the interest here? Fixed finance cost. Please consider that they have considered only interest as fixed finance cost here. They have ignored preference dividend. But actually, even preference dividend is a fixed finance cost. Okay, we can calculate degree of financial leverage. Percentage change in PBT divided by percentage change in EBIT. Means if EBIT changes by so and so percentage, how will my PBT react to it? Will it affect, sir? Yes, it will change. Why, sir? Interest is a fixed amount. Higher the amount of EBIT, higher would be the PBT. Why? Interest is a fixed amount. No matter what is my profit, I have to pay whatever interest I have to. I am agreed for. I have agreed for. Yes, sir. Next, alternate is percentage change in EPS divided by percentage change in EBIT. So denominator remains same. Numerator they are changing EPS. Actually, this is more correct answer. Why? Because here we are taking percentage change in EPS. EPS is what? Earnings available to equity shareholders divided by number of equity shares. And that profit is after considering even preference dividend. Correct. So is this more correct way, sir? Yes. But if they ask financial leverage and all, please use the same formula. Sir, if they ask degree of financial leverage, you can do both. You can do both. Financial leverage helps to examine the relationship between what? EBIT and EPS. Next, combined leverage, the product of both. The product of both, guys. So combined leverage expresses the relationship between the sales and taxable income. So combined leverage is equal to operating leverage into financial leverage. Or else the formula is contribution divided by profit before tax. Sir, how is it? Simple, guys. What is the formula for operating leverage? Contribution by EBIT. EBIT. Then what is the formula for financial leverage? EBIT divided by PBT. Now EBIT can I cancel? Yes. What is left? Contribution by PBT. Contribution by PBT. Contribution by PBT. Yes. Degree of combined leverage, percentage change in EPS divided by percentage change in sales. Top line and bottom line here. Top line and bottom line. What is top line? Sales. That is the denominator. And bottom line in the sense we are taking this, not retained earnings. Earnings per share we will calculate based on what? Profit available to equity shareholders divided by number of equity shares. Yes. I will just discuss quickly some questions on this. From the following selected operating data, determine the operating leverage which the company has the greater amount of business risk. Why? Business risk here is nothing but operating risk. Okay. What is that, sir? What if I don't earn enough operating profit? That is the business risk. Sales and fixed cost is given. Variable expenses as a percentage of sales is 50% for company A and 25% for company B. So let us calculate contribution and EBIT because that is what we require for the operating leverage calculation. Sales is 25 lakh. Be ready with your calculator. 25 lakh, 30 lakh. Variable cost is 50%. So 12 lakh 50,000. Then here 7.5 25% na 7 lakh 50,000. Sir, whatever you tell, we will be late only. 1250 and 2250. What is this called as? 2250. What do we call it as? Contribution. That is after variable operating expenses. Then if you reduce fixed cost, which is 750 and 15 lakh.
We get
5 lakh and 7 lakh 50,000. So for company A, if I am calculating what is operating leverage, contribution 12.5 lakh divided by 5 lakh. 2.5 times we call it as. That is for company A, my contribution is 2.5 times of EBIT. Same way for company B, 22.5 lakh divided by 7.5 lakh. It is 3 times. Don't write this and all in percentage into 100 and do it. Okay, please be careful. Here no into 100. So operating leverage for company B is higher than the company A. Company B has a higher degree of what? Operating risk. Whoever is having higher operating leverage, they have a higher operating risk. The tendency of operating profit may vary proportionately with sales is higher for company B as compared to company A. Yes, sir. That is the conclusion. See, only if they ask you to calculate, only stop it there. If they ask any conclusion, comment, argument and all, then only you give it. Or if they ask you which company is having more operating risk, accordingly, whichever is having higher operating leverage. The following is the capital structure. Equity share capital 1 lakh, preference share capital 1 lakh, debentures 1,25,000, present EBIT is 50,000, calculate financial leverage, assuming that the company is in 50% tax bracket. EBIT is how much? They have given 50,000. Interest, how much is the debt? 1,25,000. On that, how much is the interest? 8%. Don't consider preference dividend. I have told you, only interest here. 10,000. So PBT, profit before tax, 40,000. Now, do we have both the figures what we require for financial leverage calculation? Yes, sir. EBIT, 50 divided by 40. 1.25 times. 1.25 times. Please be careful. See, I have intentionally given here even preference share capital. Don't get tempted. Yes. So only interest we have to calculate. If by chance if you are calculating degree of financial leverage where you will use percentage change in EPS as a numerator, then this will help you. Because we have to calculate earnings available to equity shareholders, where we would have also reduced the preference dividend. Yeah, but here only financial leverage is asked. We are stopping there. Yes. ABC Limited has the following capital structure and want to know its financial. Okay, this is, we have to do it. Financial break-even point. Sir, what is financial break-even point? It is the level of EBIT at which EPS is 0. Yes. So what is the formula? EBIT is equal to interest plus tax plus preference dividend. Guys, EPS is 0 means, can I tell earnings available to equity shareholders will be 0? Correct, na? Yes, sir. Earnings available to equity shareholder is 0. So how much should be my EBIT? Interest plus tax plus preference dividend. Sir, if preference share capital is not at all there, sir, then how much it should be? Interest plus tax. Sir, assume company is tax free, sir. Then EBIT should be equal to what? I'm just changing the scenario and I'm discussing. Clear? So EPS should be 0 means earnings available to equity shareholders should be 0. Agree? So anything above that, If I add up everything, that is interest plus tax plus preference dividend, I have to get EBIT. If there is no means preference share capital, or if there is no tax and all, ignore it. Remaining you consider. That's all. Yeah. So the formula is interest plus preference dividend divided by 1 minus T. Why? Because preference dividend we pay after paying tax. That is whatever profit we are left with after paying tax. So we are calculating how much we require before tax divided by 1 minus T. Here earnings available to equity shareholders would be 0. So hence EPS also will be 0. I will just prove it with one question. ABC Limited has the following capital structure and want to know its financial break-even point. Equity share capital 5 lakh, then preference share capital 5 lakh, 10% debentures 10 lakh. Tax rate is 40%. Okay. So how much is the interest, guys? Interest plus preference dividend whole divided by, only preference dividend 1 minus tax rate. So interest is how much? 10 lakh divided by 10%, which is 1 lakh. Plus preference dividend 5 lakh into 12%. And guys, how much is the preference dividend here? 5 lakh into 12%. This I am paying after paying tax or before paying tax? After paying tax. Correct. Just a minute. So preference dividend, whatever I pay, is the profit which I have after paying a tax. After paying tax. Listen here, listen. Now assume I have to pay a preference dividend of 1 lakh, guys. 1 lakh. If I have to pay a preference dividend of 1 lakh, assume the tax rate applicable for my company is 50%. So how much should be my profit before tax?
2 lakhs.
2 lakhs. Agree, na? How is it, sir? 1 lakh divided by 1 minus 0.5, 50% is the tax rate. So 2 lakh. So on that I will pay 50% tax. So I am left with how much? 1 lakh. That 1 lakh I am paying preference dividend. So how much is my earnings available to equity shareholders? 0. How much is earnings available to equity shareholders? 0. That is what we are doing here. Yeah. 5 lakh into 12% is what I pay after paying tax. So before paying tax, how much should I have? 1 minus 0.4. So this is 1 lakh plus, how much is that? Second part.
1 lakh.
1 lakh. So how much should be my EBIT? 2 lakh. If I have my EBIT 2 lakh, how much would be the EPS? 0. Now, for a company, we are not telling earn EBIT 1 lakh. We are telling minimum you should earn 1 lakh. Because equity shareholders, they are not sitting to get 0. They have not invested to get 0. Now what we are giving an indication or warning to the companies, minimum you should have a EBIT of 1 lakh. If you earn EBIT less than 1 lakh, then equity shareholders will have negative return. If you have more than 1 lakh, they will be happy because they will also get something to take home. Clear? Yes. So this is like a target given to the company. We can also call it as like cutoff amount. Yeah, you can just see, I can prove it. We get 2 lakh only, yeah? Just a minute. 10 lakh into 10%, 1 lakh, 60,000 divided. Okay. So 2 lakh if I take. So 2 lakh is my EBIT. Interest is how much, guys? 1 lakh, huh? 1 lakh. So what is my profit before tax? 1 lakh. Tax is 40%, huh? 40,000. 1 lakh into 40%. So how much is left? 60,000. Preference dividend is how much? 60,000. So profit are available to equity shareholders? 0. Nil. EPS is 0. Thank you, equity shareholders. Yeah, for this question, Kumar company has a sales of 25 lakh, variable cost of 15 lakh, fixed cost of 5 lakh and debt of 12 lakh 50,000 at 8% rate of interest. Calculate operating, financial and combined leverage. Sales is 25 lakh. This is on all three together, guys. 25 variable cost is 15. So contribution is 10. Fixed cost is 5. Operating profit. Interest is 12 lakh 50 into 8%. 1 lakh. Profit before tax is 4 lakh. Yeah. Once you are ready with all these figures, just apply the formula and calculate. Operating leverage, contribution by EBIT. Contribution is 10 lakh. EBIT is 5 lakh, 2 times. 2 times. Then financial leverage, EBIT 5 lakh divided by profit before tax 4 lakh. 1.25. Then combined leverage, I am taking the product of it. So operating leverage is 2 into 1.25.
2.5.
2.5 times. That's all. Yeah. Next, indifference point. Indifference point. It is the point at which different set of debt ratios, percentage of debt to capital ratio employed gives the same EPS. Sir, two different capital structure giving the same EPS. At what amount of EBIT? I repeat, sir, we have two different capital structure and under both EPS is same, not zero. EPS is same. So in order to keep EPS same, how much EBIT we have to earn? Indifference level is the level of EBIT beyond which benefits of financial leverage begin to operate with respect to EPS. So what is the formula to calculate this? EBIT minus interest into 1 minus tax rate minus preference dividend into 1 plus tax rate. Because that preference dividend, I told you, we normally used to take denominator, na? But here we are taking here only, but 1 plus tax rate. Because if I have to pay preference dividend of 50,000, I have to earn profit more than that. Agree, na? Yes, sir. Because after paying tax only, I can pay preference dividend. Yes, sir. Divided by number of equity shares in plan A. Same way, divided by number of equity shares in plan B. That is two different capital structure. Let us do it with one question quickly. Yeah, you can see option A, option B, we have equity 400 lakh completely, no debt. Number of equity shares is 4 lakh. Then coming to option B, 200, 50%. So number of equity shares is only 2 lakh. Sir, how is it? 200 lakh divided by face value. We are getting only 2 lakh equity shares. Okay. EBIT, I am just keeping it as X. We don't know. We are finding it out. Minus interest is 0 for the first case. Into 1 minus tax rate. Tax rate is 40%, 0.4. There is no preference dividend. Ignore the second part. Number of equity shares is 4 lakh. Is equal to EBIT. I am assuming it as X here because same, both are same. Okay, so same X I am taking. Interest is 200 lakh into 15%. 40 lakh. 30 lakh. Interest is 30 lakh. Sir, how did you get it? 200 lakh debt capital into 15%. Okay, sir. Into 1 minus tax rate. Preference dividend part is not there, so we are ignoring. Divided by number of equity shares. 2 lakh. 2 lakh. Yes, sir. So, X here 0. So, X into 0.6. 0.6X divided by 4 lakh is equal to. Okay, here it would be 0.6. So, X into 0.6. 0.6X. Correct? Yes. Then, minus 30 lakh into 0.6. How much is that? 18 lakh? 18 lakh. I repeat, X into 0.6, 0.6x, 30 lakh into 0.6, it is 18 lakh divided by 2 lakh. Cross multiply. Cross multiply, guys. So 0.6 into 2 lakh. 1,20,000. 1,20,000 X. Then 0.6 into 4 lakh.
2,40,000 X.
2,40,000 X minus
7,20,000.
7
No,
crore.
20 lakhs.
Yes. Now 7 crore 20, I am taking it to this side. So it will become plus is equal to 1,20,000 X as I am deducting each other. So X is equal to 7 crore 20 lakh divided by 1,20,000. Quickly. 60 lakh. 60 lakh. I repeat, 7 crore 20 lakh divided by 1,20,000. You will get 60 lakh. What is X?
60 lakh.
What is it? EBIT. So if I keep EBIT 60 lakh under both the option, my EPS would be same. Correct now? That is what we are doing. Yes, sir. So let us check it. EBAT 60 lakh, 60 lakh. Quickly, this is cross checking only in the exam. If they ask you, do it. If not, just end it with your calculations, guys. Interest nil year and year 18 lakh, I guess, na? Or 30 lakh. Second option, there is a debt, na? So 200 lakh, on that 15%. So here 60 lakh is my EBET, 30 lakh. So tax at 40%. 60 lakh into 40%. Quickly. You do the other thing.
12 lakhs.
What is this? Earnings available to equity shareholders. Number of equity shares 4 lakh, 2 lakh. Divide each other. So let me give the notation. A, B. This would be A by B. Is it same? Yes. So under both, sir, capital structure, is it same? No. It is different. But still, if I have a EBAT of 60 lakh, then EPS under both the options would be same. Would be same, guys. Yes. This is all about indifference part. Next, coming to working capital leverage. Working capital leverage measures the sensitivity of a return in investment of changes in level of current asset. Means if there is a change in current asset, will my working capital change? Definitely. How, sir? Working capital, how do we calculate? Current asset minus current liabilities. So, working capital leverage is equal to percentage change in return on investment divided by percentage change in working capital. Or we have another formula. Current assets divided by total assets plus change in current assets. That is from period to period. How is it changing? Yes, guys. So, this is all about chapter 5. This is all about chapter 5. Fine, guys. Now we will start with chapter 6, which talks about dividend decisions. We are done with investment decision and financing decision. Now coming to dividend decisions. And guys, before this, in chapter 5, whatever question we solved, here actually this is not 7 crore 20 lakh. This is the figure which we get. This is the figure which we get. When I multiply 4 lakh with 18 lakh, this is what we get. Totally 10 zeros would be there. And when you divide this by 1,20,000, you will get X is equal to 60 lakh. Such so big number would be difficult for me. If that is the case, then all the numbers you take it in lakhs. Instead of 18 lakh and all, you can just take it as 18 year 2 and year 4. Okay, now? Yes, sir. Sure. Now coming to dividend decisions. Dividend policy determines what portions of earnings will be paid out to stockholders as dividend and what portion will be retained in the business to finance long-term growth. Means whatever we have earned, that is earnings available to equity shareholders, guys. Sir, out of this, how much we have to declare as equity dividend, how much we have to retain? Depends on what is the growth opportunities available to the company. And if I give the dividend to the equity shareholders, how much they can earn out of it. How much they can earn out of it. See, here two things are there, that is K and R, which is different, guys. Now assume company has earned 10 lakh earnings available to equity shareholders. If they retain and reinvest in the business, how much they can earn on their reinvestment is called R. Is called R. Now, sir, if I declare the dividend, equity shareholders will receive the money, they will invest somewhere, how much they can generate on that is called K. Is called K here. Yes. So, K and R would be different here. Types of dividend policies. Regular dividend policy, the investors get dividend at a usual rate. Here, the investors are usually persons who want get regular incomes, like the person who are retired and also regularly, like however we get interest. So same way we expect that we get regular dividends. So those are the people who will invest in this kind of companies, like PSU companies like REC, PFC, Coal India and all, they give good amount of dividends. So normally the investors invest in this company with an anticipation that we get regular dividends. Then stable dividend policy, it is of three types. Constant dividend per share, fixed amount of dividend is paid every year. For example, they have fixed DPS, dividend per share, 5 rupees. Every year they pay the same amount. And even the investors know that every year we will get 5 rupees, which is a fixed amount. Next, constant payout ratio. A fixed percentage of earnings is paid as dividend every year. Fixed dividend payout ratio means, guys, out of my earnings, how much I am declaring it as dividend? Assume 50%. Percentage wise, I have fixed it. Every year, no matter what is my earnings, I will pay 50% of that as dividend. Percentage is fixed, not amount. Previous case, 5 rupees was fixed. No matter whatever is my earnings, every year I will pay 5 rupees dividend per share. Whereas here, we declare and pay 50%. 50% means whatever is my earnings. Will earnings remain same every year? No. Whatever is my earnings, 50% of that I will declare as a dividend. Yes, sir. Next, stable rupee dividend plus extra dividend. Fixed amount of dividend plus extra dividend in the year when the company earns high profit in the form of bonus is paid. That is, every year assume we are fixed for 3 rupees plus whenever we earn extra profit or more profit than what we have expected, we may give some special dividend, extra dividend. Yeah, and that we are not committing for. 3 rupees is committed. Every year we paid. But committed in the sense it's not like promise given in agreement and all. Even investors know that every year we pay this and we also know it. Nothing on written. Clear? Yes, sir. So anything over and above that depends on the performance of the company. Irregular dividend, company will decide how much they have to pay when they will take care. There is no promise, there is nothing, there is no fixed trend. It depends on the performance of the company and growth opportunities. Companies does not pay regular dividend to the shareholders. No dividend at all. Company does not pay any dividend to the shareholders. Then you may ask me, sir, then why should we invest? Capital appreciation. Capital appreciation means entire earnings they will retain, reinvest in the business and grow the business. When the business grows, the value of the share will increase. So these are the especially long-term investors who are looking for generating more and more capital or more and more capital gains in the market or investing. They will invest in such kind of businesses. Example can be like Reliance and all. They pay dividend very less amount. And no investor will purchase the Reliance shares for getting dividend. They expect that the share price will grow. Yeah. A company may use this type of dividend policy due to the requirement of funds for the growth of the company or for the working capital requirement. Now, in Reliance also they are earning crores together of profit, but will they give the good amount of dividend? No. Why? Because they have huge expansion plan. They know how to kill the competitors and take away the market from them. Okay, for that they should have money power. Huh? That is what they use for. Yeah, types of dividend, forms of dividend based on the type of security, equity dividend and preference dividend. Equity dividend means the dividend whatever is paid to the equity shareholders, which is at the discretion of board of directors. They will decide it in the board meeting and take the approval from the shareholders in AGM. Preference dividend is always fixed. We have agreed for whatever rate we will pay at the time of issuing the preference share itself. We have to pay so much. And preference dividend will always be paid out of the profits after tax. Then, based on time, interim dividend, regular dividend. Interim dividend is something which is declared and paid in between the year. That is before the end of the year or in between two AGMs. Whereas regular dividend, or we also call it as final dividend, which is paid after the year end. The board of director will propose it to whom? Shareholders. And shareholders will approve it in AGM. Okay. So then coming to mode of payment. Cash dividend. Cash literally means not cash. Whenever the company declare and pay the dividend, it will be straight away credited to my bank account. That is called the dividend paid in the form of money. That is cash and cash equivalent. Then stock dividend, bonus issue. Instead of giving the dividend in money, they are giving it in the form of free shares. So the number of shares will increase for the shareholder. So this we also call it as capitalization of profit, because the amount of profit in reserves and surplus will be used to issue bonus shares. So the money or the amount will move from reserves and surplus to capital. Scrip or bond dividend. This is like a promise that we don't have as of now money, we will pay you after 6 months or 1 year. So we are promising you that we will pay the dividend in upcoming period or after a certain period. Property dividend means giving the assets of the business to the company. Assets of the business to the shareholders, not assets of the company to the shareholders. Sir, now even in income tax law, there is a separate section for it. How do we value it and all? We call it as deemed dividend, section 222. Clear? Sir, can the company give? Yes, they can give, and that becomes whatever is the value of the asset or property becomes the amount of dividend in the hands of shareholder. Then composite dividend, a combination of both cash and property. Partly in cash they have given, partly in property. Then optional dividend. This is the option given to the shareholders. Do you want dividend or you want capital appreciation? We are giving like that option to them. Whatever they want, they will choose it. Special dividend and all is like Deepavali offer. Or once in a while, if the company has given very good quarterly results, they will declare one special dividend, 5 rupees, 10 rupees, 15 rupees like that. It is more of like a surprise to the shareholders also. Yes, coming to theories of dividend, numerical area. Dividend decisions consist of two important concepts which are based on relationship between dividend decision and the value of the firm. Theories of dividend, relevance of dividend, Walter model and Gordon model. Irrelevance of dividend, approach. Clear? Irrelevance of dividend means, sir, whatever is our dividend policy, it will not affect the value of the firm. Whereas coming to relevance of dividend, whatever is the capital structure, not capital structure, dividend decision, whatever is the dividend decision of the company, will it affect the value of the firm? Yes, it will affect. So how is it? We will see. First, relevance of dividend. If the choice of the dividend policy affects the value of the firm, it is considered as relevant. In that case, a change in the dividend payout ratio will be followed by change in the market value of the firm. So any change in the dividend payout ratio of the company, declaring more or less dividend, will affect the value of the firm. So how do we calculate? Optimum payout ratio is the ratio which gives the highest market value per share. So first we are discussing Walter model. As per Walter model, how do we decide the value of the share or price? D by K, dividend divided by K plus R into small r divided by K square. Sir, what is D here? Current dividend per share. What is K? That is the market capitalization rate or discounting rate or cost of equity. That is what the shareholder can earn. If I declare dividend, what is that shareholder can earn? Yes, sir. Then R is retention per share. When company retain and invest, how much they can earn on it? That is small r. That is return on investment of the company. Guys, listen, please listen. Now assume per share earnings, EPS, I'm talking about it. EPS per share is 10 rupees. Company is declaring DPS or retention per share. Assume company is declaring a dividend of 6 rupees and retaining 4 rupees. Now, 6 rupees if I give it to the shareholder, when am I giving it? At the end of first year. At the end of first year. What is the present value of it? Divided by K. Then, sir, we have earned totally 10 rupees at the end of first year. Out of that, how much I am retaining? 4 rupees. So I will invest at the end of first year. On this, I will earn the return by the end of second year. Correct? At what rate? Small r. Small r. So this is the value at the end of first year or second year? Second year. Because 4 rupees I retained at the end of first year. Reinvested it. At what rate? Reinvestment rate. So this will give me return at the end of second year. So divided by K square. I am giving the reason why K square. Because the numerator is the value at the end of second year. What we retained at the end of first year, we reinvested it. On that, we will earn small r, that is reinvestment rate. That earnings, I will get it at the end of second year. So when I am finding out the present value, we have to divide it by K square. So when I do all this, what do I get? The present value of the share today. The present value of the share today. Yeah. You can see if R is more than K, means company can earn more. They should maximum retain it. That is the entire amount. If they retain, the value of the firm would be maximum. The firm should retain the entire earnings, whereas it should distribute the entire earnings to the shareholder if R is less than K, because shareholder can earn better than the company. Better give them the dividend, they will earn. Yes, sir. So in case of growth firm, R will be more than K. What is the optimum payout ratio? 0%. That is entire amount you retain. Then if it is a normal fund where R is equal to K, then any payout ratio will be optimum. Any payout ratio. Because if company retains also, they will earn same. If they give it to the shareholders also, they will also earn same. Next, R is less than K. Optimum payout ratio is 100%. Why? Give entire thing to the shareholder, he will earn better. He will earn better. Okay, sir. We will discuss this with the questions quickly. R is equal to 12%, K is equal to 10%, earnings is 4%, dividend is 2%. What is R, guys? 2. That is retention per share. Earnings is 4, dividend is 2. That means R is how much? 2. Yes, sir. So dividend at the end of first year is how much? 2 rupees. K is 0.10. So R is 2 into what we are earning on that? 12%. Divided by K square, 0.10 to the power of 2. Final figure. 24, sure? No, 24. So 24 rupees is the present value of the share. Guys, what is the scenario? R is more than K, yeah? When R is more than K, what is the optimum payout ratio? 0%. Correct. So if I take optimum payout ratio, dividend would be how much? 0. Retention will be how much? 4. Let us calculate based on that. D is 0 by K plus retention is 4 into 0.12 divided by K square. That is 0.10 square. How much is that? 48. 48. Quickly help me with the numbers. The faster you give, the faster we will finish. Yeah. 48. So can you observe when the payout ratio is optimum, the value of so is increasing? Yes. Whereas here we used to follow 50-50%. So that means what was the value of the firm? Only 20. Was it optimum? No, sir. Next, let me take one more scenario. So earnings is 4, dividend is 2. So R is less than K here. R is 8% and K is 10%. Okay, sir. So D is 2 rupees. So earnings K is 0.10. R will be how much, guys? 4 minus 2, 2 into 0.08 divided by 0.10 to the power of 2. Final figure. 36. Now, when R is less than K, what is the optimum payout ratio? When R is less than K, what is the optimum payout ratio? 10%, 100%. Pay everything. Okay, sir. If I take optimum payout ratio, let us see. Dividend would be how much? 4. R will be how much? 0. So, D, 4 by K, 0.10 plus 0. As retention is 0, I am straight away putting it as 0. How much it would be? 40. Did the value of the share increases? Yes. At optimum payout ratio. So, hence proved. When R, I have written here, R is less than K, what is the optimum payout ratio? 100%. Same way, sir, when R is less than K, what is the optimum payout ratio? 0%. If it is equal to R is equal to K means anything is fine. Anything is fine. Yes. Next, Gordon model, only formula is different, whereas assumptions, conclusion, everything remains same, guys. Here, Gordon used the following formula. What is it? P, that is the current market price, is equal to E into 1 minus P divided by K minus G. What is P, sir? Current market price. E is what? Earnings per share. B is what? Retention ratio. That is 1 minus payout ratio. If payout ratio is 40%, how much is retention ratio? 60%. If payout ratio is 25%, how much is the retention ratio? 75%. Good. G, how do we calculate? Growth rate. B into R. R is return on investment of all equity firm. The entire company will have only equity, guys. Yes, simple, guys. See, earnings, assume EPS is 10 into retention ratio is 60%, 0.6. 1 minus 0.6 is how much? 40. What is it? Payout ratio. Payout ratio. So 4 rupees we will get. What is it? Dividend per share. Dividend per share. Actually, numerator is nothing but dividend per share. Earnings into 1 minus B. 1 minus B will give us what? Payout ratio. Dividend payout ratio. So earnings into payout ratio, what do we get? Dividend per share. Divided by K minus G. It is nothing but dividend growth model. Dividend growth model. So the formula is nothing but D1 divided by K minus G. D1 divided by K minus G. Clear? So whatever we get here in the numerator is nothing but D1. Dividend at the end of the year. So here also conclusions would remain same. Gordon model conclusions about dividend policies are similar to that of Walter. This similarity is due to similarities of assumptions. So let me just prove it quickly. So formula you know, E into 1 minus B divided by K minus G. So I have taken different scenarios. So many scenarios may not be asked in the exam, but still just for your understanding, guys. Cost is 11%, earnings is 20 rupees, or they have given 3 different scenarios, 12, 11 and 10%. The market price be determined if retention ratio is 90%, 60% and 30%. Yes, different scenarios we are doing. First, R is equal to K. Sorry, R is equal to 12%, so R is more than K. How much is R? 12%. How much is K? 11%. Correct? Yes. Let me first calculate growth here. G, retention ratio 0.9 into 0.12. That is the reinvestment.
0.108.
0.108 or 10.8. Okay, sir. Same way. G is equal to 0.6 into 0.12. 0.1? 0.72. Correct? 7.2%. Okay. Then G is equal to 0.3 retention rate into growth rate. On retention, what do we earn? Small r. So it is 12%. 0.036 or 3.6 growth rate. Yes, sir. Now let us apply the formula. P is equal to E is 20. So 20 into 1 minus 0.9. So what is the payout ratio? 10%. Yes, sir. So divided by K. K is 11, 0.11 minus 0.108. Give me the number.
2 by 2 by
Okay, final figure you tell me. 1000. Final amounts you tell me straight away. Okay, P is equal to 20 into 1 minus 0.6. What is the payout ratio? 40%. So what will be the dividend per share? 4 rupees. Sorry, 8 rupees. 8 rupees. Yeah. Divided by 0.11 minus 0.072. 211.
Yeah.
211. Next, P is equal to 20 into 1 minus 0.3 divided by 0.11 minus 0.036. 189.19. 189.19. Guys, observe. R is more than K. What is the optimum dividend payout ratio? What is the optimum dividend payout ratio? R is more than K. 0%. So you can see R is more than K. Optimum dividend payout ratio is 0. Payout ratio here how much? 10%. Here how much? 40%. Here how much? 70%. So wherever the payout ratio is least, value is more there. Value is more there. Correct? Now if I bring it to 0, for example B, assume I keep it as 100%, still the value will go up more than 1000. It will go up to more than 1000. Yes, sir. Next, R is equal to 11. So R is equal, K is also 11. So they both are same. So that means value will also remain same. G is equal to 0.9 into 0.11. Quickly. 9.9. So G is equal to 0.6 into 0.11. 0.66. G is equal to 0.3 into 0.11. 0.033. Yes. So coming to the values, B is equal to 20 into 1 minus 0.9 whole divided by 0, K minus growth rate 0.099. 180? 182, right? Okay. So P is equal to 20 into 1 minus B, B is 0.6 divided by 0.11 minus growth rate 0.066. 182. Same way, 20 into 1 minus 0.3 divided by 0.11 minus 0.033. 182. As R is equal to K, whatever you declare and pay, it will remain same. It will remain same, whatever is the payout ratio. Next, R is less than K. R is 10% and K is 11%. So what is the optimum payout ratio, guys? Optimum payout ratio, 100%. So higher the payout ratio, higher would be the value of the firm. Higher the payout ratio, higher would be the value of the firm. Let us see it. So growth rate I am calculating first. 0.9 into 0.10. 0.09. Here growth rate 0.6 into 0.10. 0.06. Growth rate 0.3 into 0.10. 3%. Okay. P is equal to 20 into 1 minus 0.9 whole divided by 0.11 minus 0.09. 100. Next, P is equal to 20 into 1 minus 0.6 divided by 0.11 minus 0.06. 160. P naught. 20 into 1 minus 0.3 divided by 0.11 into 0.03. 175. So you can observe as the payout ratio increases, it is not 100%, but as it increases, the value of the share is increasing. Sir, what if I keep the payout ratio as 100%? It may increase further. It may increase further. Yes, sir. Yes, coming to irrelevance of dividend. Here, as per this approach, they are telling no matter what is the dividend payout ratio, value of the firm will not affect due to that. If the dividend policy doesn't affect the value of the firm, it is considered as irrelevant. Approach. According to the theory, the value of the firm depends solely on its earnings power resulting from investment policy and not influenced by the manner in which its earnings split between dividends and retained earnings. Investors are indifferent to dividends and capital gains. They are happy with both. You give dividends or capital appreciation. We are happy with both because both are income for us. Yes. And so dividends have no effect on the wealth of the shareholders. So how do we calculate the present value of the share? P0 means the value of the share today. D1 plus P1 divided by 1 plus K. Here we are assuming the N or life of the investment is only 1 year. We are selling the investment at the end of first year. So dividend we will get at the end of first year plus sale value P1 whole divided by, as both of them is at the end of first year, we are dividing it by 1 plus K to find out what present value. Yes, total fund requirement. Here some calculations are there. It is like this. Total fund we require for investment purpose is how much? I. And dividend to be paid. Guys, we already have n number of shares which we already issued. So we have to pay dividend for each and every share. Yes, how much? D1, dividend per share. So how much total dividend we have to declare and pay? D1 into N for the existing shareholders. Then retained earnings available for the investment proposals is how much? E is the total earnings we have got minus dividend declared. Minus dividend declared. What do we get? Retained earnings. Now how much I have retained earnings? Remaining investment I have to get it through new issue. Clear? Yes, I will explain with an example. External fund is to be raised by issue what? M number of new shares at a price of P1. We are raising the money at the end of first year. So what is the price at the end of first year? P1. How many new shares I will issue? M. So we can write the following formula like this. Guys, listen. So totally assume I require 10 lakh rupees for the purpose of investment. Yes. Now from my business, I have earned 5 lakh. 5 lakh. Can I use it for my investment purpose? Yes. But for my existing shareholder, let me give some minimum amount of dividend. Minimum amount of dividend. Now let us assume N, the existing number of shareholders is 1 lakh. For each of them, I am giving 2 rupees dividend per share. D1. How much I have to spend for dividend? 2 lakh. Correct. So how much I have retained now? Earnings is 5 lakh minus dividend I have paid 2 lakh. How much I have retained? 3 lakh. Now I totally require how much investment? 10 lakh. I have retained earnings how much? 3 lakh. How much new amount I have to raise now? 7 lakh. How will I raise it? By issuing M number of shares at P1. Clear? M number of shares at P1. Yes. So the formula is like this. MP1, that is as per my calculation, we have to get how much? 7 lakh. 7 lakh. How did we get it? Investment 10 lakh minus earnings is how much? 5 lakh. Out of that, how much we are paying dividend? 2 lakh. Correct. So on the other side, how much we will get? 7 lakh. Now this 7 lakh, how will I raise? By issuing M number of shares at P1. So using this formula, actually we determine M. We calculate M. Now what would be the value of the firm at the end of first year? P1 is the price at the end of first year. Now at the end of first year, we have totally how many number of shares? N, which was already there, plus new shares which is issued now, M. So it is M plus N. M is issued at the end of first year. So after that issue, we are calculating the value of the firm. Okay. Minus investment because the money is going out, plus earnings, whatever we have earned, profit generated, divided by all these values is at the end of first year. So if I want to calculate the value of the firm today, I have to divide it by 1 plus K, guys. 1 plus K. Yes, sir. Yeah. Let me explain this with a question. Consider the following data. Capitalization rate 12%, current market price P0 is 100. Expected dividend per share, that is at the end of first year, 3 rupees. Share outstanding, that is as of now, N, 20,000. Expected earnings at the end of the year, 3,50,000. Fund required for investment proposal is 5 lakh. Find out market price at the end of first year, that is P1. Number of shares to be issued, that is small m. Value of the firm, when dividend is declared, not declared. Both cases we will see. Dividend declared or not declared. First, MPS at the end of year 1, we will use this formula. Everything we know except P1. Except P1. Let us determine that. Help me with the numbers. P0. Okay, let me put straight away the values. P0 we know. How much is that? 100. 100. D1, dividend declared, na? So whatever is the earnings, 3 rupees. 3 rupees. Plus P1 we don't know. We will keep it as it is. Divided by 1 plus K. 1 plus 0.12. So 100 into 1 point. So 112 is equal to 3 plus P1. So P1 is equal to 109. 109. Coming to the other side, dividend is not declared. So it is 100 is equal to 0 plus P1 divided by 1 plus 0.12. So P1 is equal to straight away 112. P1 is changing, but value of the firm will not change. Don't worry. Number of shares to be issued, guys. Now, what is the formula? This formula we have to use. MP1. Now, did we find out P1 already? Yes, sir. M I will keep as it is. 109 P1 is equal to I is how much? Investment. 5 lakh. 5 lakh. Minus earnings. 3.5 lakhs. Minus ND1. N is 20,000 into 3. So 20,000 into 3. How much is that? First, tell me the right hand side. Sorry? Final figure, na? So divided by 109. M is equal to 1927. Point something you are getting? No. 1927 number of shares. New number of shares. Okay. So other side, M into 112 is equal to 5 lakh minus 3.5 straight away. That's all. No dividend. Nah? So that part will not come. No dividend. Yes, sir. So 100 and M is equal to how much? 1,50,000 divided by 112.
So 1339.28.
1339.2.
1,340.
340 I will make. Round off. Some extra money we may get. It's okay. So this is a new number of shares to be issued. Now let us calculate the value of the firm, for which we have to use this formula. P1 we know. How much is that? 109 plus M 20,000 is the existing share plus new share is 1,927 plus investments. Minus investment, which is 5 lakh. I'm just writing it in lakh. Minus, plus earnings 3.5 lakh divided by 1 plus K. 1 plus 0.12. Tell me the final value.
20 lakh, 38 rupees.
20 lakh. Okay, 38 we can ignore as it is a minor difference. Okay, 20 lakh or 20 lakh 38. Exactly also you can write. Coming to this side, 112 into 20,000 which was already there plus new share 1,340. 1,340 new shares which we have issued minus 5 lakh plus 3.5 lakh. Okay, whole divided by 1.12. 20 lakh only. Okay, just some difference we may get because of round up. We have round up the number of shares. Actually, we should get same. Sir, now is there any difference? No. Value of the firm will remain same. So whether we declare dividend or not declare dividend, will it affect the value of the firm? No, it will remain same. The minor amount, whatever 30, 20 and all, guys, I have ignored it because it should be same. Here it is not exactly same. Why? Because here we have rounded up the number of shares. That's all. Yeah, only for that reason we are getting some minor difference. If not, it should be exactly equal. Ditto. Okay. Next, coming to stock split. Stock split is like breaking the face value of the share. Guys, listen, I will give an example. Now assume the equity share capital like is, just a minute. Equity share capital is 1 lakh equity share of rupees 10 each, sir. So how much is that? 10 lakh. Will there be any change in this? No. What do they do is they will break the face value. Assume we are breaking it for rupees 5. We call it a stock split in the ratio of 2:1. Now what happens? It becomes 2 lakh equity shares of rupees 5 each. So what would be the share capital? 10 lakh. Will there be any change in any other amount, reserves and surplus? Nothing, no other change. Only change here is with respect to number of shares and face value. That's all. Now assume before stock split, I was holding 10 shares and the CMP, current market price was, before stock split I am talking about, was 500. Now after stock split, I will have how many shares? 20 shares. And CMP will be how much? It get adjusted. It get immediately adjusted, divided by 2. Stock split ratio is how much? 2:1, na? So it becomes divided by 2. So it will be 250. There is something called as a record date. On that day, it will be automatically get adjusted. Share price. Clear? Yes, sir. So will there be any change in the value of my investment? No. Before stock split, what was the value of my investment? 10 into 500 rupees. After stock split, what is the value of my investment? 20 into 250. So because of stock split, did anything change? No. Same way from company point of view. Sir, amount of capital remains same. Only number of shares and face value got changed. And sir, why does the company do this? To increase the volume of the shares, guys. That is to increase the number of buyers and sellers. Because when it is affordable, assume at 500, everyone may not buy and sell. So if it is 250, even small investors can buy and sell it. So to increase the volume of the shares to be bought and sold, the company does this to make it more affordable to all that category of shareholders. A stock split is a decision by a company's board of directors to increase the number of shares outstanding by issuing more shares to the current shareholders. For example, in a 2-for-1 stock split, a shareholder receives an additional share for each share held. So if a company had 10 million shares outstanding before the split, it will have now how many shares? 20 million shares outstanding after a 2-for-1 stock split, which is nothing but breaking the face value. Sir, can we break the face value from 10 to 1 also? Yes. In that case, it will be 10:1. 10:1, guys. Yes. Generally, a company announces a stock split when the price of the shares has risen to the point that it might be unappealing to the investors who are more comfortable with lower priced securities. Okay, so just to make it affordable to any kind of investor, that is what even Reliance, Infosys, TCS, all these companies would be doing. But this has been never felt by MRF company. This has never been felt by the MRF company. They want to be the highest price, share price of in the Indian market. They are continuing with the same.
No, it is changed.
Fine. Now coming to bonus, it is not covered here, but still I will just explain. Sir, what is the difference between stock split and bonus? Assume, guys, equity share capital was 1 lakh shares of rupees 10 each. How much is that? 10. Yes. Reserves and surplus, let me take it as 25 lakh. 25 lakh. Now company wants to issue bonus, 1:1 ratio. That means for every 1 share you are holding, we will give 1 share free. Clear? Yes, sir. Now for that, what they do is they will move the amount from reserves to capital. Now after the bonus issue, how much will be the amount of equity share capital? 20 lakh. And how much will be reserves and surplus? Minus 10 it will become. So it will become 15 lakh. Clear? Yes. So what is the entry for bonus issue, guys? It is reserves and surplus or free reserves to equity share capital. Equity share capital. So amount is moving from reserves to equity share capital. That is what happened. So 10 lakh is moving from reserves and surplus to equity share capital. Yes, sir. So after bonus issue, how many number of shares would be there? 2 lakh at rupees 10. Did we break the face value? No. We moved the amount from reserves and surplus to equity share capital. We call it as capitalization of profits. Okay. Now assume I was the shareholder who is holding 10 shares at rupees 500 each. Will my investment double now? No. I will have 20 shares after bonus, but even here 500 will become divided by 2. So how much would be the value per share? At 250. So will my value of investment change? No. The price will automatically get adjusted on the record date. So there under stock split, we will break the face value. There is no change in the amount of equity share capital. Whereas here face value will remain same, but the amount is moving from reserves to equity share capital. Accordingly, number of equity shares also will increase. So if I ask you now, what was the equity shareholders fund before bonus? 35 lakh. What is the equity shareholders fund after bonus issue? 35 lakh. So ultimately, we are just adjusting between 2 8s in the balance sheet. That's all. Ultimately, the entire 35 lakh belongs to whom? The equity shareholders only. Then share repurchase. A stock buyback occurs when a company buys back its own shares from the marketplace with its accumulated cash. We call it as what? Buyback of securities. The repurchased shares are absorbed by the company, reducing the number of outstanding shares on the market. Because there are fewer shares on the market, the relative ownership stake of each investor increases. This is done when the promoters want to increase the number of shares, or their shareholding if they want to increase and all, or if they have a more and more belief on the company's future performance, they normally buy the shares from the open market or from the existing shareholders. This is all about chapter 6, guys. Yeah. Now coming to chapter 7, which talks about working capital management. The capital which is required to finance the current assets, that is short-term assets, is called working capital. It is the capital of a business which is used to carry out day-to-day operations of a firm. Working capital is equal to, how do we calculate it? Current assets minus current liabilities. Sir, what is current assets? Right, it is the asset which can be converted into cash within one operating cycle, that is within 1 year. It includes cash and cash equivalents like bank balance, cash balance, then debtors, bills receivables, or any outstanding incomes, or prepaid expenses, or income which is earned but not received. All this will come under current assets, and also inventory. Then coming to current liabilities, this is what I am supposed to pay within one operating cycle, that is 1 year, which includes creditors, bills payable, or any short-term loans or advances, or any outstanding expenses. All that will come under current liabilities. Now, what is optimum working capital? A firm should have adequate working capital to run its business operations. Both excessive as well as inadequate working capital positions are dangerous. We should not have too much also, we should not have too less also. It is the job of the finance manager to estimate the requirements of working capital carefully and determine the optimum level of investment in working capital. Current ratio and acid test ratio. Acid test ratio or quick ratio is one and the same. Has traditionally been considered as the best indicator of working capital situation. Current ratio will, like how do we calculate? Current assets divided by current liabilities. What is the ideal ratio? 2:1. Means my current assets should be at least twice of my current liabilities. This will tell how much money or how much assets we have in order to discharge short-term liabilities. Then quick ratio or acid test ratio, quick assets divided by current liabilities. Sir, how do I get quick assets? Current assets minus inventory minus prepaid expenses. So this measures how much amount I have immediately to pay my liabilities. The ideal ratio is 1:1. That means they have to be equal. Then there are different types of working capital. First one is initial working capital. The capital which is required at the time of commencement of business is called initial working capital. Regular working capital which we regularly need. The type of working capital which remains invested in the enterprise or the business for the successful operation. It supplies the funds necessary to meet the current working expenses. That is for the purchasing raw materials, supplies, payment of wages, salaries, and other sundry expenses. That is once the business has been commenced, in order to meet regular expenses, whatever capital we require is called regular working capital. Then fluctuating working capital. This capital is needed to meet seasonal requirements of a business. It is used to raise the volume of the production by improvement or extension of machinery. Sir, assume we have 2 months of peak season, during which time we have to produce more, sell more and all. So the amount of working capital what we require for that 2 months also will accordingly increase. Yes. Assume for the 10 months of a 10 months period we will have around 10 lakh. Whereas for another 2 months we may have like 12 lakh or 13 lakh extra money because my operations are more during those 2 months. Then reserve margin working capital, it requires the amount utilized at the time of contingencies. Maybe I would have set it aside somewhere. So you guys also would have maintained in your wallet inside somewhere. Normally you will keep in the front the money, but 100 or 500 or 2000, now 2000 note is not there. Whatever amount you would have kept somewhere inside or inside your book or somewhere you would have hidden. Why? In order to meet any emergency. Same way, the companies also may set aside adequate amount of working capital in order to meet any contingencies. Then permanent and temporary working capital. Permanent is something which we have to have throughout our life, which is minimum amount. For example, 2 lakh we should have at any point of time throughout our life of the business. Whereas temporary is which keeps on changing from time to time, which it will be increasing and decreasing. Then long-term working capital, permanent also is known as long-term, which I will maintain it for a longer period. Whereas short-term is, short-term means for 1 month, 2 months, 3 months we are maintaining so much, which may change over a long period. Gross working capital means only current assets. Whereas net working capital means what? Current assets minus current liabilities. Yes. Then determination of working capital. Working capital management is concerned with, if I have to manage my working capital, then I have to manage all my current assets and current liabilities properly. I should see how much should be my each of my current asset, how much should be my each of my current liabilities. Maintaining adequate working capital management of the level of individual assets and individual current liabilities. Then financing of working capital. First, I have to decide how much should be my working capital. Assume guys, I have decided my working capital should be 10 lakh. Now, all of the sudden, I cannot keep 10 lakh. Now, we should individually work out how much should be my inventory. Inventory includes raw material, how much, work in progress, how much, finished goods, how much. Then trade receivables, how much should be my debtors, how much should be my bills receivables. Then how much should be my cash and cash equivalents. Individually, I have to work out. Then current liabilities, individually, how much should be trade payable, how much should be like bills payable, creditors, bank overdraft, everything. Individually, you work out. Then deduct current liabilities from current assets. You should get 10 lakh. Clear? So that means once I decide working capital, then individually I have to work out how much should be my each individual current asset, each individual current liabilities. Yes, sir. So now, and next, sir, once I keep the working capital as 10 lakh, how do I get it? How do I get it? Working capital financing or current assets finance is done by raising short-term loans or cash credits, but fixed assets financing is done by raising long-term loans or equity. So working capital, normally we get it through short-term finance, guys. But if it is a permanent working capital, I can get it through long-term finance also. Now coming to operating or working capital cycle, which is nothing but, guys, I have money today. I invest it in my business. I purchase raw material. I purchase my raw material, put it into my production process. I will convert it into output. My output is ready. Immediately, I may not be able to find the customer. Yes, it will take some days for me to promote and advertise and then find the customer. I sold the goods to the customer on credit basis. Now, immediately I cannot collect the money. It will take some days. I have given some credit period for him. I will take, or assume 10 or 15 days to collect money from him. So what is the duration I have spent for this is called operating cycle. From the day I invested my money into purchase of raw material till the day I collect the money from my customers or debtors is called operating cycle. As a company, we should always try to keep it as less as possible. The operating cycle is the length of time between the company's outlay on raw material, that is on purchase of raw material, wages and other expenditure, whatever is the regular expenditure, and inflow of cash from the sale of goods. If it is immediate cash sales, then there is no question of debtors and all. But here, while we are deciding the operating cycle and all, whenever sales is given, we will assume or consider it as credit sales, guys. Management has to remain cautious that the operating cycle should not become too long. We should try to keep it as low as possible. So what is operating cycle? Sir, we had cash. We started the business. Cash in the sense cash and cash equivalents, both, guys, includes bank balance also. So we invested that to purchase raw material. Then we are converting it into output. In between, we will have work in progress, that is partly finished goods. Then receivables, which is nothing but when I have sold it on credit basis, which is nothing but debtors. Then I will collect money from them. So how long did I take from cash to cash? From cash to cash, how long did I take it? So that is called operating cycle. So how do we calculate it? In the form of equation, raw material storage period plus work in progress holding period, which is nothing but production period. We also call it as production period. How long do I take to produce my output? Now raw material storage period means what, sir? Guys, I would have purchased raw material today. Immediately will I use it today only? May not be. How long will I take it till I use? From the date of purchase till the date I use it, how long did I take? Then work in progress, the holding period is nothing but how many days did I take to produce the output. Then once the output is produced, immediately I may not be able to find the customer. So once the output is ready, sir, ready to sell, I may take 10-15 days to find the customer and sell it. So that is called finished goods storage period or holding period. Then, sir, I have sold the goods on credit basis to the customer. Now he has taken a credit period of 30 days. So this is called receivables collection period or debt collection period. Fine, sir. Then I have purchased goods from suppliers on credit basis. How long did I take? That is called credit period allowed by suppliers. And this I should try to keep as high as possible. Whereas the remaining as low as possible. As low as possible. Yeah. Let us see how do we calculate each of this. Raw material, period of raw material stock. That is once I purchased it, how long did I hold it? Average stock of raw material divided by consumption of raw material per day. Yes, average stock of raw material, how do I calculate? Opening plus closing all divided by 2. Then period of credit granted by supplier, I am deducting here only. Sir, can I deduct it at the end also? Yes, better is to do here because both of them related to raw material. This is if I have purchased the raw material on credit, how many days I have taken credit in order to pay to the supplier. And we are reducing it because this is what we have got. And we should always try to keep it as high as possible. Average level of creditors divided by, why did creditors come into picture? Purchase of raw material per day. And here purchase means what purchase? Credit purchase. If in the question, if they have not specified whether the purchase is credit or cash, assume entire purchase is on credit basis. Then period of production, average stock of work in progress divided by cost of production per day. Yes, sir. Next, period of turnover of finished goods stock, average stock of finished goods divided by average cost of goods sold per day. Yes. Then period of credit taken by customer, average receivables, nothing but debtors or bills receivable divided by average value of credit sales per day. Why did debtors come into picture? We have made a credit sales. So credit sales per day. And even here, if only sales is given in the question, assume the entire sales is credit sales. Or if they only given a breakup, for example, sales is given as 20 lakh. In that 12 lakh is credit sales, 8 lakh is cash sales. Then accordingly do it, guys. Clear? If nothing is given, assume entire purchases and sales is a credit. Okay. And one more thing, consumption and purchase of raw material normally is not same. Consumption and purchase of raw material is not same. If they have given it separately, take it. Sir, if they have given it as one, sir, then consider both are same. Yes, sir.
It's sweating, sir.
Who is having remote? Shocked to listen this doubt. Sure. Fine. We have some questions on this. Okay, first let me finish this also. Now see, once we decide the operating cycle period, assume guys, we are getting it as 120 days. We are getting it as 120 days. No company will be happy with it. They always want to reduce it or put it down. Hey Sam, listen here. Put it down. And they will always try to figure out how do we reduce it. How do we reduce it? And for this operating cycle, we should have enough working capital with us. We should have enough working capital with us. Sir, how much should we have inventory, trade receivable, cash, creditors, bills payable, everything? We have to calculate. Actually, this one of the question is asked in even exam, which I would be discussing along with the question paper. Okay, now coming to operating cycle calculation. You can see, calculate the operating cycle from the following figures related to the company X. Raw material inventory 1,80,000, work in progress inventory 96,000, finished goods inventory 1,20,000, debtors 150, creditors 1 lakh. Purchase of raw material per day 2,50,000. Cost of sales per day 4,000. Sales 5,000. Sales they have not mentioned with sales, sir. Credit sales. Assume it to be credit sales and just give a note. And one more thing, guys. See, in the formula and all, everywhere it is average. If they have given both opening and closing, add up both divided by 2. No, sir, they have given only one figure. Straight away take it. Yes. So raw material holding period will be what? Average stock of raw material. Average stock of raw material is how much? 1,80,000. 1,80,000 divided by consumption of raw material. Consumption is not separately given. So for this question, purchase and consumption will be equal. How much is that? 2,500. How much is that? Quickly. 72 days. Then average level of credit period we are calculating. Average level of creditors is 1 lakh. Yes, sir. Then purchase of raw material per day 2,500. Guys, I repeat. Normally consumption and purchase will not be same because there will be opening stock of raw material and closing stock of raw material. If they are given it separately, please take it in the respective calculations. If they are not given it separately, then assume consumption is equal to purchase. 40. This we have to deduct because this is what we have got. Period of production will be average stock of work in progress, which is 96,000 divided by cost of production per day. Cost of production per day is not given, sir. Then what should we do, sir? Take cost of sales, cost of goods sold, cost of production per day is same. Clear? So cost of production, no, cost of sales, so cost of goods sold per day is same. How much is that? 4,000. If they are given separately, please take it. 24. Then average stock, next finished goods holding period. It is 1,20,000 divided by same 4,000. 120 divided by 4,000. 30 days. Then debt collection period, that is from the customers. 1,50,000 divided by sales per day 5,000. 150. 150 divided by 5. And you have to give the note for this kind of question, assuming entire sales, whatever is given in the question is credit sales. So how much is that? 30. What is the operating cycle period?
160.
160.
116.
16. 116 in days. In days. So, sir, it will take for this cycle to complete. For this cycle to complete, how many days it is taking? 116 days. Is it good, sir? No. Because now, for this 116 days, till I get the money from operating cycle, I should have enough working capital to run my show. Because in this 116 days, there will be number of expenses which I will be incurring. So for that, I should have my working capital ready with me. Yes. So how will I reduce it, sir? Maybe I have to take some necessary steps. Where and all it is more, I have to try to reduce it. Debtors could be cut by quicker collection period. Means I am already giving them 30 days, try to reduce it for 20, 25 days or 15 days. Then finished goods could be turned over more rapidly. So finished goods, you can see I am holding it or storing it for 30 days. Try to find out the customer as early as possible and sell it. Okay. Next, level of raw material inventory could be reduced. See, raw material especially is very high, 72 days. Means once I purchase raw material, till I use it, I am taking 72 days. So better try to use it as early as possible. Then production period is shortened. So production period is 24 days, which is okay. Depends on exactly what I am producing. But if possible, try to reduce that also. Try to reduce that also. And one more thing, try to take more time from the creditors. Okay, like 50 days, 50, 60 days like that, try to take it if possible. Okay, one more question. Average stock of raw materials and stores 2 lakh, average work in progress inventory 3 lakh, average finished goods inventory 1,80,000, average accounts receivable 3 lakh, average accounts payable 1,80,000, which is nothing but creditors. This is like debtors. Average raw materials and stores purchased on credit and consumed per day. Purchased and consumed is same, 10,000. Average work in progress value of raw materials committed per day, 12,500. Okay, it is nothing but cost of production per day. Cost of production per day. Average cost of goods sold per day 18,000. Average sales per day 20,000. Okay, guys. Chalo. Raw material. Average stock of raw material is 2 lakh divided by consumption per day 10,000. So 20 days. Then average level of creditors. Where is creditors? 180. 180. Purchase of raw material per day, same thing, 10,000 only. 18. Then average stock of work in progress, 3 lakh. Divided by cost of production per day. I told you this is 12,500.
24 days.
24. Next, average stock of finished goods, 180. 180. Cost of goods sold per day, 18,000.
10 days.
10 days. Then average receivables, 3 lakh. Divided by credit sales per day, 20,000. 51 days, which is okay, which is good. If possible, still try to reduce it, but not too much. Not too much. 50 is okay. Whereas here in this question, it was 116 days. Here also, any company, guys, will not be happy with operating cycle. Okay, so if it, even if it is 51 days, they will try to reduce. Okay, where and all we can reduce. 20, we can bring it down to 18, 19 at least. Then 24, we can at least bring it down to 20 or something like that. They will try to reduce it as less as possible. Okay, one more question quickly. Calculate the finished goods conversion period. If finished goods opening stock is 525 and finished goods closing stock is 850. So can I calculate average 525 plus 850 whole divided by 2? 687.5 lakhs. Okay. Then cost of production is 8,000 lakhs. Number of days in a year is 300. Cost of goods sold, can I calculate? Yes. How is it? Opening stock plus cost of production minus closing stock. So opening stock is 525. Cost of production is 8,000 minus closing stock is 850. 7675 lakhs. Then cost of production, cost of goods sold per day 7675 divided by how many days in a year? 300.
26 days.
Days are 26 lakhs. 20? Exactly tell me. It is per day. 5.58 lakhs per day. So average stock of finished goods is 687.5 divided by 25.58. Finished goods conversion period would be 87 days, not lakhs, days. 26.87 days. Yes. Yeah. Next, individually we will look into one by one, like cash management, inventory management, receivable management is a part of your syllabus. Not everything. Creditors management and all is not covered in detail. Okay. Inventory management. Inventory management. Sir, this is the second line item. You can observe. First, once I invest cash, I will invest into what? Raw material, work in progress and finished goods. So what is the second most important in the operating cycle? Inventory. And inventory includes all raw material, work in progress and finished goods, guys. Inventory management is the second important segment of working capital management. Inventory is the second step in the operating cycle, wherein cash is converted into various items of inventory, that is raw material into WIP, WIP into finished goods. Yes, strategy for inventory management. A successful strategy for inventory management has at its core the objective of holding the optimum level of inventory at the lowest cost. And when it comes to holding inventory, we have three costs associated with it, guys. First one is ordering cost. Let me take. What is ordering cost, sir? Now I have to figure out the supplier and I have to order him and I have to receive the material. So I will call for a tender invitation. I will select the respective supplier. I will place the purchase order. I will receive the goods from him, for which I have to incur transportation cost and loading, unloading cost and all. All these are called as what? Ordering cost. Till I receive the material in my godown or storehouse, what all cost I will incur is called ordering cost. Next, coming to carrying cost. Carrying cost is something which is incurred to look after my material. Once I have received it, till the date I use it, I have to look after it, I have to store it. Now for that I need space, for which I have to pay rent. Then during storage I will take insurance policy, for which I have to pay premium. So to look after the raw material from the date I received it till the date I use it, what all cost I incur is called carrying cost. Then stock out cost is, sir, I require raw material but I don't have it. This is a situation of stock out. I require raw material but I don't have it. This will affect the production process, plus this will damage our reputation. Because if I cannot deliver on time to the customer, he will never come back to me again. So this will affect not only the present but also the future. Okay. Next, we have managing the inventory level. The first one is EOQ, guys. Now assume totally in a year, guys, I require 1 lakh kgs of raw material. And anything we calculate in this chapter or under the inventory management, whatever this EOQ calculation and all is for raw material. Please be careful for raw material, even setting up of various stock levels. Now in a year, assume the total annual demand of raw material is 1 lakh kgs. Now I have enough money with me. Can I purchase the entire lot and keep it? No. Why? Because carrying cost will be huge. Because assume 1 lakh kgs or even 50,000 kgs at a time I am purchasing and I am keeping it. I need more space to store it. I have to pay more rent. I have to pay more insurance premium, and there will be a chances of having loss, obsolescence, and also whatever money I would have invested to purchase the stock, I would have got it from somewhere, for which I have to pay some return. That is cost of capital will be there. Yes. So when the quantity is more, carrying cost will be more. Whereas ordering cost would be less. Why? Assume, guys, I am placing only 2 orders, 50,000 kgs, 50,000 kgs. How many orders are there? Only 2 orders. As the number of orders are less, ordering cost also will be less, because I have to arrange for transportation, loading, unloading and all only twice. So ordering cost would be less. Whereas if I take reverse scenario, now assume, sir, quantity I am purchasing in very less lot. For example, 1000 kgs at a time or 2000 kgs at a time. In that case, I require very less space to store this. So less rent, less insurance premium. The chances of obsolescence or raw material getting outdated will be very less, because I have purchased very less quantity. Yes, sir. So carrying cost will be very less. Whereas ordering cost will be more. Why? Because assume I am placing order for every time for 1000 kgs. I have to place the order 100 times. Number of orders are how much? 100. So 100 times I have to arrange for the transportation, loading, unloading, issue purchase order. So all this is extra efforts. So ordering cost would be more. So now I have a confusion. Sir, if quantity is more, carrying cost will be more. If quantity is less, ordering cost is more. But both are costly to me. I want to keep both of them as low as possible. Tell me how much quantity should I purchase? That is what is called EOQ, economic order quantity. If I purchase at EOQ level, assume guys using EOQ formula, we have got 10,000 kgs. That means if I purchase 10,000 kgs at a time, every time I am placing the order, if I purchase 10,000 kgs, then the total of carrying plus ordering cost would be minimum. Adding both would be minimum. And at EOQ, this two will be equal. Total carrying cost will be equal to total ordering cost. Let us see how do we calculate it. First one, EOQ. EOQ is the lot size at which the total of ordering cost and carrying cost will be lowest or least. EOQ can be calculated by using the following formula. Square root of 2 into annual consumption or annual demand of what? Raw material into cost of placing an order, ordering cost per order, divided by carrying cost per unit per annum. Please be careful. This is also annum. This is also annum. If by chance, if they have given it per month, per week and all, convert it per annum. Convert it per annum. Even if carrying cost is given as a percentage, please apply it on purchase price. If carrying cost is given as a percentage, please apply it on purchase price. Simple logic. Higher the value of the raw material, higher would be the carrying cost. You have purchased iPhone, how will you look after it? You have purchased one basic phone, how will you look after it? Clear? Same way, if the cost of the raw material is more, carrying cost also will be more because we have to take exceptional care of it. No, sir, raw material is 1 rupee per kg, 2 rupees per kg. I don't mind even if I lose some kgs. So accordingly, carrying cost also will be less. This model determines the order size that will minimize the total inventory cost. Assumptions underlying the EOQ, ordering cost per order and carrying cost per unit per annum are known and are also fixed. Fixed in the sense whatever number we are considering, we are assuming that it will remain same for even future. Expected usage or requirement of material is known. That is the annual demand or annual consumption. Sir, I am estimating it standing at the beginning of the year. At the end of the year, will it be same number? May not be. But I am assuming I know it and it will remain fixed. Okay. Cost per unit of material, that is purchase price, is constant and is known as well. Lead time is 0. What is lead time, sir? If I place the order today, how long will it take to the supplier to deliver it? Assume I place the order today and he delivered it after 7 days. What is the lead time? 7 days. The time gap between the placing of order and receipt of goods. And here they are considering it as 0. And guys, see, please be careful. Whatever we are using here, carrying cost per unit per annum here. Sir, how do we calculate total carrying cost? The formula is half into lot size into carrying cost per unit per annum. This will give us total carrying cost. Same way, whatever we are using in the formula, EOQ formula is ordering cost per order. But can we calculate total ordering cost? Yes. What is the formula? Annual demand divided by lot size. If I do this, we will get number of orders. How many orders should we place? Assume 1 lakh kgs I totally require. Every time I am placing the order for 10,000 kgs. How many orders should I place? 10 orders. Into, what is the ordering cost per order? Into ordering cost per order. Yes. And at EOQ level, this two will be equal. This two would be equal. Yes. Let me quickly see the questions. Fourth one, the following details are available in respect of a firm. Annual requirement of the inventory is 40,000. Cost per unit, other than carrying and ordering, which is nothing but purchase price, 16 rupees. Carrying costs are likely to be 15% per annum. So 15% has to be applied on what? 16 rupees. Cost of placing an order, 480 per order. Determine the EOQ. So EOQ is equal to, what is the formula? Square root of 2 into annual consumption into ordering cost per order divided by carrying cost per unit per annum. So 2 into annual demand 40,000. Cost of placing an order is into 480. Whole divided by 16 into 15%. Okay, that is purchase price into percentage. Final figure. Four thousand units. Means every time when I am placing the order, if I place the order for 4,000 units, my cost would be minimum. At the end, please put the square root. Don't miss that. Got it, na? Next, a publishing house purchases 72,000 reams of a special type of paper per annum, annual demand, at a cost of 90 per ream. Ordering cost per order is 500 and carrying cost is 5% per year of inventory cost. Normal lead time is 20 days and safety stock is nil. Okay. Assume that 300 working days in a year. Calculate the economic order quantity. Calculate the reorder inventory level also they have asked. Okay. First EOQ we will do. EOQ. Yes, sir. 2 into annual demand 72,000 into cost of placing the order 500 divided by carrying cost per unit per annum 90 rupees into 5%. What is the final number? 4,000 reams. So every time I place the order, if I purchase 4,000 reams, my cost would be minimum. Yes, sir. Reorder level I have not yet discussed, so we'll keep it on hold. Later we will discuss. Now there is one option. Now see guys, if there is nothing else, every time the company is placing the order, they will place the order for how many reams? 4,000 reams, so that their cost would be minimum. Now supplier is giving some offer. Let us see. If 1% quantity discount is offered by the supplier for purchase in lots of 18,000 reams, means every time you are purchasing 18,000 or more, should the publishing house accept the proposal? So if there is no offer or proposal and all, I used to follow lot size of how much? 4,000. At that case, what is the purchase price? 90 rupees. But now the supplier is giving some offer and all, telling if you purchase 18,000 reams at a time, I will give 1% discount. How much it comes to? 89.1 purchase price. So here lot size would be 18,000, here it would be 4,000. Purchase cost will be for 72,000 only into 90, and here 72,000 into 89.1. Figures please. 72,000 into 90. 64 lakh 80,000. Other side. 200. Total ordering cost, guys. Come on, tell me the formula. Annual demand divided by lot size 4,000 into ordering cost per order 500. 9,000. And without even calculating, I can tell this will be 9,000. How is it? Half into lot size into carrying cost per unit per annum. That is 90 into 5%. It will be 9,000. Next, coming to this, 72,000 divided by lot size is 18,000. Please be careful. Into rupees 500. 2,000. Here it would be half into lot size 18,000. Lot size means how much units we are placing the order for. Into 89.1 into 5%. When purchase price change, carrying cost also will change. 40,000? 95. Totals please. Totals quickly. 6,98,000. $295. Which is better, sir? This is 64,98,000. Nah? Yes. So which is better, sir? Discount. So as we will save the cost, will we accept the discount offer and purchase 18,000 reams at a time? Yes, as it will lead to savings in cost. Okay, sir. Done with the EOQ. Next, setting up of various stock levels. Now, sir, what is this? I will just explain with an example. Assume, guys, this is a container where I am storing my raw material. This is a container where I am storing my raw material. I have fixed the reorder level. Reorder level as 10,000 kgs. 10,000 kgs. What is the meaning of it, sir? Whenever my inventory touches 10,000 kgs, immediately I will place the order. Immediately I will place the order. For how many units will I place the order is called ROQ, which is nothing but normally EOQ. ROQ and EOQ normally will be same. Whereas, see in this example, can I tell ROQ is like 18,000 if I accept the offer? Yes. Whereas EOQ is how much? 4,000. But if nothing is given in the question, we assume ROQ and EOQ is one and the same. That is the quantity for which we place the order. Okay. Now let us consider We are placing the order for 6,000 kgs at a time. So what is the reorder quantity? 6,000. Guys, listen here. Once my inventory touches 10,000, I will place the order for how many kgs? 6,000 kgs. Now, will I receive immediately? Maybe no. We will have some lead time. Clear? In EOQ, lead time will be 0. Now, we have come out of EOQ already. Yes, sir. Now, assume lead time is 5 days. So, during that 5 days also, I will be consuming some raw material. Yes. So, my inventory will go below 10,000. Yes, sir. But I will fix some minimum stock level bar. Assume it is 7,000. My inventory can never go below this. Even during lead time, it can never go it. So I repeat, guys, I will place the order at 10,000. For how many kgs? 6,000. But by the time I receive, I will be using the inventory, which will keep on going down. But it can never go below 7,000. 7,000 is minimum, bare minimum, which I should have throughout the year. Okay, sir. Assume somewhere it was around 8,500. So we received the lot. So 8,500 plus 6,000 will become 14,500. 14,500. I keep on using it. Till when? Till it touches 10,000. As soon as it touches again 10,000, what will I do? Place the order for 6,000. Clear? Until I receive, will I keep on using it? Yes. I will be keep on using it. And once I receive again, my inventory will go up. And when it goes up, it can never go above maximum stock level. Maximum stock level. Assume, guys, maximum stock level, I am fixing it at 18,000 kgs. It is like a top end. Sir, I can never go beyond this, or my inventory should never go beyond this. Is that clear? So reorder level is the inventory level at which we will place the order. For how much quantity we place the order is reorder quantity. If they ask you to calculate reorder quantity, you have to use the formula of EOQ only. Okay. And minimum stock level is my inventory should never go below this. Maximum stock level is my inventory should never go beyond that. Beyond that. So you would have heard something about cap and floor in stock, similar to that here. Maximum is what? Cap. What is minimum? Floor. Minimum is that. It can never go below that. Yes. Here don't use the word cap, floor and all. I am just trying to connect it. So I have given it in simple. Reorder stock level means at what stock level order should be placed. How much quantity we are placing the order is called what? Reorder quantity or EOQ. And if they ask you to calculate reorder quantity and all, please use the formula of EOQ one. Minimum stock level means at least how much stock level to be maintained at all time. Maximum stock level means up to how much stock level to be maintained. Average means what? Stock normally kept. How do we calculate average? Minimum plus maximum whole divided by 2. Okay. We have a formula to calculate all this. We will see. Reorder stock level. It is the level at which fresh order should be placed for replenishment of stock. That is to increase the stock level. What is the formula? Maximum consumption into maximum reorder period. This is always the first formula you will use. If that is not possible, only then go with the second one. What is the second formula? Average consumption into average lead time plus minimum stock level. Now, what is the formula for minimum stock level? First of all, what is minimum stock level? Lowest figure of inventory balance which must be maintained at all time during the year. What is the formula? Reorder level minus average consumption into average lead time. The same formula has been interchanged the position. That's all. Here we used it to calculate reorder level, and here we are using to calculate minimum stock level. Same formula, interchange of position. Maximum stock level. It indicates the highest level of inventory which should not be exceeded at any point of time. So the formula is reorder level plus reorder quantity minus minimum consumption into minimum lead time. Something extra is coming. Why, sir? Maximum stock level should definitely be more than minimum stock level. Clear? And to calculate maximum, we use minimum consumption into minimum lead time. Whereas for minimum, we use average into average, not maximum. Minimum into average into average. Yes, sir. Average stock level, minimum plus maximum whole divided by 2. Lead time or reorder period means, guys, it is a time gap between the date of placing the order till I receive it. I assume I placed the order today with you to deliver 5,000 units to me. You took 7 days. What is the lead time? 7 days. And during this 7 days also I have to consume something now. We call it as lead time consumption. Means will I stop the operation for 7 days and sit? No. Okay, that is why we have reorder level. Okay. So once I touch this level, I will place the order. You may take some days to deliver it to me. Still I have inventory with me to use it. I will be keep on continuing with my operations. Now what is stock out situation? Sir, I want raw material but I don't have it in my godown. This will interrupt my production process. This will hamper my sales also. Why? Because I'm not able to deliver on time to the customer. So my reputation also will be at stake. Yeah, some quick calculations. Calculate reorder level, minimum stock level, maximum stock level, average stock level. Normal usage is 100 units per week. Maximum usage is 150 units per week. Minimum usage is 50 units per week. Reorder quantity is 500 units. They are only given. Lag in time means lead time. 5 to 7. Minimum is how much? 5. Maximum is how much? 7. Average is how much? 6. Okay. Now annual demand have they given? So first of all, annual demand and all. If by chance, if they ask you to calculate EOQ, annual demand is not given. In that case, how do I calculate annual demand, sir? Normal usage you take per week into number of weeks. That is 52 weeks. If at all, if they ask you to calculate EOQ, normal usage per week into number of weeks in a year, guys. Okay. We'll do one by one. Reorder level. Reorder level, maximum consumption into maximum reorder period. Maximum consumption is per week 150. Maximum reorder period is 7. 50. Next, minimum stock level. The formula is reorder level minus average consumption into average lead time. Average consumption is 150 into average lead time. 5 plus 7 volt divided by 2, 6. Final answer. 450. Please cross check. Okay. If there is any changes, please let me know. Then maximum stock level. What is the formula? Reorder level plus reorder quantity minus minimum into minimum. So reorder level we have got 1050. Reorder quantity they only given 500. Then minus minimum consumption into minimum lead time. Minimum consumption is 50 into 5. Final answer.
Sir, 150.
Average is 100, na? I took 150 here. Just a minute. Average is 150. Normal is nothing but average, which is 100. 100 into 6 it is. How much it would be? 450. Then here 50 into 5 I have taken properly. Minimum into minimum. Yes, correct. How much is that?
1250. 12300.
1300. Sir, average stock level would be minimum. Minimum is how much? 450. Maximum 1300. Whole divided by 2. 875. Yes, sir. That's all, guys. Next, coming to ABC analysis. As per ABC analysis, we are using 3 different kinds of raw material in the production process. A, B and C. A being the costliest and C being the cheapest. C for cheapest. Yes. So we are using, sir, is it mandatory to use only 3 types of raw material? May not be. I might be using 10 types, 100 types of raw material. But as per this analysis, they have categorized the raw material into A, B and C. Okay. It is a system of inventory control under which inventories are classified into 3 categories, that is A, B, C, on the basis of investment involved. Guys, assume totally I want to invest 10 lakh into my inventory and total raw material all 3 put together I want 10,000 kgs. All 3 put together 10,000 kgs. Now A being the costliest, will I use more or less? Less, very less. So quantity I will use only 10% of it. So how much it comes to? 1000. That is 10,000 kgs into 10%. I want total raw material to be used is 10,000 kgs, all 3 put together. But for that 1000 kgs only, I require 70% of my investment, which comes to 7 lakh. So as this is the expensive, I should have proper control over it, precise control. I should make sure that even one unit, I have to take care of it properly. Then C we will discuss. Sir, C I will use as much as possible. Cheapest, na? I will try to use as more as possible. So how much is that? 7,000 kgs. But for this, only 10% of my investment I have to put. And as it is cheap, I am least bothered about it. I am least bothered. Even if I lose some kgs, I am okay with it. Okay. B is like average. So 20% I will use, and for that 20% is investment. 20% is the investment. So we should have a moderate control over it. Clear? So try to remember, because you may get confused with what is costliest and what is cheapest. C, cheapest. Okay. Next, VED, vital, essential and desirable. Under this system of inventory analysis, inventories are classified on the basis of its criticality, how important it is for us, for the production function and final product. If it is vital, very important. Without that, Vikas, vital, V for vital. Interrupt the production process and cause the production process. Without this raw material, we cannot produce my output. So review, strictly controlled by setting reorder level. We should make sure that we have a right quantity at the right time at the right place so that my production will not stop. Essential, cause substandardization and loss of efficiency in the production process. Even if it is not okay, still I can manufacture my output, but the quality will not be same. The quality will not be same. So reviewed periodically. Desirable is, even if I don't have also, I can still produce same quality of output. Does not cause any production or efficiency loss. Optional in nature. It is optional. If it is having, we will use it. If not also, it's fine. Next, inventory turnover ratio will tell how fast we are using the inventory. The formula is cost of goods sold divided by average value of inventory. How do we calculate cost of goods sold? Opening stock plus cost of production minus closing stock. Yes, sir. Next, or cost of material consumed also we can use. Instead of cost of goods sold, we can use also cost of material consumed. This will tell how fast you are using your inventory. Just-in-time system. Just-in-time system is cannot be used in every industry, guys. But what is it? I will not purchase the raw material and keep the inventory. Only if my customer comes and places the order, I will purchase the raw material immediately and start working it. That means I will not maintain any inventory. I will not maintain any inventory. My carrying cost will be 0 or very less. Clear? So that means, sir, as soon as I receive the customer order, I will place the order for my supplier. I will ask, hey, immediately deliver it today only. I will start working on it. I will start working on it. Is it possible for every industry to work like this? No. But see, I can give now, even automobile industries have reduced their period and all. But previously and all, guys, for especially HR motors, that is Bullet bike or Royal Enfield bikes and all, waiting period used to be 6 months, 1 year and all. So how they used to start production is, once I place the order here, design, color, everything, they will start working in the manufacturing plant as per whatever order I have placed. And that is why they had that 6 months, 1 year. They will start producing once I give the order, then they will deliver it to me after 6 months or 1 year. Now, because of competition, huge competition and all, they are in a rush. Tomorrow only we will give. May not be. I am not talking about only one company, many companies. Previously, even automobile companies like car also, they used to have very long waiting period, 6 months, 3 months, 8 months and all. But now they have tried to reduce it because of competition. Because they also know if I make the customer wait, he will go to the next door. Okay. Yes. Knock the door of the competitors. Yeah. Done with inventory. Now coming to cash management. So this is the first element. Actually, we start the operating cycle with cash. So we should have a proper cash and cash equivalents balance. By cash management, we mean that management of cash in currency form, bank balances and readily marketable securities. All this put together, we call it as in accounts, cash and cash equivalents. Cash is the most important component of working capital of a firm. It is also the terminal conversion point for other constituents. The various forms of cash holding is. Cash is considered to be the most liquid of current assets. That is the most liquid item. It is held either as cash balance with the firms or in bank accounts. So, what are the motives of holding the cash? Transactional motive. That is to take have lot of transactions or to enter into a transaction. We have to make various payments, both capital as well as revenue payments. For that, we should have a cash, that is to enter into various transactions. Then speculative motive. Speculative motive means, sir, if there is any drop, assume my raw material price all of a sudden it has fallen, like tomato, onion or anything. So we should capitalize on it. So whenever the price has fallen down, we should try to purchase and keep large quantity, provided it is also, if it is a perishable, we should make sure we are also using it as early as possible. The example, whatever I gave, onion or potato and all, I cannot keep it for a very long period. I cannot use it in next year. Then if I use it in next year, you know what would be the quality of the output. Same way, whenever there is any opportunity where I can get something at a very less price, I will make use of it. Speculative. Clear? Even now, stock market, very good opportunities are running. Clear? So year-end sale is happening where in stock market. So make use of the opportunity, because when it goes to 26,000, 27,000, 28,000, don't, it is very costly. I am not able to buy, everything is costlier. So when market corrects, red is the color of opportunity for the smart investors. We have to invest more and more, because we get very good quality company or fundamental company at a lower price. Contingency motive. The motive of holding cash is to meet uncertainty associated with a business, or by chance for safety we will have some extra cash or surplus cash. So even your family members or parents and all, you would have seen, they would have kept something for meeting contingencies and all. What if something happen, that happen, this happens, all health emergency, we will have at least like 1 lakh, 2 lakh or 2-3 months expenses. They may have it in advance. Why? In order to meet some emergency, if at all if it happens. Okay, William J. Baumol model for optimal cash balance management means what is the right amount of cash balance we should have. This model will help you to calculate. Cash management model of William J. Baumol assumes that concerned company keeps all its cash on interest yielding deposits from which it withdraws as and when required. It also assumes that cash usage is linear over time, means over a period of time, whatever cash we require will be keep on increasing. The model is almost same as economic stock order, that is EOQ model, guys. Very similar, but that we calculate it for raw material, whereas this we are calculating it for cash. So what's the formula? 2 into TB. What is T, sir? Projected cash requirement, means totally in a year how much cash we require. Okay. B is what? Conversion cost per lot. Then divided by I, interest earned on the marketable securities per annum in rate. At this level, total of cost of withdrawal and interest foregone will be minimum. The total of both will be minimum and they will be equal. The total of both will be minimum, whereas they both would be equal. Okay, sir. We have a question. So you can see here. The annual cash requirements of A Limited is 10 lakhs. Cost of conversion of marketable securities per lot is 1000 rupees. The company can earn 5% annual yield on its securities. You are required to find out economic lot size, means how much cash balance should I have it? Yes, sir. So what is the formula? Square root of 2 into T. T is how much, guys? 10 lakh. Into B. B is how much? 1000 rupees. Whole divided by 5%. Whole divided by 5%. Yes, sir. Done with cash management. That's all. Coming to receivable management. Receivables here includes both debtors as well as bills receivable. This will arise whenever we have made a credit sales. Receivables are generally referred to by the name of sundry debtors in the books of account. Those persons which owe payment to the firm for goods supplied or services rendered on credit. So long as the sundry debtors persist, the firm is strained of cash, means they will be running short of cash. So logically, the firm seeks to minimize the level of sundry debtors. Guys, when we have sold on credit, we wanted to make sales, we have made sales on credit basis. Now we want to collect it as early as possible from the debtors. Why? If I give more time for him, my money is stuck with him. Plus, there is high chances of bad debt. There is high chances of bad debt. The period of credit allowed to the debtors depends upon the position of a firm in the industry and the industry practice. Now, sir, should I make credit sales or not? Depends on my position in the market. Now, if I am a big player, monopoly, I will tell only cash. If you want, you purchase. If not, get lost. Clear? I know he has to come to me only, no matter what. Agree? So when I am dictating the terms, I have very good market share. I have a market dominance. What will I do? Only cash sales. Or even if I am making credit sales, maybe very less. If not, sir, huge competition is there. Tight competition. Now you will be getting every now and then call from banks and all telling, sir, your students are eligible for loans. Okay, so telling that you are eligible for credit card, that card, this card, and we'll keep on getting the calls. Why? Too much of competition. They are knocking your door now to give loan, to give credit card. Previously and all, it was not like that. Clear? We have to go apply, make an application, roam around from desk to desk to get the loan and all. But now it is easy. And they also will ensure that whatever I am capable of repaying, only that much they will give. Bank is a place where you have to prove you don't want a loan, then only they will give a loan. That is, you should have some backup. Backup of what? Income statement or income or asset or something to pledge. Only then they will give the loan. Now I am going with empty, nothing I have, nothing, sir, I am zero. Can I go and take a loan from the bank? Definitely not. And when I actually have so much things in my life, sir, I have property, I have very good income, I have very good salary, investments, everything. Why there is a need to go and take a loan? Only when I have all this, only when my credit worthiness is more, they will come forward to give the loan. But people, many of them are running on debt only. Clear? On the road when you are traveling, you see lot of buildings, lot of cars, bikes. Majority of them are owned by banks, not by the individuals. Majority of them are owned by the banks because they are running on EMI. So, how do firms ensure realizations? Coming to the other part. Okay. Coming to other part, which I want to mention. Now, sir, there is a huge competition. Then what I will do? We will always have a competition. Sir, I will give credit period 10 days. You will tell, I will give 12 days. Another person will tell, I will give 15 days. Okay, when there is a huge competition, the credit period also will be more and more offered to the people. How do firms ensure realization? Realization means collection from debtors. Timely realization of receivables is an important element of working capital management. Practices in this respect vary from firm to firm. Most of the firms dissuade credit sales to the first time customers, means they discourage, they don't give it. First, let us build a relationship. Let me trust you. Okay. In the first meet only, we will not decide now we will get married and like that. First, you should understand each other and gradually allow credit after development of relationship. After development of relationship means what relationship? Customer relationship. Okay. So in that case, you guys also would have seen, assume you have some provision shop nearby to your home. Will you go and purchase first day? Assume you have shifted to a new place. There is a new provision shop. You go and ask, sir, give this. I will pay you tomorrow. My father will come and pay. They will ask, who are you? Who the hell are you? I am seeing you for the first time. So they will not offer. Assume you have been there for 1 year, 2 years. You are regularly purchasing from that shop. Can you go and purchase like this? Yes. They will tell, okay, you can pay. Or your father will come and clear go. Or else you will have some book. Okay. Where whenever you want in the sense, whenever your mom want you to purchase something, you will go and purchase. In that book, they would have kept a record. Your father will go and clear it once in 15 days or 30 days. This is only after building some relationship with the customers. Okay. While giving credit, some firms obtain post-dated checks from their clients. That is just for security. Yes. In other cases, firms have special staff earmarked for recovery efforts. That is recovery team. Bodybuilders will come. Okay. If you don't pay on time, 1 or 2 times they will call and inform you officially. Sir, please, sir, please. No, you ignored it. Then they will send the people, bodybuilders, to give warning for you. Okay. If not, if you don't pay, then we will take you only. The firm may follow a lenient or stringent credit policy. The firm which follows a lenient credit policy sells on credit to customers on very liberal terms and standards. Whoever comes and asks 30 days credit, take it. Whoever comes and asks 50 days, take it. Because I want to make sales now. That is my agenda. On the contrary, that is on the opposite side. Firm following stringent credit policy sells on credit on a highly selective basis. They will not sell for all the customers. Very few selected customers. Only to those customers who have proper credit worthiness and who are financially sound. Sound means who has the capacity to repay. Now coming to factoring services. Guys, see, whatever receivables I have, if I myself is managing, I should have a proper administration team to keep on giving call for them, reminders for them. And if there is any bad debt, I have to suffer. And I have to wait till they pay. Assume the credit period is 3 months. So I have to wait till 3 months to get the money. And I'm not sure that whether I will get fully also. Plus, I am incurring expenditure to recover the money. That is administration cost. I will have a separate team to remind them and to collect the money and all. Now, in order to avoid this, there is something called as factoring services, where I can sell my receivables and get the money now only. And the person for whom I am selling is called factor. Assume the credit period is 3 months, guys. I am selling the debtors or receivables today only. And they will not pay me the entire amount. Assume the amount of receivables is 10 lakh. I sold it. They will pay me only 8 lakh. And they will collect the money. They will wait for 3 months and collect the money from the debtor straight away 10 lakh. So for their services, whatever they are getting is like 2 lakh. Correct. And here also, who will suffer the bad debt loss, if at all, if it is there, depends on whether the factoring is course or without recourse, or course or non-course. We will see that. Factoring is a type of financial service which involves outright sales of receivables. So whatever customers, I am not selling customers only, okay? Whomever I have sold on credit basis, receivables I will have, like bills, receivables and all, that documents I am selling. Whatever I am supposed to collect from debtors, I am giving that right to you to collect. Of a firm to a financial institution who is called factor, which specializes in the management of trade credit. They know how to collect the money from the customer. They are expert in that. Factoring is a financial service in which business entity sells its trade receivables or debtors to a third party known as factor at a discount. Similar to bill discounting, but not exactly bill discounting. In order to raise funds, the bank or financial institution purchasing the receivable is known as factor. If the firm could contract out the collection of accounts receivable, it would be saved from many things such as administration of sales ledger, collection of debt, and management of associated risk of bad debts. So if I sell my receivables, I can save all this. Factoring may be with or without recourse. With the recourse means bad debt loss, if any, has to be suffered by whom? Supplier, me only. Clear? I am actual seller. So if by chance if customers fail to pay, then I am the one who has to suffer bad debt loss. If it is non-recourse, factoring or without recourse means bad debt loss will be suffered by whom? Factor. And in that case, obviously the amount what he charged or fee or commission what he charged will be more because he is taking the risk. Na? So he may not pay entire 8 lakh. He may pay only like 7 lakh or 7.5 lakh because he has more risk now of bad debt also. Next, sir, what is accounts receivable loan? Account receivable loan means whatever bills I have, I am pledging it and getting a loan. Who has the responsibility of collecting the money? Me. Now, if I fail to repay the loan, who has the authority of bills? Bank. Can they use and collect the money from the debtors? Yes, they can collect it. But if I repay the loan on time, they will give back my bills. I will collect it from my customers. Only if I do default, then the right over the bills will be taken over by bank. They can collect the money from the debtors. Then forfeiting services. Forfeiting is a form of financing of receivables pertaining to international trade. If I am engaged in import and export. It denotes the purchase of trade bills or promissory notes by the bank or financial institution without recourse to the seller. The purchase is in the form of discounting the documents covering entire risk of non-payment in collection. Guys, assume I have exported my goods to a importer in USA. He is supposed to pay me $10,000. He has given me the bill. I cannot, and the bill will mature after 3 months. I cannot wait till 3 months. Can I sell it to a third party and make the money? Yes. So the person, assume the bank, I am approaching any international bank and they are paying me immediately. If there is any bad debt, the bank has to suffer. Whoever has purchased my bill, they will suffer it. And now, will the bank will give me entire $10,000? No. Obviously, they will pay me less than that because for their services, they have to charge something. So assume they are paying me only immediately, like $8,000 or $9,000. When they are collecting from my customer who is in USA, they will collect entire $10,000 and remaining is their income. If at all, if there is any bad debt, they have to suffer. Who? Bank. Yes, guys. This is all about working capital management. Yes, guys. So now we'll do chapter 8, which talks about security analysis. Investment means to forego present consumption for the increased consumption resource available in the future. Means, guys, whenever I am making the investment, I have to make the capital investment today. Why? With an intention to earn the earnings in the future. So I have to forego, for example, assume I am investing 1 lakh. So in this 1 lakh, I would have done hundreds of things. Sir, I am foregoing all those things and I am investing this 1 lakh into some asset category or asset class. And with an anticipation that I will earn some return in the future. So investment will be in present, whereas whatever future earnings expectations what I am making is with respect to future. An investor can buy a share of a company in anticipation of getting good returns in the future. And when it comes to share of a company, there can be 2 categories of income. One is in the form of dividend, the other one is in the form of capital appreciation. Financial assets are different from real assets. While financial assets are the paper claim representing an indirect claim to the real assets in the form of debt or equity commitments. So financial assets are nothing but the financial securities, guys, like debt, equity, preference and all, bonds. And the real assets are land and building, machines which are used to produce goods and services. Financial assets are more liquid and marketable. See, when it comes to real assets, sir, it is tangible. I can see it, I can use it, and I can use it in my business to generate more and more revenue. Whereas when it comes to financial assets, I cannot use it. I can have it in the paper form like share certificate and all. Now everything is dematerialized form. But still, it is in the form of paper or electronic way where I will hold it. Sir, can I make use of it and generate revenue in the business? No. I have made an investment in such a way that I will be getting some return in the future. So can I use these securities which I have invested in my business to generate revenue? No, it is not possible. Now coming to liquidity and marketability. Sir, which asset is more liquidable and marketable is the financial assets, because I can sell it at any point of time. At any point of time, especially when it comes to equity and all. See, debt or bonds will have some lock-in period. But when it comes to especially equity, I can sell it at any point of time. So it is highly liquid. I can sell it at any point of time and liquidate it into cash. Then coming to real assets. Sir, is real assets so easily liquid and marketable? May not be, guys. Especially when it comes to land and building and all. Sir, I want to sell today. Will I find the buyer immediately? May not be. And even the prices also may not match. For example, assume I want to sell it at 10 crore. There may not be a buyer who are willing to buy it at 10 crore. Over a long period of time, if I keep on searching for a good buyer, I may get it. But immediately, can I sell it and make money whatever I am expecting? May not be. So when it comes to assets, the financial assets are the one which are more liquid and marketable. Any investment decision will be influenced by three objectives, that is security, liquidity and yield. Under security means, sir, I want to keep my investment secured. Whatever money I am investing, at least I should not lose it. It's okay, I can forego returns. Even if I get less returns, okay. But losing my own capital is at very risk point. Clear? Which happens in equity. Especially in equity investments, sir, I can lose my own investment also. I have invested 10,000. It may go up to more than 10,000 or it can come down below 10,000 also. So when we are investing, one of the important thing we consider is security. So security wise, which is the best asset class, sir, maybe like debt, FD or anything where my money would be safe. The return what I get might be minimum like 6%, 7%, 8%, but still my money is secured, highly secured. Okay. Then coming to liquidity. So liquidity, sir, means many people will invest in the assets in such a way that it will help us in our difficult time. So in our difficult time, assume I am undergoing some emergency. Now immediately if I am able to sell it and get the money and meet my emergency, then the asset is helping me in my tough time. Yes. If not, then it will be difficult. So especially when it comes to financial assets, I told you, they are highly liquid. When it comes to real assets, they are not so liquid, guys. Immediately I may not be able to sell it. And even, see, when it comes to land and building and all, if I am desperate to sell, then the buyer will make use of my situation also. He will try to negotiate for a very less price. Then coming to yield. Yield is nothing but returns. So returns will always be associated with risk. Higher the risk I am ready to take, higher would be the return which I can expect. Sir, I am not ready to take higher risk and all. I want to be safe. I want to play safe. Then better invest in FD or government bonds and all, where you will get some minimum return. Or else, no, sir, I am ready to take risk. Okay, it's okay. I want bigger risk and bigger returns. Then you might go with equity. If not equity, at least before that also there is something called as mutual fund, where you will give your money to the fund manager. He will invest in the best asset class. If not, no, sir, I can only invest myself. I have enough knowledge with me, adequate knowledge. Then you can invest directly into the stock market. The best investment decision will be the one which has the best possible compromise between these three objectives. So considering all these three, we have to make the investment, not any one. What are securities? Securities may be defined as the instruments issued by the seeker of funds, that is normally the company, or government also, because normally government also will raise the money by issue of bonds and all, in the investment market to the providers of fund in lieu of funds. Now assume my company wants the money, so we are raising the money through equity, preference or debentures. Now you are the one who are interested in it. So you will invest your money by buying the shares, debentures or preference shares of my company. So you are giving me the money, in return we are giving you the shares, debentures of my company. This instrument prima facie provide evidence of ownership to the holder of the instrument. The owner is entitled to receive all the benefits due on the instrument and to retrieve his investment at the time of redemption. That is, I will get back. You will get back your money. Only in case of debentures or preference shares. Whereas in equity, you cannot demand a repayment until and unless the company is going into liquidation. Even if company is going into liquidation, you will not have a first priority. You will have a last priority. Who are you? Equity shareholders. Clear? You will have a last priority. There is an order of payment. Only when all the outside payment, tax dues, everything is paid, if something is still left, we will give it to equity shareholders. If not, Govinda. So securities are broadly divided into two categories, debt securities and equity securities. Equity, we will also call it as common stock and all, guys. Yeah. So this chapter is all about security. Okay. So the name itself is security analysis. Yes. So security analysis is primarily concerned with analysis of a security with a view to determine the value of a security. So that means what is the worth of the security, so that the appropriate decisions may be made based on such valuation as compared with the value placed on the security in the market, that is current market price. Two basic approaches of security analysis are fundamental analysis and technical analysis. Normally, fundamental analysis, we will do it for a long-term investment, whereas technical analysis is for short-term investment. Wherever I want to take the advantage of price fluctuation due to demand and supply fluctuation or any news or rumors in the market, I may use technical analysis to predict the movement of share price for a short period, not for a very long period. Yes, sir. Now, during doing security analysis, guys, using different approaches, I will determine first what is the value of the share. Assume I have got it as 120. I have got it as 120. That is, as per my calculation, this is the actual worth of the share. Now, in the market, there can be two possibilities. Normally, it will not be exactly 120. If it is exactly 120, then I am indifferent. I am indifferent. Now, there can be two possibilities. It can be less than 120 or more than 120. Assume the current market price. Means, in the market, the share price is, assume 100, guys. What do I do? As per my calculation is 120, whereas in the market it is available at 100 rupees, undervalued. The share is undervalued in the market. So as an investor, what should I do? Buy it. Buy the securities, because I know that one or the other day in the future, it will go up to 120 rupees. Maybe I can sell it then. Maybe I can sell it then. Same way, if I take vice versa scenario, assume in the market the price is 130. Whereas I have got it as 120. So can I tell it is overvalued? Can I tell it is overvalued? Yes, sir. So this is overvalued. So if at all, if I am already holding this shares, what do I do? Sell it. Sell the share, and I know that, sir, worth of the share is 120. Maybe in the future it will drop down or the share price will fall, and later I can again buy it if I wish to. If I wish to. Is it clear? Yes, sir. And also we have some option called like in trading and all, short selling. First we will sell, later we buy. That also I can do with respect to this scenario. When I feel that share price is overvalued in the market, I can sell first and then buy later. We call it a short sale. Okay. Fundamental analysis is a three-level systematic process that analyzes the overall external and internal environment of a company before placing a value on its shares. So now under fundamental analysis, we will do three-stage analysis, guys. That is, sir, economy as a whole or country as a whole, next industry as a whole, and then the company. I am investing in company, not in economy or industry, but this company belongs to a particular industry. So any movement in the industry will affect the company. Yes. Same way, this company is listed in one of the exchange in the country. So if there is any changes in the country, will it affect this company? Yes, maybe external factors. I don't have any control over it, but still I have to consider it. Yes, sir. So what are those? Analysis of the economy, or I can consider it as a country also. Economic analysis, or even global. Not only country, we can consider it as global also. Industry level analysis and company analysis. So one by one. First, economy. So in the economy, what is the situation we have to see? Sir, what is the GDP growth of the company? How is the opportunity, growth opportunity? So is it undergoing any recession? All this we have to see. Only then we have to decide. Because see guys, if there is a recession in the country or in the economy, will the stock market perform well? No. Even though company might be performing well, or even the growth will slow down in the company. They might be growing at 12-15% and all, but when during recession, people also will stop spending. When people stop spending, even companies will stop growing. Or if they might be growing, but not at the previous rate. The growth rate may come down to 8%, 6% like that and all. So if there is any change in the economy, will it have an impact on the company, sir? Yes, it will have. So let us see. If the country has the improving GDP, that is gross domestic product, growth rate, controlled inflation and increasing investment activity, then chances are that the valuation of the securities will be liberal. So you guys would have heard also, after COVID, lot of demat accounts have been opened in India. And in the recent time, lot of FII are withdrawing the money like anything from Indian market. Why? They are finding better opportunities elsewhere in China and all. Now, still Indian market is okay. They are not correcting like anything, because previously and all, if you take early 2000s and all, we were highly dependent on USA or foreign institutional investors. So depending upon their act, Indian market used to react. And there is a saying also, if US sneezes, Indian market used to get cold under. But now it is not seen. Yes, we may react, Indian market may react to something which is happening in US or China, but not like before. So if you have observed in 2008 what happened during recession, that this scam and all. So during that time, Indian market corrected like anything. But when it comes to now, the situations is not some, sir, from years together wars are happening. Okay, situation is not good at China, situation is might not be great in USA, but still we are okay. Yes, here and there small correction is not happening, but huge fall we are not seeing. Why? Because the dependency has been reduced. Dependency has been reduced. Why? Because Indian investors have grown like anything. Now, even though outsiders are taking away their money, we are pumping in the money into the market, Indian market. That is, the retail investors are investing in huge. Why? Because now the people are getting the knowledge of it. And we have seen one or two bull rally, especially after COVID. Now people thought, okay, in these 2-3 years, market has grown like this, so I will also make money. No, we may not make in the same way, but still, it is good that Indian investors are backing the market, so that in the future at least they will get the better returns. Okay. Next, as the economy is growing, the analyst expects almost every industry to do well. So if economy is growing, if there is a great situation in the economy, then every industry in the country or in the economy will do well. The capital market is said to be the bullish phase with share value shooting up. Bullish phase means when the share market is going up, guys. It is touching new highs every now and then. The opposite side is, on the other end, if GDP growth rate slackens, that is false, inflation is out of control, and investment activity, that is what happened in Sri Lanka, if you guys are aware of. Investment activity is stagnant or declining. People are not investing. They are over worried about what if that happens, what if this happens, and markets may fall. They are expecting the market may fall. So they have stopped their investment. SIPs have been stopped under this situation. Investor or the analyst will expect the performance of the industries to slow down. That is what many people were expecting. Even in US and all, they are expecting some recession will happen, that will happen. From very long time, this conversation is happening. The capital market enters a bearish phase. That is that it starts falling, or we call it as it start getting corrected, and share values will decline. These are two different scenarios. In this scenarios, people will be investing more and more, so the company also will perform better. Whereas here, the economy is not doing good, it is not in a good situation or state, so people may not invest, or even if they have invested, they may sell off all their investments, and also economy is not doing great, so company also may not perform better. Next, coming to industry level analysis. First of all, sir, what is the industry? A group of companies which are competing for the same customers, or which are in the same line of business, guys. For example, IT industry, we call it as now TCS, HCL, Infosys, and Mindtree, all this company, or L&T Infotech I'm talking about. L&T, we have a construction company also, but we have IT company as well. So all this put together, there are still number of companies, guys. I just named a few. All these companies put together, we call them as IT industry. Now, if the situation, especially when it comes to India, IT industry was born especially in India, guys, in 1990s. That is from TCS time, Infosys time and all. But they are highly dependent on foreign clients. That is USA or UK and all. Now, if something bad goes there, entire IT industry will be impacted. Same way now, if I take banking industry. So banking industry is one of the group. In that, all the banks, for example, HDFC, ICSI, Axis Bank, SBI, everyone will be a part of it. Now assume some bad news happen for one of the bank, not for all the banks. One of the banks, some bad news happen. Now Vijay Mallya case repeated by someone else. Clear? So it is not only that bank will be affected, entire banking industry will be affected. Because now RBI will start taking strict rules, conditions and all, they will start bringing it. And they will not bring only for that bank, they will bring it for overall all the industries. Or even now, every now and then, RBI chief will come and change the rate, reverse repo rate and all. Will it have impact? Yes, sir. It will have impact. On what? Not only one or two banks, and the entire group. That is banking industry. Or we also call it like NBFC and all. NBFC like Bajaj Finance and all will come under that. Yeah. Industry is a combination or group of units whose end products and services are similar. Having a common market means they are competing for the same customers, guys. In simple, if I have to tell. Having a common market, the participant in the industry group face similar problems and opportunities. The industry's life cycle or the industry's growth cycle can be divided into three major stages: pioneering stage, expansion stage, and stagnation stage. So if you ask me, sir, now IT, banking and all is always there in India. They are doing good from a very long time. Now, sir, what are the industries which may do very good in the coming future? Maybe EV, ethanol, and green energy. All these are something which we are looking. Even blockchain, artificial intelligence, all this are something which we are expecting good. Now everyone in this industries will benefit out of it if this particular industry do well. Yeah, so there are three different stages. Pioneering stage is like a starting stage, guys, like your foundation. CS, executive entrance test. The pioneering stage is related to sunrise status of the industry. Technological development takes place, products are newly introduced into the market, industry makes extraordinary profits and attracts competition. As competition increases, profitability in the industry comes under strain and less efficient firms are focused out of market. And at the end of pioneering stage, selected leading companies remain in the industry. Now, in this stage, there will be number of people entering, lot of growth opportunities are there, everyone will start making profit. When 5 or 6 people are making profit, outside, the people who are outside, now what they will feel? If I enter, I will also make profit. So everyone will start entering the business. And at the end of pioneering stage, very few people will remain. Others who couldn't manage it well, they will go out of the market. This is what happened in telecom industry, if you guys are aware of. So in telecom, it was one of the gold mine. Every people were making money, huge money. Okay, separate message pack, call pack, data pack, everything was different. And message and all monthly, even data 1 GB, 2 GB package was there. So you know, before Jio enters, how many players were there in telecommunication industry? Once they entered, they disrupted the competition, they killed almost everyone except 2-3 players. And now at the end of that, only some major players were surviving. Yeah. Expansion stage. In this stage, demand for the product increases but at a lower rate. Less volatility in the prices and production. Capital is easily available in plenty for these units because only there are only few people or few companies who are operating in this. So in that case, people are ready to invest in it, and the growth rate may not be like how it was in pioneering stage. Normally, that is what happens. Now, initially we will grow like anything. Sir, can we grow in the same rate forever? May not be. Once we have reached certain point, the growth rate will start becoming stagnant. That is what is happening with some large cap companies, guys. So as an investor, when you are seeing, sir, if I want to invest in large cap companies, definitely your money is safe. But you cannot expect under 2x, 3x, 100x and all in that company because they have already grown to that extent. The growth will be not like 100, 200, 300 and all. They have already reached to the extent that they might be growing, but in a single rate, like 5%, 6%, 8%. Whereas when it comes to small cap company or mid cap company, you can expect a huge growth. Why? Because they are very small. So they have huge opportunities. They can acquire the market share from other players and they can grow and become a large cap company one or the other day. Then the last stage is stagnation stage. At this stage, the growth rate initially slows down, then stagnates and ultimately turns negative. No product innovation, external capital is hard to come by. Why, sir? Because there is no growth. When there is no growth, who is ready to invest in your business? Because they also know they will not get any return on their investment. This stage of the industry is most valuable during times of slowdown in the national economy. Means if you come out of this stage successfully, then again you will rule the industry. If not, especially if I take the example of even COVID, many companies who doesn't have good cash position or who doesn't have good amount of profits or reserves, they couldn't survive that time. Many companies would have shut down also. Whereas other companies who were cash rich, we also call them as cash cows like Infosys, TCS, all these people have huge crores of reserves. Even though they had zero business during that time, still they could survive for few months. Why? Because they had done very good in the past and they had enough reserves with them to survive that tough time. So if it is a very small company or startup, they are still starting. During COVID time, you know how they would have been impacted. Yeah. So this is all about industry level analysis. Last one is company analysis. Now we are going and checking the company. The analyst looks at the now if I just simply connect it, may not exactly match, guys. If I simply connect it to this stage, to your course or exams, may not exactly match, I'm telling you. Pioneering stage is like CS executive entrance test where majority of the people will pass. So the percentage also is huge. And when they pass the first stage, they come with an assumption in the executive that yes, this is also easy. But only when you start attending the class, once you open the book, when you see that, you will understand the syllabus is voluminous. So we have to survive in executive, study well and pass it, and then go to professional. Professional will be little harder when compared to executive, but most of the subjects will be same when it comes to professional. And if you come out of professional, then world sky is your limit. Okay, so yes, this process will be tough, guys, especially executive and professional, I can tell. Similar to expansion and stagnation stage, it will be difficult phase, but once you come out of this as a successful person, sky would be your limit. And you will have various options when it comes to your career. You can choose whatever you wish for. If not, it will be very limited, guys. One thing I can tell you, if you are a company secretary, you will not remain unemployed. But when you have another degree and all, you know what are the situations which is going on in the economy. Or even if you are employed, you may not get the pay what you expect or what you deserve. So please make sure that no matter how easy or tough it is, you have to be on the successful side, and you can. Please give your best, that's all. Yeah, company analysis. The analyst looks at the company's specific information. Company information is generated internally and externally. The principal source of internal information about the company is what? Its financial statements or report, the board of directors report, audit report and all. There are traditional and modern techniques of company analysis. Fundamental analysis tools are as follows, guys. Although the raw data of the financial statement has some useful information, much more can be understood about the value of the stock by applying a variety of tools to the financial data. So what are those some important things which we will check? See, even all these things I have explained by taking one of the company as an example in my regular class, but now it won't be possible. I will quickly go through when we are checking whether to invest in the company or not. What are few things we have to check? Should it be more or less? Higher is better or lower is better? I will just analyze like that. Earnings per share, that is earnings available to equity shareholders divided by number of equity shares. Normally, when I am investing in the shares, I should know what is the earnings I will get in the future. Higher is always better. You should always observe that from year to year, the EPS is growing. Then price to earning ratio, we call it as P ratio in short. This ratio will tell whether the share price is overvalued or undervalued. Lower is always better. Lower is always better. The P ratio of the company I can compare with industry P, and if P ratio of company is less than the industry P, good sign. Good sign. But most of the very good company which has huge growth potential will be overvalued, guys, because normally the share market is always future oriented. If you are expecting huge growth in the future, it would have already been factored in the share price. The share price would have gone up. So for a growth company which has huge growth potential in the future, normally PE ratio will be little high. Okay. Then PEG ratio, that is projected earnings growth ratio. So instead of seeing PE ratio only, I can also see PEG ratio, that is PE when compared to growth. If it is less than 1, good is what the market opinion is. If it is more than 1, here also I can tell when compared to growth rate, the share price is overvalued. Then price to sales, that is price of the shares divided by sales. For each and every rupee of sales, what is the price of the shares? Lower is better always. Then price to book, again this is also lower is always better. When compared to the market price of the share, how much is the book value of the share? Then dividend yield, this is only for those shareholders who are looking for some regular income in the form of dividends. How do we calculate dividend yield? DPS by MPS. Means at the current market price, what is the dividend I can expect from the share? Yes, sir. Next, dividend payout ratio. Dividend payout ratio means out of the earnings available to equity shareholders, how much is declared as dividend by the company. Again, only if you are interested in the regular return from the company as dividends, you will look into it. Normally, the companies which has very good growth opportunities and all, they will retain maximum guys. They will retain maximum and give you return in the form of capital appreciation. Okay, how do we calculate dividend payout ratio, sir? Dividend per share divided by earnings per share into 100. Into 100. Yes, sir, can I calculate in total also? Why per share only? You can calculate total equity dividend declared divided by earnings available to equity shareholders into 100. Yes. And if you are the shareholders who are looking for a regular returns, always look for the higher. Higher is better. Higher dividend yield or dividend payout ratio would be better. If not, if it is lower, just see whether the growth rate of the company is good. Growth rate, how do I see it, sir? Top line and bottom line. Top line is nothing but sales and bottom line is nothing but profit. See, from year to year, quarter to quarter, sales is growing or profit is growing. Both has to be in the growth. Clear? So what I see is the growth should be in the double digit, more than 10%. Anything is fine. And other than that also, we will see return on equity, return on capital employed and all, which I as an investor look for a company which has again has double digit or more than 20%. Return on equity as well as return on capital employed. Yeah, book value per share means as per the books, what is the value of the share? I can compare that with the market price and see whether the market price is overvalued or undervalued. Yes, this is all about fundamental analysis. Now coming to technical part. An alternate approach to predict share price behavior is technical analysis. It is used in conjunction with the fundamental analysis and it's not a substitute. Sir, can I use technical along with the fundamental also? Yes, sir. Technical analysis is an analysis for forecasting the direction of the prices, though the study of the past market data, primarily price and volume. This technique assumes market prices of securities are determined by the demand and supply equilibrium. So if there are more number of buyers, we expect that the share price will go up. If there are more number of sellers, you guys would have observed. So this company's shares has been dumped by those investors. So when there are huge number of sellers, the share price will get corrected. Okay, we also call it as it will hit lower circuit. It will hit lower circuit means like minus 10%, minus 20%, minus 5%. They will lock it. Yes. So here normally while doing technical analysis, we will see in the past how the share price has reacted. So during tough time, how they have reacted. Did they fall or did they rise? If they have risen, how much? If they have fall, how much? And also guys, in the past, we will see, for example, assume the share price is 100 now. In the past, when and all it has touched 100. After touching 100, did it bounce back? We will see like that. The past trend under technical analysis. Yes, sir. And also demand and supply, as I told you, that is the number of buyers and number of sellers also will impact the short-term share price. Not in the long term, but in the short term. And technical analysis is more related to short term only. Risk and its types. Risk is in the security analysis is generally associated with the possibility that the realized return, actual returns will be less than expected return. Sir, I had expected 12% return, sir, but I actually ended up getting 10%. This is the risk. Because my expectation may not be reached. Correct? Na? Expectation hurts, right? That is why you don't expect anything. Types of risk. Systematic risk is influenced by external factors which is outside the control of the company, macro in nature. Like you guys would have studied something called as macroeconomics. No? They are macro in nature. It is outside the company's control. Unsystematic risk, influence of internal factors controllable by the organization if they take necessary steps and all. They are micro in nature. Systematic risk is subdivided into three categories. Interest rate risk. Interest rate risk is the variation in the single period rate of return caused by fluctuation in the market interest rate. So in the market, the interest rate might be fluctuating. So you guys would have seen the RBI chief and all, they will be increasing, decreasing the repo rate, reverse repo rate. Same way, the USA, that also they keep on doing it. The Federal Reserve, like how we have RBI in India, in USA, we have something called as Federal Reserve. So there also the chief might be increasing or decreasing the repo rate, reverse repo rate and all. Why? Now, especially in the past time and all, this has been done to curb the inflation or to bring the inflation in control. It particularly affects debt securities as they carry the fixed rate of interest. Market risk. Market risk arises due to rise or fall in the trading price of listed shares or securities in the stock market. Sir, in the market, what will be the reaction of share price? See, most of the time it will be due to company's performance only, but sometimes due to external factors also share price will go up and come down, especially falling. Clear? So due to assume Indian government all of a sudden falls or some bad thing happens in the border or anything, guys. I'm just giving some example which are external in nature. So what happens, sir? Will share price falls? Yes, entire market may see a downfall. Then purchasing power or inflation risk. Due to inflation, the purchasing power of money will go down, guys. Previously and all, you guys know, thousands like 20,000, 30,000 salary would have been more than enough. But now lakhs together people earn also, it is not sufficient for them. Especially in the tier 1 cities and all, sir, the cost of living is huge. Why? Due to inflation. Due to inflation. Next, coming to unsystematic risk, it is subdivided into two categories, business or liquidity risk. It originates from the sale and purchase of securities. See, we have discussed about operating risk or business risk. That is, sir, what if I don't earn enough operating profit? That is from business point of view, but this is from investment point of view. So, as we are discussing from investment analysis or security analysis point of view, it originates from the sale of purchase and sale of securities affected by the business cycles, technological changes, etc. Sir, from the purchase and sale of securities, how much profit will I make? Or how much return will I make? That is called business or liquidity risk. Financial or credit risk, it arises due to change in the capital structure of the organization, that is debt equity ratios. Then return of a security. Return is the primarily motivating factor. Sir, any person will invest in the asset because we are anticipating some return. Return is a primary motivating force that drives investment. It represents the reward for undertaking investment. Taxes, inflation, commissions, and timing of cash flows all play major roles in correct calculation of returns. The return of an investment consists of two components. Current return, it is periodic cash flow income such as dividend or interest generated by investment. Capital return, it is reflected in the price change. It is simply the price appreciation or depreciation, both can happen, divided by beginning price of the asset. So the total return can be like current return, that is in the form of dividend or interest, plus capital return. Guys, capital return normally only will be with respect to equity investment. Whereas like bonds, debentures or preference shares and all, normally you don't expect capital return until and unless it is redeemed at premium. It is redeemed at premium, then you will have capital return. If not, no. Whereas when it comes to equity, you can have capital return both positive or negative, both you can have. Current return can be zero or positive, it can never be negative. That is, sir, dividend, can it be negative? Definitely not. Interest, can it be negative? Definitely not. It will be either zero or positive. Interest, actually, if I tell you, it can never be zero also. It will be positive. But dividend can be zero. What if company is not declaring any equity dividend? It can be zero. But can it be negative? No, never. Whereas the capital return can be negative, zero or positive. It can be all three. Measuring the return. Holding period return is the total return received from holding an asset or portfolio of assets over a period of time, generally expressed as a percentage. Holding period return. Holding period, guys, how long did I hold the asset? Assume I purchased the asset today and sold it after 5 years. What is the holding period? 5 years. So in this 5 years, what is the total return I earned? Income, that is in the form of dividend or interest, plus end period value minus initial value. What do we get it as? Capital appreciation divided by initial value. That is the amount which I have invested. If I want to calculate in percentage, I will multiply with 100. Okay, sir. Sir, we calculated for holding period 5 years. How much is the return? I want to know per year how much I made. Holding period is 5 years, no doubt. But on an average, per year how much I made, sir? Because normally return and all is calculated annually, no, sir? Yes. Can we calculate? Yes. Annualized holding period return means for a 5 year, per year how much we have earned. Income plus end of period value minus initial value, whole divided by initial value, till year everything remains same. Now the difference is plus 1 to the power of 1 by n minus 1. This part is extra for calculating annual return. Yes, sir. We will discuss the questions on this. First, let me just finish all the things. Approaches to valuation of security. Security analysis begins with assessing the intrinsic value of a security. Intrinsic value or theoretical value or the worth of the share is everything one and the same. We also denote it by P naught. There are three main schools of thought on the matter of security price evaluation. The first one is fundamental approach. The fundament, and all this is one or the other places we already seen that, especially this two calculation. We already seen it in the previous chapters. The fundamental approach suggests that every stock has an intrinsic value. Equity valuation where the expected holding period is 1 year. I am expecting that I will sell the shares at the end of first year. So at the end of first year, I will get dividend as well as the selling price, which is nothing but P1. Yes, divided by 1 plus R or 1 plus K. R and K here is one and the same. Don't get confused. See, in other calculation where reinvestment rate is different and all, R is different, K is different. But here, so instead of R, can I use K also? Yes, one and the same. Okay. Now, whatever we get is called intrinsic value. If that is more than market value, what do? It is undervalued. We will buy the security. If intrinsic value is less than the market price, then it is overvalued. We will sell the security. Then when the dividends is growing at a constant rate forever, and I don't have any intention to sell the securities. I don't have any intention to sell the securities. So what do I do? How do I calculate the present value of the share? D1 divided by R minus G or K minus G. What is G? Growth rate. How do we get it? B into R. What is B? Retention rate. What is R? Reinvestment rate. Yes, sir. Now, sir, here you gave only one period return or one period formula. What if I want to sell the shares at the end of third year? Simple, guys. NPV calculation and all we did in a similar way. So, here, assume you want to hold it for 3 years. At the end of 3 years, you want to sell it. So, for 3 years, cash flow would be D1, D2, D3. That is dividend 1, dividend 2, dividend 3 at the end of each year. Plus third year, you will also get P3. What is P3? Selling price at the end of third year. And apply the present value factor at K rate, whatever is the rate, and you multiply both, you will get present value. This is present value factor, you will get present value total up here. This is P naught. This will be P naught. Same way, sir, what if it is 5 years and all? Same way, guys. For all 5 years, take dividend. For the last year, you add P5 also. Add P5, which is nothing but the selling price or expected selling price at the end of the holding period. Okay. Then coming to technical approach, the technical analyst endeavors to predict future prices level of stocks by examining one or many series of past data from the market itself. The basic assumption of this approach is that history tends to repeat itself, and the price of a stock depends on supply and demand in the market and has little relationship with its intrinsic value. If you guys have observed, some experts and all will be predicting like this. Even in 2008, same thing happened. Even in 2019, same thing happened. It tested this level. After that, it bounced back and all. So based on some past trend, they will predict what will happen now. What will happen now? It may or may not happen. Okay. But still, the prediction happens. That is what is called technical analysis. Efficient capital market theory. As per this theory, they tell share is never undervalued or overvalued. Whatever is the current market price, that is the right price. So if I tell it is undervalued or overvalued, that means market is wrong. No, that is what they do. Whatever is the market price prevailing, that is the right price. That is what they believe. The theory is popularly known as efficient capital market hypothesis. The advocates of this theory contended that securities markets are perfect, or at least not too perfect. Means there are a good number of buyers and sellers. The theory states that it is impossible to beat the market. If previously and all it is to happen, guys, Arshad Mehta case and all, if you have seen, they will decide which share price to take off, which share price to make it fall and all. Because they were the big investor, very small people were there during that time. But now, one or two people cannot decide the movement of market. Should we take it up or bring it down and all. So there are a good number of buyers and sellers. So even though there is good some sellers, like especially if you have observed in recent time, FII kept on selling the entire month. They kept on selling. But still, there was buying which happened through retail investors. Efficient market theories contend that share or stock is generally worth whatever it is selling for in the market. That is the right price. Okay, coming to few words. Face value or nominal value. Guys, you would have seen this in the balance sheet. 1 lakh equity shares of rupees 10 each or 5 each or 1 each. What do we call it as? Face value. Equity capital, debentures or preference share capital will always appear in the balance sheet at face value. You guys would have observed in a corporate accounting. Sir, what if I issue the shares at premium and all? Premium will always go and sit under securities premium, which will be shown under reserves and surplus. Even though if the share is issued at a price more than the face value, the additional amount which we call it as premium will be recorded in securities premium, whereas only the face value will be credited to equity share capital. Agree? That is nothing but face value. And whenever we are calculating interest, dividend and all, it will be calculated on face value. For example, 10% interest on debentures. Will we calculate it on issue price or redemption value? No, on face value. For example, I am just giving an example, guys. Assume 10% debentures is there. Issued at 110, sir. Issued at premium. Redemption value, we are redeeming it at 120. So 10% interest has to be calculated on, assume face value is 100. 10% interest has to be calculated on what? Face value always. Face value always, guys. Even for preference and equity also. So equity, if the company has given that it has declared a dividend of, sometimes this happens, okay, in the market, they will tell, the company has declared 100% dividend. Oh, we are very happy. 100% means what, sir? Face value is 1 rupee. Face value is 1 rupee. What is the DPS? 1 rupee. Dividend per share is 1 rupees. Yes, sir. Whenever they give it in percentage, it will be on face value, guys, even dividends. But if they tell dividend payout ratio, that will be different. Dividend payout ratio will always be on EPS. Clear? For example, EPS is 100 rupees, you imagine. Dividend payout ratio, they told it as 50%. So what would be the DPS? 50 rupees. 50 rupees. Okay. Book value. The book value may be much more than the face value. It is the price at which shares are issued, including premium, and that is issue price. Guys, in balance sheet you would have seen equity share capital. 1 lakh shares of rupees 10 each. So 10 lakh. Reserves and surplus, assume 5 lakh is there. Whom it belongs to? Equity shareholders. If there is any securities premium and all, our profit and loss which we have earned in the past and transferred to reserve will reflect where? In reserves and surplus. Now if I ask you what is the book value per share, it would be 15 lakh divided by 1 lakh, which is 15 rupees. Not 15 lakh, 15 rupees. Is that clear? That is equity share capital plus reserves and surplus divided by number of equity shares. If the company is profit making, it will always be more than face value. Okay, let me tell that also. If company is profit making and all, or if they are performing well, book value will always be more than face value. Sir, what if the company is loss making and all? Then book value can be less than face value, which is not a good sign. Market value means current market price. We also name it as CMP. In the market and all, you would have seen current market price. Market value is the price at which shares are traded in the market. And will it be fixed number, sir? No, every now and then it keeps changing. Only time it will be same is after 3:30 or before 9:15 or before the market open, that is 9:08. Clear? Only during the markets of time. When it is operating, it keeps fluctuating, guys. Whenever the market is operating. Yes, this is all about chapter 8. We have some questions. Quickly we'll discuss. Help me with the numbers. Yes, first one. A invested 10,000 in the shares of XYZ company 10 years ago. So what is the initial investment? 10,000. And that your shares including reinvestment dividends are currently worth, including dividends, 23,800. So what is the increase or return? 13,800. Using this information, calculate the total investment return. Okay. Holding period return for 10 years is how much, guys? So totally return is like that. Let me show. 23,800 minus 10,000 divided by. This is nothing but the return, including dividend. Dividends they are not given separately. Okay, because dividends are reinvested and we are getting the total value at the end of 10 years. So 10,000. Yes, sir. Into 100. 138%. This is per annum? No, for 10 years. For all 10 years put together. Assume they asked you to calculate per annum also how much? Analyzed holding period return. Guys, it is like this. Again, 23,800 minus 10,000 divided by 10,000. Till here everything remains same. Till here everything remains same. Plus 1 to the power of 1 by 10 minus 1. 10, 10. N is 10. Holding period. Yes, sir. Do it.
9.06.
First you do this part. Till here you do. Plus 1 and give me number.
2.38.
2.38 to the power of 1 by 10 minus 1. Okay, now so 1 by 10 they have given the value, that is 0.1. 2.38 to the power of 0.1 they have only given. Let me translate the value and they will give it in the question, you need not worry. Minus 1. So it is 0.906, or if I have to put it in percentage, 9.06% per annum over a period of 10 years. Over a period of 10 years. Now you may ask me, sir, if I do 9.06 into 10, I'm not getting 138, sir. I'm not getting 138. Guys, we have something called a CAGR, compounded annual growth revenue. Similar to that, this is clear. Why? Because see, what I have earned 138 is for all 10 years put together. So whatever I would have earned at the end of first year, second year and all, I have reinvested. So if I just add up everything, I will not get 1838. This is over a period of 10 years. Every year, on an average, how much did I earn? Okay. One more question. Tax rate is 30%, it seems. Okay. Beginning value, that is investment, 1 lakh. Dividends received 7,500. Capital appreciation is 12,500. So total return is 20,000. Ending value is 120. Very good. Fine, sir. So income, can I straight away tell? Straight away I am taking 20,000 guys. On an investment of how much? 1 lakh. Into 100. 20%. This is before tax. On my return, I have to pay 30% tax rates. Normally, for capital appreciation, tax rate is different. Dividends tax rate is different. But here they have not given it separately. So take same. Take same. So how much is that, sir? 20 into 1 minus tax rate. So 14%. After tax, what is the return I am taking home? 14%. Yes. Suppose we buy 1 share of SBI at the beginning of the year for 500. Can I tell it as P0? We hold the stock for 1 year. So holding period is 1 year. 20 rupees is the dividends collected at the end of the year 1. So D1. And the share is sold for 530. P1. The rate of return achieved is composite of dividend yield and change in the price, capital gains yield. Find out the rate of return. The rate they are asking R or K. R or K. Yes, sir. Chalo, P0 we have no 500. D1 is 20 plus 530. So what is my total return if I ask you? How much is that? 50 rupees. On an investment of 500 rupees. Divided by 1 plus R. 1 plus R. Okay, sir. 500 into 1 plus R is equal to 550. 550. Yes. So 1 plus R is equal to 550 divided by 500.
Which is 1.1.
Sorry? 1 plus R is equal to
1.1.
1.1. Yes. So R is equal to 1.1 minus 1, which is equal to 0.1, which is equal to 10%. 10%. R is 10%, which is nothing but K, cost of equity or expectation of the shareholders. Here, guys, see, here we are seeing from investor point of view. So that is why we are not using the word K. If you are seeing from the company's point of view, see, for shareholder return is 10%, means for company cost is how much? 10%. So if I am thinking from company's point of view, assume I am calculating cost of equity, I will name it as K. Correct? That is cost to the company, KE. But now we are seeing from investor's point of view. We are analyzing, should I invest or not? So we are seeing from whose point of view? From investor's point of view. From investor point of view, will it be return or cost? Return. So that is why we are just using the word R or alphabet R. Don't get confused with it. Okay. Same thing. If by chance if they ask you what is the cost to the company, answer will be same. 10%. Cost of equity will be 10%. Using the data given in the above, compute the present value of the share if the rate of return is 10%. Okay, means they are asking us to calculate this. Sir, they have given no, but in the exam when they ask, they will not give it. Okay, we are just doing it in different ways. P0 I need to calculate. Okay, sir. D1 is 20 and P1 is 530 divided by 1 plus they have only given 0.10. Yes, sir. So, P0 into 1.10 is equal to 550 or straight away divide it 1.10. How much you will get? P0 is equal to 500. 500. Yes. For problem 3, what will be the selling price at the end of year if the expected rate of return is 15%? Rest all you see, we need to calculate P1. Rest all you take same. Rest all you take same. So P0 is how much? 500. D0 is how much? 20. P1 we need to calculate. Divided by 1 plus 0.15. So 500 into 1.15. Come on.
575.
575 minus 20 is equal to P1. So P1 is equal to 555. 555. Yes, sir. An investor is holding 1000 shares of Right Choice Limited. The current rate of dividend paid by the company is 5 rupees. Current rate of dividend means what? D naught. D naught. 5. But what we require in the formula is D1. The long-term growth rate is expected to be 10% and expected rate of return is 19.62. Find out. Okay. D1 is equal to 5 plus growth rate is 10%. 5.5. Correct? Yes. Or you can do into 1 plus G also. Into 1 plus G also. You will say get the same number. Okay, sir. So D1 is 5.5 divided by R. They have given 0.1962 minus growth rate 0.10, which is equal to 5.5 divided by 0.0962, which is equal to 50.17. This is the current market price. Okay, that's all. This is all about security analysis. Yeah, now we will revise the last chapter, that is chapter 9, which talks about operational approach to financial decision. Guys, this is a new chapter which is added under new syllabus. This was not a part of FM previously under old syllabus. Yes. So what is cost? This is more relating to, there was a topic called management accounting or the paper called management accounting under new syllabus, under old syllabus, that has been removed now under new syllabus. So entire topic, whatever was covered in management accounting, they have tried to condense it as one chapter for you under new syllabus, and they have placed it in FM only, in FM itself. Okay, so cost, the amount of expenditure or money incurred to produce a product or to render a service. Now costing, sir, how much cost we have incurred? We have to calculate. Now, so the process of calculating how much cost we have incurred is called costing. Then application of costing and cost accounting principles, methods and techniques of cost control and ascertainment of profitability. Now, sir, to calculate cost, to ascertain the profit, or in costing we prepare something called as cost, profit and loss account. To calculate that, there will be certain principles, procedures and all concepts we have to follow. Yes, like in accounts also we have accounting principles, concepts, accounting standard, Indian accounting standards and all. Same way, even in costing, we have something called as cost accounting standards, principle, concepts and all. So we cannot calculate the cost however we want. So there are something which we have to add, deduct, what we have to consider, what we have to ignore and all. So that principles and concept what we follow to calculate the cost or to derive a profit is called cost accounting. The three main objectives of cost accounting are cost ascertainment, cost control and guidelines for management. First thing is, sir, I want to calculate what is the total cost I have incurred. Assume guys, the company has incurred a total cost of 20 lakh. 20 lakh. And now no company will be happy with whatever cost they are incurring. Ask anyone. Okay, so whatever it is, they want to control somewhere. Okay, so they feel that here we are incurring more, there we are incurring more, here there is a huge loss. So they will try to find out the areas where they can improve and reduce their cost. So cost control, they will try to find out the areas where and all they can control their cost. Then guidelines for the management. So they give some tips to the management, what all decisions they have to make. Now, whatever cost we have calculated is for past. But based on that, we can try to control and make some decisions with respect to future. Yes. So we will give some guidelines to the top level management. Based on that, they will make the decisions. Yes, just a minute. Yeah. Next, types of costing. There are different types of cost under cost accounting or costing. Accountants and managers use many different concepts of cost, each usually for a different purpose. Important types of cost are explained below. First one, variable cost. Variable cost is something which will always vary with the activity level. The more number of units I produce, more would be the variable cost. Guys, total variable cost will always vary with production, whereas variable cost per unit will always be constant. Per unit will always be fixed. For example, assume variable cost per unit is 10 rupees. Now, if I produce 1000 units, what will be the total variable cost? 1000 into 10. Sir, I produce 1200 units. What will be the variable cost? Total variable cost. 1200 into 10. Sir, I produced only 800 units. What would be the variable cost? Total variable cost. 800 into 10. So, according to the activity level or the production, total variable cost will increase or decrease. It will always go in the same direction as my activity level. Whereas fixed cost in total remains same. Whereas per unit, it will always move in an opposite direction. For example, assume guys, for my godown, every year I am paying 1,50,000 rent. 1,50,000 rent, fixed amount, no matter how many units I produce. Now, if I produce 1 lakh units, then what will be the fixed cost per unit? 1,50,000 divided by 1 lakh, 1.5. Sir, I assume I produce only 80,000 units. Then what will be the fixed cost per unit? It will accordingly go up. I assume I produce more number of units. 1,50,000 divided by, assume I produced 1,25,000 units. Now what happened? Fixed cost per unit will come down. Fixed cost per unit will always move in an opposite direction from the units of production. Whereas in total, it will always remain constant, guys. In total. Okay, I repeat, variable cost in per unit will remain fixed, whereas in total it will always vary. Higher the number of units, higher would be the variable cost. Lower the number of units, lower would be the variable cost. Whereas fixed cost is opposite. Total fixed cost will remain constant irrespective of your activity level. Whereas per unit, it will always move in the opposite direction. Higher the number of units you produce, fixed cost per unit will get decreased because the denominator will increase. Lower the number of units you produce, fixed cost per unit will increase because the denominator will be less there. Next, direct cost. Direct cost is something which is directly attributable to the product or operations. Sir, I can tell to produce each and every unit what is the cost I am incurring. For example, raw material cost. So, assume guys, for each and every unit of output, I require 2 kg of raw material. How much? How much? 2 kg. For each kg, it will cost me 20 rupees. So, can I tell, sir, what is the raw material cost per unit? Yes, 40 rupees. So, is it directly attributable to the output? Yes. So, I can tell for each and every unit of output, what is my raw material cost? We call it as direct cost. When it comes to indirect cost, sir, they are not directly traceable or directly attributable to the product or operations. For example, rent paid for factory building, salary paid to supervisor, salary paid to accountant. I am paying it per month fixed. I don't know per each and every unit how much I am paying. Agree na? So is it directly attributable to my production units? No, sir. So can I call it as indirect cost? Yes. So normally if I tell you in simple, variable cost will be direct in nature. May not be always, majority. Clear? Whereas fixed cost will always be indirect in nature. Will always be indirect in nature, guys. Then relevant cost. Relevant cost is something which is relevant for me for making decisions. Sir, irrelevant is something which is not relevant for me for making decisions. For example, assume guys, I have two plans, plan A, plan B. Under plan A, raw material cost is 1 lakh. Under plan B also 1 lakh. Whereas labor cost is 2 lakh here, 2.5 lakh here. Tell me what is relevant, what is irrelevant? Raw material cost is irrelevant. Why? It is same under both the options. No matter I go with A or B, it remains same. Whereas labor cost is not same. Can I call it as relevant? Yes. So which is irrelevant is something which will change under two different options. Whereas irrelevant is something which remains same. Sir, no matter with which I go, it remains same. So I will ignore it. So while taking decisions, I will compare only what, or I will consider only what? Labor cost here. Sunk cost. Sunk cost is something which is already incurred. Can I change my past? No. Can I crib around it? No, don't do it. Okay. So when it comes to sunk cost, sir, it is something which has already happened. I have already incurred for it, paid for it. Will I consider it for making future decisions? No, I will not. So it will not help you in any decision making. Then shutdown cost. Shutdown cost is unavoidable fixed cost which continue to be incurred even when plant is temporarily shut down. Sir, I am planning to temporarily shut down my operation. Sir, why, sir? COVID or some other reason, or I am going abroad for 2-3 months. I am stopping my operations. If I stop my operation, will my cost be zero? May not be. I may continue to incur some fixed cost. So whatever fixed cost I will continue to incur even if I have temporarily shut down my operation is called shutdown cost. It's called shutdown cost, which is nothing but similar to fixed cost, guys. Imputed hypothetical or notional cost. Guys, assume I have invested my own money 10 lakh into my business. I am not taking any interest. If I had invested elsewhere, I would have got some return. What is that? Opportunity lost for me. Correct? So can I consider it as a notional cost for the business? Yes. Same way, I am working for my own company. I am not drawing any salary from my business. If I had worked somewhere else, I would have got salary now. Yes. Or else, if I had placed someone else in my business in place of me, I would have paid salary for them now. Yes. Am I paying now? No. But can I consider it as a notional salary just for some calculation purpose? If I had considered someone else, or if I had worked somewhere else, what is the salary I would have got? Can I consider it? Yes, for costing you can consider it. Just to figure out what would have been your total cost. So there is no cash outflow here. We are not paying to anyone. Cash and cash equivalent balance remains same, but still we just consider it for calculation purpose. Whereas out of pocket cost or explicit cost is our expenses, whatever we pay, like salary paid, wages pay, printing and stationery pay, whatever we pay. Out of pocket means, sir, money is going out of my pocket. Cash balance is coming down, or bank balance is coming down, which is opposite to notional cost. Then coming to classification of cost, mainly cost is classified into three categories: material, labor, and other expenses. Guys, simple. For if I am a manufacturer, first thing for me to start with manufacturing, what should I have? Material. That is raw material. So once I get raw material, now sir, who will convert that into output? Workers, laborers. For them I have to pay salary. No one will work and come and work for me freely. Yes. Then sir, only workers can convert. There is nothing else. No, there might be some supporting staff. There may be accountants, HR department, finance, marketing, everyone who will support the manufacturing. So for that also we have to incur number of other expenses. So all this put together, we will have total cost, guys. Yeah, material cost. The price of materials needed to produce a good or render a service is referred to as the material cost. Employee or labor cost. The cost of labor is a sum of all wages paid to employees, as well as the cost of employee benefits and payroll taxes paid by the employer. Payroll taxes is nothing but TDS. We call it as income tax. It is a part of income tax, tax deducted at source. So should we know all that for FM? No, you need not. The cost of labor is broken into direct and indirect. So labor cost can be broken down into direct and indirect. Guys, the workers who are directly engaged in production. Production normally happens in factory. In factory, whoever workers are working, for whom the wages is paid based on how many units they produce, is called direct labor cost. Now, any workers who are not engaged in production but supporting the production, like supervisor, accountants, all these people directly or indirectly, administration staff, for them also we are paying salary or wages. What is it called as? Indirect labor cost. Yes. And here, all the components of salary or wages will be included. For example, in taxation and all, we call it as allowances, so perquisites and all. Everything is a part. Sir, will they give it separately and all? No, guys. For this is only one small chapter what they have covered. They will not ask you to calculate what is the cost, that this labor cost, overhead cost, or even material cost and all. It is very simple topics. Marginal costing, yes, they have covered something in detail. Now, what is marginal costing? Before marginal costing, we will understand what is marginal cost. Marginal cost is something which is incurred for producing one additional unit. Sir, if I produce one additional unit, what is the cost I will incur? That is called marginal cost, which is nothing but variable cost. Because if I produce one additional unit, will I incur any fixed cost? No. How much ever units I produce, total fixed cost will be same. Only if I produce more and more number of units, I have to incur more and more variable cost. So marginal cost is nothing but variable cost. Yes, sir. Now, I can also put it in another way. Sir, if I don't produce one unit, what is that I can save? Marginal cost, which is nothing but variable cost. One and the same. Yes, sir. Now, marginal costing. It is one of the technique of costing, guys. It is useful only for decision making within the company, where they tell where we will consider only variable cost. Why, sir? Because only variable cost is in my control. Fixed cost is not in my control. No matter what, I have to incur so much. Now, if I have to decide how many units to produce, more or less, will it affect fixed cost? No. Then, as my decisions cannot change fixed cost, we will ignore it. We will focus on more on what? Variable cost. Because my decision can impact only variable cost. So, marginal costing is of the opinion, variable cost is in my control. Let me focus only on that. I will make decisions only based on variable cost. Period cost, they will calculate, they will include it, but decisions will not be based on fixed cost. Clear? Yes. The term marginal cost is the cost of producing one additional unit. It is the variable cost of one unit of a product or a service. That is, cost which could be avoided if that unit was not produced or produced. If I produce one additional unit, what is the cost I will incur? Assume 20 rupees. If I don't produce one unit, what is the cost I can save? 20 rupees. Marginal costing is a principle whereby variable costs are charged to the cost units and fixed costs are attributable to relevant period. It is written off in full against the contribution for the period. Guys, under marginal costing, we have a format. This is the format. Sales minus variable cost. We get something called as contribution. From contribution, we will reduce fixed cost. We get net profit. So here, fixed variable operating cost and all should be considered. No. Okay, straight away only variable cost. Variable cost here includes all variable cost. Yes, sir. You will get contribution. Higher the contribution, better is the performance as per marginal costing. Yes, sir. And fixed, see, variable cost, they treat it as product cost. Whereas fixed cost, they will treat it as what? Period cost. Straight away, they will debit it to costing P&L account. They will treat it as indirect cost straight away. Whereas variable cost, they will use it to value the product. Guys, assume now. I'm giving it an example. Direct material cost. Assume 20 rupees per unit. Direct labor cost is 30 rupees per unit. Variable manufacturing overhead, like other expenses, okay, is 20. Fixed manufacturing overhead is 15. So how much it comes to? 85. Ah. So cost per unit 85. Now under marginal costing, they are clearly telling we will use only variable manufacturing cost to value the products. Assume guys 1000 units are produced. Out of that, 800 units are sold and 200 units are closing stock. Now what is the cost of goods sold? 800 into
85.
70. 800 into 70. What is the closing stock? Well, cost of closing stock? 200 into 70. 200 into 70. Sir, what about this, sir? We will treat it as period cost. We will not include it while valuing the products, guys, whether it is goods sold or closing stock. We have something opposite to marginal costing called absorption costing, which we use for external reporting purpose or for preparing financial statements, which is opposite to marginal costing. Absorption costing is not a part of your syllabus, but I'm just mentioning for your knowledge. Absorption costing will tell cost is cost, no matter which cost it is. We will take total cost. We will value the products and all at 85. And it is not used for internal decision making. It is used only for external financial reporting. So when you guys would have seen while preparing financial statements and all, will you give a breakup how much is variable or how much is fixed and all? No. Even if for income tax purpose, we never care about what is variable, what is fixed. We only bother about what is allowed, what is disallowed. Clear? So for income tax purpose and financial reporting purpose, we use absorption costing, which is more for external purpose. Whereas for internal decision making purpose, we should know what is in our control, what is not in our control. So that is why we use marginal costing, guys. In marginal costing, costs are classified into fixed and variable cost. Marginal costing is known as variable costing, in which only variable costs are accumulated and cost is ascertained only on the basis of variable cost. Under marginal costing, finished goods inventory or simply inventory will be valued at only variable cost, which includes direct material cost, direct labor cost plus variable manufacturing overhead. Sir, what about fixed manufacturing overhead? We will treat it as period cost. Guys, only one format is there and we can derive a lot of formulas from this. What is the format under marginal costing? Sales minus variable cost is equal to contribution minus fixed cost will is equal to profit. Yes, sir. You can see marginal cost equation. Sales minus cost, which includes both, is equal to profit. Now, if I break the cost into two parts, fixed and variable, which is equal to profit. So, what is the equation? Sales minus variable cost is equal to contribution, which is equal to fixed cost plus profit. Yes. So, before we go through various formulas and concepts, guys, I want to just test your knowledge. Okay, how good you are in calculations and that. Please answer. Please answer. Now, assume I am making a profit per unit 10 rupees. For each and every unit I make and sell, how much profit I am making? 10 rupees. Now I want to make 10 lakh profit. Tell me how many units should I sell? Matthews, do it. I am making 10 rupees profit for each and every unit I sell. I want to totally make a profit of 10 lakh rupees. Tell me how many units should I sell? 1 lakh units. Sir, nothing I funda, sir. Nothing I funda. So how many units should I produce and sell to make a profit of 10 lakh? 1 lakh units. Very good. Next. Guys, I am making 10 lakh profit. And the profit percentage is 20%. Tell me how much sales should I make? I am making in rupees totally profit of 10 lakh. Profit percentage is 20%. How much sales should I make?
50 lakh.
50 lakh. How did you get? Sir, sales in rupees divided, profit in rupees divided by profit in percentage. Correct, na? You guys would have done like this. Sir, gross profit percentage is assumed 20%. So they have given sales as 50 lakh. Tell me what is the amount of gross profit? 50 lakh into 20%. 20%, correct. Now what is the gross profit here? 10 lakh. Correct. Now, so we had 10 lakh, we had 20%, we found what? 50 lakh. We found 50 lakh. Is that clear? That's all, sir. Formulas are based on this only. CVP analysis, cost volume profit analysis. It is a technique that may be used by the management to evaluate how cost and profits are affected by the changes in volume. Volume here is nothing but quantity. So if there is more number of units produced and sold, sir, how will it affect the profit? How will it affect the cost? Or if there is less number of units produced and sold, how will it affect our profit and cost? That is what we will understand here. First one, PV ratio, we call it as. The ratio or percentage of contribution margin to sales is known as PV ratio. Guys, simple. How much is my contribution when compared to sales? That is after meeting variable cost, how much is left with us? How much is left with us? So, how much is my contribution when compared to sales? What is the formula? Contribution by sales into 100. Assume my PV ratio is 40%, which is nothing but my contribution is how much of my sales? 40%. How much is my variable cost? How much is my variable cost? 60%. Assume they have given in the question, variable cost is 20% of sales. How much is my PV ratio? 80%. Variable cost is 30% of sales. How much is PV ratio? 70%. PV ratio is 65%. How much is variable cost? 35%. That is 100 minus that. Clear? Yes. Because contribution plus variable cost is equal to sales now. If I just do reverse calculation, contribution plus variable cost is equal to sales. Okay, sir. This ratio is also known as marginal income ratio, contribution to sales ratio, or variable profit ratio. PV ratio usually expressed as the percentage. It is the rate at which profit increases with increase in volume. So, formula. First formula is always this. Contribution by sales. If I want to put it in percentage, into 100. If 2 period data is given, 2 period data, then we use the second formula. What is the formula, sir? Change in profit or change in contribution divided by change in sales. This is only when 2 period data is given. Okay. Higher the PV ratio is always better. Now assume I am evaluating 5 products. Which product is more profitable means whichever product is having higher PV ratio. Yes. Then break-even analysis. Sir, what is break-even? Guys, break-even is a point where my total cost is equal to total sales. Total cost is equal to total sales. Means I have recovered all my cost. I have recovered all my cost. Now, once I reach break-even point, after that, I will start making profit. But before break-even, I will be suffering loss because of my huge fixed cost. Because of my huge fixed cost. Yes. So, break-even sales or break-even point is a point where total cost is equal to total sales. Or I can put it in another way. It is a point where there is no profit, no loss. When cost is equal to sales, obviously what do we have? Zero profit or zero loss. But before I touch break-even sales, I will be suffering loss. Once I cross break-even sales, I will start making profit. Okay. I have given it in the diagram format. You can see. Guys, fixed cost. Oh, okay. In x-axis production units are there, whereas in y-axis cost and sales. Cost and sales, that is in rupees. Okay, you can observe no matter how many units you produce and sell, total fixed cost will always be fixed. Even if you have produced 0, still fixed cost will be there. Yes, sir. Next, total cost will always start from here. Why, sir? Variable plus fixed. Variable plus fixed. This part is what? Variable. This part is variable. Yes, sir. Sales will start from where? Here, No. It will always start from 0. If I have not produced anything and sold, for sales is how much? 0. Sales will always be like this. And you can observe, guys, this area. Cost is above sales. Cost is above sales. What can I call that area as? Loss area. And once the cost and sales intersects, what do I call that point as? Angle of incidence, which is break-even point. If I extend it to x-axis, we will get break-even sales in units. Means, assume I got 5,000 units. Means, if I produce and sell 5,000 units, I will break even. I will recover all my cost. I am not telling sell only 5,000 anta. Minimum 5,000 you have to sell. Now assume I am producing and selling 7,000 units. That means 2,000 extra units is what for me? Margin of safety. It is giving me profit. It is giving me profit. Anything over and above break-even sales is margin of safety for me. Now guys, margin of safety in my example is 2000 units. Tell me for this unit, will I incur all the cost or only variable cost? Only variable cost. Because no matter how many units you produce, whether 3000 or 5000 or 7000 or 8000 or fixed cost in total will remain same. Now, by producing 5000 units, I have recovered all my cost including fixed cost. So, to produce and sell 2000 additional units, I will incur only variable cost. I will incur only variable cost. So, for margin of safety, we will incur only variable cost. There is no fixed cost for it. Now, can I tell? For margin of safety, contribution is equal to profit?
Yes.
Just think. Is contribution is equal to profit? Yes. For margin of safety, not for entire 7000. For 2000 units, can I tell contribution is equal to profit? Yes. Why, sir? Fixed cost is 0. Fixed cost is 0 only for margin of safety, not in total. In total, I will have, but by the time I produce and sell 5000 units, I have already recovered it. For producing and selling additional 1000 or 2000 units, will I incur again fixed cost? No, only variable cost. So for margin of safety, only variable cost will be there. So contribution is equal to profit. Okay, sir. So you can see once we cross the break-even sales point, sir, sales line will go above the cost line. So we will have profit. We will have profit, guys. Same way, if I extend this break-even point to a y-axis, we will get break-even sales in rupees. Assume we are getting it as 10 lakh rupees, guys. Means if I make a sales of 10 lakh rupees, I will break even. If I make more than that, assume my total sales is like 13 lakh. 3 lakh is margin of safety, which will bring me profit. To make that 3 lakh extra sales, I would have incurred only variable cost. So can I tell? 3 lakh is margin of safety, na? Into PV ratio. What do we get? Contribution is equal to profit. Is equal to profit. Correct? Yes. Now, this is diagrammatic, guys. Yes, chart wise. Now, let us try to frame the formulas or derive the formulas. Guys, come on. First, let us understand margin, break-even sales. At break-even sales, profit is 0, na? Yes, sir. So, can I tell contribution is equal to fixed cost? Correct, na? Profit is 0. Yes, sir. Contribution is equal to fixed cost. Now, assume my fixed cost is 10 lakh. My fixed cost is 10 lakh. In order to break even, how much contribution should I earn? 10 lakh. 10 lakh. Yes. Assume PV ratio, guys. PV ratio is 20%. So, can I calculate what should be my break-even sales?
Yes.
Contribution in rupees divided by contribution in percentage. I repeat. Sir, I am checking my break-even sales. At break-even sales, my profit would be 0. Yes. That means my fixed cost should be equal to contribution. Yes. Assume my fixed cost is 10 lakh. In order to break even, how much should be my contribution? 10 lakh. 10 lakh should be in rupees. And assume my PV ratio is 20%. So, if I divide each other, what do I get, sir? Break-even sales in rupees. Break-even sales in rupees. How much rupees of sales I should make in order to have a contribution of 10 lakh, which is nothing but break-even sales. Same way. Same way. Assume I want to earn a total contribution, same 10 lakh. For each and every unit I produce and sell, contribution per unit is 10 rupees. For each and every unit I produce and sell, contribution is how much? 10 rupees. Now what will I get? How many units should I produce and sell in order to break even? What was the numerator? Total contribution I should earn to break even. What was the denominator? Contribution per unit. Now how many units should I produce and sell? 1 lakh units. Why? To break even. Assume I am selling 1,20,000 units. 20,000 units will bring in profit for me. For that only variable cost would be there. So for 20,000 units, if I multiply with PV ratio, what do I get? Contribution. Contribution is equal to profit. Hope you guys got it. So if I want to calculate break-even sales in rupees, what is the formula? Total contribution divided by PV ratio. And here total contribution is nothing but fixed cost. Can I name it as fixed cost, sir? Yes, that is what they have used in the formula, which is actually nothing but total contribution. If I want to calculate break-even sales in units, what is the formula, sir? Total contribution divided by contribution per unit. And here total contribution is nothing but fixed cost. So what is the formula? Fixed cost divided by contribution per unit. Yes. The break-even point tells the manager what level of output or activity is required before the first start the making the profit. Reflects the relationship between cost, volume and profits. Below break-even point level, the firm will make losses. While above this, they will start making profit. This is so because that while variable costs vary according to the variations in the volume or level of activity, while the fixed costs do not change. The angle of incidence, we call this as angle of incidence. That is the point of intersection of total cost and total sales line. The angle of incidence is created by intersection of total cost line and total sales line. Okay, sales line, because income may confuse you with respect to profit and that. It is sales line. So what is the formula, sir? Break-even sales in rupees, how do I calculate? Fixed cost divided by PV ratio. Here fixed cost is nothing but contribution. And sir, what should I use in the formula? Please use fixed cost only, but it is nothing but contribution. Then break-even sales in rupees, we are done with. Now units, fixed cost divided by contribution per unit, guys. So denominator is changing, numerator is same, per unit. If you want to calculate in rupees, PV ratio, which is in percentage or decimal. Whereas if you want to calculate in units, the denominator will be per unit. Hope you understood why I started with this. Okay, if this basic calculation is good, you will understand why numerator is this, why denominator is this and all. Clear? Actually, the formula they have used the numerator as fixed cost. It is actually nothing but contribution. Total contribution divided by contribution per unit. You will get it in units. Same way. Total contribution divided by PV ratio, which is nothing but contribution in percentage. What do you get? In rupees. That is what we did it, yeah. So profit divided by profit percentage. What we got? Sales in rupees. Here, total profit divided by profit per unit. What did we get? How many units should I produce and sell? Same calculation we are doing there. Okay. Next, cash break-even point is the level of, okay, 1 second. At break-even point, fixed cost is equal to contribution as profit will be 0. And we have something called as cash break-even point where cash inflow is equal to cash outflow. What is the formula? Same formula. Instead of total fixed cost, we will take only cash fixed cost divided by contribution per unit, or here divided by PV ratio. Cash fixed cost means from total fixed cost, we will remove the non-cash fixed cost like depreciation and all. Yeah, yes. Then next, guys, here while calculating break-even sales, what was my profit? 0. So what was my fixed cost? 10 lakh. So if I want to break even, how much contribution should be? 10 lakh. Now company is telling I want to make a profit of 5 lakh. Tell me how much sales should I make? So what should be my total contribution? 15 lakh. Correct. Nah? 10 lakh fixed cost. After recovering that, I have to make 5 lakh profit also. So what should be my total contribution? 15 lakh. Correct. So if I divide it by contribution per unit, what do I get? How many units should I produce and sell in order to make a profit of 5 lakh? Not break even. Make a profit of 5 lakh. So we call it as required sales in units. Then assume, guys, 15 lakh, that is the total contribution, which includes fixed cost plus profit, divided by PV ratio I2. What do I get? Rupees of sales I should make in order to earn a profit of 5 lakh. 5 lakh. So what is the formula? So sometimes they will give it in the question, company is willing to earn so much of profit, how much sales they should make. This is what the formula we will use. Required sales in rupees is equal to fixed cost plus desired profit divided by PV ratio. This is what, guys, numerator is equal to what? Total contribution. Same way, if you are calculating in units, it would be fixed cost plus desired profit divided by contribution per unit. Agree na? Yes. Sir, why didn't they take desired profit, sir? Because it is 0. Even if you want to write plus desired profit is equal to 0, write it. What? We may lose a few seconds, that's all. Clear, but not required. We know that at break-even sales profit is 0. Na? That is why we didn't take that element here. Whereas here they are clearly giving company wants to make so much profit. So please add it. Guys, in this formula, numerator is nothing but total contribution. Clear, but please use in the formula while writing in the exam and all, please write whatever is there in the formula, that is fixed cost plus desired profit. But actually understanding has to go properly. It is the formulas is nothing but total contribution divided by per unit. You will get number of units. Another formula is Total contribution divided by contribution in percentage. You will get it in rupees. That's all. Next, we have another way also. Guys, assume you have calculated break-even sales in units. Sir, how can I calculate it in rupees? Multiply with selling price. Break-even sales in units into selling price. What do you get? Break-even sales in rupees. Or else, sir, I have got break-even sales in rupees, sir. Divide it by selling price, you will get in units. Same way here. Required sales, assume you have got in units. How can I calculate in rupees, sir? Multiply with selling price. Or else, sir, I have got break-even sales in rupees, sir. Sorry, required sales in rupees, sir. How can I find it down in units, sir? Divide it by selling price. Okay. Either you can do in that way or you can use the same formulas. Next, margin of safety. Margin of safety is the difference between the actual sales and break-even sales. Sales beyond the break-even sales bring in profits. Margin of safety is equal to what? Total sales minus break-even sales. Margin of safety can also be calculated with the help of PV ratio. How is it, sir? Margin of safety is equal to profit by PV ratio. Guys, profit we will earn for what? Margin of safety only. For margin of safety, profit is equal to contribution. Yes, sir. It is indirectly nothing but contribution divided by PV ratio. Correct, na? Yes, because for margin of safety, contribution is equal to profit. So the formula they have used is profit by PV ratio, which is nothing but contribution by PV ratio. But contribution here is not total contribution. Contribution for margin of safety. Clear? That is after break-even sales. After break-even point, there is no fixed cost. So margin of safety into PV ratio is what? Profit. Actually, it is contribution. But as there is no fixed cost, zero. So contribution is equal to profit. Yes. Now you guys tell me some basic things. Guys, company has achieved break-even sales at 60%. What is margin of safety? 40%. Now assume margin of safety is 20%. They have achieved break-even sales at how much? 80%. Correct? Yes, that's all. Some basic things. Because sometimes they will test you like this in the questions. Okay, chalo. Coming to the questions quickly. This is just understanding of marginal cost. One example. Variable cost per unit is 25 rupees, guys. Fixed cost is 1 lakh. No matter how many units you produce and sell, fixed cost will be how much? 1 lakh. Whereas variable cost, total variable cost will be how much, sir? 25 into number of units. Assume I have produced 10,000 units. What would be the variable cost? 10,000 into 25, 2 lakh 50. What will be my total cost? 2 lakh 50 plus 1 lakh, 3 lakh 50. Yes, so. Then, if I produce 10,001 units, what would be my total variable cost? 2 lakh 50,000 25. What will be my fixed cost? 1 lakh. What would be my total cost? 3 lakh 50,000 25. What is the additional cost I have incurred? 25. To produce one additional unit, what is the extra cost I have incurred? 25, which is nothing but. Sir, why, sir? Fixed cost will remain same. Whether you produce 10,000 units or 10,001 units or 11,000 units, it remains same. Yes. Now, coming to some questions. Find out break-even sales and margin of safety. Sales is 20 lakh. Variable fixed cost is 5 lakh. Variable cost is 12 lakh. Okay. So first let me derive the values, guys, so that it will help in my calculation. Sales minus variable cost will give us what? Contribution. Minus fixed cost, which is 5 lakh. Profit 3 lakh. What they have asked us? Break-even sales and margin of safety. What is the formula for break-even sales? Fixed cost divided by PV ratio. PV ratio they are not given. Let us calculate. PV ratio is equal to contribution by sales. Contribution is 8 lakh. Sales is 20 lakh into 100. 40%. So divided by 40% will give us break-even sale. 12 lakh 50,000. Sir, can we calculate in units? No. Selling price is not given. And even contribution per unit we don't know. We cannot calculate in units. Then margin of safety. What is my total sales? 20 lakh. What is my break-even sales? 12.5 lakh. So what is my margin of safety? 7.5 lakh. If I ask you what is the amount of profit into PV ratio, how much is my PV ratio? Into 40%. Is it matching? Is it matching? 3 lakh. Yes, sir. Please be careful. Margin of safety into PV ratio you do. Sir, straight away total sales into PV ratio I made, sir, I am not getting profit. You will not get profit. Because for total sales, you will have fixed cost also. Clear? So when you are calculating profit, you have to do margin of safety into PV ratio. I told there will not be fixed cost for margin of safety and not for entire sales. Okay. A Limited discloses the following information. Sales of a company are 200 per unit, 20 lakh. Can I calculate now how many units are sold? 20 lakh divided by 200. Yes. Variable cost is 12 lakh. Fixed cost is 6 lakh. Capacity of the factory is 15,000. Maximum they can produce 15,000 units. Okay. Determine the break-even point. How much profit is the company making? Okay. First let us calculate profit only. 20 lakh. Variable cost is 12 lakh.
8 lakh. 12 lakh. Minus 6 lakh.
Yes. 2 lakhs.
So profit is 2 lakh. So what they have asked, break-even sales. Formula is break-even sales is equal to divided by PV ratio. PV ratio, let me calculate. Contribution by sales into 100. How much is contribution? 8 lakh, na? 20 lakh. 15 lakh. What is break-even sales? 15 lakh. Sir, now can I calculate margin of safety? They are not asked. Still we can do it. How much is that? 20 minus 15. Fine. Okay, now yes. Can we check the profit properly? Yes, sir. So what is the margin of safety? 5 lakh. 5 lakh into 40%. Will it match? Yes, 2 lakh. Yes, sir. Now can we calculate in this question break-even sales in units, sir? Yes. How is it, sir? Contribution 8 lakh we have got divided by number of units. How many units, sir? 20 lakh divided by 200 you do. How much? 10,000 units. 10,000 units. Yes. So now 8 lakh divided by 10,000 you do. How much? 80. 80. So if I just divide fixed cost, how much? 6 lakh divided by 80. You will get break-even sales in units. Or different ways are there. I am trying to cover everything. 6 lakh divided by rupees 80. What is rupees 80? Contribution per unit. Or else you already know break-even sales in rupees divided by selling price. Divided by selling price, that is 15 lakh divided by 200. Or else another way, we know selling price 200 into PV ratio will give us what? Contribution per unit. Use that straight away as a denominator. Yes, sir. Now 2 period data is given. Sales are 1,50,000 producing a profit of 4,000 in period 1. Sales are 1,90,000 producing a profit of 12,000 in period 2. Determine break-even point. Okay, change in profit is 12 minus 4, 8,000. 12 minus 4, guys. Okay. The change in sales, 1,90,000 minus 1,50,000, 40,000 into 100. 20%. What is this? PV ratio. Now, what does they have asked? Break-even point. Now, sir, fixed cost is not given. Can we calculate? Yes. Take any one period. Which period shall we take? First period. So, what is the contribution? 1,50,000 into 20%. What is contribution? 30,000. Fixed cost, I don't know. Profit is how much? 4,000. So what is my fixed cost? Break even margin of, sorry, balancing figure. 26,000. Correct? Huh? Yes, sir. So fixed cost. So why did you take period 1 only? Why not period 2? Takes, you will get same. So contribution will be how much? 1,90,000 into 20%. 38,000. So profit is how much? 8,000. Sorry, 12,000. 12,000. So what is the balancing figure? Fixed cost. Fixed cost 12,000. Okay, guys. Fixed cost 26,000. Any one you do, both the period is not required in the exam. 26,000 divided by PV ratio is 20%. 1,30,000. What is this? Break-even sales in rupees. Yes. And guys, just a clarification. Now see, in this case, both the period profit was there. As in period 1, loss was there 5,000. Period 2, profit 20,000. What is change in profit? Change in profit. As in this is like 2 lakh, this is like 3 lakh. What is change in profit? 25,000. From minus 5, we have gone to plus 20. What is the difference between both? 25,000. Please be careful. Students will take it as 15,000 by mistake. If you by mistake take 15,000, you know everything will go wrong. Yeah. Yes. So it is like this, guys. I will just show you. Sir, I was minus 5. I went to 0 and I went to plus 20,000. So what is the gap between this? 25. 25. Yes. Sure. This is just for clarification. A product is sold at a price of 120, selling price. Variable cost is 80. So what is the contribution? 40. Yeah. Fixed expenses is 8,000 per year. Okay. PV ratio is 40 divided by 120 into 100.
1 by 2.
33.33, or whenever it is like this, if you want to get exact answer, better take 1 by 3. Okay, so what all we are supposed to calculate? Break-even sales in rupees and units, profits made when sales are 240 units, sales to be made to earn a profit of 5,000, required sales formula. Yes. First, break-even sales in units and rupees. Fixed cost 8,000 divided by contribution per unit 40.
Hey, division 200.
200.
Units are rupees.
200 units.
Now, I have to sell 200 units in order to break even. So, break even sales in rupees is equal to fixed cost 8,000 divided by 1 by 3. When it is 1 by 3, you have to do like this: 8,000 by 1 into 3. 24,000. Sir, any other alternate way? Yes, we already got 200 into selling price 120. You will get same. Any one way you do. 200 into 120. Yes, sir. How much profit we are making if we are selling 240 units? Contribution is 240 units into 40. Sir, can I start from sales, sir? Yes, you can start. 2 extra step you will have. That's all. Or else you can straight away. Anyway, we know the contribution. Straight away you start with contribution. So 240 into 40.
9,600.
Fixed cost is 8,000.
600.
Profit is 1,600. Then company wants to make a profit of 5,000. They are asking how much sales should I make? Desired profit they have given. So fixed cost is 8,000 plus desired profit. How much they are willing to make? 5,000. Guys, what is this? 8 plus 5. What is it? Total contribution. So if they want to earn a profit of 5,000, they have to earn a total contribution of how much? 13,000. Contribution ratio is how much? 1 by 3. 39,000. So if they want to make a profit of 5,000, how much sales should they make? 39,000. Sure. PV ratio 40%. The firm wants to increase its selling price by 10%. That is revised. The firm's variable cost is now higher by 5%. Fixed expenses of the firm have gone up from 2 lakh to 2,58,500. Work out the original BEP sales and revised BEP sales. Guys, they have not given the numbers here when it comes to selling price, variable cost and all. Can we assume? Yes. First, original we will go it. Sir, original they have told PV ratio is 40%. Let me assume sales as 100. So contribution is how much? 40. So how much is variable cost? 60. So fixed cost they have only given 2 lakh. And it has gone up to 2,58,500. Okay. Revised. Did they mention anything about sales? Selling price will increase by 10%. If I have assumed as 100, now it will increase by 10%. 110. Okay. Variable cost will increase by 5%. So 60 plus 5%. 63.
63.
Correct. No? Yes, sir. Now, what would be my contribution?
47.
47. Revised. So they have asked original sales, BEP sales and revised BEP sales. Original is what? Original or duplicate and all not. So before change what was there, after change what is there. That's all. Okay. Yes. So original break-even sales is equal to original fixed cost divided by original PV ratio. Okay. Original fixed cost 2 lakh divided by original PV ratio 40%. Fine. What is this? Original break-even sales. Now, sir, revised break-even sales is equal to revised fixed cost, which is 2,58,500 divided by revised PV ratio. PV ratio, you will get 47 by 110. Correct? And you will get it in decimal. Keep it like this only. Better avoid it. If not, there will be difference in answer. So I am taking 47 by 110 only. In the calculator, how do you calculate? 2,58,500 by 47 into 110.
6,05,000.
This is revised after the increase. This is the break-even sales. Sure. The following data relate to manufacturing company. This is like not exactly covered in your syllabus and all, guys, but still I am doing it. There are chances of asking questions and all on few topics related to marginal costing only. I will just touch that so that if at all if there is any question, you will know how to answer it. The following data relate to a manufacturing company. Plant capacity is 4 lakh units per annum. Means maximum they can produce and sell 4 lakh units. And see, up to 4 lakh units, their fixed cost will not change. Assume I want to produce 5 lakh, 6 lakh and sell. Maybe my fixed cost will increase. If I am going beyond the capacity, my fixed cost will increase. But up to 4 lakh, no increase in fixed cost. But sometimes they may only give in the question, fixed cost has increased from so and so. Please consider it. Sir, you taught us fixed cost will not change, but here they change. No, sir. If they have given it in the question, take it. Clear? If not, please assume it is same. Yeah, present utilization is 40%. Means how much units they are producing and selling? 4 lakh into 40%. Actuals were following. Selling price 50, material cost 20, variable cost is 15, fixed cost is 27 lakh. In order to improve the capacity utilization, the following proposals are being considered. Reduce selling price by 10%. Okay. Spend additionally 3 lakh on sales promotion. How many units should be made and sold in order to earn a profit of 5 lakh? Okay. Fine. So, variable cost per unit, guys. 35. Correct? 20 plus 15. 35. So, selling price they are telling. Selling price we are revising. So, from 50 we are dropping it to 10%. So, 45. Then anything else, fixed cost will also increase by 3 lakh. So 27 plus 3, 38 would be. Okay, required sales, 30 lakh fixed cost plus they want to make 5 lakh profit. So how much contribution they should earn? 35 lakh divided by contribution per unit. So contribution per unit also I will show it here. 45 minus 35 is equal to 10. So 10 rupees per unit. How many units? 3,50,000 units. So after reducing their selling price and their fixed cost also is increased, and if they want to earn a 5 lakh rupees profit, how many units they have to produce and sell now? 3,50,000 units. Do they have so much of capacity? Yes, they have. Yes. Next, this part especially, make or buy decision. Guys, see, let me just give an example. Assume, guys, make or buy decision is always on raw material, not on output. Because I am a manufacturer, I have to manufacture the output. So, make or buy decisions we are making with respect to raw material. Under that, there are two scenarios. Please pay attention. I am already manufacturing my raw material. Assume I am already manufacturing my raw material. Now, what would be my cost? Variable manufacturing cost, assume it is 40 plus fixed manufacturing cost is rupees 10. What is my total cost? 50 rupees. Now, if I purchase it from outside, the purchase price, if I stop manufacturing and purchase from outside, they are telling I'm ready to sell it for me for 45. Means I can buy it at 45. What should I do? What should I do? Continue manufacturing. Why, sir? Because even if I stop manufacturing, this will continue to incur. As I have already set up my manufacturing and all, fixed cost will continue to be incurred. So, can I tell it as irrelevant cost? Yes. Guys, listen. If I continue manufacturing, what would be my cost? 50. If I start purchasing now, what would be my cost? 40 plus 10, 55. So 10 is common in both the cases. Yes. Can I call it as irrelevant? Yes. So if I am already manufacturing my raw material, and if I now think of deciding or thinking of to purchase it from outside, I have to always compare variable manufacturing cost with what? Purchase price. Whichever is lower, I have to go with it. Because even if I stop manufacturing, fixed manufacturing cost will continue to be incurred. Okay, sir. Next. Sir, till now I was purchasing the raw material, sir. Now I am thinking I should stop purchasing and produce in-house. If I produce in-house, total manufacturing cost, same cost I am taking is 50 rupees, sir. If I purchase from outside, it is 45, sir. What should I do? Purchase. Continue to purchase. Why? Because till now I was purchasing. I don't have any manufacturing facility. My fixed cost was 0. If I now start manufacturing, I have to incur both variable and fixed. So I have to compare what with what? Total manufacturing cost with purchase price and go with whichever is lower. Whichever is lower, guys. Okay, fine. A TV manufacturing company finds that while it costs to make a component X, the same is available in the market at 5.75. Okay, purchase price. With all assurance of continued supply. The breakdown of the cost is, means if they make it, how much? Material, labor, variable overhead, depreciation and other fixed cost. So total manufacturing cost is how much? Per unit, 6.25. If I remove fixed, how much is that? 5 rupees. Variable manufacturing cost is how much? 5 rupees. Should the company make or buy the component? If they are already manufacturing, what should they do? Better continue manufacturing. because 5 is less than 5.75. What should be your decision if the supplier is offered 4.85 per unit purchase? Stop manufacturing and start purchasing. Why, sir? I can say 15 paisa for each and every unit. 15 paisa for each and every unit. Yes. Yeah. The cost of manufacturing company for a product is accepting an offer. This is a question on that. Material, labor, variable expenses, fixed expenses, total is 45. Unit of a product is sold for 51. Are we making profit already? Yes. The company's normal capacity is 1 lakh units. The figures given above are for 80,000 units. Means presently we are selling how much? 80,000 units. The company has received an offer for 20,000 units at 36 rupees per unit from a foreign customer. Advise the manufacturer on whether order should be accepted or not. Also give your advice if order is for local merchant. Guys, from producing 80,000 units and selling it, are we making already profit? Yes, quickly we will check it. 80,000 units into, what is the selling price? 51. Give me the numbers.
So 14 lakh 80,000. The first.
14 lakh.
40
lakh 80,000. Variable cost. Let me just add it. 12 plus 9 plus 6. 27. So 27. Sorry?
21.
21 lakh 60,000.
60,000. Contribution.
19 lakh 20,000.
19 lakh
20,000.
20,000. Fixed cost would be, it will always be based on capacity, guys. 1 lakh into 18. Because no matter how many units I produce and sell, it will be fixed. So
18 lakh.
18
18
lakh.
lakh.
1 lakh 20.
Presently, am I making profit? Yes. How much? 120. This is for how many units? 80,000 units. Guys, now additional offer is for 20,000 units. Now, can I call this as margin of safety? Yes, we already break even. We already started making profit. So this is like margin of safety for us. For margin of safety, I will incur only variable cost. Now, see, if I can sell it in my normal market, I can sell it at 51 only. But no, sir, too much demand is not there. Now, foreign customer are coming and telling, Vikas, I will purchase 20,000 units from you. How much you can offer it? I am okay with any price more than 27. I am okay with any price more than 27. Why? Assume 30 rupees. I will get contribution how much? 3 rupees, which is equal to profit. Which is equal to profit, which will increase my overall profit. Correct, na? Yes, sir. So for additional units, which is nothing but like margin of safety for us, we are okay with any price which is more than marginal cost or variable cost. But there are few things which I have to consider. I should make sure that this 20,000 additional units will not affect my present market. Assume 20,000 units also I am selling it in the same market at 30 rupees, where I am selling 80,000 units at 51. Then the customers who had purchased 80,000 units at 51 will be labo, because obviously, you know, Indian customers, they will stand in front of my door and telling, for me also sell it at 30 rupees. So my present market would be affected. So now as it is from foreign customer, like we are like almost exporting. Can I do it? Yes. Assuming it will not affect my present sales. They have also asked, what if it is from local merchant? Thank you. Okay, it may bring me more profit, but in a greediness of having little profit, don't lose your present market of 80,000 units. Yeah. So if it is from local merchant, we will not go with it. If he is offering 51 only, okay. But anything less than that, not suggested. Whereas foreign customer, any price more than 27 is okay for us. Yeah. Next, a national company has just been formed. They have patented process that will make them sole suppliers of product A. During the first year, the capacity of the plant will be 9,000 units, and this is the amount they will be able to sell. Their cost, they have given it in dollar. Labor 15 rupees per unit, $15 per unit. Raw material 5 per unit. Other variable cost 10 per unit. Fixed cost is $240,000. There are two parts to this question. Okay. If the company aims to make a profit of $210,000 for the first year, desired profit, what should the selling price be? What is the contribution margin at this price? That is PV ratio. Okay, let us do it. Direct labor 9,000 into 15. Give me the numbers quickly. Huh? Sorry? 1 lakh?
35,000.
Materials.
45,000.
90,000. Total
2,70,000.
17.
70.
70. Fixed cost is 2,40,000.
40.
All things are in dollar. I have mentioned in the top only.
30,000.
Total cost 5,10,000. Profit they want to make, they have given you 2,10,000. 2,10,000. So what would be their total sales? 720. How many units they are selling? 9,000. 9,000. So what would be their selling price? 80.
80.
80. And they asked contribution also, I guess PV ratio. Contribution, yes. So PV ratio or contribution margin ratio, contribution by sales into 100. Contribution, selling price is how much? 80. Minus variable cost is 15 plus 5 plus 10. So 20, 30. 30. Minus selling price 80 into 100. So 50 by 80 into 100.
62.5.
Huh?
62.5.
Percentage. Selling price is 80 only, no? Yeah. 15, 20, 30. Yeah. 62.5%. Okay, sir. Second requirement we will see. If at the end of first year, the company aims to increase its volume, that is the quantity, how many units will they have to sell to realize a profit of 7,60,000? What is the desired profit? $7,60,000. Given the following conditions, an increase of 1 lakh in the annual fixed cost will increase their capacity to 50,000 units. So they are increasing their capacity, whatever is their 2,40,000 plus now how much? 1 lakh. Selling price is at 70 per unit and no other cost change, because as they are producing and selling more number of units, they are giving some discounts. They are reducing their selling price. And $5 lakh is invested in advertising. So this also should be added for fixed cost. Okay. What are they asking? How many units?
They sell to realize the profit.
Of 760, which is nothing but required sales formula. So what is the total fixed cost, guys? $8,40,000. 240 plus 1 lakh plus 5 lakh, including whatever is the increase. Contribution per unit would be 70 minus, as they have not mentioned any change in the variable cost, we'll assume same. 15 plus 5 plus 10, 30. So 40. Contribution per unit is 40. So fixed cost is 8,40,000. They want to make a profit of 760, right? 760. 7,60,000 divided by contribution per unit is 40.
40,000
Units. If they ask in rupees, into selling price, that's all. Into selling price. Yes, guys. So, okay, if at all if they ask, here they have asked only units. Okay, we are stopping there. How many units? Some more question, quickly. From the following particulars, find out the amount of profit earned during the year using marginal costing technique. Marginal costing means always go with the format, guys. Sales minus variable cost, you will get contribution. Contribution minus fixed cost, you will get profit. Output to selling price, variable cost, and total fixed cost is given. Total fixed cost means they have not given the breakup per product and all. So straight away put it only in total column. Sales revenue, output into selling price. Give me 10,000 into 10. Next 20,000 into 10.
2 lakh. 1,50,000.
30,000 into 5, that is. Okay. Yeah, total is 4 lakh. Yes. So then variable cost. So you multiply 6 with 10, 7.5 with 20. Once again. 7.5 with 20,000 and 4.5 with 30,000. Give me the amounts.
60,000. 1,50,000. 1,55,000.
Total.
3,45,000.
Contributions 40.
15.
15. 9.
5.
1,05,000. So what is the profit? 25,000. 25,000. That's all. And if by chance if they have given fixed cost product wise, accordingly show the fixed cost individually and also show profit. Normally they don't give it, they will give it in total. So you can just put it in total column. Yeah. MNP Limited sold 2,75,000 units of its product at 37.5 rupees per unit selling price. Variable cost is 17.5. So what is the contribution? 37.5 minus 17.5, which is 20. Okay, so variable includes manufacturing cost 14, selling cost is 3.5 rupees per unit. Okay, fixed costs are incurred uniformly throughout the year amounting to 35 lakh, including depreciation of 15 lakh, non-cash. 15 lakh is non-cash. There is no beginning or ending inventory. Required, compute break-even sales level in quantity and cash break-even sales in quantity. So total fixed cost is how much? 35 lakh. So break-even sales in units is 35 lakh divided by contribution per unit 20. 1,75,000 units. Okay, sir. Cash fixed cost would be 35 lakh is my total cost. In that depreciation is how much? 15 lakh, which is non-cash. So what is cash fixed cost? 20 lakh. So 20 lakh divided by contribution will remain same because variable cost will always be in cash, guys. 20. 1 lakh units. So in order to have cash inflows equal to cash outflows, how many units should I sell? 1 lakh units. So cash break-even point is the point where there is cash inflow is equal to cash outflow, or it is a point where there is no cash profit or no cash loss. Yeah, Mahindra Limited sells 2 products, J and K, not Jammu and Kashmir, products J and K. The sales mix is 4 units of J and 3 units of K. The contribution margins per unit are 40 for J and 20 for K. Fixed costs are 6,16,000 per month. Please be careful. Sales mix is 4 units of J and 3 units of K. Sales ratio 4:3. Compute composite contribution per unit, that is both products put together, by taking weights for the product sales quantity. Guys, simple. For J, how much is the contribution? 40. What is its weight? 4/7. Same way. For K, what is the contribution? 20. What is its weights? 3/7. It is nothing like weighted average calculation. Very similar to it. Sir, I have 2 products which has individual contribution. I want to know both put together what is the composite contribution per unit. Very similar to WACC. Sorry?
22.86 plus 8.57.
No, tell me the total.
Total 31.4.
31.43. What is this? Composite contribution per unit, both products put together. Okay, sir. Now common fixed cost, both products put together how much? 6,16,000. Divided by composite contribution per unit, 31.43.
19,600.
600. What is this? Break-even units. This is individually or both put together?
Yes.
Both put together. Now I want to know how many units of J and K should I sell? So 19,600 into what is the weight of J? 4/7. 19,600 into what is the weight of K? 3/7.
8,400.
So in a month, in order to break even, how many units of J and K should we sell? 11,200 units of J and 8,400 units of K in a month. Why, sir? Why month you are stressing? Because fixed cost is given per month. Sir, what if by chance if fixed cost was given per annum, then break-even sales also would have been for per annum. Yes, guys. So this is all about FM marathon. So as it was marathon or revision, the pace of it was little fast. Hope you guys would have got it. And whatever is possible in a short period of time, I will try to cover majority of the concepts along with some questions also, guys. So hope it has helped you. And also after this, I would be discussing the question paper of both December 2023 as well as June 2024. Make use of the same and study well and try to score exemption in all the papers, not only in my paper, all the papers. And all the best for your exams. Chalo guys, so now we will just discuss the question paper. Which question paper, sir? Financial Management, which was asked in June 2024 attempt. Yeah. So I have taken only part 2. Part 1, as you guys are aware of, it is corporate accounting for 60 marks. So this is for June 2024. June 2024. So part 2 for 40 marks, what all questions they have asked, sir, how much can we score? You guys can count your score. Okay, I will discuss the solutions, you just count how much you can gain. At the end, let me know how much, what is your score. Magma Limited is a manufacturing industry which has a mix of equity and debt to finance its business. The company is growing at a considerable rate, prompting the management to go for an expansion. The company is considering various alternatives to raise funds for the same. The particulars and amount are as follows. 12% debentures they have, which is first issued, 3 lakh. Then they have also issued one more debenture, 13% debenture, second issue. Means they have 2 debentures, both are debt. How much? 2 lakh. Then 10% cumulative preference shares, 2 lakh 50. Equity shares face value of rupees 10 each, 6 lakh. Retained earning 1 lakh 50. This is their capital employed or capital structure. Okay, sir. First question would be mandatory question, like question number 5 I am talking about. Okay, mandatory question where there won't be any choice. Additional information. Equity shares are sold in the market at 25 rupees per share. Can I call it as current market price or P naught? Yes. The company is contemplating the declaration of dividend at 3 rupees per share at the end of current financial year. Can I call it as D1? D1. Please be careful. The company has a practice of paying all earnings in the form of dividend. Means entire EPS is paid as DPS. No retained. No retained. Okay. Then second one. 100 rupees per debenture first issue redeemable at par as 2% flotation cost. Flotation cost will be there, nothing but issue of at the time of issue, whatever is the expenses we incur. Okay. And 8 years of maturity. It has a life of 8, N is 8 years. The market price per debenture as on today is 120. Guys, come on, tell me, is it irredeemable debt or redeemable debt? Redeemable. Where it is redeemable, a life is there. This will not help us to calculate cost. Okay, maybe for some other calculation it may help. 120 is current market price, which will not help. Please be careful. If it is a irredeemable debt or if it is like, sir, it is not at all repayable, then we take what? The interest by the current market price. But here current market price is given, but for calculating cost, that is not required. What is the formula for calculating the cost of redeemable debt, guys? Come on. Interest plus redeemable value minus sale proceeds by N whole divided by redeemable value plus sale proceeds by 2. This will be before tax. You will do into 1 minus tax. Clear? Or else at the time of interest calculation only you can take into 1 minus T. Clear? Hope you guys got it. Anywhere do we use market price? No. Okay. Now, listen here. Redeemable at par is given, but issue price is given? No. So what should you take? Issued at par. But here issue price would be 98. 98. That is, issue is actually 100. Minus 2 rupees cost is there. How much is that? 98. Redemption is how much? 100. So can I tell redeemable value is 100, whereas sale proceeds is 98. Clear? Yes. We will derive there, then and there only, so that it becomes easy. Even your minds has to run like this when you see the questions. Okay. And sometimes see, I can also suggest like this. See the requirement of the question and then start reading the question. What they have asked, so that you will start connecting to the things. What should I do with this? What should I do with that? Yeah. Just read the requirement of the question and then start reading the content. That is also one good strategy. Okay. Especially when question is lengthy. Okay. So you can see, okay, let me just read it. Find out the weighted average cost of capital using book value weights, market value weights. They have asked. Okay, means in simple WACC they are asking based on book value and market value. Okay, please be careful. 120 I told you for book value calculation not required, but for market value we require it. It's not like, sir, okay, not forever, not required. No, only for book value. Next, the second issue of debentures at 100 rupees each is redeemable after 5 years. Again, redeemable debenture. What is the life? 5 years. Are currently selling at 90 per, that is the market price. This is nothing but market price. Come on guys. Issue price is how much? Or sale proceeds. I can call it as sale proceeds. Sale proceeds how much? 100. They are not given anything. So at here only I guess 100 they have given. Then redeemable. Redemption value how much, sir? I have told you if nothing is given, what do you take? 100. par value or face value. Fine, sir. Then 100 rupees per preference shares redeemable at par as 3% flotation cost and 10 years maturity. Again, redeemable preference shares. Redeemable preference share. The market price is 18. This is MP. So here, what is the sale proceeds? 100 minus 3% means 3, or else 3% only I will take, 97. Then redeemable value, they are not given anything, par. Sorry, here they have given redeemable at par. So that means 100. Clear? Please be careful. Flotation cost, please reduce only from issue price or sale proceeds, not from redeemable value. Okay, sir. Done. Current market price is 908. Tax rate is 30%, which is helpful for KD. Please be careful. Whenever you are calculating KD, even question doesn't specify, it should always be after tax. Into 1 minus T will always come. Then the shareholders' tax liability may be assumed as 25%, whereas the capital gains tax is 20%, maybe for retained earnings. Because for retained earnings, we have a formula to calculate. Okay, what is it? We will see. Please be careful. Tax liability of shareholder is 25%. So that we can take it as like on dividend income. Whereas on capital gains, what is the tax rate? 20%. Okay. The CFO of the company is keen at understanding the cost of capital. Accordingly, you are appointed to complete the following task. Find out the weighted average cost of capital using book value weights and market value weights. Guys, please pay attention because this is a bit lengthy and it is 10 marks. No, that part I am talking about this one. Okay, it is 10 mark component. Okay, another two is 5 each. 5 each. Hope you understood what I tried to tell. So first part is 10 mark question. Weighted average cost of capital. Cost of debenture, KD. CD they have used. Okay, nothing wrong. Okay, you use KD. Sir, will they deduct the marks and all? No. Okay, yes, but write full form and in bracket you can use short form. What is the formula, guys? Interest into 1 minus T. They have used 1 minus T here only. Sir, can I do it separately, sir? No problem. Okay. Plus market value. So it should be redeemable value. MV, what it stands for? Maturity value. Okay. Okay, we use redeemable value. So no problem. See, whatever short forms you have used in the formula, just give the abbreviation here. Okay, sir, they have used maturity value, but you taught redemption value, sir. Nothing wrong. Both are same only. Both are same. Even sometimes they may call repayment amount. Okay, everything, redemption value, everything is one and the same. Okay. Because MV means it may also look like market value. Please be careful. Maturity value it is. Minus net proceeds by N, life. Okay, yes. Whole divided by maturity value plus net proceeds by 2. And whenever you use short forms like this, please give the abbreviation. Okay, please give it. Because, see, you may use something which the evaluator may not know. So, always tell what is the abbreviation of it. And sir, can I use full forms in the formula only? No, it will be too long. Okay, better use short forms but give the abbreviation of it. Yeah. And also when you are writing abbreviation, what are those amounts also you can write? For example, interest, you show the calculations here only. Okay, for example, interest for debentures, how much is that? Oh, first issue. There are different issues. Oh, better you write like this because there are two calculations. Okay, when there are two calculations, we will show like this only. Hope you are understanding. Only if it is there, only one, then you can show here only. Then and there itself, the values. Okay, first issue, guys. What is the interest? 12 rupees per debenture we have taken. Into 1 minus tax rate. Tax we are doing after tax. Plus redeemable value 100. Into net proceeds 98. That is after flotation cost of 2%. By life is how much? 8. Please be careful. By 8 should come here only, not for interest part. Hope you guys can recall whatever we have discussed in the class. Because by mistake what you can do is 12 into 1 minus tax plus 2, then you may divide it. It will be wrong. Please be careful. This part is different. Clear? Yes. Then whole divided by redeemable value plus sale proceeds by 2, which will give you 0.087, or if you convert it into percentage, 8.7%. 8.7%. Then second issue also is there where the interest rate is 13%. So per debenture we are taking 100 is the face value into 13%. What is the interest? 13 rupees. Correct? Yes. Into 1 minus tax. Okay. Plus What is the redeemable value? 100. What is the issue price? Sale proceeds? 100. You can see I have written already na? Here. Second issue. Sale proceeds also 100. Redeemable value also 100. Okay, which is like when you deduct each other 0 by 5. By 5. Whole divided by 100 plus 100 by 2. Average is also 100. So you will get 0.091 or 9.1%. 9.1%. 1 decimal, 3 decimal is taken.
No, even in the previous one, 3 decimals, but still when we converted it to percentage, we have only 1 decimal.
See, percentage into 100 when you do.
So because it comes to 8.74%.
Okay, you will 0.87. Okay, if you want, you can write 4 decimal also. So in that case, 8.74 you will get. Okay, that is also fine. Okay, so especially when percentage, try to take 4. Especially when you are calculating the percentage decimals and all, it is good to take more. Okay, so 3 is also okay, but better would be 4. Better would be 4. Okay. Next, coming to preference shares, what is the formula? Similar formula, but now instead of interest, it is preference dividend. And here no tax, because it will always be after tax. It will always be after tax. And please be careful, KD, whether they have asked or not, you should always calculate Vishnu after tax or before tax? After tax. Okay, rest all remains same, guys. Rest all remains same. So, preference dividend, what is the percentage? 10. So, face value is 100, Yeah, 100. So, 100 into 10, 10 rupees preference dividend, per preference shares. So, your sale proceeds is 97, redeemable value or maturity value is 100. Let us do the calculation. So, you can see dividend 10 rupees. How did you get it? Better show always. If not here, at least here you show 100 into 10%, which is equal to 10. Okay. Plus 100 redeemable value minus net proceeds 97, that is after 3% flotation cost, by life 10 years. 3 by 10 it should be. 3 by 10 plus 10. Okay. Whole divided by 100 plus 97 by 2. You will get 0.1046, which is equal to, in percentage, 10.46 percentage. Clear? This is normally what they ask, but here they have asked the retained earnings part also. Okay. Cost of equity also is there, which we will do. Cost of equity. What is the formula, guys? DPS by market price or net proceeds. Net proceeds. So what they have given? DPS, dividend, I guess they have given. First information only, additional information. Current market price is 25 and dividend is 3 rupees. So can I divide each other, sir? Yes, we get cost of equity straight away. 3 by 25. 3 by 25. Here they have done. 3 by 25. 12%. So 0.12 or 12%. Any doubt in this? No. Next, retained earnings. Cost of retained earnings. What is the formula? We have discussed it in the cost of capital chapter also. What is it? DPS into 1 minus T. 1 minus T. They have not presented properly here, but see. DPS into 1 minus T. And here 1 minus T means what? Tax on dividends. Tax on dividends. Into 1 minus B. Retention ratio. What is B here? Retention ratio. Whole divided by market price into 1 minus T. Here T stands for what tax? Capital gains tax. Very good. And have they given both of them separately in the question? Yes. They have given shareholders tax. Let me just show it. Shareholders tax liability 25% is on what? Dividends. Because they are always taxed at normal rate. Whereas capital gains tax is how much? 20% in the denominator. Okay. Let us see. Dividend is how much, guys? 3 rupees. Then into 1 minus tax rate. On dividend, what is the tax rate? 25%. So 1 minus 0.25. Divided by, straight away they have done this. Why? Because there is no retention ratio. They have clearly given the question on the information. Whatever they are earning, they are declaring it as dividend. Have they given it? Yes. The company has practice of paying all earnings in the form of dividend. So what is retention ratio? 0. Retention ratio is 0. In my calculation, can I show, sir? Yes, still answer will not change, but you can show it. Please be careful. In the numerator, here they have excluded that part as it is 0. Means this part I am talking about. Clear? But can I show it, sir? Yes, you can show it. Okay, anyway, answer will not change. Divided by what? Market price 25 into 1 minus tax rate on capital gains. How much? 20%, 0.2. You are getting 0.1125 or 11.25%. Clear? Any doubt in this? Okay. Now we have got the cost of each component. So using weights, we will calculate WACC. So table presentation. Guys, whatever amount they have taken here is book value. First table. Book value. Yes, sir. 6 lakh. 250, 3 lakh, 2 lakh, 1 lakh, 50, including retained earnings. See, if retained earnings, if nothing is given, we will take cost of equity only as cost of retained earnings, if nothing is given. But in this question, they have given some data like tax on capital gains, all those things. So we have to calculate retained earnings cost separately. Please be careful. Okay, sir. Now, weights you have to calculate. Sir, how is the weight? Simple. That respective capital by total capital. For example, here 0.4, how did I get? 6 lakh divided by 15 lakh. Okay, sir. Same way. For here, how did I get 0.167? 250 divided by 15 lakh. Each capital divided by total capital. So please ensure that weight is equal to 1, total weight. Then cost, whatever we have calculated, we have to take. One thing you have to be careful here is debt should always be after tax. Debt should always be after tax. Okay. Then weighted average means you have to multiply. Better you give a notations like this, guys. A, this is like B, this is A into B. Clear? So the total is my weighted average cost of capital based on book weights. 5 marks in the pocket. Next, another 5 marks. 10 marks question, but there are 2 parts in that only. Okay. Market weights. How do I get market weights, sir? Interesting. Guys, here capital is given. Can we calculate the number of debenture, number of shares and all? Yes, sir. How is it? Divided by face value. 3 lakh divided by 100. 3 lakh divided by 100. 3000. Then 2 lakh divided by 100. 2000. Everything is face value 100 only, na? For equity shares, here they are given 10. Please take care. Others are 100. Then this is 2500. Then equity shares 6 lakh by 10. 6 lakh by 10, 60,000. Now can we calculate market value? Yes. How is it? Multiply with market prices. For equity they have given 25. So into 25. Then we will go with the debenture first. How much is that market price? 120. Where is debenture first? 120. 120. Please calculate the amounts and keep it. Then second issue 90. Second issue 90. Then preference shares. Market price is how much? They have given the market price of each, guys. 108. See, one more important thing. See here, market price of debentures and preference shares also is given. Please take it to calculate market value. If it was not given, we will assume market value of debt and preference as book value of same. Clear? But here we cannot assume. Please be careful. I have clearly told you, if they have given, take it. If they don't give, assume book value. Numbers, please. First one, 360. 180. 2 lakh? 15 lakh. What are those, guys? Market value. Market value. Hope you understood. First calculate number of debentures or shares. How did we get it? The amount of capitals divided by face value. For debentures, both the debentures and preference shares, the face value is 100. Whereas for equity shares, it is 10. Divide the amount by face values. You will get number of debentures or number of shares. Multiply that with market price. This is like number into market price. Got it? Got it? Yes, sir. Now coming to this. Amounts is mentioned, guys, but they have taken the amounts directly. You guys please show the calculations. Okay, maybe by note or working note, please show the calculations. They have taken directly, so can I also do it directly, sir? Please don't do it. Maybe they will deduct marks, if at all, if you do it. Okay, so you can see same numbers, whatever I derived there, where we got. And retained earnings, please take face value only. Take face value only, because for retained earnings, there won't be any market value and all. Clear? Yes. Yeah, 15. How much is that? 15 lakh. Where is it? 15 lakh. See here, normally market value of equity should include retained earnings, but here we calculated the cost also separately, so we have to take it separately, because we know that cost of retained earnings is different. If at all, if by chance cost of retained earnings is not given separately, then we know that, sir, cost of retained earning is same as cost of equity. We will not take reserves and surplus separately. We will not, reserves and surplus is nothing but retained earnings, but here please take it, which is nothing but book value, which is nothing but book value. We assume for retained earnings, book value is equal to market value. Actually, it is not a good practice of taking it, but just because cost of retained earnings is given separately, we have to take it separately. If not, we would have not taken here. Okay, chalo. Market value, weights we have to calculate. Total market value is how much? 2460. So how do we get it, sir? 15 divided by 24.6, like that. Okay, each amount divided by total. How do we get it for preference shares? 2,70,000 divided by 24,60,000. Are you getting it? Same numbers, cross check. You guys simply don't listen. Simply do calculations and check it. Total 24,60,000. 24,60,000. 6,1. Is it clear? Yes, sir. Then cost, whatever we have got, here it will not change. Whatever cost I have taken here, same thing would be the cost here, guys. Same thing would be the cost here. And again, give notation. A, B. A into B. So what is the weighted average cost of capital here? 11.09. Sir, will it same as be working book weights? No. It would be different, because market value is not equal to book value everywhere. Okay, it would be different. Got it? Yes. Chalo. Second requirement of the question. First, we are done with 10 marks. Done. Next, second one. Further, the company also intends to know the market price of the equity share at the end of current year. Means what? P1. At the end of current year means P1. Using approach. Silliest question for 5 marks they have asked. Along with citing the assumption. For this you have to take some time. Only if they have asked, then current price, it would have been easy. But now they are asking you what? Assumptions also. This is for 5 marks. You can see. 5 marks. Yes, sir. So how is it? approach, simple formula. What is it? D1 plus P1 or divided by 1 plus K. Sir, why that 1 plus K, sir? Because D1 and P1 is at the end of first year. Clear? So they have given P0, they have given D1, they have also given K na. Yes. So what are we supposed to calculate? P. And K we calculated in the first requirement. Same thing we will take it here. Correct? In first requirements we have done it. Yes. Chalo. You can observe, see, for each of the things full forms are given. D1 is nothing but dividend at the end of first year. P1 is nothing but market price at the end of first year. P0 means today's price. Okay. Formula, guys. Come on. D1. Okay. Straight away dividend. Okay. Let me just show it. D1 is 3 na. P1, we have to do it. Divided by 1 plus K. K, how much we have got? KE? 12%. 12%. 12%, na? No, Baba, cost will remain same only, na? I'm not talking about a weighted average, only cost of equity. That will remain same. 0.12 is equal to P0. 25, 25. So we will take 1 plus 0 0.12, that is nothing but 1.12 to the other side. So 3 plus P1 is equal to 25 into 1.12. 28. So P1 is equal to 28 minus 3. 25. Clear? That is what they have got. 25. What is it? P1. Price at the end of first year. Is that clear? Yes. Assumptions, you know. Whatever are the assumptions under approach, you have to write it. And please be careful. Don't ignore, because sometimes you will see only the calculation part and miss out this part. Please always read the full requirement and accordingly answer. These are the assumptions under approach, which you have to write, like there are no taxes, all those things. Okay, and see, assumptions you can get it in formula only. Okay, whatever you take in the formula, all those things we assume that it is constant. Okay, what are those, like D1, P1, K, everything we assume it to be constant. Okay, especially P1 we are determining it, don't take that as constant, especially D, K and all, we assume it will remain constant. Hope you guys are getting it. Chalo, last requirement. Assuming the company has sales of 20 lakh, variable cost of 12 lakh and fixed cost of 5 lakh, excluding interest. Okay. Calculate the, means that 5 lakh is what? Fixed operating cost. Fixed operating cost. Okay. Calculate the operating leverage, financial leverage and combined leverage. Laddu for 5 marks. 5 marks. That format you have to be careful, that's all. Okay, this format similar to whatever we discussed even in marginal costing. What is it? Numbers, everything is given. You need to just apply the formula and calculate. That's all. Sales minus variable cost. And here variable is nothing but operating variable cost. Okay. Contribution, fixed cost, which is again nothing but operating fixed cost. You will get what? EBIT. From that EBIT, you have to reduce interest. Two interests are there. First issue, second issue. Okay. Take care of it. Because by mistake you may leave the one. Okay. So how much it is like? 2 lakh into 13%. 26,000. Then 2 lakh 50 into 10%, 25,000. Sorry. 3 lakh into 12%, 36,000. I repeat. 3 lakh into 12%, 36,000. Then 2 lakh into 13%, 26,000. You have to add both the interest. Please be careful. The third one is in preference shares. Okay. You don't take that. Okay, sir. Interest 36,000 and 26,000. You better show how you got it also. Okay, don't straight away write it. 62,000. Then profit before tax, then tax. They have also given tax rate. Okay, reduce it. Tax rate for the company is how much? 30%. Please be careful. Don't take that 20 and 25. That is for shareholder. Okay, for the company it is 30%. That step is not required, but anyway, actually this two step is not required for this calculation, but still they have shown. I am just explaining. Tax, how will you calculate? It is like 2,38,000 into 30%. Then we get PAT. Anyway, PAT is not required for our calculation. Okay, chalo. Let us see. Operating leverage. What is the formula? Contribution by EBIT. Just replace the number. Okay, which is nothing but profit before fixed operating cost, profit after fixed operating cost. Then the formula, financial leverage, EBIT by EBT. That is nothing but profit before interest and divided by profit after interest. So 3 lakh divided by 2 lakh 38. Why they have shown the calculation again, I don't know. Because anyway, we have ready figure here. Na? Straight away you can take 238. Again, they have shown minus 62 and all, which is not required. So straight away 3 lakh divided by 2 lakh 38. Clear? And whenever you are doing, guys, don't use this slash symbol. Straight away do like this 3 lakh by, because maybe that will also be confusing to the evaluator. Better use like this. Okay? Yes. So financial leverage is 1.26. Then combined leverage, multiply both. Product of both. 3.36. Sir, should I comment anything? No. When they are not asked, if they were just asked to calculate, please stop it there. No need to comment anything. Okay, 20 marks done with. All the 3 requirements we have taken care. And guys, especially This first question in any exam, even in CA exams, sometimes will be very time taking. Sir, can I do 6th first and then come back to 5th also? Yes. See, in reading time, you read the questions and accordingly decide it. Okay, especially the 10 marks, you know now only how much time we took, explanation, everything. And now assume in the exam, you guys have to derive everything. Yeah, it will be time taking. And when you take too much time on the first question, maybe sometimes your confidence will go down, you will start panicking, your hand starts shivering, all those things will happen. Okay, better, sir, if that is the case, you can start with 6th, then go back to 5th. Then go back to 5th. And please make sure that once you choose a question, all sub questions should be in the order. Clear? Like 1, 2, 3, like that. Okay. Coming to 6th one. An investor is considering purchase of new investment for 15 lakh. What is it? Initial investment. The investor has two options, option M and option N, and their expected cash flows are as follows, cash inflows, two options, 1, 2, 3, 4, 5, both has 5 years life. Okay, sir. Okay, what is the question is on? When you see this, immediately it has to into present value calculation. Okay, yes. The investor has a target return of 12%. Risk premium rates are 3% for investment option M. So what is R here? 15%. 12 plus 3. Then for 7% for option N. This is premium. Please be careful. So that means 12 plus what? 7. So what is the rate here? 19%. Clear? Yes. And present value factor, you see they have only given. How lucky you are. Okay, you need not even do that 1 divided by 1 plus. Okay, so sometimes they do this. Okay, and actually under new syllabus they are giving like this, which is very easy. But even if they don't give, we have seen how to calculate it. Okay, for example, which are the two rates we require? 15% and 19%. Sir, why did they give that other three rates, sir? Just to confuse you. Just to confuse you. So for our question, these three rates not required. Clear? Yes. And please be careful. You guys can cross check also. For example, this 15%. 1 divided by 1.15 is equal to number will match. Sir, should I do it in calculator and take it? No. When they have given it in the in the question, please follow the same. When they are given 3 decimals, please take 3 decimal. No, sir. In the class I took 4 decimal. I will do it. Please don't do that. Please use what decimals they have given. Clear? Yes. Which investment should be preferred? Is it annuity? No. That means individually we have to do it. Individually we have to do it. Clear? Means annuity means we can add up and use annuity concept if it is equal. Cash flows are equal. Okay. Chalo. We'll see the answer. 6A. So they have done both together. You can do it as two separate calculation also. First in option M and next option N. So simple, guys. Cash flows they are not shown. Okay, better show that also. Cash flows year discounting factor. Oh, year only they have given. Oh, why did they give the heading like that? Cash flows it should be. Okay. Then present value factor at to 15%. Somewhere some headings problem is there. Okay, cash flows are like 152, 236 like that. Present value factor, which is already given in the question, please take the same and mention what rate you are considering. Okay, rate actually should not come here in the present value factor or discount factor. So present value means you have to multiply both. For example, let me give the names X, Y. So this would be X5 I will not use because into may confuse. This is again A, B. So this will be A into B. Same way for option N, but here it is 19% at 19%. This is cash flow. Cash flows. Clear? So multiply the cash flows with present value factor, you will get present values. So for example, this I can use it like C. This is C, this is D. So C into D. Okay. So we get present value of cash inflows, guys. Of both the projects, present value of cash inflows. From that we have reduced outflows. Initial investment. Initial investment. In table only they have done, na? Means outside the table.
Do it inside the table.
Inside the table or outside? Means we would have also done in the class. Means in the table you calculate only present value of cash inflow. Below that you show NPV is equal to present value of cash inflows minus initial investment. So can we do this minus outside the table below, sir? Yes. Nothing wrong. Okay. NPV for one project it is negative, for another project it is positive. Which one will you accept? What is the name of it? Option N. Option N. Hope you guys are clear. Sir, what if both are positive? Whichever is higher. Whichever is higher. Simple calculation for 5 marks. But bit time taking because two things are there. And see, what I suggested, instead of presenting in one table, better do this as one table and this as another table. Okay, that is also more convenient and better way of presentation. Because anyway, rate is also different. Rate is also different. Investor will prefer option N as it has higher NPV. Fine. A is done. B. ABD Limited. ABD, not RCB player. ABD Limited has provided the following information: earnings per share EPS, dividend per share DPS 9, cost of capital 12, internal rate of return 16%. Clear? So this is like E, this is like D. Chiller question. Correct? Na exam. It is asked in exam. Okay, I am not doing my own questions. You are required to compute the market price per share using Gordon and Walter. Simple question. 2.5, 2.5. Okay. Yes, 5 marks. Na they have to share equally. If not, they will start quarreling. Formula. You have to calculate. Oh, they have to give everything for you. You have to calculate. G is not given for Gordon means you have to calculate. You can do it now. B into R. Retention ratio into R. Chalo. E into 1 minus B divided by Gordon approach. Gordon means for whom? Growth. Divided by K minus G. And G is not given means don't assume it is 0 anta. You have to do it. We will show how to do it. I guess they have done. Here. Okay, B is 0.64, sir, which is nothing but retention ratio. How did we get it? Guys, EPS is how much? 25. DPS is how much? 9. So R is how much? 16. So retention ratio is how much? 16 by 25. 16 by 25. Are you getting 0.64? Retention ratio. On this retention, how much do we earn? R, small r. 16%. So B into R is our growth rate. I will show you. Listen here. How do we get retention per share? EPS minus DPS divided by EPS. So that will give you what? Retention ratio, which I denote it by B. Then growth rate, how do we calculate? G, small g. B into R, that is 0.64. On that, whatever we earn is called return on investment, which is 16%. So how much do you get? 10.24. 10.24, which is nothing but G. Okay. So E into 1 minus B, they have taken 9 straight away, guys. So E is 25 into 1 minus 0.64, which is nothing but 9. Better show the numbers also. Okay. But anyway, formula is not using direct. I told you this, I mentioned in my regular class also. It is nothing but dividend. But don't straight away write it as D1. As the formula is E into 1 minus B, show it. Okay, which is actually nothing but DPS. Okay. Yeah. Divided by K minus G. K is 12% minus the growth rate is 10.24. You are getting 511.36. 511.36. Okay, coming to Walter's approach. Guys, Walter approach, even in ICSI material, the formula what is given is different. But I have simplified it and I have given the formula. Same formula you can use. What is that formula? What you have given, sir? D by K plus R into small r divided by K square. Correct? Same only. Result would be same. I have just simplified it. You don't worry. So let us apply. D is how much, guys? 9 divided by K, 12%. Plus retention is how much? 16. On that, how much percentage? 16%. Please be careful, don't take 16 into 16. It is percentage, whereas this 16 is rupees. Okay, divided by K square. Help me with the numbers. First, 9 by 12%. 75. Then give me the numerator, denominator separately, so that we will do. Divided by 0.0144. Okay. Now give me the total. 177 point. Total UB. 250.78. 252.78. Is that clear? Yes. And please be careful, here no growth and all. Walter doesn't suggest any growth. Okay. Done. Another 5 marks. Next, C. Two components A and B are used as follows. Normal usage 3000 units, maximum usage 4500 units, minimum usage 1500 units. Then there are two units, guys, means or product or raw material. Please be careful. Whenever they ask all this calculation, it is always for raw materials. Okay. Yes, there are two kind of raw material A and B. Reorder quantity 20 and 40. And reorder period is 4 to 6. What is minimum? 4. Maximum 6. Average? 5. Good. Same way. B. Reorder period 2 to 4 weeks. Minimum 2. Maximum 4. Average 3. That's all. Clear. Once you decide all this number, you have to just apply the formula and change the numbers. That's all. What are they asking? Reorder level, maximum stock level, minimum stock level, and average stock level. That's all. We did it under inventory management, na? Same thing. Yeah. 6C. Reorder level formula, maximum usage into maximum usage, maximum consumption, maximum requirement, everything is one and the same, which is nothing but raw material. Okay. Yes. And they have used normal. Normal is nothing but average. They have given normal, which is nothing but average. Okay. Maximum usage into maximum reorder period. So for A, it is 4500 into 6. For B, 4500 into 4. And whereas usage is same for both, guys. Just a minute. Yeah. Usage they are not given separately for A and B. So that means it is common for both. Clear? Only reorder level and reorder period they have given separately. Accordingly consider the same. Yeah. Maximum stock level. Formula is reorder level plus reorder quantity minus minimum usage into minimum reorder period. Sir, should I write separate formula for A and B? No, formula remains same only. Numbers may change, but not formula. So write one universal formula. Under that you do calculation for both A and B. Okay, reorder level separately we calculated here 27 and 18. Take it, guys. 27, 18 for both. Then reorder quantity they have only given in the question. They have only given in the question, which is 20 and 40. Take it. Minus minimum into minimum. Do it. 1500 into 4. And here 1500 into 2. Quantity remains same, but the days will change. Please be careful. 1500 is common, but 4 and 2 is different. So you will get 41 and 55. Minimum stock level, reorder level minus normal into normal or average into average. Normal, average, one and the same. So for A, 27,000 reorder level minus 3,000 into 5. You will get 12,000. Same way for B, 18,000 minus 3,000 into 3, which is equal to 9,000. Okay. Average stock level, they have done it in two ways, but I always suggest with this way. In the exam, are we supposed to do both, sir? No. Average level is what? Minimum plus maximum whole divided by 2. whole divided by 2. There is another alternate way where you will see minimum level plus half of reorder quantity. Half of reorder quantity. But sir, will we get same answer? No. Please be careful. Year 22, year 26 finally you can see, and year 29 and year 32 you can see. Same numbers will not be there. Sir, what do you suggest us? Average with this. Always average is nothing but like minimum plus maximum whole divided by 2 or opening plus closing whole divided by 2. Go with that principle. Clear? And in the exam, are we supposed to do both? No. Okay. The second one I suggest straight away. Okay. If by chance, if this is not possible, then you can think of it. Okay. But always the first priority is for whatever they have given here. Okay. The last part here. This is on RSI. And then, what is RSI? Relative Strength Index. Relative Strength Index. Question is on that. Share price of P Limited was trading at the following prices at NAC. What is NAC full form? National Stock Exchange. Good. On various trading sessions. Totally they have given 14. Totally they have given 14. So recently, just yesterday we did it. Okay, increase or decrease we have to see for each day. First day it will be 0 only as we don't have base before that. From second day we have to calculate gain or loss, guys. Please maintain 2 separate column for it, gain as well as loss. Don't mix up both. Yesterday also we discussed one question very similar to that. Okay, I also gave you one question. Gain and loss. Gain and loss. Come on, day. First case, there is no gain or loss. Second, you can see, always go like this. Listen. You do 2 minus 1. So, 4254 minus 4344. So, it is a loss. See, don't see only last 2 numbers. Sir, 54 more than 44 anta. See the second number also. Clear? Because sometimes in a hurry, we may do that also. Okay, thinking, 10 rupees gain, sir, anta. Please be careful. Hope you understood. How do you calculate? 4254 minus 4344. Then, third, when you come to the third day, 4211 minus 4254. You will get in the calculator negative. Whenever it is negative, it is loss. Okay, next, 4308 minus 4211. You will get positive 97. Then 4487 minus 4308. Again, positive 179. Then 4213 minus 4487. Negative 274. Then 4240 minus 4213, positive 27. Then 4112 minus 4240, negative 128. You need not put symbol minus plus and all. You write it in 2 different column. Gain separate column, loss separate column. Don't mix up in same column also, guys. Okay. Next 4061 minus 4112, 51 negative. Then 4414. Minus 4061, 353 gain. Then 4030 minus 4413. In the calculator, you will get negative. Always follow that approach. Okay, like this. Okay, so that it will be easy. So 4030 minus 4413, you will get negative 384. Then 4336 minus 4036, positive 306. 4230 minus 4336, negative 106. Then 4392 minus 4230, positive 162. Positive 162. Just a minute. Okay, once you are done with this, guys, please be careful. Go slow only, in a hurry. Don't calculate wrong numbers and all, because if you go mistake anywhere here, then the entire answer will change, which is very important. Okay, so first calculate total gain and total loss. Total gain is how much? 1124. What is total loss? 1076. Then calculate the number of gain days and number of loss days. Number of gain days is how much? 1, 2, 3, 4, 5, 6. So divide the total gain by number of gain days. You will get gain per day. Gain per day. Same way. What is the total loss? 1076. Divided by loss days. 1, 2, 3, 4, 5, 6, 7. 7 is there. If you want, I will just show it once. I don't know whether it will be visible or not. Just for counting, 6 and 7. So you will get loss per day how much? 1076 divided by 7. 7 is nothing but loss days and here 6 is nothing but gain days. So I repeat, once you calculate gain and loss, calculate the total of that, and better you can do this below that table. Calculate total gain and total loss and calculate separately. Gain per day, loss per day. Total gain divided by number of gain days. Total loss divided by number of loss days. Okay, sir. Once we have calculated this, we can calculate RS. How is it? Gain per day divided by loss per day. You are getting 1.219. Then calculate RSI. RSI. The formula is 100 minus 100 by 1 plus RS. RS is nothing but whatever we have got here. So 100 minus 100 divided by 1 plus 1.219. First do this part. Then add 100. Then deduct from 100. Then deduct 100. I repeat. First you do 100 divided by 2.219. Then deduct it from 100. You will get 54.93. Have they asked anything else other than the calculation, guys? You can see at the end, calculate RSI from the above data. Comment if the share is overbought. Come on, guys. RSI we learned. If it is 70 or more, overbought. 30 or less, oversold. So here how much we got? 54 change, right? So is it overbought? No, it is not overbought. Clear? Not oversold also. Please be careful. It is like average. You can see an RSI reading 70 or more indicates the overbought situation, whereas a reading of 30 or below indicates an oversold condition. Hence the share is not overbought as RSI is below 70. Sir, what is it? You need not tell, because what they have asked, is it overbought? No, that's all. Clear? And that line also better write it. 70 or more means overbought, 30 or less means oversold. So here it is not more than 70, so it is not overbought. That's all. Yes, numerical part we are done with. We are done with, guys. So how much can you get out of 40? I think Rams you can get out of 40 also. Okay, maybe assume worst scenario here and there you will lose marks. 35 is not achievable. Rams achieve. 40 also achievable. I am telling you, not less than 35. Not less than 35. We are not yet touched the theory question. And theory, see, when it comes to 6th question, if you know both, always go with numerical. Okay, chances of scoring more is in numerical. Okay, sir, no sir, by chance I don't know some calculation there, then go with theory. Clear? Choice always go with, first priority is always for numerical. If by chance if you don't know any part of it, maybe you can think of theory. Theory question we will see. The concept of negative working capital is a sign of what? Strong bargaining power. Comment and explain with an example. Guys, negative working capital means what? Current liabilities is more than current asset. Is it good? No, sir. But it is not good. Okay, but still, if by chance if collection is earlier and all, there are some exceptions cases. What are those also? I will just tell you. The remaining things we will see later. I will just cover this theory question. Other theory question we may not go in detail, but only for this. Negative working capital implies a situation where current liabilities are more than current asset. We know, Nana, because what is working capital? Current asset minus current liability. We always expect positive. If it is negative, is it a good sign? No. Generally, a negative working capital is a sign that entity may be facing bankruptcy or serious financial problems because my liabilities are more than assets. Poor working capital management could lead to increased borrowing and late payments to creditors. This could result in lower credit rating. Also, the entity may have to forego revenue growth opportunities due to lack of working capital because we don't have enough money to fund our growth. This is what regularly thinking is. But there can be different scenarios also. Another scenario where a situation where a company can have negative working capital is where inventory is sold and cash generated is on quick time. These are companies with bargaining power to take advance against supply of goods or services or demand a slightly longer credit period from the suppliers. Negative working capital can be a sign of managerial efficiency here. Not inefficiency, efficiency. How is it also I will tell. In a business with low inventory and accounts receivable. Very simple. Assume the DMart operating cycle. Or how do they operate? They buy it from the manufacturer or suppliers on credit. They display it in their showroom. They sell it and then they pay to the supplier. So should they have working capital? Should they have cash balance and all? No. They generate cash and then they pay. It is not like they pay first, get it and then sell, make money out of it. Clear? So for them, is negative working capital good? Yes. They can, because they maintain very less inventory and also, see, they may maintain huge inventory also, but have they paid for it? Have they invested for it? No. They are playing around with like other goods, with others' goods. So, one example. Low working capital requirement also imply what? Possible higher return on capital employed. Because I am investing very less amount in working capital. So my money is not stuck with inventory, debtors and all. And also coming to my buyers, am I selling it on credit basis? No. So it's like I don't have debtors balance. I need not have too much cash balance. Why? Because I don't have any payments. Clear? When will I pay? Only when I sell. I hope you are understanding. I am taking DMart as an example. Assume they buy it from the suppliers for 30 days. Credit. Should they pay them immediately? No. Now they come and display these goods in their showroom. The customers come and pick it. Will they give any credit to the customers? No. They have to pay and get it there only. Clear? Now they get the money. And they also have some additional time now. Can they use that money to generate some return? Maybe yes. They will pay to the supplier when? On the 30th day. So now should they run behind the money, how to arrange to pay for them and all? No. They will buy on credit, sell goods on cash and get the money and pay the suppliers. So can they have negative working capital? Yes, they can, because they need not maintain cash balance. They don't have too much inventory. They don't have debtors balance, zero, because everyone is purchasing on cash basis. So current assets would be in this case less than current liabilities. Because current liabilities is what now? They are suppliers. Hope you are understanding. 30 days they have purchased now. So that is nothing but their creditors. So your creditors or current liability is more than current asset. Is it a good sign or negative sign? See, if I am just thinking from general point of view, negative sign. But if I am thinking from this, whatever DMart example I gave, it is a good sign. It is, my company is able to manage it efficiently. And one example is given. Let us just see it. Suppose Walmart orders 5 lakh copies of DVD to Warner Brothers and they were supposed to pay within 30 days. What if by the 6th or 7th day, Walmart had already put the DVDs on shelves? They have taken 30 days credit period. On the 5th or 6th or 7th day, they are already started selling it. Put the DVDs on their shelves on its stores across the country. By the 20th day, they have already sold the DVDs. So they have already generated the cash on 20th day. When should they pay? 30th day. Still they have 10 days of luxury. They can make use of it. Here Walmart received. Walmart is similar to like DMart or Amazon and all, you know. Flipkart is taken over by them only. Okay, retail. They are into retail business. Here Walmart received the DVDs, shipped them at its store and sold them to the customer, making a profit in the process. Purchased on credit, sold on cash. All before they have paid Warner Brothers. If Walmart can continue to do this with all their suppliers, it doesn't really need to have enough cash on hand to pay all its accounts payable. Because I have liability, but I know I need not pay it by myself. I will sell and then pay it. So should I generate money from somewhere else or should I borrow to pay my suppliers? Need not. As long as the transactions are timed right, they can pay each bill as it comes due, maximizing their efficiency. The bottom line is that negative working capital can also be a sign of managerial efficiency in a business with low inventory and accounts receivable. So low inventory they have and also account receivable is like zero debtors, which means they operate on an almost strictly cash basis, but only on sales. Whereas purchase, they are getting it on credit. Okay. You can also take DMart as an example there. Instead of foreign company, why not Indian company? Radha Kishan Damani is the owner of it. Yes, chalo. Anyone. You can take your name only. Vishnuvardhanand. What is systematic risk and describe its types. Okay, which you can manage. Then what is price rate of change and advance decline ratio? They have asked both. Last chapter we have discussed. Then what is EVA and MVA? Under what conditions will EVA will increase? Same cost. First chapter. Don't forget first chapter. Clear? So all the contents whatever. Just a second. This price rate change you know. So we'll take the closing price as on today or maybe yesterday and minus closing price few days before divided by closing price few days before. For example, I will just give an example for those who have already forgot. Okay, assume today the closing price is 100. Okay, let us not take 100 because 100 is always easy. 120. 30 days before the closing price was 90. So in this 30 days, is there a positive moment or negative moment? We have to see. So 120 minus 90, 30 rupees change divided by base is what? 90, the past always. Clear? Yes. Into not 1000. And that also you can ignore percent. If you get positive guys, it means bullish. There is an increase. Sir, what if it is vice versa? For example, today the price is 120. Today the price is 120. 30 days back it was 180. 180 divided by base is what? 180. Positive returns or negative returns? Negative. We can call it as bearish. There is a negative movement. Whenever you get the answer in negative, it is like negative movement. Whereas whenever you get in positive, positive movement. More than 0, less than 0. Okay. Advance decline ratio we saw. We took even Nifty as a thing. Sir, there are totally 50 stocks in Nifty. Today, how much went up? 45. How much went down? 5. This is called advance decline ratio. We can call it as like 45:5 on a particular day. EVA and market value added, it is a topic which we already covered in chapter 1. They have also asked one addition thing. Please don't miss out this. How do you increase your EVA? Okay, that's all about this question paper guys. Clear? This was June 2024 question paper. Yeah, yes sir. Fine guys, silence, pay attention. Now we will discuss December 2023 question paper with respect to financial management, that is part 2 we will discuss. First question especially interesting. What is it? We will see. XYZ Limited is a company manufacturing standardized chandeliers. The segment they deal in is more or less an oligopolistic kind of market with mediocre market potential. Means there are very less number of sellers. Oligopolistic means the demand of their product had been wavering in the past, but owing to increasing economic level of middle class in India, the board of directors is confident of brighter days in the future. On 1st April 2023, that is on the first day, the board of directors of a company is desirous of knowing the amount of working capital that will be required to meet the planned level of operations during 23-24. Means they are calculating for upcoming year. Following details have been provided in this regard. Guys, too much data are there. Please be careful. But before that, we will just read the requirement once and then go back to the data. First one. Assuming production and sales follow a constant pattern, you are required to prepare an estimate of working capital required by the company for ensuring the year. For ensuring year means coming year. Okay. Add 10% of your calculated figure as contingencies. Fine. Whatever number we get plus 10%. Okay. That would be the working capital required. Prepare a forecast of P&L account for the ensuring year. Prepare a forecasted balance sheet. Okay. First one is bit challenging. All the rest two is easy only. 5 it is 10 plus 5 plus 5. Okay, data we will see. Following details have been provided in this regard. Issued share capital 2 crore, 10% debentures 50 lakh, fixed asset on opening day 1.25 crore. Productions and sales during the year 23-24 is expected to average out to 500 units per month. So per annum if I calculate, it would be 6,000. Am I right? Am I right?
Yes, sir.
During the previous year, the ratios of cost to selling price, which are also likely to be maintained in the current year as follows. Guys, please be careful. Whatever percentage is given is of what? Sales. Please be careful. Cost to selling price they have told. Okay, whatever is the selling price, raw material is 60% of it. Wages is 10% of it. Overhead is 20% of it. Okay. Following additional information has been provided in this regard. Raw materials and components. Have they given the selling price here? No. Okay, let us see. Where else they are given? Okay. Till now we have not got selling price. We'll see. Raw materials and components are expected to remain in the store for an average period of how much? 2 months. Before being used to assembly and production. Guys, what is the raw material holding period? 2 months. Okay, means after purchase till the date of use, there is a 2 months gap. Each unit of product is expected to be in the process for 15 days. Production period. WAP we used to calculate now, which is nothing but production period is 15 days. Finished goods stay in warehouse for an average period of 1 month before being dispatched to customer. Finished goods holding period. Finished goods holding period. Suppliers of raw material components extend an average credit of 1.5 months. What we get? We used to deduct it now. Clear? Rest all we used to add. This we used to deduct it. Then 80% sales on credit basis. That means 20% is on cash. And though credit extended to the customer is 2 months. 2 months. Average credit collection period is 75 days. So what are we supposed to take? 75 only. Means we are giving 60 days, but they are also taking little extra days. So what is the average collection period? Debt collection period, 75 days. Hope you guys are getting. Operating cycle we used to do calculation. Now they only given directly. Here we used to calculate, add everything, minus creditors period. We used to get operating cycle period. But here calculation is bit different. On an average, overhead is 2 weeks remain outstanding. Means we always pay 2 months later. 2 months later. 2 weeks later. 2 weeks it will be outstanding. Selling price per unit is 5,000. Important. Selling price is 5,000. Guys, let us come back. Raw material they told 60% of 5,000. So how much is that? Quickly. 3,500. Raw material cost. 3,000. 3,000. Then 5,000 into 10%. 500. Then overhead 5,000 into 20%. Hope you understood these numbers. Okay? Yes. Work in progress cost involves 100% of material, 50% of labor and overhead. Means work in progress is partly finished. With respect to material, 100% cost we already incurred. Whereas labor and overhead, how much we have incurred? Only 50%. Hope you are understanding. Normally for work in progress, we would have not done 100% work. Now they have told element wise. For work in progress, we have done 100% raw material work. Cost is fully incurred. Whereas labor and overhead, we have incurred only 50%. Remaining 50% we will be incurring later. Okay, work in progress. Now it is partly finished. Okay. Sundry debtors to be valued at cash cost. Sundry debtors has to be valued at what? Cash cost. Normally sales will be made at cost plus profit. But here they are asking you to value at what? Cash cost. Means ignoring profit. Entire overhead cost is assumed to be in cash cost. Okay, this is also at cost. Even if they don't give also, we know overhead is a cost. Then 10th point. 1 year is equal to 360 days or 52 weeks. That is for calculation we are supposed to take it. Okay, that's all. The requirement is first one. Prepare an estimate of working capital required by the company for ensuring year. Add 10% of your calculated figure for contingencies. Yeah, let us do it. Please be attentive. One by one we are doing. Okay, annual demand or annual production is how much? 6,000. How is it? Monthly 500 into 12. So also per unit cost I already shown. So 5,000 is the selling price into 60% is raw material into 10% is wages into 20% is overhead. Hope you guys got it. Yes, please observe these calculations. Inventory under the 3 category. Raw material, work in progress and finished goods. Are they given the holding period for each of this? Yes. Now, come on guys. How many units? 6,000 into what is the raw material cost for each unit? 3,000. Correct, a raw material cost which we found out. I repeat. See, number of units output is 6,000. For each output, what is our cost? 3,000 raw material cost. And what is the raw material holding period? 2 months. Okay, guys, come on. Now, please listen. 6,000 into 3,000 if I do, what will I get? Total cost of raw material. But out of that 2 months would be the holding period into 2 by 12, which we get 30 lakh. Next, same way, work in progress. What is the total output? 6,000. What is the cost? Work in progress. Please be careful. See, 3,000, 50% is there. Correct? Not only raw material, because we have invested labor and overhead also, but 50%. So we have to take material full 3,000. Wages, 500 into 50%, 250. Overhead, 1,000 into 50%, 500. Hope you guys are getting for WIP. It is not only raw material. Labor and overhead also will come, but 50%. So you can see raw material fully. Wages and overhead 50%. Whatever is the amount we got, 50% of that. Okay, because it is partly finished. Raw material fully done, labor and overhead 50%. This is the total investment in WIP. What is the production period? 15 days. 15 days. So we will do that calculation into 15 by 360. Into 15 by 360 or 15 days you can also take into 0.5 by 12. 0.5 is nothing but half month. You will get 9,37,500. Finished goods again 6,000 units, which is nothing but output, into all the cost fully. All the cost fully, because we know it is 100% complete. So full raw material cost, full labor cost, full overhead cost. Into what is finished goods holding period? 1 month. Finished goods holding period. Here you can see 1 month. Okay, sir. So you can see full cost is taken. Please be careful, guys. For WIP we have taken only 50% of labor and overhead as per the information given in the question. So we will get finished goods value 22,50,000. Hope you are understanding. Simple. Take total cost of raw material, total cost of WIP, total cost of finished goods into their period. Into their period is what? The amount of closing the raw material, closing WIP and closing finished goods. Okay. Coming to debtors. Please be careful. One hint given in the question is the debtors has to be calculated at cash cost. So we should not take it at sale value. Now again, how many units? 6,000. How many units is credit sales? 80%. Correct? Now they have given clearly here. 80% is credit sales. Where is it? Here. Correct? 80% is on credit sales. So out of 6,000 units, 80% is sold on credit basis, because debtors will come only when there is a credit sales. You should know it. Okay. Now we will see how many units are sold on credit basis. Into raw material cost plus labor plus overhead. All are at cost. Into, this is total cost, or you will learn total investment in debtors. Into, what is the debt collection period? What is the debt collection period? 75. We did know one problem. Total investment in debtors, we are foregoing something on it, opportunity cost, similar to that. Okay. Yeah. Hope you guys are getting it. What is that 80%? Credit sales. So 6,000 is the total units sold into 80%. That is the units sold on credit. Into what is the total cost of it? Raw material fully, labor fully, overhead fully. This is the total investment in debtors. But what is the debt collection period? 75 days. So 75 by 360. Clear? Please be careful. They have told debt credit period given is 2 months. But on an average, how much time they are taking to pay? 75. So what are we supposed to take, sir? 2 months or 75 days? 75 days. Okay. So debtors is 45 lakh. Current assets totally 1,06,87,500. Coming to current liabilities. Creditors will come when, guys? Sales or purchase? Purchase. So here should we take only raw material or labor and overhead also? Should we pay labor, overhead and all for creditors? No. What we have purchased from them? Raw material. Hope you are getting it. See the differences. For raw material we took only raw material cost. Whereas for WIP We took raw material plus labor plus overhead, but labor and overhead was 50-50. Then finished goods all three fully. Here creditors 6,000 is the total number of units into what is the raw material cost 3,000 into what is the credit paid we are taking, guys? 1.5 month. Fourth point. Okay. By 12. 1.5 by 12, which is nothing but months calculation. So 22 lakh 50,000. When you are straight away writing in outer column, this is not required. Or else you can take total to the outer column. Okay. Some presentation mistake they have done. That's okay. Okay. Because here individually also they have taken, outside also they have taken. Next, outstanding overhead. They told 2 weeks outstanding. Yes. What is the total overhead cost? 6,000 into 1,000 rupees per unit. Overhead cost. Total overhead cost. Into 2 by 52. 52 weeks is there totally. How many weeks it is outstanding? 2 weeks. 2 by 52. Yeah. 2,30,769. So this should be my actual working capital. Current asset minus current liabilities. But they added some masala also telling maintain 10% extra for contingency. So whatever we already got, if nothing is given, we will stop it here only, guys. Working capital requirement, amount of working capital. Okay. Now they are told to maintain 10% on contingency basis. So same thing, whatever we already got into 10%. Into 10%. So what is the estimated working capital requirement for the upcoming year? 90,27,404. Clear? Yes. First part is done. Second and third becomes very easy. Okay, here. What are those also we'll see. P&L account is asked. Okay, P&L account always I suggest you to do in 2 steps. Like you guys would have learned trading and P&L account. But here, sir, they have asked only P&L account, but do that only in 2 steps. Okay, what is it? Material components, that is raw material consumed, you can take it as how much? 1 crore 80, which we already got here. Okay, but into 2 by 12 will not come. That is only closing stock. Now we have to take total. So in simple, 6,000 into 3,000. Total material cost. Total material. How many units we have sold? 6,000. Produced and sold. For that, what is the raw material cost per unit? 3,000. So 6,000 into 3,000. 6,000 into 3,000. Same way. Labor. 6,000 into, what is the labor cost? 500. Overhead how much? 5,000 into, 1,000 into 6,000. Is that clear? In simple, number of units into the cost per unit. Whatever, raw material, labor and overhead. Sir, overhead is outstanding and all. Obviously, you know, outstanding we will always add it. So please take it whatever is accrued totally for a year. Even if you are not paid also, you should still consider it. Because 2 weeks it is outstanding. Na? So hope you guys know how do we calculate. Paid plus outstanding. Correct, Matthews? Paid plus outstanding, which is nothing but how much you are incurred. Okay, sales is how much? 6,000 units into, what is the selling price per unit? 5,000. 3 crore. 3 crore. So what do you get now? Gross profit, which is like balancing figure. Clear? Take it to the second step. Balancing figure means gross profit brought down. And here only one expenditure, interest on debenture. Please be careful because students may miss it. They have given some debt here. 10% debentures on 50 lakh. So 50 lakh into 10%, 5 lakh. Correct? Interest. No other expenditure is given. We cannot assume any. Sir, what about other office expenses and all? Don't assume any number. Whatever is given, only consider that. So 50 lakh into 10%. 50 lakh. Don't straight away write the number, guys. Please show the calculation always. 50 lakh into 10%, 5 lakh. Net profit is 25 lakh. And here in the second step, don't write the same total. 30 lakh is the total here. Second step. Hope you guys know all this. Correct? We have just done it in 2 steps. First step, we always call it as like manufacturing account or trading account. Second part is like P&L. But when they ask only P&L, please prepare that only in 2 steps. Any doubt in this? Understood, na? Net profit. Please be careful. Even if by chance if anything is outstanding allowed, take it what you have incurred totally. Then they have also asked balance sheet again, which is easy, just presentation of the data. On the liability side, shared capital already given in the question. Okay, equity share. Then debenture also they have given. P&L we have calculated 25 lakh. You know it will go under reserves and surplus. Better you can write reserves and surplus under that profit. Under that profit. T format we have done. Sir, are we supposed to follow schedule 3 format and all? Don't do it. For even though question is for company, please follow T format only. They will still accept it in FM. Fixed asset they have given in the question, guys. You can see. I will just show you. See, share capital, fixed assets they have only given. Clear? And if nothing is mentioned, assume that same thing will remain at the end of the year also. Because this is opening value. Sir, what about depreciation and all? They have not given anything. Actually, depreciation will be there. But as they have not given anything, we are taking same values. Because I cannot assume 10% depreciation, 15% depreciation, 20%. I cannot assume any numbers. Please be careful. And one more thing. If at all, if depreciation is there, that will also come here to depreciation in the second part of P&L. If at all, if it is there. Okay. Yes. And here we have to reduce depreciation if it is there. Opening value minus depreciation. But here it is not there. So we are straight away taking the same value. Okay. Inventory, whatever we have calculated, guys. Raw material 30 lakh. WAP 937,500. Finished goods 2250. Here only we did it now. Closing stock of raw material, WAP and finished goods. Same thing we have to take it. Clear? Yes. And see, coming to debtors. For working capital requirement, we did debtors calculation at cost. At cost. But actually in the balance sheet, will it appear at cost, sir? No. Because we would have always sold the goods for debtors on sale value. Clear? So please be careful. Just because they told at cost price, we took it for working capital. Whereas for balance sheet purpose, it will change. Okay, finished goods. So this is like nothing but closing stock of inventory, which includes raw material, WAP and finished goods. Then debtors you see 50 lakh. Sir, there we took some different number. No, sir, where is it? Yeah, here it is 45 lakh because this was at cost. So now we have to do different calculation. How is it, sir? There for that purpose I am telling. 6,000 into 80% into straight away sale value. Into straight away sale value, that is 5,000 into 75 divided by 360. Okay, I guess they have shown it. Let me show here working. Debtors on selling price to be shown in balance sheet. You can see 6,000 into 80%, that is credit sales, into sale value how much? 5,000 per unit. Into what is the debt collection period? 75 by 360. We will get 50 lakh. We will get 50 lakh for balance sheet purpose. Okay. Next, guys, cash and bank balance is not given, but that would be the balancing figure. That would be the balancing figure. And creditors and outstanding overheads we have taken here only. Same figures will come. These figures. 22 lakh 50 and 2 lakh 30,769. Is it a current liability? Yes. See, they have shown it here only as reduction. Okay, but better way, show it on the liability side. Show it on the liability side. Clear, guys? So balance sheet has to tally. Here this would be the balancing figure. Okay, check the liability side total, which includes, means as per me, it should include share capital, P&L account, 10% debentures plus current liabilities. Plus current liabilities. Then you deduct fixed assets, inventory, total inventory minus debtors, you will get cash and bank balance as balancing figure. Sir, can I do like how they have done also, sir? Nothing wrong. Nothing wrong. But better way is current liability, always show it on the liability side. Here only they have shown but as a reduction. But I don't suggest it. Is that clear? And sir, cash and bank balance we didn't take here, no, because they didn't suggest us. Correct? So in working capital balance or calculation, we have not taken it. But there in balance sheet, we are taking it as balancing figure. Because question was silent. Question was silent. And just because in the balance sheet we will get balancing figure, please cross check whether it is tallying. As it is not, as it will not be tallying, we are putting the balancing figure as cash and bank balance. No, that and all in reality we don't do. Okay, don't open suspend account, especially in balance sheet. That and all in the Journal entry, ledger, we do it. Okay. Balance sheet, don't open suspend account. Just a second. See, balancing figure, they have shown cash balance and all. Here, candidate solving the above question by any format, vertical or horizontal, will be awarded marks. So please, you follow T format only. And short forms, whatever they have used, they have given the full forms. Okay, 20 marks. 20 marks. We are done with all three. We are done with all three. Sixth one. There is a choice between 6 and 6A. Guys, one more time I am repeating. Please make sure that once you select 6 or 6A, answer all sub questions. There is no choice between sub questions. For example, I will take 6A and I will answer, sir, from here I will answer A, and from the remaining I will answer from 6A, sir. No. You cannot do it. Okay? Yes, chalo. Question number 6. ABC Limited provides the following information regarding the cost of the product. Direct materials 20,000, direct wages 16,000, variable factory overhead 25% of wages. Okay, 25% of wages. Variable administrative overhead 10% of factory cost. They have not given the full stop here and there, but still, please be careful. Then variable selling and distribution overhead 4 rupees per unit. Then fixed overhead 8,000 rupees. Okay. Then units sold is 1,000 at 64 rupees per unit. From the above data of ABC Limited, you are required to calculate PV ratio, break-even point, margin of safety, and profit. You are not. Actually, you are not supposed to write anything. But if at all, if you want to, maybe you can use pencil, but don't write too much also. Maybe if you want to mark something or hint something later which will help you to write answer, you can do it. But actually, as per the institute, you cannot write anything on question paper. Okay, you don't start solving in the question paper only. That and all, yes, you can. Sir, it was not given. Can I add full stop? Yeah. You are not supposed to write anything. And even for working, you use your answer sheets only. Okay. Yes, silence. Statement of marginal cost or variable cost. Marginal cost is nothing but variable cost, because we need total variable cost, like contribution calculation and all. Yes. Material they have only given, wages they have given, both put together we call prime cost. Madam, finished? Can I continue? Prime cost. Sir, are we supposed to show this prime cost? No, you can keep on adding variable cost. Okay, but still. Variable cost, then variable factory overhead we get, which is 25% of wages. Wages is how much? 16,000 into 25%, 4,000. Then you will get factory cost. Are we supposed to show this? Yes. Actually, this is nothing but, like, we call it as cost sheet format. This is something like that. Okay. Sir, factory cost. And they have told variable administrative overhead is 10% of factory cost. So are we supposed to present this? Yes. Please be careful. That is required. Prime cost was not required to be shown, but still they have shown, that is okay. But factory cost is nothing but direct material, direct wages plus variable factory overhead.
So, but why should we write marginal factory cost?
Everywhere it is variable, na? We are taking only variable. Marginal is nothing but variable. Okay, we are not taking total cost, only variable cost. Okay. Then we will add variable administrative overhead, we get cost of production. Then for that we will add variable selling and distribution overhead, which is 1,000 units into 4 rupees. 4 rupees per unit it is. So you will get cost, total marginal cost. Total marginal cost, which is nothing but total variable cost, which is required for our PV ratio calculation, because we need contribution. If I want to do contribution, how do I do it? Sales minus variable cost. So sales is 64 rupees selling price into 1,000. 64,000. So calculate what and all they have asked. Guys, one by one. First, contribution, let me calculate. 64,000 minus 48,000. 16,000 is contribution. So, chalo. PV ratio, contribution by sales into 100. So, they have shown the calculation 64 minus 48, which comes to 16,000 divided by 64,000, 25%. Next, break-even sales, fixed cost. Have they given the fixed cost in the question? Let me just show. $8,000. Yes. So fixed cost divided by PV ratio 32,000. 32. Sir, can I calculate in units? Break-even sales in units? Yes. How is it? Contribution means total contribution you have got now 16,000 divided by 1,000 units. You get per unit. Yeah, 33,000 also you can divide it by selling price, or else our formula if you are using fixed cost divided by contribution per unit. Can I calculate contribution per unit? Yes, total contribution divided by number of units. The other way is divide break-even sales in rupees by selling price, which is 64. Okay. When they are not told which, always try to do both units as well as rupees. If they have simply asked only break-even sales, what they have asked here, let me just see. Okay, only break-even point is asked, better do both. When it is possible to do both, better do both, guys. So it is nothing but break-even sales in rupees divided by selling price, or else fixed cost by contribution per unit. At this your here now, margin of safety, sales minus break-even sales. Then profit. So they have done S into PV, that is sales into PV, you will get contribution minus fixed cost. Clear? You can do it in the format also. For example, sales minus variable cost is equal to contribution minus fixed cost is equal to profit. Clear? Yes. Or in the equation form, like how they have done, sales into PV ratio, you will get contribution minus fixed cost will give you profit. Equipment A as a cost of 75,000 and net cash flow of 20,000 per year for 6 years equal. When it is equal, I may use annuity concept. A substitute equipment B would cost 50,000 and generate net cash flow of 14,000 per year for 6 years. So life is like 6 years each. The cash flows are also equal. We can use the concept of annuity to calculate present value. The required rate of return for both the equipments are 11%. Calculate NPV and profitability index for both the equipments. Which equipment should be accepted and why? And at 11% they have only given present value factors. At 11% they have only given present value factors, and when they have given, please use the same. Whether they have given 3 decimal, 2 decimal, 4 decimal, whatever it is, please use the same. Sir, you told we can use annuity. No sir, they have not given annuity. Add it at least. Add and take it. Present value of annuity factor for 6 years. What do I do? Add it everything. Do it quickly. 231. Clear? Sir, can I do individual calculation also? Yes, you will get same, but it will be time taking. When the cash flows are equal, please use annuity concept. Equipment A, NPV. Present value annuity factor into 20,000, which we got 4.231. We did a total of all, guys. That's all. Present value factors added, we have taken. Aggregate of what? Minus initial investment. Better write the formula, guys. They have not written the formula. Straight away they have put the numbers. You don't do it. But should I give separate formula for A and B, sir? No, one single formula you can give. Present value of future cash flows minus initial investment. You are getting 9,620. Profitability index, present value of cash inflows by initial investment, 1.128. 1.128. Next, equipment B, equal cash flows into annuity factor. Annuity factor. That one is looking like I, don't get confused here. Okay, 231 it is 4.231 minus initial investment. This is giving what? 9,234. Profitability index, which is present value of cash inflows 59,234 by 50,000. You will get 1.185. Now, if you go by NPV, which project will you choose? A. If you go by profitability index, which one will you choose? B. Which is higher? B. Conflicting results. Why? Initial investment is not seen. So which one should I follow? Profitability index. Correct? See, you go. Why, man? Control yourself. Okay, enough. Shh. Listen here. The only logic here is 50,000 is the initial investment here, whereas here it is 75,000. With the less investment, I am getting better return, especially when I have limited capital and all. Which is better, sir? 50 or 75? Investing 50 or 75? 50. You can see the conclusion. They have asked conclusion also. Please give conclusion. If they are not asked, just calculate NPV, just calculate PI. If they have asked, just do that and stop it. If they have asked comment, decide, suggest and all, please answer it. As per NPV, project A is to be preferred over project B. Why? Because NPV of project A is more. Project equipment. Equipment. Okay. See, suggested answer. Sometimes they give like this. If I write like this, means as a student, will they accept, sir? Maybe not. But as per PI technique, that is profitability index, project B is to be preferred. Why? Because that is having higher profitability index. You can see 1.185, whereas this is 1.128. The NPV decision should be preferred unless there is a capital rationing. Means, sir, I don't have any capital limit, sir. I can invest how much ever I want. I will go with NPV as per that equipment A. But normally we will have capital limit, capital budget limit. If the firm has funds of rupees 75,000 to invest, then project A should be adopted. This will result in increase in shareholders' wealth to the extent of 9,620 against project B, which will increase the wealth only by 9,234. Sir, what if they have a budget less than 75,000? Then they will go with 50,000 budget. They will go with 50,000 budget. Yes, madam. That is what they are given. If you have more capital 75,000, then you can go with equipment A. No, sir, I have capital limit. I don't have 75,000 with me to invest. If you have at least 50,000, invest for equipment B. Sir, I don't have 50,000 also, sir. Please close your shutter and stay at home. Okay, Matthews, better option. Chalo. Next one. See, the following is the extract from the financial statements of XYZ Limited. Operating profit 105 lakh, interest on debentures 33 lakh, so you will get 72. See how they are given the alignment. It is 105 minus 33. Okay. Income tax 30%, 21.6 lakh. 30% of what? 72 lakh. Okay. Then net profit is 50.4 lakh. Equity share capital 200 lakh, reserves and surplus 100 lakh, 15% non-convertible debentures 220 lakh. So the total is 520, all these three put together. The market price per equity share is 12 and per debentures 93, for both they are given. Calculate EPS, okay. Then percentage cost of capital to the company for debentures funds and equity. Cost of capital. Sir, what is that percentage cost of capital? It is nothing but cost of capital. Cost of capital. Okay. Chalo. C. Earnings per share is easy. Earnings available to equity shareholders, number of equity shares. Earnings available to equity shareholders is what? Net profit. Nice answer. 50 lakh 40,000. Correct? Yes. Then don't write like that in the exam. Next, number of equity shares is how much? 200 lakh by 10. 200 lakh by 10. Correct? 20 lakh. 20 lakh. Fine, sir. EPS we got. Then percentage cost of capital, cost of equity, D by MP. D by MP. That is nothing but dividend by a market price. Market price is given, dividend 2.52. Here dividend means here earnings only is taken. Capitalization of earnings method we call it as. E by, actually it is instead of D by MP, it is E by MP. E by MP, that is earnings per share divided by market price per share. EPS by MPS I can call. EPS by MPS. Okay. Next, which is 21%. Then cost of debenture funds. Both market value, book value we can take because they have given market price also. Okay. Yes. Value of 15% debentures 220. Interest cost for the year 33. Interest cost after debt, after tax. Okay, straight away if you have interest, you can take like this 33 into 1 minus tax. Okay, yes. 23.10. So numerator is nothing but interest after tax divided by what, guys? Divided by 220 into 100. What is 220? Value of debentures into 100 is percentage. Hope you are understanding. This is at book value. Sir, what if it is at market value? Denominator will change. That's all. 206.25. Sir, how did we get it? Number of debentures into market price. Number of debentures into market price. Where is it? Yeah. Number of debentures, how do we get? 220 by 100. If I want to calculate into market price, 220 by 100, you will get number of debentures into 93.75. But what I suggest is straight away take face value. For example, that is better calculation. Why with go to total? Sir, interest after tax you know na 23.10. Any doubt in this? No. Divide it by face value into 100. Here it is. Interest after tax divided by, what is the market value? 93.75, I guess, na? Market price is how much? 93.75 into 100. I will just cross check because your reaction is like, I am getting down. 93.75. 93.75. Are you getting same numbers? Yes. Better go with per debenture because that will save your time. Oh, one second, because 23 is total. One second, just a minute. I guess interest we have missed part. Interest, okay, 15% is given here. Okay, per debenture the interest would be like this. Face value is 100, na? 100 into 15%. It should be 15. It should be 15 into 1 minus tax rate. Tax rate is how much? 30%. Okay, 30%. How much is this? 10.5. This is the interest after cost per debentures. Now you try to match. Now it will happen. Because that interest, whatever was there for total, we took that only. Now let us do 10.5 interest per debenture after tax divided by face value into 100. Are you getting 10.5? Yes. Same way here. It would be 10.5 divided by 93.75 into 100. This is more convenient. Hope you understood. Same like guys, this is like what formula we have used is interest into 1 minus tax rate. If nothing is given, we will take face value. Face value if you take, it will be same only. Divided by 100 into 100. Clear? So we need not do it actually. Divided by face value into 100. But if it is market price, you know, denominator would be what? Market price or net proceeds we have to take. Correct? Yes. So please be careful with it. Here, sir, however, they have done also, we can go same calculation you will get, but that is done in total. So if you do per debenture, you can save some time. Okay, let us go to the last one. D. 6D. RST Limited has a capital of 10 lakh in equity shares of 100 each face value. The shares are currently quoted at par. Okay. The company proposes to declare a dividend of 10 rupees per share at the end of current financial year. So can I call this as D1? At the end of the year, the capitalization risk for the risk class of which the company belongs to, K, 12%. You're requested to calculate market price of the share at the end of year, that is P1. If dividend is not declared, dividend is declared. Okay, which method they are asking you to follow? Approach. Correct. Good. See, sir, where did you get it, sir? See, some of them catch, others also should be able to get it because dividend declared, not declared, and what all data they have given. You see, what all they have given quoted at par, which is nothing but P naught. D1 they have given, K they have given. They are asking you to calculate P1. So, in which formula will you use all this? You have to see. D1 plus P1 whole divided by 1 plus K. Third one. Okay. Sir, what even if this is not given? You should understand that you should use model. Assuming that the company pays the dividend and has a net profit of 5 lakh and makes new investment of 10 lakh during the period, how many new shares has to be issued? That MN calculation and all. Clear? At the end they have given. Use model. Now sometimes without reading full question, assume you start answering 1 and 2, but you don't know which model, then you will be scratching your head. Okay? Always read full question and then decide. Cost of equity 12%. Number of shares at the beginning, which is nothing but already issued. Small n 10,000. M is what we will issue newly. Okay? Current market price P0 100 at par value. Net profit is 5 lakh earnings. Okay. Expected dividend, that is D1 at the end of first year, 10 rupees. I is investment. Okay. They have given whatever is required for third one also. Okay. No dividend is declared, guys. What is D1? 0. So what is the formula? You know na, P1 plus D1 divided by 1 plus K. P0 is equal to. P0 is given, but we need to calculate P1. So first case it is 112, second case it is 102. Hope you guys know na. Okay, dividend is declared means it is like, for example, P1, I don't know, let me keep it as P1 or D1 also you can take first, nothing, no problem, divided by 1 plus 0.12, P0 is 100. So 100 into 1.12, 112. 112 minus 10 is equal to P1, which is 102. Correct? Very easy calculation. Please be careful when dividend. Sir, they gave question in the question dividend 10 rupees. No, sir. So we should always take no. When dividend is not declared, take D1 as 0. Take D1 as 0. Coming to third one, guys. Come on. How much dividend we are distributing? 10 rupees per share. How many shares are there presently? 10,000. N, small n. So total how much equity is dividend is distributed? 1 lakh. Funds available. Guys, how much earnings we have earned? 5 lakh. Out of 5 lakh, how much we are distributing dividend? 4 lakh. Sorry, 1 lakh. How much is retained earnings? 4 lakh. Totally how much we require for investment? 10 lakh. How much short is there? 6 lakh. So we have to raise it by issuing new equity shares. New equity shares. Okay. So funds to be raised is 6 lakh. So 6 lakh divided by at what price? 102. Have they did they mention dividend declared or not declared? Assuming that the company pays the dividend. Assuming the company pays the dividend. When the company pays the dividend, what is P1? 102. So totally we require 6 lakh divided by 102. How many shares? 5,882.35 we will get. I told you when it is shares, always round it off to next number. Clear? Yes, sir. That is what they have asked. Not done. Not done. Theory is there. Shh. Hey, what please, sir? We are in the last moment. It's okay. Last day, na 5-10 minutes extra. It's okay. When do you mean by iron indicator? Sorry, what do you mean by iron indicator? Explain. Iron up, iron down, all those things you have to explain. Then explain Amada. This is like bouncer out of the box. Explain Amada equation and also calculate Amada coefficient using following information. A company has a debt to equity ratio 0.65 is to 1. Means for 1 rupee equity you will have 65 paise of debt. It is like that. Tax rate is 35% and an unlevered beta means where they don't have debt is 0.80. I will just explain this, guys. Simple calculation. I will just explain that. Here it is like this. Beta of levered firm. Beta of levered firm is equal to beta of unlevered firm into 1 plus 1 minus tax rate. Okay, and into D by E, which is nothing but debt equity ratio. I'm just explaining this because this is some bouncer, some out of the box question they have asked. That is why I'm just explaining you. So the formula is this. Try to remember that also. Again, chances of repeating may be less, but still good to know. Okay, how much will you get? 1.138. That's all. Okay, the theory explanation you guys can just go through. And they have also asked annuity due and ordinary annuity, guys. The difference is like this. Okay, see, if you start, assume 10,000, you start getting every year. If you get it from today, it is different. If you start getting it from the end of first year, it is different. That is the only difference between ordinary and the, means whatever they have told, annuity due and ordinary annuity. 10,000 you will receive every year. Is it like from the end of first year or is it from today? You need to see, that is the only difference. Then the last question was what? On what? Emerging roles of financial manager, first chapter. Emerging roles of the financial manager. Is it done? Yes. Thank you for your patience and listening. All the very best for your exams. Do let us know when you guys get the results. Thank you. And guys, one more thing, small thing. Shh, listen. Guys, one clarification. Shh. Cost of retained earnings, na, that part. Shh, guys, this is like previous questions, June 2024 question paper. Cost of retained earning. Shh. Here, this B stands for brokerage cost, not retention ratio, brokerage cost. Actually, while discussing, I mentioned it as retention ratio, but it is brokerage cost. Please be careful. And for this question, nothing about brokerage cost was given, so we have assumed it to be 0. Thank you. Take care.